Coming to the next part, that's all about rights issue, which is very, very different. Rights is given by the company at a concessional price. So in this price, some part is like free of cost, bonus, and some part is consideration. So you are supposed to find what is the bonus element in the rights issue. To find the bonus element in the rights issue, you are supposed to adopt the following procedure. Say for example, originally there are 1 lakh equity shares at the rate rupees 10 face value, or else let me take the example that's given here. This one. If you observe, net profit for last year is 30 lakhs, for current year is 50 lakhs. Number of shares outstanding prior to rights issue is 20 lakhs and rights price is 20 rupees. And date of exercising the rights is 1/7/2017. Rights issue is 1 for each 5, which is nothing but 1:5. So you will get 4 lakh new right shares, and fair value of each equity share prior to rights is nothing but 26. So this is the question. Let's start computing basic last year EPS and adjusted EPS for this question. Shall I start, my dear children? Okay. So first of all, the task is all about to find the variance itself. But rights, it is totally a different style of computation. Rights is totally a different style of computation. So first of all, you have to find theoretical X rights price. You have to find dash amma. Logically, this is nothing but a kind of average price. Number of original equity shares multiplied by cum rights price plus right shares multiplied by rights price divided by total number of shares, that is original equity shares plus right shares. How many original shares are there? 20 lakhs. 20 lakhs, na? Yes, 20 lakhs. Multiplied by, what is the cum rights price given? 26. Plus, right shares are given at 4 lakh and each right is offered at 20 rupees. So, whole divided by original shares 20 plus right shares 4. On a whole, it comes to 24 lakhs. So, what is the total theoretical X rights price? 25, which is nothing but theoretical X rights price. And as I told you, you have to find the bonus element in the rights issue. Bonus element, or it is also called as bonus factor, or it is also called as a rights factor, or it is also called as adjustment factor. Any kind of way you can call. Anyways, this is equal to, take care of cum rights price divided by theoretical X rights price. Students will be confusing whether it is theoretical X right price by cum right price or cum right price by theoretical X right price. Always remember, this should be more than 1. So if in examination, if you have done something like 25 by 26, you will get 0 point and it's not correct ani ardham. So do the reverse calculation. Is it clear, everybody? So something like it should be always greater than 1, remember. So cum rights price 26 divided by theoretical X rights price 25, which comes to 1 point. From here, my style of teaching is totally different. So just concentrate here. I'll make this 1.04 into 2 parts. One is 1 and the other is 0.04. So the meaning of this 26 by 25 is all about, each share is like 26, but you have offered every share at 25 ani ardham, which implies that 1.04 by 1. Ante, if your original price is 1.04, you have offered every share at 1 ani ardham. And the 0.04 is the bonus element here. Hey, logic clear, huh? Originally it's 26, but after that every share had become 25, which implies that originally it's 1.04. After that every share had become 1. Ante 0.04 is your bonus. Clear, everybody? So 0.04 multiplied by how many original shares are there, amma? 20 lakhs, which comes to 80,000 is similar to bonus shares. And balancing figure, totally you have offered 4 lakh shares, Nana. Out of 4 lakhs, 80,000 is the bonus. So remaining is 3,20,000. This was to be assumed as if these were issued for full consideration. Respond everybody clear. So this is the categorization. Be careful. If it is 1.09, then make it into two parts. One is 0.09 multiplied by original shares is equal to bonus. So total right shares minus bonus shares offered is equal to total number of shares which are issued for full consideration. This is the logic. Respond clear. Now as per the example, how many right shares were offered? 4 lakh. Made into two parts. 0.04 multiplied by, not 4 lakhs, 20 lakhs. You have to take original shares, which comes to 80,000. Out of 4 lakh, if 80 was bonus, then 3,20,000 is for full consideration. Respond everybody understood. Now, let me start with wins. Weighted average number of equity shares. Weighted average number of equity shares for current year. For which year, Nana? So please take care and please participate carefully. Weighted average number of equity shares for current year is equal to, originally we are having 20 lakh equity shares into 12 by 12. Am I correct or wrong? Plus, these 3,20,000 equity shares are issued for full consideration. So 3,20,000 into rights were issued on 1/7 annattu kadandi. I mean 1/6 annattu. So from 1/6/2017 to 31/3/2018, it comes to 10 months. So 10 by 12. Clear. Plus bonus shares 80,000. Assume as if these were issued right from the beginning of the previous period. That is nothing but 12 by 12. Hey, respond clear everybody. Because only these shares will be similar to dash shares, bonus shares. And hence your weighted average number of equity shares comes to. This is what wanes for current year. Respond everybody, done. Now you have to compute wanes for last year. It's very, very simple. Last year only 20 lakh shares are there. No concept of rights and bonus. So 20 lakhs into 12 by 12. There ends the matter. Now we have to compute wanes for adjusted. Take care, my dear children. 20 lakhs into 12 by 12 plus. Yes, don't take these shares because we have assumed this for full consideration. You have to take only which shares, Nana? Bonus shares. And hence it comes to 80,000 into 12 by 12. Respond everybody clear. Of course, in your institute material, they will be doing it in a different style like 1.04. They'll multiply it with 1.04. Sometimes they'll multiply it with 1. And that confusion will be there. And hence what I am going to do is that after finding the rights factor or bonus factor or adjustment factor or bonus element, which is nothing but cum rights price divided by theoretical x rights price, which will be always 1.0 something. Now you take the total right shares, make it into two parts. 0.0 something multiplied by original shares is equal to bonus shares. And this balancing figure is nothing but shares issued for full consideration. Now you know how to do shares issued for full consideration and also you know how to do the bonus shares. Respond everybody, done. And my dear children, this is the rights issue. And let me go ahead with the last and final thing, diluted EPS. Sir, even diluted EPS is also applicable to those increase or decrease in number of shares without change in resources. But this is applicable only for potential equity shares. Take care, adjusted EPS is also increase or decrease in number of shares without change in resources, but that is existing equity shares like rights, bonus, share split, consolidation. Diluted EPS also computed for those shares which are increase or decrease in number of shares without change in resources, but this is considering the potential equity shares, or they are also called as prospective equity shares, which are nothing but as of now they are not the equity shares, but in future it will become an equity share. So future equity share is considered here. Respond everybody clear, Future equity share is considered something like this, my dear children. Take more care. That's all about convertible debenture, which might convert into equity share in future, convertible bonds, convertible preference shares, and finally ESOPs, employee stock options. Now, how to find diluted EPS for convertible debentures? Sir, first of all, diluted EPS is equal to earnings available to equity shareholders plus potential equity shareholders divided by weighted average number of equity shares plus potential equity shares. Respond clear? Now let me compute diluted EPS in case of debentures is equal to earnings available to equity shares plus, if debentures are converted into equity shares, interest will be saved, but you have to pay tax. Correct or wrong, sir? Which is nothing but interest after tax has to be considered, which is nothing but interest into 1 minus tax rate, whole divided by weighted average number of original equity shares plus potential equity shares is also to be considered. Respond, everybody understood? Now moving on to the next thing, diluted EPS with respect to preference shares. Earnings available to equity shares straight away plus preference dividend. Ante. Tax is not considered here because preference dividend is always paid after tax, divided by weighted average number of equity shares plus those preference shares which are converted into equity shares has to be considered. And diluted EPS in case of options is equal to earnings available to equity shares plus 0. Earnings will never change, divided by weighted average number of original equity shares plus options which are issued at free of cost, which implies that if company had issued 20,000 options at the rate rupees 20, where the fair value is 25. What is the fair value? What is the fair value? 25. What is the issue price? 20. How much is the free portion? So 20,000 options into 5 by 25 is considered, which comes to 4,000. How much ever, enta aithe anta. And take only that portion of shares here. Don't take the total options. Take only such part of options which are issued at free of cost. Respond, everybody clear? Shall I proceed further? Now, very important thing, one last provision with which I am going to close EPS. Say for example, current year, debentures were already converted into equity shares. In current year, is there any need to compute diluted EPS now? Current year, debentures are already converted into equity shares during the year. So, in current year, is there any need to compute diluted EPS? Yes. Standard is telling the same, that irrespective of conversion of instruments into equity shares, that year is also to be considered for the purpose of computation of diluted EPS. Is the logic clear? Even though the debentures are converted into equity shares in the current year, you need to compute diluted EPS for debentures for current year. Respond, understood? And if at all it is anti-dilutive, then don't report. Hope you have got my intention. Dilutive ante your EPS should decrease. If it is anti-dilution, ante if your EPS is increasing, then no need to report the same. Respond, everybody understood? And my dear children, there's one more point which I did not cover. That's all about if there are series of potential equity shares, what to do. I mean to tell, for one company there is debentures, options, bonds, preference shares. At that time, the computation of dilutive EPS is totally different. That's an advanced concept, and hence I'm not covering this concept in marathon. And my dear children, that is the end of accounting standard number 20 EPS. And relax for 2 to 3 minutes. And okay, let us start the next standard, which is accounting standard number 22. Again, one of the difficult standards. But it is not very difficult standard, provided if you have solve the same with some rules and regulations, it will become very easy. So if you feel this standard is difficult? Just listen to this class. I guess you can understand it. You can get the concept, overview concept that is there in this standard. Again, disclaimer, provided you should have a minimum concept of accounting standard number 22. Otherwise, you can't learn everything from scratch here. And AS 22, what is the name of accounting standard number 22, Nana? Accounting for taxes on income, which implies that this standard is applicable only for income tax. This standard is applicable only for income tax, but this standard is not applicable for all the indirect taxes, wealth taxes. Yes, as I mean to tell, GST, customs, wealth tax, for all these things, this standard is not applicable. This standard is applicable only for income tax, which is nothing but taxes on income. And coming to accounting standard number 22, before starting, you are supposed to learn these things, which is very, very important. What do you mean by accounting profit or loss? Profit or loss computed as per statement of P&L account is nothing but accounting profit or loss. Taxable profit or loss. Profit or loss which is computed as per tax records. You will be taking profit or loss as per P&L account as base, and you will be doing all the allowances and disallowances as per your PGBP, as per your capital gains, etc. and etc. And then you will be having something like profit or loss as per income tax records. I mean to tell, gross total income minus chapter 6A deductions is going to give you net total income. So this net total income is nothing but profit or loss as per tax records. Now, current tax, whatever we call provision for tax. Strictly speaking, the terminology as per accounting standard number 22 is not provision for tax. It is all about current tax. This is very important. Take care. And current tax is nothing but tax which is computed on accounting profit or loss. Is nothing but current tax. Correct? Correct? No, that's wrong. Current tax is the tax which is computed as per taxable profit or loss. And tax expense, of course, tax as per accounting records is nothing but tax expense. Clear, everybody? So tell me, what are the four things you have learned, my dear children? Accounting profit or loss. Profit or loss computed as per accounting records. Taxable profit or loss. Profit or loss computed as per taxable records. Next, tax expense is the tax as per accounting records. Current tax is the tax as per taxable records. Current tax is also called as provision for tax. Respond, everybody, clear? And there is some other thing called deferred tax. Deferred tax is the difference between taxes as per accounting records and tax records. Let me ask you one question. Is profit or loss as per accounting records and profit or loss as per taxable records one and the same or different? So automatically the tax will also get some difference. The difference of tax is nothing but deferred tax. What is it called as, Amma? Difference between the taxes of accounting records and tax records is called as deferred tax. My dear children, differ is not D-I-F-F-E-R here. D-E-F-E-R-R-E-D, deferred tax. Then what do you mean by defer, sir? Postponement. What do you mean by defer, Amma? Postponement. Understand? Remember this carefully. I'll speak with it later. Now, let me come to the next part. That's all about the differences. Sir, are accounting records and tax records one and the same, or there are differences between these two records? And that differences are divided into two parts. Number one, timing differences. Number two, permanent differences. What are the differences categorized into, Amma? Timing differences and permanent differences. Those differences which arise in one period and reversed in the subsequent periods, we will call that as a timing difference. Those differences which arise in one period and they did not get reversed in any of the further periods is called as permanent difference. Respond, understood? Difference are categorized into two types. What are those two types, Amma? Timing difference and permanent difference. differences arise in 1 year and correspondingly reverse. Timing differences. Difference arises and will never get reversed or dash differences. My dear children, remember, if at all a difference arised, you create a default tax. If the difference get reversed, default tax also will get reversed. Respond logic clear. If at all difference arised, then you have to create a default tax. Whenever that difference is getting reversed, that created deferred tax will also get reversed. Respond everybody clear. My dear children, if at all difference is arised and you have created deferred tax in permanent differences, do the permanent difference reverse in future? So do the DT reverse in future? Please respond. No. And hence conclusion, don't create deferred tax for permanent differences. You have to create deferred tax only for timing differences. My dear children, deferred tax is created only for Chapali timing differences, whereas deferred tax should not be created for permanent differences. Reason being, after creating a deferred tax, it will be continued to be shown, since the difference will never get reversed. But if at all under timing differences, if you have created a deferred tax and in future it might get reversed because timing difference is getting reversed. Respond everybody, understood? Okay, so this is point number 1. I mean to tell, DT must be created only for timing differences. DT must not be created for permanent differences. Is this concept understood to each and everyone? Now moving on to the next thing. This deferred tax is of two types. Deferred tax asset, deferred tax liability. What is that, Nana? Deferred tax asset, deferred tax asset is purely similar to prepaid expense. Deferred tax liability is absolutely similar to outstanding liability. No need to by heart, no need to understand. Use your common sense, that's it. Let me talk. Accounting profit is 1 lakh. Taxable profit is 1,20,000. And automatically accounting tax will become 30,000. But taxable tax will become 36,000. Let me start. Sir, you are preparing dash records now? Hey, you are sitting in which marathon, right? Accounting. Advanced. So you will also prepare accounting records only. Hey, clear? And hence, what is your tax amount? Please participate. What's your tax amount? But you have to pay taxes per Income Tax Act. So as per Income Tax Act, how much you have to pay? 36,000. What is your tax? 30,000. What should be your payment? 36,000. So your P&L account will be like this. Listen very, very carefully. My original net profit is 1 lakh. My original net profit is, my tax expense should be 30,000. What is my tax expense? But unfortunately, this is not shown here. How much I have to pay? Which is called as a current tax, 36,000. How much is my current tax? But what should be my tax expense? What should be my tax expense? How much extra debited? 6,000. That 6,000 will be credited. That 6,000 will be credited. And this is, simply use your common sense. How much you have to pay? 30,000. How much you are paying? Paid extra, which is nothing but prepaid expense, which is nothing but asset, which is nothing but deferred tax asset. Respond everybody, understood? Pakka. And say for example, your amount of income tax is 90,000 this time. Your net profit is 1 lakh. Your tax expense should be 30,000. But your income tax amount is only 90,000 into 30%, which comes to 27,000. So automatically 2 tax expense, sorry, 2 current tax, which is nothing but 27,000. But How much should be your expense originally? 30,000. But how much is debited? 27,000. How much is the shortage? 3,000. That 3,000 has to be immediately debited. And this is nothing but deferred tax liability, because you have to pay 30,000 but you are paying only 27,000, since 3,000 is nothing but outstanding, and hence it amounts to deferred tax liability. Now check out in case 1. Tax expense is equal to 36,000 minus 6,000. Or in second case, tax expense is equal to 27,000 plus 3,000. In other words, tax expense is equal to CT minus DTA or CT plus DTL. Respond everybody, clear? In a single word, tax expense is equal to current tax minus deferred tax asset or current tax plus deferred tax liability. Respond everybody, understood? So this is one of the conclusions that you should be aware of. If at all in the examination, if he is asking you to draft net profit, statement of P&L account, then this might help you. In the question, if he is asking to draft statement of P&L account, this will help you for sure. Then how will be your P&L account, sir? Very, very simple. Check out by net profit or to net loss. If it is DTA, by DTA. If it is DTL, to DTL. And finally, you will be getting to net profit carried down or by net profit carried down. Reverse Rasana. 1 second. Yes. To net loss. To net profit carried down or by net loss carried down. Respond everybody, clear? This is what your generalized format of P&L account if he is asking you. Respond everybody, clear? But sometimes you will not be provided with all such information. You will not be provided with all such information. You will be just provided with some items. From items also, you should be in a position to grasp whether it is DTA or DTL. Shall I start now? Listen very, very carefully, everybody. So till now, what we have seen. If it is DTA, accounting profit is 1,20,000, tax profit is 1 lakh. Accounting tax is, 1 second, let me show you the example. Where is that example? This one, right? This is the example. So check out. I'm speaking the case of DTA. I'm speaking the case of accounting records and tax records. Tax records, the income is 1,20,000. Accounting records, the income is 1 lakh, which is nothing but profit. Next, tax. It's 36,000 and this is 30,000. In the sense, profit is more in tax records. Profit is less in accounting records. Tax is more in tax records. Tax is less in accounting records. Respond everybody, clear? And the next one. So, income is also more in tax records and income is less in accounting records. And finally, expense is less in tax records and expense is more in accounting records. In all these cases, you have to create DTA. If it is exactly reverse, you have to create DTL. But it is highly difficult and impossible to remember each and everything in the question. So I would like to recommend to remember only one thing. It is my pick to remember. It's my pick to remember in accounting records. If expense is more, create DTA. Remember this one. My dear children, tell me in dash records. So please participate in dash records. Accounting records. If dash is more, expense is more, you have to create DTA. Remember this word. Remember this statement. Something like this is a thumb rule for answering everything. Shall I proceed further? And moving on to the next thing. If it is the new difference, what is that, my dear children? If it is a new difference, then you have to create. Point number 3. If it is old difference, then you have to reverse. And remember, my dear children, creation of DTA is similar to reversal of DTL. And also, creation of DTL is similar to reversal of DTA. Respond all these rules clear to each and every one. Remember, these are very, 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 very important. First of all, how to do? Identify the difference. Is it temporary difference or permanent difference? If it is permanent difference, no DT concept is there. If it is timing difference, then DT concept will be there. Then do you need to create DTA or DTL? Follow these rules. Rule number 1, in dash records, accounting records, if dash is more, expense is more, you have to create DTA. If it is a new difference, you have to create. If it is an old difference, you have to reverse. And creation of DTA is similar to reversal of DTL, and creation of DTL is similar to reversal of DTA. Respond everybody clear. Now keep these 4 rules aside and let's come back to our original discussion. That is, I told you deferred tax is the difference between tax records of accounting records and tax records. But here difference doesn't mean DIFFER, it is DEFERRED, which is nothing but postponement. Now listen very carefully. In the context of postponement, for DTA and DTL, what is getting postponed is very important. Under DTA, are you paying more or are you paying less? Cheppali. Because it's very simple. DTA is similar to prepaid expense. DTL is similar to outstanding liability. Here are you paying more or paying less? And hence in future no need to pay. So what is postponed, sir? Benefit is postponed. What is postponed, Amma? Benefit is postponed. Whereas coming to deferred tax liability, it's an outstanding liability. In the sense you are paying less. Here, payment is postponed. What is postponed, Amma? So under DTA, dash is postponed. Benefit is postponed. Under DTL, what is postponed? Payment is postponed. Respond everybody clear. Sir, any doubts to anyone? With these simple rules, you can solve the problems actually. Hey, is it clear? Start telling me rule number 1. Check out whether is it timing difference or permanent difference. If it is permanent difference, no DT. If it is timing difference, you have to create DT. Shall I continue now? So just answer me. Depreciation is dash difference. Timing difference. Clear everybody? So timing difference is that difference which arises in 1 year and capable of being reversed in subsequent years. Whereas permanent difference is those differences which arise in 1 year and will never get reversed. Never get reversed. Take care. So depreciation, it is just a matter of time. Whatever is the asset that has to get fully depreciated. Whatever is the value of the asset that has to get fully depreciated either in accounting records or in tax records, but it is just a matter of time. It is just a matter of time. Anyways, shall I proceed further? And amortization. Answer. Timing difference. Amortization of goodwill. Permanent difference. Because if you have remembered, amortization of patent is permitted as per Income Tax Act, but amortization of goodwill is not permitted as per Income Tax Act. So amortization is timing difference, but amortization of goodwill is a permanent difference. For this, DT is not needed to be created. For these two things, DT is to be created. Section 43B. What is section 43B? Actual payment basis. You have to allow the expenditure on actual payment basis. And the cutoff date is due date of return filing. Hope you have remembered. Sir, say for example, 12-13 is the year for which you have to pay the interest. As per Income Tax Act, this is guided by section 43B. And interest can be allowed only on payment basis but not on accrual basis. Say for example, 1213 return has to be filed on 31/7. Our business concern is not paying this interest during 1213 and it is outstanding at the end of 2012-13. But the same is paid in May and the return is filed on 31/7. Clear everybody? Now answer me. What is the difference of interest? Answer. Timing difference. Any other answer? Permanent difference. Super. Any other answer? There's no difference. There's no timing difference. There's no permanent difference here. Why, sir? Listen. As per accounting records, interest is accrued during the year 1213. So it has to be recorded in the P&L account of 1213. Respond, is this concept clear? As per income tax records, interest is allowed on actual payment basis, but the cutoff date is due date. Due date of return filed is 31/7. Our business concern is paying this interest on or before 31/7, that is on May. And hence business concern can claim this expense as the expenditure as per income tax records for the year 1213. Hey, respond everybody clear? Sir, as per accounting records, this expense can be claimed in the year 1213. As per tax records, 1213, even though it is paid in, please respond, even though it is paid in next year 1314, it can be claimed in the year 1213 because we have paid the same on or before the due date of filing the return. Respond everybody clear? Say for example, you are not paying here. Then what is the difference? Timing difference on which you have to create DT AL. Okay, let me tell you even this one also. Check out. In dash records, what is the rule I told you? In accounting records, if dash is more, then you have to create. There ends the matter. Now tell me what you have to do now. You have to create DT AL. Yeah. Because interest is an expense. This is not there in tax records. This is there in accounting records. And hence you have to create DTA. Respond everybody understood. Still any doubts to anyone? Okay. And let me go with some other differences. Section 40A3. What is section 40A3? In excess of rupees 10,000 to a single person on a single day if paid in cash. Allowed or disallowed? Disallowed. Am I correct or wrong? Whereas in accounting records it is allowed. Okay. Say me, what is this difference now? Permanent difference. Because if anything is paid in cash in excess of 10,000 to a single person on a single day, then it is disallowed in tax records, but whatever is that, it is an expense in accounting records. And hence this is dash difference, amma, for which DT should never be created. Respond everybody clear? And that's it, my dear children. Like this, you just work on, you identify the difference. If the difference is getting reversed in future, we'll call it as timing. Otherwise, we'll call it as permanent. Something like donations paid. Why? Donations paid are allowed even in Income Tax Act also. If at all you're paying donation for scientific research, statistical research. Hope you have remembered. Sir, if at all, yes, of course it is in connection to PGBP only. Is it clear? 35A AD. As per section 35 AD, all the donations paid, whatever is there, it will be allowed. Of course, upon a time it is 125% and 150%. But now every percentage was limited only to 100%. Respond everybody clear? And hence it is also dash difference, amma. timing difference. And preliminary expenses, timing difference. As per accounting records, as per accounting standard number 26, this has to be written off in the first year only. But as per your income tax act, it is like 1/5 every year. Clear everybody? Anyways, so first of all, if you come across with the difference, just identify whether is it a timing difference or permanent difference first. This is judging almost half of the matter. Respond clear everybody. Sir, I did not speak about the donations which are not permitted by income tax act. Of course, if you take chapter 6A deductions, then there are many things. 100% deductions available, 50% deductions available, 100% star deduction available, 50% star deduction available. I mean to tell, star is nothing but conditions on adjusted net profit. Hope you have remembered. I'm not speaking about those things. If at all 50% deduction is available, then dash difference. Listen. Let me give you an example. Say for example, donation paid 1 lakh. In income tax records, only 50% is allowed. As per chapter 6A, another 50% is disallowed. Is it clear everybody? Wait. In this situation, just answer me whether will you create DTA or DTL? DTA or DTL? No need to create at all. Reason being, accounting records is like this. 50,000, 50,000. I mean to tell, total is 1 lakh. Your taxable record is like this. Only 150,000. Matched. No difference. Another 50,000 is permanent difference, for which no DT is required. I hope the concept is clear for you. So take care, of course, and you people might have said donations are not allowed basing on those things. Some donations will be allowed, some donation will not be allowed. Again, those donations which are allowed as per 80G, if I was not wrong. So 100% to 50%, 100% star, 50% star, and there are some other donations which will not be allowed at all. And as per section 35A(b), that is totally a kind of different donations. Those donations are given for statistical research, scientific research, and etc. and etc. Those will be allowed at 100%. Anyways, is the concept clear to each and everyone? So tell me how to identify the things now. First of all, you have to check out whether is there any difference or not. If there is difference, identify whether is it a or permanent difference. If it is permanent difference, no need to create anything. If it is a timing difference, if it is a new difference, you have to create. If it is an old difference, reverse. Respond everybody clear, huh? Sir, if at all old difference is reversing, you have to reverse. If old difference is erasing, create. I hope the logic is clear. New difference is erased, create. Old difference is getting erased more, then create. If old difference is getting reversed, then you have to reverse. Respond everybody understood. On a general tendency, if it is a new difference, create. If it is old difference, reverse. If it is old difference still erasing more, then you have to create more. Respond understood. Of course, after doing one example, it will be more clear, but concentrate on the provision. If it is new difference, undoubtedly create. If it is old difference, check out whether is it reversing or creating more. If it is creating more, you also need to create. If it is reversing, then you have to reverse. Respond done. And moving on to the next rules, Amma. What is the simple rule I told you? In dash records, accounting records, if at all expense is more, you have to create DTA. And remember one last thing, creation of DTA is similar to reversal of DTL, and creation of DTL is similar to reversal of DTA. Respond everybody pakka. So hold on these things. Let me explain you this problem, which might give you a better understanding. Sir, if you are well and pretty sure about AS22, it's okay. But if you are having little confusions with what you have learnt, I don't know how you were taught. Now I told you some principles. Basing on those 4 principles, I'll answer all these things. So you just concentrate. I'm giving pretty assurance that you're going to get AS22 easily now. Don't forget those 4 principles. Shall I start now? Okay, check out. The following particulars were stated in the balance sheets of Deep Limited as at 31/3/2020, and the following are the transactions occurred during the year 2021. So these 2 things are nothing but opening balances. Now check out point number 1. Depreciation as per books. Books is nothing but books of accounts. What is books, Amma? So depreciation as per books of accounts is 70 lakhs. Whereas depreciation for tax purposes is 42 lakhs. Concentrate carefully. So depreciation as per accounting records, how much? 70 lakhs. Depreciation as per taxable records, 42 lakhs. Very important thing is the next statement. There were no additions during the year. There were no additions during the year. And the entire difference is old difference or new difference. No additions during the year ante the entire difference is old difference or new difference. Old difference. Remember this one. Start telling the rule. First one, depreciation. What is the difference? Timing or permanent? So is the rule applicable or not applicable? And do you need to create DT or no need to create? Create. What is the thumb rule I told you? In accounting records, depreciation is an expense is more. So you have to create DTA. Am I correct or wrong? But wait, is it new difference or old difference? Old difference I told you it has to be reverse. So creation of DTA is similar to reversal of DTL. In this context, dash is applicable. Creation of reversal. Reversal, because this is old difference. Respond everybody clear. So what is the difference, Amma? 70 minus 42. 28 lakhs multiplied by, what is the income tax rate given? 40% multiplied by 40%. 11.2. This is nothing but reversal of DTL. Respond everybody clear. Just wait. Still 3 more things are there. You will get better part. Just wait. Be patient. Shall I continue with the next point? Again concentrate here. Expenses disallowed in 1920 and allowed in 2021. So in the sense, last year and current year. Am I correct or wrong? Take the 2 records. What are the 2 records you are having, Nana? Accounting records, tax records. Take both last year and current year. Shall I start now? Expenses disallowed in the last year. Disallowed is a term that is used for tax. Ante expenses in the last year disallowed 0. But in the current year, expenses of rupees 14 lakhs allowed. So let it be here. Which implies that in accounting records, last year expenses Chapali 14 lakhs allowed. Current year expense is equal to 0. Shall I continue? Point number 1. Timing difference or permanent difference? Timing, because see last year disallowed, current year allowed. Correct or wrong, sir? So if it is timing difference, do you need to create or ignore? Create. Let me start again. Creation. What is that simple thumb rule I told you? Accounting records, if expense is more, DTA. But in accounting records, this time expense is less. So creation of DTL. Wait there. Creation of DTL is similar to reversal of DTA. Now in this context, is this reversal of expense new difference or old difference? And hence reversal of DTA. How much is the difference? 14 lakhs multiplied by 40%, which comes to, respond everybody clear. I hope you have got better. Hey, is it clear? So like this, if you have done, I'm pretty sure that this concept AS22 is going to become easy for you. Anyways, I'm not going to leave you. Let me continue. Share issue expenses are allowed 1/10 every year annadu. here given, and the total expenses are 70 lakhs incurred in 1920. Incurred in which year, amma? Okay, whereas as per Income Tax Act, it is allowed 1/10, which implies that as per accounting records, share issue expenses will be allowed in the first year only. Hope you know this one. Share issue expenses is not going to generate any future economic benefit, so it should not be treated as asset. It has to be written off in the first year itself. Shall I continue? So last year, accounting records, entire 70 lakhs was written off. Tax records, only 1/10 was written off. Ante only 7 lakhs. Current year, accounting records 0, taxable records 7 lakhs. Shall I start now? Everybody concentrate carefully. Is it timing difference or permanent difference? Create or ignore? Create. Creation of DTA or DTL. Let's check out. In dash records, accounting records, expense is less. If expense is more, creation of DTA. But since here expense is less, creation of DTL, which is similar to reversal of DTA. Again the next one. Is it the old difference or new difference? If old difference, you have to choose reversal or creation. How much is the difference? 7 lakhs multiplied by 40%. Respond done. I hope you are getting the easiness of accounting standard number 22. And let me proceed further, like the repairs and maintenance. Repairs to plant and machinery were 140, spread over 2 years equally in the books, which implies books of accounts, whereas the entire expenditure was allowed in the income tax in the year 2021. My dear children, please take care. Repairs and maintenance during the year. And is the difference new or old? New, erased only in the current year. Let me start. Current year, accounting records, and current year, taxable records. Repairs. Repairs. In income tax records, he is asking you to record the total expense, 140 lakhs. Whereas coming to accounting records, equally spreading over 2 years, so which comes to 70 lakhs. Again start. In accounting records, expense is less. Creation of DTL. If expense is more, DTA. Since it is less, DTL. Hey, do I need to check out the reversal part here? Why no? Because this is a new difference, which is nothing but 70 lakhs multiplied by 40%. That's it, my dear children. I hope the concept is absolutely clear. Okay. And check out this one. Next question. Rama Limited has provided you the following information. If you observe, he did not give whether is it relating to current year or previous year. Like in the previous problem, he told you during 2021, during last year, and this is during the year. Some clue was given, but here no clue was given. So if no clue was given, assume that every year happens only in current year. Shall I continue? Start everybody. Depreciation as per accounting records 2 lakhs, tax records 5 lakhs. Depreciation dash difference. Create or ignore. Okay. And what to be created? Once again, in accounting records, depreciation is less. Ante expense is less. So creation of DTL. Is there any need to check out the reversal part here? Why no? New difference. And what is the difference, Nana? 3 lakhs multiplied by 50%, which comes to 1.5 lakh DTL must be created. Respond done. And the next one, unamortized preliminary expenses. Sir, this is very important. Amortize ante, it is appearing in tax records. Listen carefully, everybody. Sir, unamortize ante, it is not appearing in P&L account. Amortize ante, it is appearing in P&L account. Something like yesterday I told you, DGG, amortized portion, unamortized portion. Amortized portion will be appearing in P&L account. Unamortized portion will not be appearing in P&L account. It will be appearing in balance sheet. So now, unamortized preliminary expense ante, is it appearing in P&L account or not appearing in P&L account? Not appearing in P&L account as per tax record. Ante it is appearing in P&L account as per accounting record. How much is the amount, Nana? 30,000. So accounting records it is 30,000, tax records it is 0. In this case, in accounting records, preliminary expense is more, so you have to create DTA. No need to check out the reversal part because everything is new, and the difference is nothing but 30,000 multiplied by 50%, which comes to 15,000. Clear? But there's a point here. From depreciation, you got creation of DTL 1,50,000. From preliminary expenses, you got creation of DTA 15,000. So now can I set off or not? If you observe in first problem, he did not set off. So conclusion, sometimes you can set off, sometimes you should not set off. How will you know that in exam? Of course, there are rules for that. Set off is permitted only when the following two conditions are satisfied. When the items can be set off, DTA can be set off. If it is not possible to set off the items, then corresponding DTA also cannot be set off. Is it clear? And second rule, it must be under same tax laws. It must be under same tax laws. Something like Indian holding companies having DTA and foreign subsidiary companies having DTL. Indian holding company DTA, foreign subsidiary company DTL. Can you set off? Why no? Different tax laws are applicable here. Respond everybody clear. And moving on to the next thing, my dear children. Condition number 1. If the items are possible to set off, you can set off DT. Otherwise, you can't set off. Let me give you an example. Say, for example, you are having profit from specified business and loss from speculation business. Can you set off these two things? So, corresponding DTA and DTL can't be set off. Respond logic understood. From capital gains, you are having DTA. From racehorses income, you are having DTL. Possible or not possible? Because these two things is not possible, this is also not possible. From depreciation, you are having DTL. From preliminary expense, you are having DTA. Now, it is possible because two things are set off against the same income called revenue from operations or sales. Hey, respond logic clear? Even depreciation can be deducted from the sales income. Even preliminary expense can also be deducted from the sales income. Since two things set off is permitted or guided under similar rules and regulations, corresponding DTA and DTL can be set off. Anyways, conclusion. Here, can you set off or not now? Answer. Yes, because these two things are guided under same tax laws and set off is possible with same income. Clear everybody? So set off creation of DTL to the extent of 1,35,000. Respond everybody, done. Let me move on to the next thing. Yeah. There is a question. Let me give you an example. Just check out. This is a bit different. Sir, say for example, incomes are like this. Income. I'm telling income. Accounting records and taxable records. Say 10 lakhs, 12 lakhs, 9 lakhs. What's the total? 21, 31 lakhs. Say for example, as per taxable records, it is 11 lakhs, 14 lakhs, balance 6 lakhs. So total is 31 lakhs again. Am I correct? Okay. Tax rate is equal to 40%. Okay. So this is not just 1 year, series of years are there. Till now, whatever the problems we have solved are relating to 1 year only. But here, same item for series of years. In this context, how to solve? Very, very simple. Just check out. Take the accounting records. Take year 1, year 2, year 3 and take the total amounts. What is the total income, Nana? 10, 12 and 9. 10, 12 and 9. Take taxable records 11, 14, 6 lakhs. Shall I proceed further? Now check out very, very carefully. The total, how much you have got? 31 lakh. What is the total you have got? Dash difference. This is dash difference. Timing difference because the total is matched. It is just a matter of time and hence this is nothing but timing difference. So create a ignore. Cheppali create a ignore. So absolutely you need to create. So what to create is the biggest task. So dt at the rate 40%. Let me start. Listen very carefully. Sir, if it is expense, accounting records, if expense is more than DTA. Now what is this, Nana? Income. Under dash records, income is lesser. Sir, if expense is more, DTA. Expense is more ante, income is less ane kada. So you have to create. Clear everybody? How much is the difference, Nana? So timing difference, 1 lakh. Timing difference, 2 lakhs. Sir, 1 lakh erased. Yes or no? Take care. Again 2 lakhs erased. Here 3 lakhs reversed. You might ask me, sir, how did you tell erase and reverse? Check out. Yes, you have to observe little bit common sense. Accounting record income is less. Erase. Accounting records again income is less. So again erase. I told you, if old difference is erasing, create more. Did you remember? So since it is less, erase. Again it is less. So it is erasing again. But check out the last and final part. Accounting records, this time income is more. Less was more and hence reversed. So whatever created, it has to get reversed. Respond clear, huh? So creation of DTA 1 lakh into 40%, 40,000. Creation of DTA 2 lakhs into 40%, 40,000. 80,000. Create. Last and final, reversal of DTA 3 lakhs into 40%, 1 lakh 20,000. I hope even this concept is also clear. Respond understood. Sir, first year more, then create, erasing. The immediately decreased. Reverse, again increased. Create, again decreased. I hope the concept is clear for you. In the sense, increase, 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 create, create, create. Decrease, decrease will become reverse and reverse. Or year 1, decrease, decrease, decrease. Create, create, create. Immediately increase, immediately reverse. So I hope the concept is clear. Whether it is income, whether it is expense, that's hell. You have to check out the difference is there or not. If difference is erased, create. If difference is reversed, reverse. Respond everybody understood. Now, one special case. In case of loss, you have to create DTA. In case of loss or unabsorbed depreciation, you have to create DTA. My dear children, normally there is a rule. DTA has to be created only when there is reasonable certainty. There is a rule that DTA has to be created only when there is Cheppali, only when there is reasonable certainty. Respond everybody clear. DTA has to be created only when there is reasonable certainty that in future profits will be there. DTA has to be created only when there is reasonable certainty that in future profits will be there. But in case of loss, you have to create DTA only when you are having virtual certainty that profits will be there in future. In case of loss, you should have virtual certainty that in future profits will be there. What do you mean by reasonable certainty and what do you mean by virtual certainty? Reasonable certainty is nothing but maximum chances. Virtual certainty is nothing but 100% proof. So 100% proof is needed for losses, whereas maximum chances is enough for profits. Clear everybody? So DTA will be created only when there is a reasonable certainty that in future profits will be there. But in case of loss, you should have a virtual certainty that in future profits will be there. In the sense, you need some proof. Respond everybody clear? Okay. So the next question, you read the question but I'm going to explain the outcome of the question. And if you observe, company feels antadu ikkada. Initially it had got some loss, but company feels that there will be sufficient future taxable income. But what is that feeling? Reasonable certainty or virtual certainty? We don't know. But in the question at the end, he is asking you to prepare a statement of P&L account for the 3 years. In the sense, this feeling must be assumed as if it is virtual certainty. Sir, I hope, is it clear? Point number 1, in year 1 there is loss. If loss is there, you have to create dash. DTA only when there is virtual certainty. But in the question, no clarity is given. In the question, it was given that company feels. What is the feeling? Is it virtual certainty or reasonable certainty? He did not tell. But at last, if you observe, he is asking you to prepare statement of P&L account for all the 3 years. And hence conclusion, it is a virtual certainty, deemed assumption. Respond everybody clear. Anyways, here it's all about, okay, first year, 2 lakhs loss. Second year, 1 lakh profit. Third year, 1 lakh profit. There is no timing difference at all. There is no timing difference. Sir, strictly speaking, if there is no timing difference, is DT needed or not needed? But in this case, it is needed. Because there is a loss. I hope the logic is clear. You have to create DT only when you have to create DT only when there is dash difference, timing difference. But even when there is no timing difference, you have to create DTA in case of loss. Respond everybody clear? Hey, listen. Accounting records. Listen everybody. Initially there is loss. Initially there is loss. So 2 net loss brought down, which is nothing but 2 lakhs. My dear children, in loss case you have to create DTA. I already told you DTA will be a debit side or credit side. Credit side. At initial, simple, or else you can also use some common sense. DTA is nothing but asset kada. So DTA must be debited kada. So automatically you have to credit P&L account. So DTA will be at credit side by DTA. How much? 2 lakhs into 40. 40%, which comes to 80,000. Hey, respond everybody clear? And finally, sir, strictly speaking, this is not tax expense. This is tax savings. This is tax savings. So ultimately, by net loss carried down, which comes to 1,20,000. If you have remembered accounting standard number 20 EPS, I told you in case of loss, earnings available to equity shareholders in case of loss is equal to profit before tax plus tax expense. Did you remember? So here loss is 2 lakhs plus they have got a tax benefit, tax savings of 80,000. So net loss is only 1,20,000. Did you remember? And of course you have to deduct preference dividend, and then this is nothing but earnings available to equity shareholders. Anyway, shall I go back here? So my net loss in year 1 is only 1,20,000, not the 2 lakhs, because of tax savings. Respond, shall I proceed further? Year 2. Listen very carefully. By net profit, 1 lakh. Straight question. What is my last year loss? 2 lakhs. Sir, what is my last year original loss? 2 lakhs. What is my current year loss? 1 lakh. What is my current year profit? 1 lakh. Will I pay any tax? Will I pay any tax? So please try to understand, sir. Last year, my loss as per accounting records is 1,20,000. But as per my tax records, my loss is 2 lakhs. This is carried forward to the next year. Next year, I got a profit of 1 lakh. Will I pay any tax or I don't pay? Why I don't pay? I'll set off my loss. Clear everybody? Sir, if you pay, then it is to current tax. But my current tax is 0. I don't pay now. Why you don't pay, ra? Because I'm having a tax saving. And that name is nothing but DTA. So whatever DTA you have created in case of loss will get reversed in case of profit. Clear, huh? So reverse to DTA. How much will get reversed, sir? 1 lakh into 40%, 40,000. And finally, to net profit carried down, 60,000. Respond everybody, clear? And if you did not understand this clearly, just concentrate on year 3, you will get better clarity. This time the net profit is 1,20,000. Loss carried forward is 2 lakhs. Last year set off is 1 lakh. Still balance loss is 1 lakh. Set off to the extent of 1 lakh and still on 20,000 you have to pay the tax. So since you have to pay the tax to current tax, now you have to pay the tax on 20,000 multiplied by 40%, 8,000. Hey, why did not you pay the tax on remaining 1 lakh, ra? Because I'm setting off. So at the time of loss, I have created DTA. Now when the profit comes, I will reverse the DTA, which is nothing but 1 lakh into 40%, 40,000. And finally, to net profit carried down. That's it, my dear children. Respond, everybody understood? This is all about statement of P&L account with respect to deferred tax. Shall I proceed further? And the next one is tax holiday. Very simple provision. I'll tell you. Listen. Sir, always DTA and DTL, you have to use one tax rate, kada. That tax rate is not, should be the current year tax rate. This tax rate should be the future available enacted tax rate has to be used. Which tax rate has to be used? Future available enacted tax rate. Sir, say for example, current year tax rate is 30%. But next year Finance Act is already ready. They are told that from the next year tax rate is only 25%. Then what nonsense is there behind creating DT at 30%? Because whatever the DT creates now will be reversed in future at the 25%. Then what is the nonsense need to create it at 30%? Enough of creating it at 25% only. Respond, everybody, clear? So tax rate used for DT and DTL, is it present tax rate or future tax rate? So the next concept, remember tax holiday. Tax holiday is a period for which no tax is needed to be paid for next set of years. Tax holiday is the tax holiday period is the no tax period for some set of years. Respond, everybody, clear? Say for example, year 1, year 2, year 3, year 4, year 5. 5 years tax holiday is given. And from year 6, normally you have to pay the tax. So you are at the starting of year 1. Since for the 5 years tax holiday is there, we know that for all these 5 years it will be 0%. But what is the tax rate at the end of year 6? How will you know when you are standing at year 1? So what is the current normal tax rate? 30%, sir. Assume that in future also it will be 30%. Respond, is it clear? Now check out if any timing difference is getting erased. Remember the rule. Those timing difference which arise and reverse in tax holiday period, no DT is required. Sir, listen. Rule. Those tax differences which arise and reverse during the holiday period only. No DT is required. Because no need to pay the tax, ra. Why will you get DT? You will get DT only when there is a tax difference between accounting records and tax records. Now I'm telling that no need to pay the tax at all. If no tax, then no DT. Respond, logic, clear? And hence, remember very carefully, for all the timing differences. For all the timing differences which arises during the holiday period and reverses during the holiday period. No need of dt. But those timing differences which arise during the holiday period and reverses after the holiday period, dt is required. Those timing differences which arise during the holiday period and reverses after the holiday period, dt is required. Respond everybody, clear? Now check out, say the timing difference is 100 lakhs, 20 lakhs, and from third year 10 lakhs is getting reversed, and even it's continuing with 10 lakhs is getting reversed every year. Answer me, what is the total timing difference arised during the holiday period? 120 lakhs. What is the total timing difference reversed during the holiday period? 30 lakhs. What is the total timing difference which reverse after the holiday period, Nana? 90 lakhs. Because out of 120, 30 lakhs is reversed during the holiday period. Remaining 90 lakhs will get reversed in future. Respond, shall I proceed further? My next question, how much is the tax difference arised during the holiday period and reversed during the holiday period? 30 lakhs. So on this 30 lakhs, no need to create dt. So 120 minus 30 until it comes to 90. This 90 lakhs this 90 lakhs is erased during the holiday period and it is reversing after the holiday period. Ante kada? Sir, this 90 lakhs is erased during the holiday period and reversed after the holiday period. 30 lakhs is erased during the holiday period and reversed during the holiday period. Total 120 lakhs is erased during the holiday period and 30 lakhs is reversed during the holiday period and 90 lakhs is reversed after the holiday period. What is the rule now? Erased and reversed during the holiday period. No dt is required. So on how much amount dt is not required? On how much amount dt is required? So 90 lakhs into some rate of tax is nothing but dt. But biggest question, what is this 90 lakhs? Ante, is this 90 lakhs from year 1 na year 2? For this purpose, you have to follow first in, first out method. What is the method you have to follow? First in, and a first arising should reverse first. Clear everybody? Year 1, how much is erased? 100 lakhs. So first year 1 should reverse. So the balance is 70 lakhs. So on year 1 you have to create dt on 70 lakhs and on year 2 you have to create dt on 20 lakhs. Antegani total 90 lakhs aithe in year 1 you can't create dt on entire 90 lakhs. Logic clear? Because first arised must reverse first. First arising is 100 lakhs. So first 30 lakhs should be reversed only from the first arising portion, which will become 70 lakhs. And year 2 on 20 lakhs you have to create. Respond everybody, understood? So this is all about tax holiday period. And the last and final, MAT concept. Minimum alternate tax, MAT. Sir, as per your income tax record, what is your tax payment? Tax as per normal provisions or tax as per MAT provisions, whichever is higher. Whatever the excess of MAT tax paid over the normal provisions, we will call it as MAT credit, and this has to be carried forward for 15 years. Am I correct or wrong? Sir, now what is the impact of MAT in accounting standard number 22? It's very, very simple. But for this, you must remember the initial concept. Just answer me, my dear children. Tax expense is equal to? Tax expense is equal to dash plus dash or dash minus dash. Current tax minus DTA or current tax plus DTL. Did you remember? Sir, I have spoken only. I have spoken only. It's okay. I have spoken only about the creation part. Am I correct or wrong? If it is reversal, then again it will be reverse. But initially, tax expense is equal to CT minus creation of DTA or CT plus creation of DTL? Respond everybody pakka. So now tax expense under MAT is equal to CT minus DTA or CT plus DTL plus excess of tax paid over normal provisions. There ends the matter. Hey, this is not this by this ra. Or 9. I respond everybody clear. So tax expense under MAT case is nothing but normal tax expense. Tax expense under MAT case is nothing but normal tax expense plus excess of tax paid over normal provisions. Respond everybody pakka. Shall I proceed further? Check out this. This one. So accounting profit is 6 lakhs. MAT profit is 3 lakh 50. Normal income tax profit is 60,000. Normal tax rate is 20% and MAT rate is 7.5%. So let me actually compute the three things separately. Accounting profit, accounting records, taxable records. Under taxable records, normal provisions, MAT provisions. Let me start. Accounting records, 6 lakhs into 20%. 1,20,000. Under normal provisions, 60,000 into 20%. 60,000 into 20%, 12,000. Whereas last and final MAT provisions, 3,50,000 into 7.5. Check out 26,250. Now listen everybody very, very carefully. First of all, let me find the tax expense. Shall I start now? Sir, everybody concentrate here. Tax expense, what is the definition of tax expense, Amma? No, I'm asking definition of tax expense. Tax as per accounting records. Ante straight away tax expense is nothing but 1,20,000. But let me break it. Let me break it into DTA, DTL, CT, etc. and etc. Shall I start now? Sir, if I have prepared my P&L account as per accounting records, it's something like this. To CT, current tax, how much Nana? 12,000. But my tax expense is equal to 1,20,000. And a shortage or excess. Shortage. How much shortage is there? So immediately put 1,08,000 and since it is the debit side, to DTL. So in a single note, tax expense is equal to CT plus DTL. Clear everybody? But I want tax expense under MAT case. So tax expense under MAT case is equal to CT plus DTL plus excess of tax paid over normal provisions. Let me find it. Tax expense as per MAT case is equal to my CT 12,000 plus my deferred tax liability 1,08,000 plus check out excess of MAT paid. Sir, as per tax records, he has to pay whichever is higher kadamma. That is 26,250. That is original amount 12,000. How much is excess paid? Enta? 14,250. So my tax expense under MAT is nothing but that is the end of your accounting standard number 22. And I hope again you have got an exhaustive revision. Sir, with respect to some standards, I'm not getting compromised and I'm explaining you the whole parts. Likewise, to tell you ACE 19 Gani, even ACE 10, I have given you an exhaustive revision. Even ACE 20 we have done. Ante nothing great. If at all, there are good chances of understanding it in a simplest way. Since the time is there, I'm covering in an exhaustive way. As I already told you, the first session of marathon is fast itself. Reason being, I have done all the basic things there. Anyways, my dear children, that is the end of accounting standard number 22 and I'm going to start accounting standard number 28 in the next 2 to 3 minutes. What is ACE 28, Amma? impairment of assets. Listen, the point of impairment of assets here is generally applicable for all tangible assets and intangible assets. This standard is not actually applicable for current assets, because impairment of current assets is dealt as per accounting standard number 4. Something like debtors will be getting impaired with the form of creating a provision for bad debts. That will be dealt as per accounting standard number 4. Anyways, shall I continue now? Sir, this is the most simplest and the easiest standards, provided if you forget about the provisions. Because coming to provisions, many lengthy aspects of provisions will be there. But coming to the problematics, no need to read any of the provisions. Whatever the knowledge that you have gained in accounting standard number 10 and 26, you can solve it. Anyways, let me start. Sir, first of all, a company need to go with impairment test. A company has to do impairment test only when it is having some indicators. Those indicators might be either external indicators or internal indicators. Clear, everybody? What is a list of external and internal indicators? You can go through the material, nothing great. And you might get it for a theory question. Take care. So tell me, impairment test will be done by the business concern when there are indicators. The indicators might be either external indicators or the internal indicators. Only then you have to carry on the impairment test, and only then you might need to provide impairment of loss, which has to be transferred to P&L account. Exception: even when there are no indicators, you have to check the impairment test for intangible assets in the following two cases. Number 1, when the intangible asset is under development. Number 2, when the amortization life period of intangible asset is greater than 10 years. In these two situations, a business concern has to undertake the impairment test even when there are no indicators, as per accounting standard number 26 linked to 28. Respond, everybody. Clear? Sir, these provisions were not dealt as per AS 28. These provisions are dealt as per AS 26. Now you have to conduct impairment test as per AS 28. Please get the difference. Provisions relating to intangible assets were given in AS 26, but the test has to be conducted as per AS 28. Generally, impairment test has to be conducted only when there are indicators. If there are no indicators, no need to conduct impairment test. Respond, everybody. Clear? But for intangible asset, in these two situations, you have to conduct impairment test even when there are no indicators. Shall I proceed further? Now, first of all, what to do? Take the cost price of the asset or the revalued figure of the asset and then deduct it with accumulated depreciation, and then find net book value before impairment of loss. Compare this net book value before impairment of loss with recoverable amount. What do you mean by recoverable amount? Recoverable amount is nothing but value in use or net selling price, whichever is higher. Net selling price is nothing but selling price minus selling expenses. Value in use is nothing but present value of future economic benefits. This future economic benefit has to be considered as net cash inflows. And say, for example, by using the machine, in the next year you are estimating you are going to get 15,000 benefit. And also you have to put a repairs and maintenance of 2,000. Now you have to take net benefit of 13,000 only. Sir, is the logic clear? Huh? You have to take only the net benefit but not the gross benefit. And also remember, many people will forget, at the end of the year, residual value is also future economic benefit. Don't forget. Respond, everybody. Pakka. And conclusion, if net book value is greater than recoverable amount, bring down net book value to recoverable amount. That difference is nothing but impairment of loss and transfer the same to P&L account. Respond everybody, clear? Pakka. Okay. Now moving on to the next part. If at all you are unable to compute recoverable amount properly. What is recoverable amount, Nana? Value in use or net selling price, whichever is. If you are unable to compute any of these elements properly, then you have to include such asset in CGU. CGU is nothing but cash generating unit. A smallest, that word is very, very important, a smallest group of assets which can collectively generate the cash. Individually, it is not possible to generate the cash, so it has to be included in the smallest CGU. CGU itself is the smallest actually. CGU is the group of assets, smallest group of assets which can generate the cash individually. We will call it as CGU. Respond everybody, clear? Now, special items will be there, of course advanced, if CGU is included with goodwill, or if CGU is included with corporate asset. If this goodwill is or corporate assets are identifiable or unidentifiable, we will be checking out those things, and if it is identifiable, you have to perform top down test. If it is unidentifiable, first of all you have to do top down test, and then again you have to perform bottom up test. Hope you have remembered. What is top down test? What is bottom up test? Actually, it's not needed for you because only there is provision. There is no single problem that was tested in any of the institute sources. But even though not being less risky, in the regular, for the regular batch students, we have given the examples. And let's go back. If at all it is technically not possible to any particular asset to identify the recoverable amount, then it has to be included in the CGU. CGU is the smallest group of identifiable assets which is generating the cash. Respond everybody, clear? You might tell your asset is impaired due to some damage. You might tell your asset is impaired due to some damage, but this asset is unable to, there is no reliability to find recoverable amount from this asset. Did you get my point? An asset gets physically damaged, so automatically will the value of the asset decreases or not, which is nothing but impairment. But there is no reliability to compute recoverable amount. So will you treat the asset separately or will it be included in a particular CGU? Sir, is the question clear? No? There is an asset. It gets physically damaged. If it gets physically damaged, do the selling price decreases or not? Tell me how to find recoverable amount. Value in use or net selling price, whichever is. But I am telling that asset gets physically damaged and hence its net selling price has decreased. But value in use you can't compute. There is no reliability to compute recoverable amount because you cannot compute value in use. So now my question, will that asset be treated separately or will it be included in a CGU? Chapali. Separately. So just now I told you, if it is not possible to compute recoverable amount, that has to be included in a CGU. This is the rule, sir. Since here value in use can't be computed properly, recoverable amount can't be computed, and hence asset cannot be treated individually. It must be treated as a part of CGU. Respond clear? But luckily CGU is not impaired. CGU is, and hence indirectly asset is also not impaired. Hope you have got what I am trying to tell. Individually, if you are taking, asset might be impaired, But since asset is unable to provide the cash flows, it should not be treated separately. It must be treated in a CGU. And the luckiest part is that CGU is not impaired. Since CGU is not impaired, this asset is also indirectly not impaired, even though it is physically damaged. Respond everybody clear? And next one. However, you are finding impairment of loss for an individual asset. In the same way, for CGU also you have to find the impairment of loss. How, sir? Net book value of all the assets in CGU before impairment of loss has to be compared with recoverable amount of CGU. If net book value is greater than recoverable amount, bring down net book value of all the assets in CGU to recoverable amount. This is nothing but loss which has to be transferred to P&L account, and it is impairment of loss. But the problem here, this is impairment of loss of not one single asset. This is impairment of loss of total CGU. Clear? So now this total impairment of loss of CGU has to be apportioned to all the assets in CGU in proportion to the book value. Respond everybody, understood? This is what your all the provisions that are needed for your examination. More than needed, I told you. Respond everybody, clear? So quickly answer me. Initially, a company has to perform impairment test only when there are indicators. The indicators might be either external or internal. But in the following situation, as per accounting standard number 26, even when there is no clue of indicators, it has to perform impairment test. And what are the two situations? Intangible asset is under development. Amortization of intangible asset is greater than 10 years. Respond everybody pakka. Hey, don't ask me why only 10 years. Because it is rebuttable presumption as per accounting standard number 26. Respond everybody clear. Now, one simple question. My dear children, what do you mean by impairment of loss? In standard, it was given that impairment of loss is the difference between net book value and recoverable amount. I mean to tell, if net book value is greater than recoverable amount, bring down the net book value to recoverable amount. That difference is nothing but impairment of loss. In standard, this is the definition given for impairment of loss. But you need to understand in a generalized version, like what is impairment of loss. My dear children, by using an asset, you will occur an expense called depreciation. Sir, even depreciation is also decrease in the value of asset. Even impairment of loss is also decrease in the value of asset. But depreciation is a healthy reduction. You are using and hence asset value is decreased. So depreciation is called as an healthy reduction. Respond everybody pakka. But impairment of loss is not a healthy reduction. It is a loss other than the depreciation, other than the healthy reduction, might be due to some abnormal factors. Respond everybody clear. And how to find recoverable amount? Value in use or net selling price, whichever is. If you are unable to compute any of these things or all of these things, then it has to be immediately included in a CGU. What is CGU, Nana? Smallest group of assets which will be able to generate the cash independently. Respond everybody clear? And after that, I also do an impairment test for your CGU. If at all there is impairment of loss in CGU, then that impairment of loss has to be distributed to all the assets in that CGU in proportion to the book value. Physically, an asset might be impaired, but it is unable to compute recoverable amount. So that asset has to be included in a CGU. If your CGU is not impaired, then indirectly your asset is also not impaired, even though there is physical damage on the asset. Respond everybody pakka. The next one, last and final thing. Of course, I'll tell you journal entries. Before that, the last and final thing. Sir, one simple question. Is it possible to get impairment of loss more than the net book value? I mean to tell net book value before impairment of loss is 1 lakh. Is it clear? I'm telling that impairment of loss is 1,20,000. Thereby I'm showing recoverable amount is negative 20,000. Is this situation possible or not possible? Absolutely possible. What is that situation, sir? Listen. Recoverable amount is equal to value in use or net selling price, whichever is higher. Your value in use, there are no cash inflows, only there are cash outflows. Net selling price minus selling expense. There is no selling price there, but there are selling expense like deinstallation. Scrap value is 0, but you have to deinstall the asset by incurring some expenses. Clear everybody? And even negative book value is also possible. Respond everybody, understood? And this is one hypothetical situation. Like you might get in MCQs. So be careful in this area, but not in the problematics. Respond, shall I proceed further? And if you check out entries for impairment of loss, check out. Impairment of loss journal entries. Impairment loss account debtor to provision for accumulated impairment of loss. Like similar to depreciation account debtor to provision for depreciation account. Impairment of loss account debtor to provision for impairment of loss. And whatever the impairment of loss is there, it has to be transferred to P&L account. P&L account debtor to impairment of loss account. Respond everybody, clear? Now, there is one different situation. Check out this one. The special situation is all about you are providing impairment of loss after revaluing upward your asset. Is it clear everybody? Already asset is upward revalued. What is the entry you will write? Asset account debtor to revaluation surplus account. Am I correct or wrong? Now you have got impairment of loss. What is the journal entry for this one? Impairment of loss account debtor to provision for impairment of loss account. Now close impairment of loss account to impairment of loss. But immediately don't use P&L account. First use revaluation surplus, and if it is not sufficient, then you can use P&L account. Respond everybody, clear? And this is purely similar to subsequent downward of the asset whenever already first revaluation upward is there. Respond everybody, clear? Now the next question. Is impairment of loss be reversed? Yes, impairment of loss can also be reversed, but there is a very different and peculiar provision for that. So you just remember impairment of loss can be reversed. That's an advanced provision. It will be something like impairment of loss can be reversed to that extent had if there is no impairment of loss is there, up to that extent it can be reversed. Had if there is no impairment of loss, how much ever the book value of your asset will be there, to that extent you can reverse. I mean to tell, check out. Say for example, with impairment of loss, your asset is like this. Net book value is equal to 1 lakh minus impairment of loss is equal to 60,000. Balance of your asset is equal to 40,000. Like that, the remaining life period is 10 years. Like that, 3 years completed. So 40,000 divided by 10 years. 4,000 per annum multiplied by 3 years. 12,000 is the depreciation. So net book value is equal to 40,000 minus 12,000. 28,000. Clear everybody? At this point, company had decided to reverse the impairment of loss. So the question, what is the maximum amount of reversal of impairment of loss? No, it's not like that. Shall I start now? So listen very carefully. This is an advanced provision, but since the provision is there, it might be tested at least in your MCQs, I'm telling. Whereas top-down test, bottom-up test is very advanced. This is not very advanced, simple provision. Sir, compute had if there is no impairment of loss. And how, sir? net book value is equal to 1 lakh. Is it clear, everybody? Minus, you provide depreciation for 3 years under SLM method. That is 1 lakh divided by 10 years multiplied by 3 years, which comes to 30,000. Balance is equal to 70,000. Am I correct or wrong? Now, how much is the maximum amount you can reverse? Is up to 70,000 from 28,000. How much is the maximum amount? Only up to 42,000 you can reverse it. Hey, what is the impairment of loss already provided, Nana? 60,000. How much amount of impairment of loss you can reverse? Impairment of loss can be reversed to that extent. Had if there is no impairment of loss is there, how much ever is your net book value, to that extent you can reverse. Is the provision clear? So with impairment of loss, your book value is 28,000. Without impairment of loss, your book value is 70,000. Had if there is no impairment of loss, your book value should be at 70,000. So you can reverse up to 70,000. And from 28 you can reverse up to 70, and 42,000 is the maximum amount of impairment of loss that you can reverse. Respond everybody, pakka. So this is reversal of impairment of loss. And one last thing, let me show you here. If you've remembered, I told you 2 cases for reversing of revaluation surplus as per ACE 10, Nana. Number 1, you can reverse the entire revaluation surplus at the end of life or at the point of sale by transferring it to general reserve. Did you remember? In case 2, you can reverse revaluation surplus every year by transferring to P&L account. Respond, is it clear? So listen very carefully. In year 1, say for example, we are having revaluation upward to the extent of 10,000. My original asset value is equal to 1 lakh. Add revaluation upward is equal to 10,000. So the total value comes to 1 lakh 10,000, which has to be amortized for 10 years or depreciated for 10 years. Like that, 3 years completed. So 1 lakh 10,000 divided by 10 years multiplied by 3 years. Minus depreciation is equal to 33,000. So net book value is equal to 1 lakh 10,000 minus 33,000. 77,000. At this point of time, you would like to provide impairment of loss to the extent of, listen very carefully, to the extent of 25,000. Clear, everybody? Will you please tell me the journal entries for impairment of loss now? Impairment of loss account debtor to provision for impairment of loss, 25,000. Next. To impairment of loss, 25. Debit what? Revaluation surplus, 10,000. Remaining 15,000 has to be transferred to P&L. Respond, is this clear? Now, say for example, company is having a policy to write off revaluation surplus every year to P&L account. In this case, what happens? Total revaluation surplus is 10,000. 3 years completed kada? Respond. So 10,000 divided by 10 years multiplied by 3 years, and 3,000 written off. Balance how much will be there? Only 7,000 will be there. So now you have to debit revaluation surplus only to the extent of 7,000. Clear? Balance 18,000 has to be transferred to P&L account. Respond everybody, pakka. And my dear children, that is the end of accounting standard number 28. I know I did not tell each and every provision, but I have covered almost all the important provisions from AS 28. And anyways, let me start with the first standard, that is all about accounting standard number 11. What is AS 11, my dear children? First of all, learn the name of the standard. The effect of changes in foreign exchange rates. So that is the name of the standard. So whatever the foreign exchange rates are there, something like, simply to tell you, conversion of reporting currency to foreign currency is being dealt by accounting standard number 11, whereas the reconversion or conversion of foreign currency to reporting currency is not dealt by accounting standard number 11. Anyways, this standard is applicable for 3 parts, my dear children: foreign currency transactions, foreign currency operations, forward exchange contracts. What are the 3 standards, 3 parts, my dear children? Foreign currency transactions, foreign currency operations, forward exchange contracts. As I said, this standard will be dealing with conversion of dash to dash, Nana. Reporting currency to foreign currency, but this will not be dealt by conversion of foreign currency to reporting currency. What is reporting currency, my dear children? No. Reporting currency is the currency in which books of accounts are reported or prepared. Clear, everybody? Say for example, there is an Indian subsidiary company. There is an Indian subsidiary company which is guided by US holding company. And as per the orders of US holding company, Indian subsidiary company is reporting their books of accounts in dollars. So now what is the reporting currency to this entity? Dollars. Rupees will become foreign currency in the current situation. Be very, very careful. So there might be a situation where rupees can also become foreign currency, and this is one of such situations. And shall I proceed further? And one more thing that you have to take more care. Be careful, my dear children. Something like, sir, this Indian subsidiary is in India. Even though the books of accounts are prepared and presented in dollars, it has to file the books of accounts to income tax department. While filing the books of accounts to income tax department, it has to convert these dollars into rupees. Am I correct or wrong? So conversion of dollars into rupees in this context, is AS11 applicable or not applicable? Is AS11 applicable or not applicable? All my dear children, it's not applicable, because in the present situation, dollar is reporting currency, rupee is foreign currency. Accounting standard number 11 is dealing with conversion of foreign currency to reporting currency, but not reporting currency to foreign currency. Clear, everybody? Don't be in a wrong notion that rupee is always reporting currency. In the current scenario, rupee is foreign currency. Dollar is reporting currency. Conversion of reporting currency to foreign currency. AS11 is not applicable. Respond, everybody understood? What is the reporting currency? Currency in which books of accounts are prepared and presented. Other than reporting currency, every currency is called as dash currency, foreign currency. Generally, books of accounts will be prepared in Indian rupees, and hence generally, if nothing is mentioned, reporting currency is equal to Indian rupees. Respond, everybody, clear? Generally, each and every country which is domiciled in India, which is existed in India, for all those companies, reporting currency will be rupees, because every Indian company has to prepare and present their books of accounts in rupees itself. But if at all your Indian company is guided by some other company to present in some other currency other than rupees, say US dollars, then US dollars will become reporting currency. I hope the concept is absolutely clear. Hey, understood? Take care. You have taken belly full lunch. After that, ACs were switched on. You're getting my sweet voice actually. And finally, you're getting... Don't sleep. Respond, everybody, clear? What is understood? A7 is applicable for those conversions from foreign currency to reporting currency, but not from reporting currency to... And let us start the first part of accounting standard number 11. What is the first part of accounting standard number 11? Foreign currency transactions. What are foreign currency transactions, Amma? Transactions which are either denominated or settled in foreign currency. All those currencies are foreign currency transactions. Tell me, my dear children, what are foreign currency transactions? Transactions which are denominated or settled in foreign currency are called as foreign currency transactions. Shall I start now? Sir, every foreign currency transaction is denominated in dash currency, foreign currency. But you being in India, generally the reporting currency is rupees. So you have to convert dash to dash. Foreign currency to reporting currency. That's like Indian rupees. So is AS11 applicable or not applicable? Applicable or not applicable? Applicable. Shall I start now? Let me start the conversion rules. Let me start the conversion rules. Rule number 1 for assets and liabilities. Rule number 1 for dash and dash, amma? There are two kinds of recognition. Initial recognition, subsequent recognition. Initial recognition is the recognition which is done as on the date of transaction. Subsequent recognition is generally done at the year ending or as at the balance sheet date, which is done after the initial recognition. An initial recognition is to be converted at spot rate. What is spot rate, my dear children? Rate on date of transaction. What is spot rate, amma? Rate on date of transaction. What is the first recognition, my dear children? Initial recognition. What is the next recognition? And initial recognition is done as on the date of transaction. Subsequent recognition is done as at the end of the year or as at the balance sheet date. Initial recognition is to be converted at dash price, amma. Spot rate. Spot rate is equal to rate on date of transaction. Subsequent recognition actually depends on classification. Subsequent recognition depends on classification. Entire assets and liabilities are to be classified into two types only. Monetary items and non-monetary items. Tell me, what are monetary items? My dear children, this is not the definition as done in accounting standard number 12. In AS 12, monetary ante cash, non-monetary ante kind. But here it is totally different. Start telling me what is a monetary item. Number 1, money held. Monetary items includes money held. Number 2, assets and liabilities for receipts and payments which are expressed in fixed determinable terms of money. That word is very important. Assets and liabilities which are expressed in fixed determinable terms of money. And what are non-monetary items? Other than monetary items. Now, what will be included in money held, amma? Cash and cash equivalents as per accounting standard number 3. Now, what is the second one? Listen very carefully. What is the second one that is given here? Very simple. Check out if it is asset. Check out if there is receipt. Check out whether that receipt in cash. Check out whether it is fixed. Check out if there is a liability. Check out whether if there is a payment. Check out whether if it is in cash. Check out whether if it is fixed. If all these conditions are satisfied, it will become a monetary item. Otherwise, it will become a non-monetary item. Sir, still there is no confusion. Telling monetary or non-monetary is pretty simple. You take any item like debtor. Is debtor asset or liability? Asset. From debtor, will you get cash or not? So receipt is there. That receipt in cash. Is it fixed or not? Sir, how much you will actually receive is not needed. How much you have to receive is needed. How much you actually receive is not needed for us. How much you have to receive from the debtor? 1 lakh. Exaction will be there. Fixed determinable term will be there. And hence ultimately the debtor is nothing but monetary item. Respond everybody clear. What about inventory? Chapali. Is it asset or not? Receipt is there or not? How much cash will you receive? Fixed or not fixed? And hence it is non-monetary item. Respond everybody clear. And creditor? Yes, because the payment is fixed. prepaid expenses. Why non-monetary? Prepaid expense is a receipt. I'm sorry, asset. Yes, you are having receipt, but the receipt is not in cash. Receipt is in service, and hence it is a non-monetary. Take more care. Advance from customers. Why non-monetary? Because if you have received advance from the customer, then you have to deliver the goods to them. You should not give the same cash back to them. And hence ultimately it is also a non-monetary. Shall I proceed further? Let me go with some deeper aspects. Number 1, investment in equity shares. Why non-monetary? Because even though it's asset, receipt in cash is there, not fixed, because they will trade in the stock exchange. Investment in debentures. Non-monetary. It's a non-monetary. Hey, I'm telling you it's non-monetary. You're telling me it is monetary. No. Investment in debentures is also non-monetary. For your kind information, yesterday we have seen investment account. Even debentures also actively trade in the market. Even while telling cash flow statement, I have clarified once again that actively traded debentures is having risky bond market, but comparatively it is less risky, but ultimately it is having some risk. Hey, respond everybody clear? So investment in debentures is also generally non-monetary. Now if at all given something like this, investment in debentures held till maturity, this time it is monetary, because held till maturity in the sense you are having that confidence that you will be holding the debenture till the end of the maturity period, redemption period. As at the end of the redemption period, company will pay you the fixed amount. Respond. And hence it is monetary. Investment in debentures held for sale, non-monetary, because you are going to sell it in the stock market. The amount that you are not going to receive is fixed. Respond. Understood? Some other things like provision for gratuity, provision for some other provisions. No, apart from provision for warranty. Sir, ఇప్పుడు చెప్పండి provision for tax. What are these items? చెప్పాలి. Non-monetary. Any other changes? Provision for tax is a monetary, whereas these two will become non-monetary. Reason is very, very simple. How much gratuity you have to pay? Just you'll create a provision, but exactly you don't know. How much warranty you have to incur? It is an estimation, you don't know. But provision for tax is not like that. Already you know how much tax you have to pay as per tax record, and hence as per accounting standard number 22, it is not at all called as a provision for tax. It is called as a current tax. So logically speaking, how much tax that the business concern has to pay is not an estimation. It has to work out as per income tax records, and it has to find one figure, and that figure is absolutely nothing but current tax. And hence this is dash item, my dear children, monetary item. What is this item, Nana? Monetary item. Respond everybody, clear? Okay, so let me proceed further. Something like, yes, that's the end of monetary and non-monetary discussion. Now why is this discussion? Because subsequent recognition depends on classification. The classification is monetary item and non-monetary item. My dear children, if it is a monetary item, it has to be converted at closing rate. Closing rate is nothing but rate on date of transaction. Is wrong answer. Rate on date of balance sheet is called as closing rate. Now coming to non-monetary item, check out at what price non-monetary item is recorded. If non-monetary item is recorded at Chapali historical cost, then it will have to be converted at spot rate. If at all non-monetary item has to be recorded at fair value or net realizable value or realizable value or market value. In such a case, this has to be recorded at closing rate. Why these differences are there? Very, very simple. Sir, initial recognition is always at dash rate, Nana. Please respond. Initial recognition is always at dash rate, spot rate. Now come to the subsequent recognition. Say for example, there is a debtor, there is a loan, there is a creditor. Clear everybody? There is some cash. All these things are fixed. You have to receive this much amount. You know that one. If it is fixed, automatically every user would like to know what is the current position. Debtor, $1 lakh should be received. Creditor, $50,000 has to be paid. My FC, foreign currency bank account, is having $25,000 as balance. I have to pay $2 lakhs loan. I have to receive $85,000 loan. All these things are fixed in foreign currencies. So every user would like to know what is the current amount of those elements. Current amount is nothing but closing rate, which is nothing but rate on date of balance sheet. So if it is a monetary item, it has to be converted to closing rate. And if it is a non-monetary item, it is not at all fixed. And hence, such non-monetary item which are recorded at historical cost. Historical cost is nothing but old rate. So use the old rate, spot rate. Those non-monetary items recorded at market value, fair value, NRV, realizable value. All these are nothing but new rates. New rate is nothing but closing rate. So even converted closing rate. Respond everybody, done. So quickly answer me. Debtor initially at dash rate, spot rate. Subsequently at dash rate, closing rate. Creditor initially dash rate, subsequently dash rate. Cash or bank account initially dash rate, spot rate, subsequently closing rate. Tell me, my dear children, what about inventory? Initially spot rate, subsequently wait, monetary or non-monetary? Non-monetary. Check out whether is it recorded at cost price or NRV. No, you can't tell like that. Inventory has to be recorded at cost or NRV, whichever is lower. If cost price is lower, you have to record it at cost price. At that time, you have to use spot rate only. If at all NRV is lower, you have to record it at NRV. In such a case, you have to record it at closing rate. Respond everybody, clear? In the same way, investment, current investment. My dear children, current investment has to be recorded initially at spot rate. Subsequently, again check out what is the rule of current investment. Cost or fair value, whichever is lower. If this investment is recorded at cost price, the conversion will be at spot rate only. If this is recorded at fair value, the conversion will come to closing rate. Respond everybody, understood? In the same way, even PPE also initially dash rate, spot rate. Subsequently, check out if you are following cost model or revaluation model. If you are following cost model, spot rate. If it is revaluation model, closing rate. Respond everybody, pakka. And if at all the difference between initial recognition and subsequent recognition is there, that has to be transferred to P&L account as either profit or loss. Respond everybody, understood? This is all about assets and liabilities in foreign currency transactions. Now coming to incomes and expenses. My dear children, assets and liabilities will be recorded twice. One at the time of transaction, two at the end of the year. But incomes and expenses will not be recorded like that. They will be recorded only once whenever the transaction occurs. At the end of the year, these incomes and expenses will be closed and transferred to P&L account. Respond everybody, understood? Now, income and expenses. Tell me what to do. It has to be recorded at spot rate. Incomes and expenses have to be recorded at spot rate. Shall I proceed further? Now, there is an exception. Instead of spot rate, you can also use average rate. Instead of spot rate, you can also use average rate. My dear children, this average rate can be used only when following two conditions are satisfied. Condition number 1. The transactions are happening on a daily basis in due course of business. Transactions are happening on a daily basis in due course of business. And part 2, there are no greater fluctuations. Respond, everybody understood? My dear children, take care. All the incomes and expenses have to be recorded at dash rate, nana, spot rate. Exception, these have to be recorded at average rate. Average rate can be used only when the following two conditions are satisfied. Number 1, transactions are happening on a daily basis in due course of business and when there are no greater fluctuations. If greater fluctuations are there, then you are supposed to use spot rate but not average rate. Respond, everybody, clear? And after that, the next one, contingent assets and contingent liabilities. These will be recorded only at the end of the year, that is as at the balance sheet date, and hence these must be recorded at closing rate. At what price these have to be recorded, Nana? Closing rate. Respond, everybody understood? This is what the rates of conversions of foreign currency transactions. Tell me, foreign currency transactions or those currencies which are denominated or settled in foreign currency. For assets and liabilities, you have to check out whether is it an initial recognition or subsequent recognition. Initial recognition is at dash rate, Nana. Subsequent recognition depends on classification. It might be either a monetary item or a non-monetary item. If it is monetary item, closing rate. If it is non-monetary, again check out whether is it recorded at historical cost or fair value. If it is recorded at historical cost, then it has to be converted at spot rate. If it is to be recorded at fair value, then it has to be recorded at closing rate. Respond, everybody understood? Difference between initial recognition and subsequent recognition has to be transferred to P&L account. Incomes and expenses, spot rate. Exception you can also use only when there are no greater fluctuations and transactions are being done on a daily basis in due course of business. And the last and final one, contingent assets and contingent liabilities which are to be recorded at closing rate. Respond, everybody, clear? And the next one, in how many ways you will get this exchange rate differences? Listen, if at all the settlement is completed within one accounting period only, if at all the settlement completed within one accounting period only, then you will be having only one type of difference, initial recognition to settlement date. But if at all the transaction is spreading over through different financial years, then two types will be there. Initial recognition to subsequent recognition to settlement date. Sir, I hope the concept is also clear. In how many ways you will be having exchange difference? If everything happened only within one accounting period, then the difference will be initial recognition to settlement date. If it is spreading over through different financial years, then initial recognition to subsequent recognition to settlement date. Respond, everybody, clear? Okay. Now moving on to the next one, which is very important, which is nothing but paragraph number 46A. Sir, paragraph number 46A is an extension to paragraph number 46. Whenever the validity of paragraph number 46 is completed, immediately the authorities have reacted and they have introduced a new paragraph called 46A. And this is issued by MCA. And this is applicable only for companies. This is optional but not mandatory. But once chosen, it can't be withdrawn. Clear with the rules, everybody? So tell me, paragraph number 46A is an extension to 46. And my dear children, paragraph number 46A is issued by MCA. This is applicable only for companies. Hope you have remembered the formulation procedure of the accounting standards. Those standards which are issued by ICAI are directly applicable for non-corporate entities. In order to make them applicability for companies, NFRA will review and revise, and finally central government will approve and release the accounting standards through section 133 of Companies Act 2013. Respond everybody, clear? Now this paragraph is applicable only to company, and is it optional or mandatory? Optional but not mandatory, but once chosen it cannot be withdrawn. Once chosen it cannot be withdrawn. Respond everybody, understood? Now what is there in paragraph number 46a, sir? Very simple. They have considered a new item called LTFCMI, long term foreign currency monetary item, which is nothing but a monetary item denominated in foreign currency, and it is for long term period, that is greater than or equal to 12 months from the date of transaction. Take care, but not from the date of balance sheet. It's from the date of transaction. Now such items are chosen, and check out very carefully. Check out whether this LTFCMI are relating to depreciable assets or other than depreciable assets. Check out whether this LTFCMI are relating to depreciable assets or other than depreciable asset. If at all these LTFCMI are relating to depreciable assets, then exchange difference has to be transferred to PPE account, property, plant and equipment, instead of transferring it to P&L account. If at all this LTFCMI is relating to other than depreciable asset, then exchange difference has to be transferred to FCMITD, which is nothing but foreign currency monetary item translation difference account, and depreciation on PPE has to be provided with prospective effect, and FCMITD account has to be amortized to P&L account over the contract period or life of the loans. Respond everybody, understood? Sir, generally exchange difference has to be transferred to dash account, P&L account. But if dash is adopted, 46A paragraph is adopted, then exchange difference should not be transferred to P&L account. You have to check out whether is it relating to depreciable asset or other than depreciable asset. If it is depreciable asset, then it has to be transferred to PPE account, and depreciation has to be given a prospective effect. And if at all this exchange difference is not relating to depreciable asset, other than depreciable asset, then exchange difference has to be transferred to FCMITD, foreign currency monetary item translation difference account, which has to be amortized to P&L account over the contract period. Respond everybody, understood? That is the end of foreign currency transactions. Clear everybody? Just relax for 2 to 3 minutes. Let me start with foreign currency operations. Fine, let me continue with the next part, that is all about FCO. FCO is nothing but foreign currency operations. Listen very carefully, my dear children. The only difference between foreign currency transactions and foreign currency operations is very simple. Foreign currency transaction implies there is an entity established in India, and this entity in India is doing some transactions with foreign countries or foreign companies. Whereas foreign currency operations are the entity which is established in India is operating from India with an entity which is established in foreign country which is outside India. Respond everybody, understood? Hey, take care, eh? So check out an operation which is established outside India. an operation which is established outside India, but it is operated from head office which is established in India, is nothing but foreign currency operation. This foreign currency operation can be either in the form of subsidiary company, associate company, joint venture company, or it can be in the form of warehouse, or it can be in the form of branch, or it can be in the form of segment. Respond everybody clear. So etc. So this can be, any of these can become a foreign currency operation. But for all these things, remember only one thing. Head office is established in, please respond. Head office is established in India. Head office is established in India, and an operation is established in foreign country, and that operation is being controlled by the head office which is established in India. Respond everybody clear. And now these foreign currency operations are actually divided into two types, Nana. Integral foreign operations, non-integral foreign operations, which are popularly called as IFO and NFO. Now check out what is the meaning of integral foreign operation. Very simple. It's an integral part. What is the meaning of non-integral foreign operation? Which is a non-integral part? I mean to tell, integral part is like an extension to head office. Non-integral part in the sense, head office all the time will not interfere. The foreign operation will be doing their own operations. Just we will guide them. That's it. So we will treat as if it is our investment. Respond everybody understood. So take care everybody. Integral foreign operation is treated as if it is an extension to head office. Non-integral foreign operation is treated as if it is an investment, which implies that we will invest, we will establish a foreign operation, and it will do its own work. What is that called as? Non-integral. We will invest, we will establish a foreign operation. For everything it has to depend on head office. It is called as an integral. Respond everybody clear. So now moving on to the next thing, conversion. Listen very carefully. Sir, foreign currency transactions are made by our entity. Response, sir. Foreign currency transactions are made by our entity in foreign currency, and hence each and every FCT has to be converted from foreign currency to reporting currency. Now you are an Indian head office. You are having a foreign currency operation outside India which is doing its transactions in foreign currency. But since it is Indian head office, it has to incorporate all the foreign currency operations books of accounts also. But the books of accounts of foreign currency operations are prepared in foreign currency. So you have to convert, but here it is not called as conversion. The technical terminology is translation. What is the technical terminology, Amma? So you will be translating the trail balance. You will be translating the trail balance of foreign currency operation from foreign currency to reporting currency. Respond everybody clear. My dear children, in foreign currency transaction you are having conversion of foreign currency to reporting currency. But in foreign currency operation, you are having translation of trail balance from foreign currency to reporting currency. Respond everybody clear. Now who has to send the trail balance? Foreign currency operation has to send their own trail balance which is in foreign currency to Indian head office. Now Indian head office will take the foreign currency operations trail balance and it will convert by following the rules. Listen very carefully everybody. If it is asset and liability, check out if it is monetary item. Then monetary item has to record at closing rate, whether IFO or NFO. If it is non-monetary item, very important. If it is non-monetary item, recorded at historical cost. IFO has to use spot rate, but NFO has to use closing rate. If it is non-monetary item recorded at fair value or market value or realizable value or net realizable value, IFO has to use closing rate and NFO also has to use closing rate. Expense and incomes, both IFO and NFO, spot rate or average rate. Contingent liabilities and contingent assets, both IFO and NFO, closing rate. Exchange difference, if it is IFO, the exchange difference has to be transferred to P&L account. If it is NFO, the exchange difference has to be transferred to FCTR account. Now, one very important thing, if you observe the whole classification, whether IFO or NFO, the conversion rates is almost the same, except only for one element, that is non-monetary items at historical cost. Shall I convey the reason now? My dear children, I already told you, integral foreign operation has to be treated as if it is an extension to head office. Integral has to be treated as if it is an extension to head office, and whatever the head office is following the rules for FCTs, the same rules have to be followed. Whatever the rules that was followed by head office for FCTs, the same rules must be followed here also, and hence monetary aithe closing rate, non-monetary recorded historical cost aithe spot rate, non-monetary recorded at fair value or market value or net realizable value or realizable value aithe closing rate. Respond everybody, done. For assets and liabilities, that is the process, and for incomes and liabilities it's normal, spot rate, exception average rate, contingent liabilities and contingent asset closing rate. Respond pakka. Now coming to NFO, I already told you NFO will be treated as if it is just like an investment. If you are treating it as an investment, you would like to know what is my current value of the investment. Respond, sir, what is my current value of the investment? So if you would like to know what is your current value of the investment, everything must be converted to closing rate, and hence even non-monetary recorded at historical cost also should be converted to closing rate, whereas all the remaining conversions are absolutely same. But at last, exchange difference with respect to IFO has to be converted, transferred to P&L account. NFO has to be transferred to FCTR. What is FCTR? Foreign Currency Translation Reserve Account. What is FCTR, my dear children? Foreign Currency Translation Reserve. Respond, shall I proceed further? Now, very important, if it is IFO, integral, then since it is similar to head office, extension to head office, exchange difference will be as usual transfer to P&L account only. But if it is NFO, it has to be treated separately, and hence you are putting all the exchange difference in a separate account called Foreign Currency Translation Reserve. And this will be closed only when the foreign currency operation is closed. FCTR will be closed only when the foreign currency operation is closed. Respond, everybody understood? This is absolutely required for provisions. But for problematics, this is the concept. While doing the problematics, this much concept is not being required for solving the problems. So for problems, what is the best part? If it is opening asset and opening liabilities, use the opening rate. If it is closing assets and closing liabilities, use the closing rate. If it is expense and income, straight away use the average rate. And the exchange difference of IFO will be transferred to P&L account. Exchange difference of NFO will be transferred to FCTR. Respond, everybody, clear? Now moving on to the next thing. As I already said you, FCTR will be closed only when the foreign currency operation is closed. Now my next part, which is very important, reclassification. Initially you thought of like it is like integral, but later on you have decided let us convert it to non-integral. Initially you thought of like it is non-integral, but later on you would like to convert it to integral. Is it possible or not possible? Respond, everybody, possible or not possible? Absolutely possible. It is absolutely possible. In this case, how to treat it? Sir, Generally you have to translate the trail balance at the end of the year. Yes or no? Generally investments will have to be valued only at the end of the year. But as on the date of transfer, if any reclassification is there, once again investments must be valued kada. In the same way, generally you have to translate the trail balance only at the end of the year. But you have decided to reclassify, then also you have to translate the trail balance as on the date of reclassification. Respond everybody clear. Say for example, last year ending, it is treated as IFO. Current year, mid of the current year, you have converted from IFO to NFO. Immediately, as on this date itself, you have to translate the trail balance of your foreign currency operation. Respond everybody clear. And after translating, you will get some exchange difference kada. Since it is NFO, that exchange difference has to be transferred to FCTR. If at all you are translating or you are reclassifying your NFO to IFO, then exchange difference has to be transferred to P&L account. Respond everybody clear. Check out reclassification from IFO to NFO. As on the date of transfer or as on the date of reclassification, you have to transfer the trail balance on NFO basis and the exchange difference has to be transferred to FCTR. If you are translating it from NFO to IFO, you have to translate the trail balance on IFO basis and it has to be transferred to P&L account. Very important. Existing FCTR continues. Existing FCTR continues. Because I already told you FCTR will be closed only when the foreign currency operation is closed. But here is the foreign currency operation closed, reclassified. And hence, when it is NFO, there is some FCTR. Am I correct or wrong? That FCTR will never be closed. Respond everybody, is the logic clear? Sir, take care, that is the end of foreign currency operation. Tell me, what is a foreign currency operation? Operation which is established outside the India, but it is controlled by the head office which is established in India. And for foreign currency operation, you will be having a technical terminology called translation. What you have to translate on a trail balance. It is denominated in dash currency. Foreign currency, you have to transfer it to dash currency, reporting currency. Shall I continue now? Check out integral foreign operation, non-integral foreign operation. Quickly answer me, my dear children. Assets and liabilities. If it is monetary item, dash rate. Cheppali, closing rate. If it is non-monetary item, recorded at historical cost. Spot rate, but here it will be closing rate. If it is recorded at market value or net realizable value or fair value, closing rate, closing rate. Next, incomes and expenses. Both things, spot rate, exception, average rate. Even here also, spot rate, exception, average rate. Contingent liabilities and contingent assets, closing rate. And finally, exchange difference for integral will be transferred to P&L account. Exchange difference for non-integral will be transferred to FCTR. This FCTR will be closed only when operation is closed. Respond everybody clear. Now let me come for problematic parts. For problematic parts, it's very easy. IFO and NFO. Start telling me. Opening assets and opening liabilities. Opening rate. Closing assets and closing liabilities. Closing rate. Expenses and incomes. Average rate. Respond clear. But let me tell you some other things. Likewise, fixed assets. Integral fixed asset is considered at spot rate. Non-integral fixed asset is considered at closing rate. For problematic, I am telling. Because fixed asset is nothing but non-monetary item. Generally, you will be following historical cost model only. And hence, for integral, it is spot rate. For non-integral, it is closing rate. Shall I proceed further? Next, sir, very important, transactions between head office and branches. then you should not convert anything. You have to take the actual values or actual figures. If there are any transactions between head office and branch, you should not convert. Take the actual values. Contingent assets and contingent liabilities. Closing rate. And finally simple. Exchange difference. Integral aithe P&L account. Non-integral aithe FCTR. Respond clear. Generally you have to translate the trail balance only at the end of the year. Generally you have to translate the trail balance only at the end of the year. But as on the date of reclassification or date of transfer also you have to translate. If your reclassification is from IFO to NFO, then tell me. If at all reclassification is from IFO to NFO, then you have to translate the trail balance as on the date of reclassification on dash basis, NFO basis, and exchange difference has to be transferred to FCTR. If it is NFO to IFO, then you have to translate on IFO basis and exchange difference has to be transferred to P&L account. But till that moment it is NFO kada. It might have some FCTR kada. This FCTR should be closed or continue. Because FCTR shall be closed only when foreign currency operation is closed. But here closed or reclassified. And you are not going to close it. Respond everybody understood. Hold on just 2 to 3 minutes. Now I'm going to start the next part, which is forward exchange contracts. Listen. The next one, forward exchange contracts. I'll give 2 minutes after the completion of AS11. Now, listen. Forward exchange contracts. Those contracts which are entered now to exchange foreign currency in future at a predetermined rate. Contracts which are entered now to exchange the foreign currency in future at a predetermined rate. There are people who will be confusing a lot with forward exchange contracts, but it is actually simple. But there are some specified rules and regulations. If you have learned those rules and regulations, it will become very simple. But before learning the rules and regulations, let me tell you 1 or 2 tips for solving this forward exchange contracts. Remember, in market, there will be different rates at different rates that a particular foreign currency will trade, which are nothing but spot rate and also forward rate. My dear children, remember one more thing. Forward rate is also predetermined in the market. You are not going to enter agreement with one particular person. You are going to enter the forward rate contracts in the stock market itself with unknown parties. Likewise, say for example, you are selling your share to one person. To whom you have sold? In stock market, you have sold a share to one party. Who is that? We don't know. You are purchasing from one person. From whom you are purchasing? We don't know. Anonymous. In the same way, even forward rates also. You might enter into forward contracts in foreign currency market with which person? We don't know that one. Respond clear everybody. That's point number 1. And point number 2, foreign currency will be trading in the market at spot rate and forward rate. Spot rate is nothing but on the spot, if you would like to exchange at whatever price you have to pay, that is called a spot rate. Forward rate is nothing but not now. The exchange will happen in future. The exchange will happen in future at some price kada. That price is nothing but forward rate. Now in market there might be different rates like forward 1 month, forward 2 months, forward 3 months, like that, forward 6 months, forward 1 year, like that. Different rates will be there. And again you have to choose whether do you need to buy the currency or sell the currency. Depending on that, you have to choose the forward contract. A respond clear. Say for example, listen very carefully. I'm having a foreign currency transaction. I'm having a, please respond, I'm having a foreign currency transaction. I have purchased a machinery and the credit period allowed is equal to 3 months. So do I need to pay on the spot or after 3 months? After 3 months. Hey, do I need to pay on the spot or after 3 months? After 3 months. Present spot rate is equal to 80. What is the spot rate, Nana? 80. I'm thinking in future, exactly after 3 months, ante spot rate after 3 months is estimated to be 89. And hence I am checking forward rate. How many months I have to check out? 3 months. Sir, I have to pay after 3 months ante. First of all, I have to buy the foreign currency and then I have to pay. I have to buy the foreign currency and then I have to pay. So forward 3 months buy. What is the contract name, Nana? So please respond. What is the name of the contract? Forward 3 months buy. So forward 3 months buy. I'm checking at what price it is. It is at 82. What is my estimated rate? 89. What is the forward estimated rate? 82. So I'll immediately enter into this contract. You might ask me, sir, spot rate is still cheaper, kada? If I have that money, why will I do the credit transaction? Understood? Take care. Moreover, as per Foreign Exchange Regulation Act, FEMA Act will be there, right? FEMA, Foreign Exchange Management Act. Remember, as per that act, you are not allowed to hold foreign currency in your hand. You are not allowed to hold foreign currency. And hence, my dear children, I am entering into forward 3 months buy now. What is the price, Nana? 82. Respond everybody clear. So this is how I have to pick the contract. Say for example, if at all I have sold a machinery. I have sold a machinery. And the credit period is 3 months. Exactly after 3 months, I am going to get the money. Spot rate is 80. If my estimated spot rate after 3 months is 72. Estimated spot rate after 3 months is 72. I am estimating. Present rate is 80. After 3 months, the rate will be only 72. Oh no, for $1, 8 rupees loss. Let me check out the forward rate. Forward 3 months. After 3 months, I'm going to get the foreign currency. So I have to sell this. So I need to check out the sell rate. Forward 3 months sell rate stood at 78. Yes, this is the best contract for me. So I'll immediately enter into this contract. So that in future, even though the rate is 72, I will get 78. Clear? Even though the rate is 89, I will get only 78. Because I have already entered into the contract. Respond everybody clear. Of course, there is one more option that the contract can be cancelled. Contract can also be cancelled. Now, is the initial logic clear to each and everyone? Sir, what is initial logic? Very simple. On a particular day, two rates will be trading in the market. Number one, spot rate. Number two, forward rate. Coming to forward rate, number of months will be there. Like forward 1 month, forward 1 week, forward 2 months, forward 3 months, forward 6 months, forward 1 year, like that. Again, you have to check out whether is it a buy contract or a sell contract. Up to this clear to each and everyone. Now, listen very carefully. Sir, I have given you 2 examples. Example number 1, purchase of machine. Example number 2, sale of machine. Sir, respond everybody. Example number 1, purchase of machine. Example number 2, sale of machine. In this 2 situation, is there need for foreign currency to me or not? Respond. Yes, I'm having a need for foreign currency. After 3 months, I will get the foreign currency. I have to sell and I have to convert it into rupees. Or after 3 months, I have to pay the foreign currency. First of all, I have to buy and then I have to pay. And there is reality. There is a need for foreign currency. And hence I am entering into the contract, which is called as hedging. What is this context called as, Amma? Hedging. I would like to minimize my risk. There is a reality. After 3 months, either I will receive or I have to pay. There is a real need of foreign currency exactly after 3 months. And I'm thinking it is a bit risky. And hence, to minimize my risk, I am entering into a contract. These kinds of contract are called as hedging. Clear? Now there is another person. He is not having any purchase. He is not having any sale. He is not having any need of foreign currency at all. He is not having any risk. Every time he will be risky. He is wantedly purchasing some contracts and wantedly selling some contracts. And this concept is called as speculation. Respond everybody clear. What are the two types of forward exchange contracts, Nana? Hedging and speculation. Under dash there is no need of foreign currency. Speculation. Under dash there is need of foreign currency. Hedging. Respond everybody clear. Real contract is dash. Hedging. Contract which will never performed will be dash. Speculation. Respond everybody understood. Now, if at all this is hedging. If at all this is hedging. Check out the rules very carefully, my dear children. Premium, sir, these rules are very important. Depending on these rules only you can solve a problem. If it is hedging, premium or discount between spot rate or forward rate has to be amortized over the contract period. What is hedging rule, my dear children? Dash or dash? Premium or discount. My dear children, I can't tell premium is profit and discount is loss. Because it depends whether payment or receipt. Payment premium is a loss. Payment premium ante increase nana. Is it clear? Receipt premium is a profit. Payment discount is a profit. Receipt discount is a loss. So I'm not telling that premium is profit and discount is loss. You have to check out for what the premium or discount is there. Whether is it a payment or is it a receipt? Respond everybody done. So dash or dash, Nana? Premium or discount. Between dash and dash, Nana? Spot rate and forward rate. Between? Please respond, sir. Between spot rate and. Because a person is thinking like present rate is 80. Estimated future rate is 89. Estimated forward rate is 83. Like this he is comparing all the alternatives. And hence premium or discount between spot rate and forward rate. Premium or discount between spot rate and forward rate has to be amortized over the contract period. This has to be amortized over the contract period. And I told you sometimes contracts can also be cancelled. Did you remember? Like that, if any cancellations or renewal is done, if any profit or loss is there, it will be transferred to P&L account. It will be transferred to, please respond, P&L account. Respond everybody clear. So check out. Sir, understand the question carefully. You'll get the difference. Rao Limited purchased a plant for US $1 lakh on 1st February 2011, payable after 3 months. So a person is entering into the forward contract now for 3 months since he is having a concept of payable after 3 months. And is it hedging or speculation? Hedging or speculation? Hedging, because there is a real need here. Now check out the next question. Mr. A bought a forward contract for 3 months. He is not having any need. He is not having any purchase. He is not having any sale. Wantedly he is purchasing a forward contract. What is this? Speculation. I hope you have got the difference. Now if it is hedging, what is the rule I told you, Amma? Premium or discount between spot rate and forward rate. First, let us identify what's spot rate and what's forward rate. Company entered into a contract, forward contract for 3 months at 49.15 per dollar. What is this rate, Nana? Forward rate. Exchange rate as on 1st February was 48.85. This is nothing but spot rate. Now compare these two rates, 48 to 49. Increase or decrease? Cheppali. Increase ante premium or discount? Premium. Sir, payable after 3 months annadu. Ante is it payment or receipt? Payment premium. Profit or loss? Loss. Understood everybody? So $1 lakh into 49.15 minus 48.85. Entama? 30,000. This total has to be amortized over the contract period. Listen very, very carefully, my dear children. Originally, it is 1st February 2011. Am I correct or wrong? Entered for how many months, Nana? 3 months. Until this contract will actually expire on 1-2 plus 3 months, which will expire on 1-5, which is exactly nothing but 34. I mean to tell February, March, April. What is our year ending? 31st March. And hence 2 months are there in the current year, 1 month is there in the next year. My total loss is 30,000. This has to be amortized over 3 months, 10,000 per month. Out of which, since 2 months are there in the current year, 20,000 has to be recognized in the current year. Since 1 month is there in the next year, 10,000 has to be recognized in the next year. Respond everybody, clear. This is dash contract, hedging contract. My dear children, this is dash type of contract, Nana. And if it is speculation, the rule is very, very, very simple. As simple as such. Initial recognition to subsequent recognition to settlement date. If everything happens only in the one financial year, initial recognition to settlement date. Respond clear. Very important. You have to do the gameplay of speculation only with the forward rate. Spot rate is not considered. Is it clear? Dash rate is not considered. Spot rate is not considered. My dear children, what is the hedging rule, Nana? Dash or dash? Premium or discount? Between dash and dash? Spot rate and forward rate. Whereas coming to speculation, dash rate will never be considered. Spot rate will never be considered. You will be considering only dash rate. Forward rate will be considered. Respond everybody, clear? Coming to forward rate, please be very, very careful. What is the rule, Nana? Initial recognition to subsequent recognition to settlement date, or initial recognition to settlement date. Shall I continue? Now check out this question. No, first check out the question that I am giving you. Mr. A bought a forward contract of $1 lakh at a price of rupees 48.85. This is a forward contract for 3 months. $1 lakh at 48.85 when the exchange rate is 49.15. And this was purchased on 1st February 2013. As at the end of the year, that is on 31st March 2013, forward rate for remaining 1 month is 49.20 when the rate on that date is rupees 49.10. Respond everybody, clear? And finally, and Mr. A sold on 2nd April at a price of rupees 48.90. This is the total example. Take care, my dear children. Mr. A bought a forward contract for 3 months on 1/2/2013 of $1 lakh at 48.85 when the exchange rate is 49.15. And at the end of the year 31/3/2013, forward rate for remaining 1 month is 49.20 when the rate on that date is 49.10. Mr. A sold on 2nd April at a price of 48.90. Clear everybody? Tell me what is the profit or loss that has to be recognized in current year, next year. Current year, 35,000 loss. Next year, answer. Sir, listen. Is the question clear? Okay, check out. Sir, first of all, dash rate is not to be, first of all, is it hedging or speculation? Speculation, because I did not mention their payable or receipt is there. So for speculation, dash rate is not considered. So forward rate is 48.85 when exchange rate is 49.15. Tell me what is this rate? Forward rate. What is this rate? Spot rate is to be not to be considered. Ignore. Cancel that. Throw it aside. So this is nothing but initial recognition. Is it clear? Now go to the end of the year. Forward rate for remaining 1 month. Sir, originally he entered the contract on 1/2/2013 for 3 months. By the year ending 31/3/2013 ante, February completed, March completed. Totally how many months, Nana? 3 months. Out of 3 months, how many months completed? 2 months. Remaining how many months? 1 month only remaining. And hence, forward for remaining 1 month is 49.20 when the exchange rate on that is D is 49.10. Now tell me what is to be subsequent recognition and what is to be ignored. Tell me what is to be ignored. 49.1 has to be ignored. Because I told you as on that rates to be ignored. When the rate on that date and 31/3/2013 is 49.1. Rate on date of transaction is nothing but spot rate kada. So even this has to be ignored. And this is forward rate for remaining 1 month. So this is forward rate, which is nothing but subsequent recognition. Is it clear everybody? And finally he sold the contract for 48.90. Understood? Which is nothing but settlement date. So now check out. Current year, $1 lakh into initial recognition to subsequent recognition. Sir, 48 to 49. Profit or loss? Profit. So 49.20 minus 48.85. 35,000 profit. And finally, next year, $1 lakh into 48.90 minus 49.20. 30,000 loss. Respond everybody clear. This is how you have to solve the problem. Check out this question which is very peculiar. Mr. A bought a forward contract for 3 months on 1st December at $1 is equal to 47.10 when the exchange rate was 47.02. Tell me what is 47.10? Forward. What is 47.02? Spot. On 31st March, when he closed his books of accounts, the exchange rate was $1 is equal to 47.15. What is that rate now? Spot rate and not to be considered. So initial recognition is there. Initial recognition is there, but subsequent recognition data is not there. And ultimately in the question he told that he sold the contract for 47.18, which is nothing but settlement date. Respond everybody clear. Strictly speaking, there is year end here, 31st December. But unfortunately, we were not provided with subsequent recognition. And hence, don't consider subsequent recognition. Finally, do the profit or loss by comparing initial recognition to settlement date. Respond everybody, is the logic clear? In this question, dash data is missing. Subsequent recognition data is missing. And hence, ignore that and solve the problem normally. Respond everybody clear. And that is the end of forward exchange contracts. Wait, let me show you one thing here. Yes, this one. ABC Limited is an Indian company, took a loan from US company amounting to rupees 30 lakhs. It was recorded at $1 is equal to rupees 60. How many dollars ante? Rupees 30 lakhs divided by rupees 60, which comes to dollars 50,000. Don't think that AS11 is not applicable in this case. Because you might be thinking something like, you are converting rupees to dollars. And you might think something like conversion of reporting currency to foreign currency, and hence AS11 is not applicable. If you think like that, it is wrong. Why? Because it was very clearly given in the question that it was recorded at $1 is equal to rupees 60. Ante we have borrowed only in dollars. $50,000 multiplied by 60 is equal to rupees 30 lakhs. Respond clear, huh? In all the questions, he will be giving, you have borrowed $50,000 when $1 is equal to 60. And while writing the answer, you will be writing like cash or bank account debtor to loan account $50,000 into 60, which is nothing but rupees 30 lakhs. Hey, respond understood, huh? But this time in the question itself, he had given this figure. And he had already computed all these things and finally given this figure. Respond, everybody understood? Hey, respond, everybody understood? In the question itself, he had already computed all these things and he is giving this figure. It doesn't mean that conversion of reporting currency to foreign currency. It is something like a small trick is played on you in order to confuse you. Ante. Respond, everybody understood? That is first point that could be noted a lot. And check out. This is a very different question again. Question is not different. Answer is differently presented. Check out. A Limited purchased a fixed asset at rupees 3,000 lakhs with fully financed foreign currency loan payable in 3 equal annual installments. Strictly speaking, here this was financed by a loan. Loan is a monetary item. Fully financed in US dollars, ante this is foreign currency. Payable in 3 equal annual installments, ante it is long term. So this is nothing but long term foreign currency monetary item. This is absolutely long term foreign currency monetary item. No doubt at all in that. So, and moreover, A Limited is a company. So it is having two options. Normally transferring exchange difference to P&L account, and option number 2, transferring it to. No, you should not tell like that. Following paragraph number 46A. And since as per paragraph number 46A, you are having LTFCMI. That is relating to fixed asset, which is a depreciable asset, and hence exchange difference has to be transferred to PPE account. Respond, everybody understood? My dear children, please take more care, concentrate. Normal option, transferring exchange difference to P&L account. As per paragraph number 46A. As per paragraph number 46A, it is LTFCMI, and hence you have to check out whether is it depreciable asset or other than depreciable asset. If it is other than depreciable asset, అయితే FCMI TD. If it is relating to depreciable asset, అయితే PPE. Here it is relating to depreciable asset, and hence it has to be transferred to PPE account. Respond, everybody clear? If paragraph number 46A is adopted. If it is not adopted, then normally it has to be transferred to P&L account. Now check out very carefully. Exchange difference is given. First installment was paid is given. Check out. The entire difference in foreign exchange has been capitalized. Entire difference in foreign exchange has been capitalized. So we will assume something like paragraph number 46A is adopted. Respond, everybody clear? But the solution is given to you in such a way that the company has done wrong accounting treatment. It has to transfer the exchange difference to P&L account. Clear everybody? The company had done the correct accounting treatment only when it has adopted paragraph number 46A. Sir, నేను ఏం చెప్పానో అర్థమైందా? By looking at this statement, we can conclude that company is following paragraph number 46A. We understood like that. But the answer is given in such a way that the company's accounting treatment is absolutely wrong because exchange difference has to be transferred to P&L account. The company's accounting treatment is correct only when paragraph number 46A is adopted. This is how the solution is framed. So if you observe at last, something like note is given. The entire loss should be charged to P&L account. So transferring to fixed asset account is wrong. The above answer has note. The above answer is given that company did not exercise the option as per paragraph number 46A. If the company availed the benefit given in paragraph number 46A, then nothing is required to be done. Company has done the correct accounting treatment. Respond, everybody understood. And my dear children, that is the end of accounting standard number 11. And those students who are actually watching on YouTube, it seems you people are understanding the concepts, and hence please give a big thumbs up. Please do like, share and subscribe. And get relaxed for 2 to 3 minutes. We are going to start accounting standard number 29. Let us start accounting standard number 29. And age 29 is nothing but provisions, contingent liabilities and contingent assets. My dear children, it's a kind of pure theoretical standard. Okay. Sir, point number 1, provision is the most dangerous element in the financial statements because it is always created on estimated basis. Whether the provision is created more or less is, whatever the provision which is created, whether the amount is correct or wrong, except business concern, nobody knows this one. Except business concern, nobody knows whether the provision created is correct or wrong. Sir, there is something called profit smoothing. Profit smoothing is nothing but 1 year we are getting high profits and another year we are getting low profits, and hence we have decided to equalize them. How, sir? In a year we are getting high profits, we will create more provisions. In the next year, whenever we are getting less profit, we will reverse the provision. So automatically profit is matched. In the year we are getting less profits, we are creating less provisions. In the year we are getting more profits, wantedly will create more provision. So automatically profit is almost equalized every year. Profit is almost equalized every year. Respond, everybody understood? So this concept is called as profit smoothing. Because of these provisions, this profit smoothing might be quite possible. So provision is the most dangerous item, and hence one should be very, very careful while creating the provision, and hence they have to follow all the rules and regulations. Respond, everybody, clear? And now, whenever we speak about provision as per accounting standard number 29, we have to speak something about obligation. What do you mean by obligation? Obligation is nothing but responsibility or duty to settle the liability. To settle the liability. This obligation can arise in any of the following 3 ways. Either by statute or law, either through agreements, or just to maintain good relations. Respond, everybody, clear? So whenever we are speaking about accounting standard number 29, we have to speak about something called obligation. Please respond, what is an obligation, Nana? Responsibility or duty in order to settle the liability. This responsibility might arise because of 3 things, any of the following 3 things. Number 1, statute or law. Number 2, agreements. Number 3, to maintain good relations. Respond, shall I proceed further? Now, one more important thing, there is something called present obligation, possible obligation, future obligation. Present obligation is an obligation which is existing as on the balance sheet date. Possible obligation is also an obligation which is existing on the balance sheet date. But future obligation is not existing on the balance sheet date. It will arise somewhere in future. Respond clear. Those obligations which are existing on the balance sheet date are categorized into present obligation and possible obligation. Already we have discussed. Present obligation is nothing but chances are more likely than not to occur. Possible obligation, equally likely or less likely to occur. In accounting standard number 4, something like contingency and events. Contingency, contingent gain, contingent loss. Contingent gain is dealt by AS 29. Contingent loss, check out whether the loss is probable or possible or remote. Did you remember? Probable is nothing but more likely than not to occur. Here also the same thing. Present obligation is also called as probable obligation. And the obligation or loss is more likely than not to occur. And for occurrence of liability, there is more chances than non-occurrence of a liability. So immediately you have to create a provision. Whereas coming to a possible obligation, equally likely chances are there or less likely chances are there to occur, and hence no need to create a provision. Just to disclose it as a contingent liability. Respond, everybody understood? This is what your present obligation and possible obligation. Future obligation is not at all existing as on the Chapali balance sheet date, and hence no need to consider the future obligation. Respond, everybody clear? Okay. Now the next one. Very important thing. As per accounting standard number 929, provision is a liability. What is a provision, my dear children? Liability, which may not be exactly and accurately represented, but it is represented with a substantial degree of estimation. What is a provision as per AS 29, my dear children? Provision is a, please respond, provision is a liability which is measured with substantial degree of estimation. So provision for bad debts is not a liability, and hence it is not dealt as per AS 29. Respond, everybody clear? Provision for depreciation is dealt by AS 10, since there is a specific standard for that. Respond, everybody done? Okay. Just answer me. Listen very carefully and answer. Company is creating provision for repairs and renewals for its fixed asset, which is absolutely good in its position. Company is creating provision for repairs and renewals for its fixed assets, but the fixed assets condition is absolutely good. Now you tell me the answer. Can company create provision for repairs and renewals or not? Yes or no? Why no? My dear children, fixed asset condition is absolutely good. There is no present obligation that fixed asset has to be repaired. Since the condition is absolutely good, you are not supposed to create repairs and renewals. You are asking, why did you create repairs and renewals? I have created provision for repairs and renewals because my fixed assets might get repair in future. So you are telling it might get repair in future, and hence it will become a future obligation. It's not a present obligation. As on the balance sheet date, are there any fixed assets which are in problem? No sir, every fixed asset is absolutely good in condition, and hence you are not supposed to create provision for repairs and renewals, since it is a future obligation. Now we are creating provision for repairs and renewals on those fixed assets which are in damaged conditions as at the balance sheet date. Answer. Can it do so or not? Yes, absolutely. Reason being, already as on the balance sheet date, fixed asset position is not good, and hence you have to put repairs and renewals in future. For that purpose you are estimating and you are creating. Respond, everybody understood? Okay, so yes, some other important points with respect to provision. Provision will be created only for present obligation. It should never be created for future obligation. Exception. A provision can also be created for future obligation whenever there is a virtual certainty. And this is an example which is given in the original accounting standard itself. Original accounting standard itself. A new law is going to enact in future for cleaning up the environment by those industries which had caused damage to the environment. Say for example, a factory is established. This factory had released hazardous chemical into the environment and it has damaged the environment. And hence government took it very seriously, and government is going to enact a law that your business concern which has been damaged, which has caused damage to the environment, it has to clean up the environment immediately. So it is a law which is going to get enacted in future. But this is an open source to each and every business concern. This is an open source to each and every business concern. Sir, law is not enacted. It will be enacted in future. So strictly speaking, is there any present obligation or future obligation? Cheppali. But this future obligation is virtually certain. This future obligation is virtually certain, which implies that 100% chances that law is going to enact, and those industries or factories which has caused damage to the environment has to clean up the environment. Respond, everybody understood? So take more care. Generally provision has to be created only for present obligation. It should not be created for future obligation. Exception, a provision can be created even for future obligation provided if there is a virtual certainty. Response, shall I proceed further? A provision should never be discounted. Exception, provision for decommissioning and restoration expense which is created as per accounting standard number 10 can be discounted. Respond clear, everybody? Provision can be discounted or cannot be discounted? Cannot be discounted. Only the provision which is created as per AS 10, which is nothing but provision for decommissioning and restoration expense, has to be discounted. Respond clear? I told you this provision has to be created as per AS 10, but what is the treatment for the provision is dealt in AS 29. I told you one terminology, unwinding of discount. Did you remember? Provision for decommissioning and restoration expense has to be brought to the present value and it has to be capitalized for the fixed assets. If at all those fixed assets are used for the purpose of producing the inventory, this provision for decommissioning and restoration expense has to be added to the cost of production. Creation has to be done as per AS 10. But further accounting treatment is dealt as per AS 29. I told you the concept also, which is nothing but unwinding of discount. Now let me tell you what is unwinding of discount. Initially I have created a provision for decommissioning and restoration expense with a fixed asset by bringing it to present value, say 3 lakhs. Clear, everybody? So I have to book discount or interest every year. My dear children, what is the difference between present value and future value? What is the difference between present value and future value? I'm asking, what is that portion called as? Interest portion. Difference between present value and future value is nothing but interest portion, amma. So that interest has to be recorded every year. Shall I start now? So the entry will be interest or borrowing cost account debtor to provision for decommissioning and restoration expense. And then whatever this borrowing cost is there, it has to be closed and transferred to P&L account. They respond, everybody clear? Please take care. Initially, say, take an example, you will get better clarity. Say for example 10 lakhs for 3 years at the rate 10%. Cheppannamma. Tell me the present value, sir. 1 divided by 1.1 whole power n, where n is equal to 1 to 3. Tell me what is the cumulative present value factor? 2.4868. Am I correct or wrong? Sir, please listen, sir. Tell me what is the journal entry for provision for decommissioning and restoration expense now. Fixed asset account debtor to provision for decommissioning and restoration expense, which is nothing but 10 lakhs into 2.4868. 24 lakhs 800. Respond everybody clear. Sir, this goes correct if every year you are doing like that. But is it every year or at the end of third year? Sir, please participate. I am going to give you the break after the completion of accounting standard number 29. Will you create this provision for decommissioning and restoration expense every year or at the end of third year? So no need to do with cumulative present value factor. Tell me what is the present value factor at the end of third year? 0.7513, and hence 10 lakhs into 0.7513. Respond everybody clear? So this is at the start of year 1. Now check out very, very carefully. Year 1 ending. Year 1 ending. Year 1 ending, I have to create a borrowing cost or interest account debtor to provision for decommissioning and restoration expense. 7,51,300 multiplied by 10%, which comes to 75130. And immediately P&L account debtor to borrowing cost or interest account 75130. This process is nothing but unwinding of discount. Unwinding is nothing but transfer. Discount is nothing but interest portion. So transferring of discount or interest portion to P&L account is nothing but unwinding of discount. Respond everybody clear? Now go for year 2 ending. Year 2 ending also, borrowing cost account debtor to provision for decommissioning and restoration expense. How much amount will be the borrowing cost this time? 7,51,300 plus 75130. Because even on interest also interest is computed because this is annuity kada. Hey, respond understood? Tell me, multiplied by 10%. 643, and ultimately this will be transferred to P&L account. And finally year 3 ending, borrowing cost account debtor to provision for decommissioning and restoration expense, and this has to be transferred to P&L account. And how much is this, sir? 751,300 plus 75130 plus 82,643 multiplied by 10%. 907. Now check out, my dear children. 90,907 plus 82,643 plus 75,130 plus 7,51,300. 9,99,980, which is almost equal to 10 lakhs. Respond everybody understood? So this is how the provision for decommissioning and restoration expense will be created, and every year unwinding of discount will be done. Every year what will be done, my dear children? Unwinding of discount. Unwinding of discount is nothing but transferring the interest portion every year to P&L account. Respond everybody pakka. And now, sir, I have transferred this borrowing cost to P&L account. I have transferred this borrowing cost to P&L account. Say for example, if my fixed asset is a qualifying asset, then this borrowing cost has to be transferred to. Is the question clear? In this context, I have transferred the borrowing cost to P&L account. As per accounting standard number 16, if this borrowing cost is incurred for my fixed asset, and my fixed asset had satisfied the qualifying asset definition, then this borrowing cost has to be transferred to Cheppali P&L account only. This is not to be transferred to fixed asset account, sir, because AS 16 is not applicable to notional borrowing cost or imputed borrowing cost. Hope you have remembered. Notional or imputed borrowing cost is nothing but no outflow of resources is there. Moreover, did you take any loan? Please respond. Did you take any loan? No, this borrowing cost is provided in the current year in order to increase the value of provision for decommissioning and restoration expense. This borrowing cost is not at all dealt as per AS 16 because AS 16 is not dealing with the imputed cost. Hope you have remembered. If not, tomorrow you will get that. Okay, so take care. Ultimately, this borrowing cost is no way dealt by accounting standard number 16. This is dealt only as per accounting standard number 29. And one more thing, provision is always created before tax. And no provision is created for future losses. I'm estimating in future loss will come, sir. And hence for future losses, I'll create a provision now, sir. Standard will kick you. And yes, one very important thing, reimbursement. This is very important. Sir, say for example, somebody filed a case on you. You have filed a case on somebody else. So somebody outsider filed a case on you asking for the damages. You have filed the same case on the other party to reimbursement of for that damages. Say for example, you sold one oil tin. And that oil tin was totally adulterated. It was consumed by the consumer and he got some illness and hence he was employed, admitted in the hospital. Clear everybody? Since he got admitted in the hospital, he is filing a case on my business concern for the damages compensation. I did not manufacture that adulterated oil. That oil was manufactured by the manufacturer. And hence, I had filed a case on the manufacturer. Respond everybody clear. Now the party is asking the damages of rupees 10 lakh. I am claiming the same. I would like to claim the same from the manufacturer and hence I had in turn filed a case on the manufacturer. Respond everybody clear. So now, when to recognize this reimbursement? If at all there is virtual certainty, legal counsel is telling, sir, you did not manufacture the oil. You did not adulterate the oil. This was the oil which was packed by the manufacturer. So obviously, even though you are paying the damages to the consumer or the customer, you will be getting 100% recovery from the manufacturer. Respond everybody clear. So like this, if you are having virtual certainty, then you have to recognize the reimbursement. If there is no virtual certainty, just it has to be disclosed. And one very, very important thing, my dear children, this virtual certainty provision, whatever the reimbursement is there, it has to be created in P&L account, credit side as an income, or it can also be set off with the respective provision. Respond clear. But very, very important, in balance sheet, reimbursement cannot be set off with the provision. Logic understood? In P&L account, you told logic is understood, but outright I did not tell any logic. I told you the provision. Provision is all about in P&L account, you can set off. That's your choice. But in balance sheet, you can't set off. Is the provision clear? Say for example, customer is asking you, pay the damages of 1 lakh. In P&L account debtor to provision for damages 1 lakh. I am creating another provision because I am having reimbursement by reimbursement for damages 80,000. This is option number 1. Or option number 2, you can also set off this reimbursement provision for damages 1 lakh minus reimbursement 80,000. Net outflow is only 20,000. Respond everybody clear. Either you can follow option 1 or option 2. That's your choice. Likewise, how sports fund can be set off with sports expenses. The same logic is considered. But coming to balance sheet, provision for damages 1 lakh should be a liability and reimbursement of damages 80,000 should be asset. You can't set off here at any cost. Clear, huh? Why, sir? Reason is very simple. This is an asset. Inflow of future economic benefits is there. This is a liability. Outflow of future economic benefits is there. And hence you can't set off asset and liability whenever there is a clear-cut establishment of receipt of future economic benefits and payment of future economic benefits. Respond, everybody understood? Sir, chappandi sir. Okay. So this is what the concept of reimbursement. And one more thing, reimbursement can never be more than the provision amount. You can get, but you're not supposed to recognize. If you are recognizing, then we will call it as violation of prudence concept. Reimbursement cannot be more than the provision amount. You can get, but you are not supposed to recognize in the books of accounts. If you are recognizing more reimbursement than the provision, then we will call it as violation of prudence concept. Respond, everybody understood? I'm not covering the concept of restructuring. You just go through restructuring. It's easy. And moreover, concept is there, provision is there, but you're having only one question on restructuring. So it's not that important concept. And straight away I'm proceeding to the contingent liability. Sir, point number 1. As on the balance sheet date, you know for sure you have to pay the expense. But how much? We don't know. As on the balance sheet date, 200% you know that you have to pay the damages. But how much? You are unable to estimate at any cost. In such a case, it will become a contingent liability, a present obligation which cannot be estimated. And next one, a possible obligation arising from the past event whose existence is confirmed upon happening or non-happening of one or more uncertain future events. Already we have covered this in accounting standard number 4. Hope you have remembered. If confirmation is received, we will call it as an event. If confirmation is not received, we will call it as contingency. Respond clear, huh? Sir, a possible obligation is always a contingent liability. A possible obligation is always a contingent liability. If it is a present obligation and exactly measured, then it is a normal liability. If it is a present obligation and measured with substantial degree of estimation, then it is a provision liability. If it is a present obligation and unable to measure reliably, then it also will become a contingent liability. Respond, everybody, clear? So this is all about contingent liability. Take care. And moving on to the next thing, contingent asset. Contingent asset is also similar to contingent liability. A liability may become a liability or not in future. An asset might become an asset or not in future is called as a contingent asset. A possible asset or a present asset arising from the past events whose existence will be confirmed in future upon happening or non-happening of one or more uncertain future events. We will call it as contingent asset. Very important accounting treatment. Provision has to be recognized. Reimbursement has to be recognized only when there is a virtual certainty. Contingent liability has to be disclosed. Contingent asset neither recognized nor disclosed in the financial statements. If you want, you can disclose in the board of directors report, which is similar to non-adjusting event. Respond, everybody, clear? And already I have showed you what is unwinding of discount, right? That's it, my dear children. This is what the simplest form of accounting standard number 29. But wait, learning the concept is very easy, but the problem is that while solving accounting standard number 29, you will be having many controversies in your brain. So for all those things, only one simple answer. It's all about just check out the question carefully. After checking out the question carefully, you have to come to a conclusion whether it is present obligation or possible obligation or future obligation. Of course, what is it called? While telling it's very easy, but while applying it's not that easy at all. Especially AS29 and AS4 also. Two things are something like very judgmental decisions. We can help you how to think, but we can't make you think, especially in your examination. Sorry. Check out. Sun Limited entered into a sale contract for rupees 5 crores during the year. The profit on the transaction is 1 crore. The delivery should take place during the first month of the next year. In case of failure, a compensation has to be paid of 1.5 crores to X Limited. Sun Limited planned to manufacture during the last month of the previous financial year. As on the balance sheet date, the goods were not manufactured and it was unlikely that Sun Limited will be in a position to meet the contractual obligation. Is the question clear? Simple. I have to deliver goods to you in the next year, April. But at the end of the year, I did not manufacture a single good. Now, do I need to create a provision or not? Wait. It is depending on different situations. Point number 1. Okay. What is your manufacturing cycle? My manufacturing cycle is just 2 days, sir. I have to deliver the goods to you by April 30. The manufacturing cycle is only 2 days. Still I'm having 30 days time period. Correct or wrong, sir? In this situation, it will never become a present obligation. It will become a possible obligation. Hope you have got the logic. What am I telling you? Sir, I have to deliver the goods to you at the end of April 30. Today we are at 31st March. I did not still start the manufacturing at all. Do I need to pay the compensation? No need to pay the compensation because my manufacturing cycle is only 2 days. So in any of the April, I can choose for 2 days and I can manufacture and I can sell you the goods. But here Sun Limited is telling we can't meet the contractual obligation. And they told that it is a present obligation. If we are unable to meet the contractual obligation, then we have to pay the compensation, which is a present obligation for which you need to create a provision. I hope the concept is clear for you. Next, should Sun Limited need to provide for the contingency? Yes, because unlikely, until it is nothing but a present obligation. Next, should the provision be measured in excess of profit? Should the compensation be measured as the excess of compensation to be paid over the profit? No, I have to pay the compensation. That's like 1.5 crores, ante. Respond everybody clear, huh? He is asking the profit is 1 crore. The compensation is 1.5 crore. So in excess of profit is only 50 lakhs. Do I need to recognize the provision to the extent of 50 lakhs or 1.5 crore? 1.5 crore. This is just a trash question. Hey, respond everybody clear. That's it. And this question is easy, nothing great. Check out this question again. Be very careful. Be careful with the question terminology. You have to create a provision for warranty. If the balance warranty period is less than 1 year, create 2% provision. If the balance warranty period is more than 1 year, create 3% provision. If the balance warranty period is less than 1 year, create 2% provision. If the balance warranty period is more than 1 year, create 3% provision. Is the rule clear, everybody? Now, let me start. He is asking you to create the provisions as at the year ending 31st March 2018 and year ending 31st March 2019. First of all, let me check out the warranty periods because these are invoice dates and the date of sale. plus 2 years is nothing but warranty period kada. So tell me what is the warranty period for first sale? 16th February 2019. Second one, 24th December 2019. Third date, 3rd October 2020. Clear everybody? So now let me start first year, 31/3/2018. 31/3/2018 ante I need to consider only these 2 days nana, because 4th October 2018 is after 31/3/2018. No sale is happened till 31/3 kada. So you are not supposed to create any warranty provision. Now check out 16/2/2019 and 24/12/2019. Balance warranty period antunnadu kada. So you have to check out the balance from end of the year, from 31/3/2018 till 16th February 2019. Is it less than 1 year or more than 1 year? Less than 1 year. If it is less than 1 year, provision is 2%. Ante 60,000 into 2%. Is it clear? The next date 24/12/2019. So from 31/3 till 24/12, this is 2 kada. Okay, 12/2019. And is it more than 1 year or less than 1 year? More than 1 year. And hence the provision will become 3%. 40,000 into 3%. Respond everybody clear. So 1200 plus 1200, provision will become 4,800. Abba sarele 2,400. You people are great in mathematics. I'm poor in mathematics. Anyways, is it clear to each and everyone? Sir, now wait. Next year ending is 31/3/2019. Next year ending is 31/3/2019. My dear children, sale which is happened on 17th February 2017, warranty completes on 16/2/2019. Now you are at 31/3/2019. What is the balance warranty period? 0, because already warranty expired. Since already warranty expired, 16/2 is somewhere here, sir. Warranty already expired. Now you are at 31/3 and hence there is no balance warranty period and hence no need to create a provision. Now check out from 31/3 till 24/12. Less than 1 year this time, and hence 40,000 into 2%. 800. Next warranty period is 3/10/2020. From 31/3/19 to 3/10/2020. This is greater than 1 year and hence you have to create a provision of 3%. So 135,000 into 3%. 4,000, 4050, and hence total provision is nothing but 4850. Respond everybody clear? So current year provision is 4850. Last year opening provision is 2,400 and hence I have to create 2,450 in the current year. Respond everybody understood? Okay. Next. So problem number 3. If you observe this one, this is very different one. 85% is due to installation of oil rig. 15% is due to extraction of oil. Please take care. Something like, listen very carefully. There was an oil rig which is installed in seashore. So government is asking you, at the time of deinstalling this oil rig, you have to restore the seabed. So already we know that after some X number of years, we have to dismantle this oil rig and we have to restore the seabed. And hence I have to create a provision for decommissioning and restoration expense. Clear everybody? Sir, 85% of this cost will be due to installation. 15% of this cost will be incurred due to production. Is the logic clear? Say for example, I have installed, might be up to 10 feet below, but due to the production automatically the machine will vibrate and hence it will be going deep up to 12 feet. Clear everybody? So 85% is due to installation. The remaining 2 feet is due to production. Clear everybody? By the end of the year, oil rig was installed, but production was not yet started. Do I need to create a provision or not? By the end of the year, oil rig was installed, but production was not yet started. Do I need to create a provision or not? Yes, but I have to create only up to 85%. This 15% is not to be created because it is not yet started. Understood everybody? Okay. This is normal. You can get this. Check out this one. Different versions of the answer will be there for this one. This will be the last point for accounting standard number 29. Company's sales tax assessment has been completed on 14th February 2017 and the government authorities are asking you to pay 2.76 crores. Clear everybody? They are asking us to pay more. And the company had paid 2.76 crores and we have gone for appeal for a sum of 2.1 crores. Respond logic understood? Listen very, very carefully everybody. How much they are asking me to pay extra? 2.76 crores. Did I pay the extra amount or not? Yes, we have paid the extra amount. But for 2.1 crore, we have gone for appeal. And we are accepting for 0.66 crores. Logic understood? How much we have paid? 2.76 crores. Clear everybody? How much we have gone for appeal? 2.1 crore. For remaining 0.66 crores, we have accepted that this is our liability and hence paid. So no need to speak about this one. Only we have to speak about this one. Check out how to treat this one. Everybody be very, very, very careful. So, since the company is not appealing for 0.66 crores, the same should be provided in its books of accounts. The amount which is paid under protest has to be kept under loans and advances and disclose the same with a contingent liability. In the sense, I'm paying, am I correct or wrong? Respond. What is the entry I have to write? Sales tax expense 0.66 crores to cash or bank account. I'm paying 2.76 crores. So balance 2.1 crores is debited as loans and advances and it is shown as an asset. Clear everybody? This is my expense transfer to P&L account. I have shown this as an asset. Along with this asset, I can't give guarantee that this is my asset. If at all, taxation authorities is asking me to pay. I have gone for appeal kada. Judgment paid. Judgment is paid. I have already paid kada. And hence convert this asset into expense. Respond everybody clear? And next one. They are telling no need to pay. Very happy. I'll get my asset back. And hence I have shown it as an asset. Respond everybody clear. But along with this, I also need to show that this as a contingent liability. Because whenever authorities are asking me to pay, then I have to pay. But since already I have paid, I am recording it in my books of accounts along with a contingent liability. Respond logic understood? So take care. For 2.1 crores, I am going for appeal. I'm going for appeal. Paid and gone for appeal. If at all court order is you have to pay, I have to pay it and hence it is a contingent liability and hence record it as a contingent liability. But since I have already paid, treat it as an asset. Two parts are there here. Please try to understand. I have paid extra and I'm going for appeal. Since I have paid extra, I have to treat it as a loans and advances. Because I'm treating, I'll get it back. I may get it back. And since I have gone for appeal, authority might ask you to pay the remaining. And in such a case, I have to pay it. Yes or no? And hence it is a contingent liability. If at all court is not asking, then I'll get this money back. And hence I'm showing it as an asset. If court is asking, not a very big deal. Already I have recorded it as a contingent liability, convert it into liability, and since already paid, need to set off these two things. Respond everybody clear. This is version 1 of answering. Version 2 of answering, you record entire 2.7 crores, transfer it to P&L account. Clear everybody? And 2.1 crore can be treated as a contingent asset. This is second version. Whatever amount I paid, transfer total amount to P&L account. Since I have paid it. If at all court is asking me to pay, I have already paid. No need to pay. If at all court is asking no need to pay, take back the refund. It is my contingent asset. Respond, is the logic clear? So version 1, you can treat it under loans and advance and corresponding contingent liability has to be created. Style 2 of answering, no need to show a contingent liability, no need to show the asset. Total 2.7 crores can be transferred to P&L account. And finally, 2.1 crores will be treated as if it is a contingent asset. Respond everybody clear. And my dear children, that is the end of accounting standard number 29. Accounting standard number 26. My dear children, what is accounting standard number 26, Nana? Intangible assets. So, first of all, what do you mean by intangible assets? There are some very important terminology in the definition. You should never forget that important terminology. Intangible assets are identifiable non-monetary assets without having physical substance, whose life period is greater than or equal to 12 months and it is used for the purpose of administration purpose, rental purposes, production of goods and rendering of services. Now, the first and foremost thing, what do you mean by identifiable? My dear children, remember, identifiable implies separable from self-generated goodwill. What is identifiable, Amma? Separable from self-generated goodwill. Because, just simply answer me, can self-generated goodwill be separately sold? Please respond. Say for example, I usually give this example. Say the assets are 1 lakh and the liabilities are 20,000. What are my net assets of the company? Please participate, sir. What are my net assets of the company? 80,000 are my net assets of the company. Now I would like to sell my company. Outsider who would like to purchase is offering 1,10,000 purchase consideration. How much is he offering? What is the net assets value of my business? But why is he offering 1,10,000? I mean, he had offered some extra. Am I correct or wrong? So I'm asking, why are you offering some extra portion? Which is nothing but goodwill. So now our business had got a cunning idea. I will not sell my asset. I will not sell my liability. I will not give you net assets. I will not transfer my business. I will not give you the balance sheet. Don't pay me 80,000. That extra 30,000 you pay me. So is it clear? So you are ready to pay some extra, right? Yes. What is that extra portion? Over and above net assets, sir. What is over and above net assets, sir? Goodwill. How much is the amount, sir? 30,000. So I'm telling, I don't transfer my business at all. I don't transfer my business. No need to give me 80,000. That extra goodwill is there, right? You take the goodwill and give me the 30,000. Answer me, is it possible or not possible? Sir, please respond, possible or impossible? Impossible. Because here that company is ready to pay that extra amount only when the business gets transferred. If the business did not get transfer, that company will not give you any extra amount. And hence conclusion, my dear children. Conclusion. Self-generated goodwill cannot be separately sold or separately used or separately rented. Respond everybody clear. So please respond. Self-generated goodwill cannot be separately sold or separately used or separately rented. And hence self-generated goodwill is identifiable or unidentifiable. Please respond. Self-generated goodwill is unidentifiable. But you want intangible asset to become identifiable. Respond everybody clear. So intangible asset should be, please respond, intangible asset should be identifiable from self-generated goodwill, because self-generated goodwill is unidentifiable. So if you are able to separate any asset from self-generated goodwill, we will tell that it is identifiable. Respond everybody understood. This is point number 1. Point number 2. But remember, always identifiability doesn't mean separability. You don't need separability all the time in order to get identifiability. If at all, you can identify by some other means. What are those some other means, sir? Like generating of future economic benefits. If you are able to prove that from a particular asset there is a generation of future economic benefits, then no need to check out whether separability exists or not. We can tell that that particular asset is absolutely identifiable. Respond everybody clear. So my dear children, what is intangible asset? Identifiable non-monetary asset without physical substance. Now what is the first part we are discussing with? Identifiable. It must be identifiable. What do you mean by identifiability, Amma? Separability from self-generated goodwill. Why we are speaking only with self-generated goodwill, Amma? Because self-generated goodwill cannot be identifiable. Apart from this, if any other asset is separated, we can tell that particular asset is identifiable. But remember, always identifiability doesn't mean separability. If it is possible to find identifiability in some other way, like generation of future economic benefits, then no need of separability. We will tell that particular intangible asset is identifiable. Respond everybody clear. Next, identifiable. What is the second one, Nana? Non-monetary asset. Already you know what is non-monetary asset. I already told you, as per AS 12, monetary and non-monetary is different. As per AS 11 and 26, it is different. So now we are learning the standard of AS 26. So non-monetary asset is the definition as defined in AS 11, but not as defined in AS 12. As per AS 12, monetary ante cash, non-monetary ante kind. But coming to accounting standard number 11, what are non-monetary items? Which are other than monetary items. Now what are monetary items? Number 1, money held. Number 2, assets and liabilities for receipts and payments which are expressed in fixed determinable terms of money. Respond everybody clear. So this is all about monetary item. Other than this, whichever item is there, we will just call it as a other than this, whichever item is there, we will just call it as a non-monetary item. Respond everybody clear. So conclusion, my dear children, be very, very careful. Accounting standard number 26, intangible asset is a non-monetary item as defined in AS 11, but not in AS 12. Now, intangible asset is not having any physical substance. But remember, intangible asset always needs the support of tangible asset or support of tangible item. Intangible asset always needs the, please respond, intangible asset always needs the support of tangible item. Support of tangible item is needed, but intangible asset is not having physical substance. Best example, I already told you, painting is an intangible asset. What is painting, my dear children? But to paint, will you paint on air or what? You'll paint on one cardboard sheet. Response, sir. Or you'll paint on some wall. So painting on cardboard sheet, whatever is there. Painting on cardboard sheet, whatever is there. This is nothing but intangible asset. But cardboard sheet is a tangible item. What is painting, Nana? You're drawing a painting on cardboard. So cardboard is dash item, tangible item. Clear, everybody? Sir, painting is an intangible asset, but to paint, you need the support of a tangible item. Respond, everybody, clear. And hence conclusion, intangible asset is not having physical substance, but intangible asset needs the support of physical substance. So to tell you in a single word, cost of intangible assets include both cost of tangible items plus cost of intangible items. Now how to consider this one? Is it as per AS10 or AS26? No. For this case, you have to check out this concept. Listen very, very carefully. You have to check out whether separable or inseparable. Whether the tangible and intangible are separable. Whether the tangible and intangible are inseparable. Is it clear, everybody? Hey, respond understanding. Best example. Say, for example, I have taken antivirus. I've taken antivirus software. Say Kaspersky antivirus software I have installed in my system. Clear, everybody? After say some X number of years, say after 1 year, this system is corrupted, but the antivirus is not corrupted, and hence I have decided to deinstall the antivirus in this system and to reinstall the antivirus in another system. Is it clear? Or something like I have taken Adobe license, Adobe Photoshop license, Adobe Reader license I have taken. I have installed this Adobe license in this system. Say after 1 year this system gets corrupted, and hence I would like to reinstall my Adobe license in another system. Possible or not possible? Please respond, possible or not possible? So to tell you, Adobe license is tangible or intangible? Intangible or tangible? Intangible. But it is installed in the system called laptop. Clear? So now laptop and Adobe license, separable or inseparable? Separable. And hence for laptop, AS10 is applicable. For Adobe license, AS26 is applicable. Respond, everybody, clear? So this is the context when there is separability. Now you have to check out inseparable. Let me give you an example again. Say for example, you have purchased Windows 10 license. Windows 10 license was purchased around for 10,500 rupees, which was delivered in a pen drive or which was delivered in a CD. You're paying 10,000 rupees just for pen drive or CD or for Windows. Okay, next question. Is pen drive and Windows software separable or inseparable? Inseparable. It's not possible to separate those two things, my dear children. And hence, in case of inseparability, you have to check out the predominant element. You have to check out the, if the predominant element is tangible item, then AS10 is applicable. If the predominant element is intangible item, AS26 is applicable. In pen drive example, Windows 10 which was delivered in a pen drive, you are paying 10,500 rupees. Point number 1, is this pen drive and Windows 10 separable or inseparable? If it is inseparable, you have to check out for dash element, Nana. Please participate, you have to check out for dash element. Predominant element. In Windows pen drive, what is predominant element? Windows. And is it tangible or intangible item? And hence which standard is applicable, Amma? AS26. Say for example, you are purchasing a laptop. In laptop itself, he is giving something called Windows 10 OS. We are paying around 60,000 rupees. We are paying 60,000 for laptop. In laptop, they have given re-inbuilt Windows 10. Now this Windows 10, can it be separable from the system which you are originally purchasing? No, that's not possible. If you are purchasing Windows 10 separately, you can separate it in any system. But if you are purchasing a laptop in which Windows 10 is already reinstalled or installed, in such a case, this Windows 10 can't be separable. So check out, is it separable or inseparable? Inseparable. You have to check out for dash element, Nana. What is the predominant element here? Laptop, and hence dash standard is applicable. Respond everybody clear. That is the end of definition. Respond everybody clear. So tell me, what's an intangible asset, my dear children? Identifiable, non-monetary, without physical substance. Identifiability meaning separability from self-generated goodwill. But always identifiability doesn't need separability. If you're able to identify in some other way, like generation of future economic. And now coming to the next one, non-monetary is the non-monetary item as defined in AS 11 but not in AS 12. Coming to the next one, without physical substance. Answer. You have to check out whether, point number one, intangible asset does not having any physical substance, but it always needs the support of tangible items. So you have to check out whether the tangible and intangible are separable or inseparable. If it is separable, then for tangible item, AS 10 is applicable. For intangible item, AS 26 is applicable. For inseparable, you have to check out the predominant element. If the predominant is tangible, AS 10 is applicable for both tangible and intangible. If the predominant is intangible, AS 26 is applicable for both tangible and intangible. Respond everybody, understood. So this is the concept of definition. But take care, you already know the recognition criteria. First of all, it should satisfy the definition of, and then it should satisfy the definition of intangible asset. Only then we'll call it as a intangible asset can be recognized in the books of accounts. Respond everybody, clear. And moving on to the next thing, applicability. Remember, AS 26 is applicable for both intangible assets and expenditure. My dear children, what is the name of AS 26? But don't think that this standard is applicable only for intangible asset. This standard is applicable for intangible asset and also for expenditure. Is it clear? Something like expenditure relating to advertisement, training, research and development, startup expenses, and yesterday we have seen preliminary expenses. As per accounting standard number 26, preliminary expenses have to be written off in the first year itself. Did you remember? So accounting standard number 26 is applicable for both. AS 26 is applicable for both intangible assets and expenditure. Respond everybody, clear. So take more care, my dear children. Check out some of the applicabilities. Of course, I'm not dealing with non-applicabilities because actually they are very simple. If you read it, you'll understand. And coming to intangible assets applicability, this is applicable for both intangible assets and expenditure. Some of the list of intangible assets are given here. Check out. Goodwill, patent, copyrights, trademarks, masthead, publishing titles, recipes, secret formulas. These all are like next. Import quotas, customer list, pilot plan, IPRs. Intellectual property rights. Did you remember this one? Licensing arrangements with respect to motion picture films, cinemas, video recordings, documentaries or short films, plays, dramas, manuscript. Which standard is applicable? AS 26. In which standard you have learnt it? AS 19. That AS 19 is not applicable. Hope you have remembered. Now coming to this one, masthead. What do you mean by masthead? My dear children, masthead is nothing but on doctor prescription you will be given everything. Top of the page. Or else if you pay the fees, you will be getting the receipt at top of the page. Along with at top of the page or top of the receipt, along with the logo, along with the name, along with the phone numbers, along with the branches, along with the courses offered, along with everything, you will be getting the topmost part, which is called as masthead. If you have gone to the doctor on the prescription, you will be getting the topmost part, his name, qualifications, doctor symbol, hospital symbol, phone numbers, etc. and etc. That total is called as masthead. And the next one is publishing titles. In movies, you will be seeing AVM Creations, Maitri Productions, etc. All those things are nothing but publishing titles. Coming to the next one, recipes. Hope everybody of you know it. Recipe is nothing but the style of preparing. Something like initially, you know, Limca is not belonging to Coca-Cola Private Limited. Limca is a separate company. But later on, Limca is sold to Coca-Cola Private Limited. Limca is sold to Coca-Cola Private Limited doesn't mean that the manufacturing unit is sold. The manufacturing formula of Limca is sold, where we'll call it as a recipe. And secret formula, even this is also similar to that concept. And the next one, import quota and customer list. So whatever the list of customers you are having, that's an intangible asset. Of course, that is self-generated intangible asset. My dear children, self-generated intangible asset had satisfied the definition of intangible asset or did not satisfy. Self-generated intangible asset had satisfied the definition of intangible asset or did not satisfy. Did not satisfy. Because intangible asset must be identifiable, but self-generated intangible asset is unidentifiable. So strictly speaking, self-generated intangible asset did not satisfy the definition of intangible asset, but AS 26 continues to apply. What is the treatment? You will learn later. Respond clear? AS 26 is applicable for both intangible assets and expenditure. That intangible asset might be either self-generated or purchased. Self-generated intangible asset is not satisfying the definition of intangible asset as per AS 26, but for self-generated intangible asset, AS 26 is applicable. How to do the treatment, you will learn later. Next, pilot plan. Pilot plan is nothing but production plan. That is like after which process has to be done. How many days a particular intermediary product has to be stored and then issued for production. What is that called? Blueprint. That blueprint is nothing but a kind of pilot plan. IPRs, as you all people know, intellectual property rights. By using your brain, by using your intellect, by using your knowledge, if you manufacture anything, we'll tell it as IPR. And already discussed with these things. And coming to the next one, expenditure relating to advertisement, training, startup, research and development, etc. Respond everybody clear. Sir, listen very carefully and answer me. If an intangible asset is given under lease, or if a tangible asset is given under lease, clear everybody, which standard is applicable? AS 19. For intangible asset, AS 26 is not applicable in this case. For tangible asset, AS 19 is not applicable in this case. Wrong Japana? Sorry, AS 10. For intangible asset given under lease, 26 is not applicable, 19 is applicable. For tangible asset given under lease, AS 10 is not applicable. AS 19 is applicable. Respond everybody clear. Exception. For amortization and depreciation, AS 26 and AS 10 continues to apply. If you have remembered the leases concept I told you, under finance lease, since the risk and rewards are transferred to, please participate, risk and rewards are transferred to lessee, depreciation must be claimed by lessee as per accounting standard number 10. Under operating lease, the risk and rewards are not transferred to lessee. Risk and rewards are there in the hands of lessor. So he has to claim depreciation in accordance with AS 10. But for that asset which is given under lease, which standard will take care? AS 19 but not AS 10. Intangible asset given under lease, that standard will take care? AS 19 but not AS 26. But for amortization on intangible asset, AS 26. Respond everybody clear. As usual, the concept of recognition and measurement. Two types of elements will be there. Number one, initial recognition. Number two, my dear children, if it is asset related standard, obviously there will be these two recognitions. Initial recognition and subsequent recognition. You might ask me, sir, you told AS2. Miradagaru, I know that. What is AS2, my dear children? Valuation of inventory. I have done valuation of inventory, but I did not cover the concept of initial recognition and subsequent recognition. Hope you have remembered. But AS10 covered, 13 covered, 11 covered, 26 going to get covered. And for all the asset related standards, I am telling initial recognition and subsequent recognition. But why I did not tell that concept in AS2? Since it is marathon class, huh? This standard deals only with valuation, that is measurement. This standard will not deal with recognition, and hence no concept of recognition is dealt in AS2. Whereas coming to AS26, 11, 10, in all these standard, all the four things, recognition, measurement, presentation, disclosure were dealt. And hence, my dear children, recognition and measurement, what are the two recognitions you are having, Amma? Initial recognition depends on modes of acquisition. Initial recognition is depending on. Coming to subsequent recognition, only one model is there, that is cost model. No concept of revaluation model. My dear children, no concept of revaluation model. Only there is a concept of cost model. Shall I proceed further? Now coming to initial recognition, it actually depends on modes of acquisition. Coming to modes of acquisition, number one, cash or credit. No concept of self-construction here, take care. Exchange of assets, issue of securities, research and development, acquired in the course of amalgamation. Of course, I am not dealing with government grant because you know well. Government grant received either in cash or kind. If it is cash, tell me, grant received is monetary cash for a depreciable asset. Intangible etc. So either asset reduction method or deferred grant approach method, DGG method. Did you remember? If it is non-monetary, like straight away you are getting one intangible asset in your hand, then you have to check out whether is it received for free of cost or concessional price, and hence already it was totally covered in AS12, and hence I don't cover now. Now let me continue. Cash or credit, very very simple. It has to be recorded at cost price. Cost price is equal to purchase price plus direct expenses. Purchase price is the price which is stated in the invoice. My dear children, all the time purchase price is the price which is stated in the invoice, except for accounting standard number 13. Because for accounting standard number 13, purchase price is nothing but quoted price. That's it. Because there will be no invoice for investment, that I already told you. And for all the remaining, it is just price which is stated in the invoice. Respond, everybody understood? And next, direct expenses like all the brokerage, commissions or legal fees, registration fees, etc. and etc. have to be added. And next one, exchange of assets. I'm not going to cover here once again because clearly covered in accounting standard number 10. And also I told you how to write the entry once again in accounting standard number 13. Commercial substance. Exchange of asset in the sense you have to check out for commercial substance. I'll tell you the rule, that's it. Sir, I already told you 99.999% in all other standard, if any asset is exchanged, there will be commercial substance. But if you are doing the same in accounting standard number 10, you have to check out whether there exists a commercial substance or not. Simple logic. Exchange is between the same asset. No commercial substance. Now listen very carefully. I have given one patent and taken another patent. I've given one patent and taken another patent. Commercial substance exists. If it is the same patent, why will I give and why will I take? The patent right also might be different, and hence I'm giving my patent right and I'm taking another patent right, and hence deemed assumption, always there exists a commercial substance. In this case, it has to be recorded at fair value of asset given up or fair value of asset acquired, whichever is more clearly evident. If these two things are clearly evident, first preference will be asset given up, second preference will be asset acquired. If fair values itself is not there, net book value of asset given up. If commercial substance are not there, net book value of asset given up. Sir, this concept is absolutely covered in all the remaining standards and hence delivered a bit faster. And the next issue of securities absolutely covered in all the other standards. Now coming to amalgamation and research and development. These two things are pending. Listen very carefully. First, let me complete amalgamation. Listen very carefully. If you have got any intangible asset during amalgamation, if you have got any intangible asset during, how to treat this? That is our concept. Listen very carefully. Sir, if at all you are acquiring intangible asset existing in transfer or company's balance sheet, you are acquiring intangible asset existing in transfer or company's balance sheet, then it is nothing great to discuss with AS26 here, because simply it will be recorded at fair value. Hey, respond, am I correct or wrong? You are acquiring PPE of that company, you are acquiring creditors of that company, you are acquiring debtors of that company. Like that, you are acquiring intangible asset of that company which is appearing in the balance sheet. If some intangible asset is appearing in the balance sheet, then nothing great to discuss. Simply it can be recorded at fair value or agreed value as per accounting standard number 14. Understood? So please respond, understood? For those items which are appearing in the balance sheet of transfer or company, if you are acquiring, at what price you have to record will be the understanding between the transfer or company and transferee company as per accounting standard number 14. So point number 1, this concept is not dealing with those intangible assets which are existing in the balance sheet of transfer or company. Clear everybody? Now next, we are going to deal with such kind of intangible asset which are not existing in the balance sheet of transfer or company. Let me start. Listen very carefully. Say for example, this is amalgamation in the nature of purchase. Please respond. This is amalgamation in the nature of purchase, and your purchase consideration is greater than net assets. Your purchase consideration is greater than net assets. That difference we'll call it as goodwill, since it is amalgamation in the nature of purchase, which has to be treated as per accounting standard number 14. Respond everybody, clear? Huh? So take care. If it is amalgamation in the nature of purchase and if the purchase consideration is greater than net asset, that difference we will call it as goodwill, which is nothing but balancing figure which is dealt as per accounting standard number 14, and also this has to be amortized only for 5 years. Clear? Now even we are not speaking about this concept. We are speaking about other intangible assets relating to transfer or company but not recorded in transfer or company's balance sheet. We are speaking about other self-generated intangible assets relating to transfer or company. My dear children, is the concept clear? Huh? Point number 1, we are not dealing with those intangible assets which are recorded. Point number 2, we are not going to deal with such kind of goodwill which is a balancing figure, because it is amalgamation in the nature of purchase. We are not speaking about even that item also. Now with what item we are speaking about, sir? Those intangible assets which are self-generated are not recorded in transfer or company's books of accounts. Respond everybody, clear? So now observe. Say for example, transfer or company is getting acquired. Say for example, TCS. You are acquiring Tata Consultancy Services. Say for example, TCS is having their own brand name. Am I correct or wrong? Frankly speaking, their brand name is having active market or not? Of course, yes. If I started a Dabba company, and if at all my Dabba company is acquired by some other person, is my Dabba company having any active market? Absolutely no. Hey, respond everybody clear, huh? So now you have to check out those self-generated intangible assets which are not recorded in transfer or company's balance sheet. Say for example, brand name, customer relationships, getting my point everybody, etc. Check out whether these elements are having active market or no active market. If at all active market is there, take care, if at all active market is there, it can be recorded at fair value. It can be recorded at. If active market is not there, you have to record at such price which is not creating capital reserve or which is not increasing capital reserve. In a single word, it must be limited only to goodwill. In a single word, it must be limited only to. Respond everybody, concept understood. So let me tell you once again, take more care. Self-generate, we are dealing with those self-generated intangible assets which are not recorded in the transfer or company's balance sheet. Check out such self-generated intangible asset of transfer or company is having active market or no active market. If active market is available, you can record it at fair value. If active market is not there, you have to record at that price so that it should not create or increase capital reserve. In a single word, it must be limited only to goodwill. Respond everybody clear. Let me tell you an example. Say you are acquiring assets, 1 lakh. 2 liabilities, 20,000. 2 business purchase, say 80,000. Any problem? Say respond, any problem? Say for example, you are paying 1,10,000. Automatically 30,000 has to be debited to. Antena? Antega? So automatically 30,000 has to be debited to goodwill. This is balancing figure. For this one, dash standard is applicable. AS 14 is applicable, but not AS 26. Respond, shall I proceed further? Now listen very carefully. Assets got 1 lakh. 2 liabilities got 20,000. 2 business purchase. You are ready to pay 1,10,000 and goodwill you have already recorded 30,000. Now you would like to acquire customer relationship, which is a self-generated intangible asset of transfer or company. Say for example, this is having active market. If this is having active market, you can record at any price. Say 50,000. Okay. Say it is 50,000. Hey, respond clear, huh? Record 50,000 and cancel goodwill. You will get capital reserve to the extent of 20,000. Hey, logic clear, huh? The goodwill, whatever balancing figure, cancel that. Respond understood. Say for example, you would like to record the customer relationships fair value 10,000. Then goodwill will be limited to 20,000. 20,000. Goodwill will be limited to 10,000. 30,000. Goodwill will become 0. 40,000. Set of 30,000 goodwill and capital reserve 10,000 will arise. Respond, is it clear? Only when customer relation is having active market. If customer relations is not having active market, you have to record only up to the value of goodwill. And how much is the value of goodwill? Maximum amount attained to customer relationship only 30,000, not even 30,001 rupee. Because if it had become 30,001 rupee, 1 rupee capital reserve will come. You have to record it at that price so that it should not create or increase capital reserve. Respond everybody understood. That's the end of Amalgamation, intangible assets acquired in the nature of amalgamation. Shall I proceed further? And the next concept is all about research and development. My dear children, what do you mean by research and development? Listen, first dash process will be started. Research. If research is successful, we'll go with development. Am I correct or wrong? Research is nothing but originally planned and investigated in order to gain scientific, technical or marketing knowledge and understandability. Whereas development, sir, this is just gaining some knowledge and understanding that knowledge. But development is application of research. Development will be started only when the research is completed. Only when the research is successful, you will start with respond. Only when the research is successful, you will start with the development. Otherwise, no development. Respond, everybody clear. You can develop either material or product or service or system or methods or process or devices. Devices is nothing but plant and machinery. You can develop any of these things. You can develop any of these things. Take care. Respond clear. Now, what is the accounting treatment for research and development? Again same. Check out whether the research and development expenditure is separable or inseparable. Sir, please respond. You have to check out whether research and development expenditure is. If it is separable, then research phase has to be charged to P&L account. Development phase has to be capitalized. If it is inseparable, treat entire research and development as if it is research phase and hence this has to be charged. Respond clear. Now special element, development phase has to be capitalized only when it satisfied the recognition criteria. Generally, what is the recognition criteria for intangible assets, Amma? It should satisfy the definition of asset. It should satisfy the definition of intangible asset. For development, there is one more recognition criteria, that it should satisfy the 6 conditions. Respond, everybody understood? So tell me, research and development accounting treatment, you have to check out whether is it separable or inseparable. If it is separable, research has to be charged, development has to be capitalized. If it is inseparable, entire research and development has to be treated as if it is research phase and immediately this has to be charged. And the development has to be capitalized only when it satisfies the recognition criteria. What is the recognition criteria? It should satisfy the definition of asset, it should satisfy the definition of intangible asset, and it should satisfy the 6 conditions. What are 6 conditions? Very, very simple. Condition number 1. There should be some technical feasibility to complete. Technical feasibility is nothing but technical possibility to complete. It should be technically possible to complete. Next one, you should have intention to complete. Number 3, you should have enough resources. Say for example, Mr. X. Yes, he is having quite good knowledge. He can complete CA. He is having capability to complete the course of CA. But he is not having intention to complete. What can he do? He can complete CA. He is having capability. He is having intent. But he is not having any resources to study. Hope you have got my intention. So it will get success only when these 3 conditions are there. What are the 3 conditions? Technical feasibility, intention to complete, only when there are adequate resources. And last and final, other 3 conditions. They should be able to generate future economic benefits either through sale or through usage. And finally, it must be measured reliably. These are normal conditions. These are conditions which are relating to asset. Asset should generate future economic benefit either through usage or through sale. And ultimately, it must be measured reliably. Respond, everybody clear? So a development phase has to be capitalized only when all those conditions are satisfied. If any of the conditions are not satisfied, immediately it has to be charged to P&L account. Respond, everybody clear? And moving on to the next thing, self-generated intangible asset. Sir, is self-generated intangible asset satisfied the definition of intangible asset or not satisfied? But AS 26 is applicable. What AS 26 is telling? Ignore self-generated intangible assets. That's it. Because you are not going to spend any amount on self-generated intangible assets separately. Sir, TCS is the brand. Tata is the brand. Everybody of you know recently Mr. Ratan Tata has passed away, and who had created an impact on the entire, not only on the Indian economy, on the entire world's economy. Am I correct or wrong? So now the biggest point, how did he get that good name? How the Tata company had got that brand name? Did they spend any exclusive expenses on branding? Absolutely no. They have just provided quality products. They have held the employees in the safest and secured way. They took care of employees. They are providing quality products. They are taking care about the investors. And hence that's the reason whenever the share price of Tata Consultancy Services is increasing a lot, immediately it will announce a share split, so that a retail investor will be able to participate in the stock market. Even it took measures for investors also. So they are having their own brand name. But for developing that brand name, nobody will put any expenditure. Clear, everybody? For the quality services that they are providing, automatically that the brand name will increase. And hence self-generated intangible assets can be measured or cannot be measured. And hence these are to be recognized or not to be recognized. Not to be recognized. My dear children, I am not telling it is not to be treated as asset. Not to be recognized at all. And it should not be appearing in balance sheet. It should not be appearing in P&L account. Respond clear. Self-generated goodwill or self-generated intangible assets should, please respond, should not be recognized. Some of the list of self-generated intangible assets, goodwill, brand, masthead, publishing titles, etc. These must not be recognized because they did not satisfy the definition of asset and intangible asset. Respond, everybody, understood? Okay. And these concepts are pretty simple. Expenditure on intangible asset. Initial expenditure has to be capitalized. Coming to subsequent expenditure, you have to check out for the future economic benefit. If future economic benefit increases, it has to be capitalized. Otherwise, it has to be charged. Retirement and disposal are absolutely similar to accounting standard number 10. Now, the next important part is all about expenditure. My dear children, accounting standard number 26 is dealing with both dash and dash and expenditure. Now this is the time to learn expenditure. Check out if the expenditure is relating to securities. Check out whether the expenditure is not relating to securities. Sir, for example, discount on issue of debentures, loss on issue of debentures, share issue expenses, underwriter's commission, brokerage and commission on issue of shares. For all these things, accounting standard number 26 is not applicable. Since AS 26 is not applicable, company can have their own accounting policies. If you want, they can be either amortized or they can be written off in the first year itself. Say for example, underwriting commission, write off in the first year itself. Share issue expenses, write off in the first year itself. Loss on issue of debentures, amortize. Hope you have remembered, in your foundation you will be getting discount on issue of debentures, amortize. Clear, everybody? Those expenditure which are relating to, please respond, those expenditure which are relating to securities. AS 26 is not applicable and hence company can have their own accounting policies. Those expenditure which are not relating to securities like preliminary expenses, training, advertisement, promotion, inauguration, pre-opening, pre-operating, etc. For all these expenses, AS 26 is applicable, and for your kind information, none of these items are generating future economic benefits and hence these items have to be charged to P&L account. Exception, if you are having a clear-cut notice that future economic benefits are generated with respect to any particular item, then that item can be capitalized. But in general, all these items must be charged. But if you can give assurance that future economic benefits can be generated, then it can be capitalized. Respond, everybody understood. And already done with impairment of loss. While telling impairment of loss, I also covered AS 26. Generally, impairment tests will be carried on only when there are indicators. But as per AS 26, even when there are no indicators, the company has to perform impairment test under this following two categories. Assets still under development, and if amortization tenure is more than. And coming to the last and final part of accounting standard number 26, amortization. My dear children, what is the method of amortization you can use? Any method which is reflecting the pattern of generation of future economic benefits. If equal benefits are there, SLM. If it is depending on units, production units method. My dear children, I specifically told you one thing in AS10. If you are using the machine and you are producing the goods from that machine and you are selling those goods and some cash flows are generated, can you depreciate the machinery in proportion to cash flows? No, that is specifically prohibited by accounting standard number 10. But the same is not specifically prohibited by accounting standard number 26. And hence, if your future economic benefits are depending on cash flows, then you can also amortize on the basis of future cash flows. Respond, everybody, clear? Now, sir, I am unable to tell the method. Follow SLM. If you are unable to choose the method, then you have to follow SLM. Respond, everybody, clear? Now one person is telling, sir, I am able to tell that my intangible asset is giving some equal benefits and also cash flows pattern is there. They are having cash flows pattern and they are having SLM basis, which is recommended. SLM. Clear, huh? He is having cash flows pattern and also he is having units pattern. What is recommended? Please respond. Units pattern is recommended. So cash flows pattern is the last option. Cash flows pattern is the last option. Even if business concern is unable to establish cash flows pattern, then it is recommended to follow SLM. Respond, everybody, clear? So take care, my dear children, which is a method that you can use. Any method which is reflecting the pattern of generation of future economic. If equal benefits, dash method, SLM. If at all units, then dash method, production units. If decreasing benefits, WDV method. If these methods can't be found and if there is a cash flows pattern, then you can also choose cash flows pattern only when the above are not possible. Even when cash flows pattern is also not possible, then follow SLM method. Next question. For how many years, sir? Rebuttable presumption, 10 years. What is a rebuttable presumption? But if you want, you can also choose more than or less than 10 years. But for this thing, management has to give some proof. Management has to give some proof. That's very, very important. As per AS 26, there's a rebuttable presumption, deemed assumption 10 years. But while choosing more or less than 10 years, you are supposed to consider economic factors or legal factors whichever is lower. Economic factors is nothing but capability of generating future economic benefits. Legal factors are nothing but for which period we are provided with the license. The license is provided for 5 years, but future economic benefits you will get for 10 years. What is the amortization period? 5 years. License is there for 5 years, but future economic benefit will not be there after 3 years. So now how many years you have to amortize? Only 3 years. Even though license is there for 5 years, future economic benefits are not there for remaining 2 years. If future economic benefits are not there, why will you amortize? Respond, everybody. Is the concept clear? Okay, and moving on to the next thing. Residual value is generally estimated to be 0. Residual value of intangible asset is generally estimated to be 0. But there is some exception. The exception is all about when there is a commitment given by the third party. Third party is entering into the agreement. Third party is entering into the agreement. Then you can consider some residual value. Next, if at all there is an active market at the end of useful life. If at all there is an active market at the end of, I'm having an intangible asset. some other outsider is entering into a contract that he will purchase the intangible asset after 5 years. So you can take residual value after 5 years. Or there is an active market for my intangible asset at the end of the life period. Even in that situation also we'll tell that there exists a residual value. But exception in these two situations, residual value will generally become 0. Very important. Residual value in future can be decreased, but it can never be increased. Change in accounting estimations. Life period is an estimation. Change in method of amortization is an estimation. Impairment of loss is an estimation. Fair value is an estimation. Net selling price is an estimation. Selling expense is an estimation. Value in use is an estimation. Correct or wrong? For all these estimations, if any change is there, you have to follow as per accounting standard number 5. Which effect has to be given? Prospective effect has to be given. Correct or wrong? But residual value as per accounting standard number 26 in future can be decreased, but it can never be increased. Understood everybody? So estimated residual value can be changed or cannot be changed? Respond. Can be changed, but the change can be only decreased. It can never increase. Respond everybody, clear? And my dear children, this is the end of accounting standard number 26. Most important parts of accounting standard number 26 is all about number 1, research and development. Number 2, amortization. These two things are very, very important. Take care. And my dear children, just relax for 2 to 3 minutes and then we are going to start the next standard, that is accounting standard number 16. Accounting standard number 16. Sir, seriously to tell you, we have to spend some quality time only on one model of the problems. Sir, A16 is such a kind of standard where every time institute is coming forward with a new model. Only in one concept, that is average capital expenditure on fixed assets. I mean to tell, you will be having some specific loans and you will be having some general borrowings. Hope you have remembered. So, my dear children, listen very carefully. A16 is such a simplest standard. Nothing great about any of the provisions. Such a simplest standard. But this model is always becoming a very complication in the examination. Every time we being the students and faculty or the teachers, knowledge gainers are learning that model, he is coming up with a new model again. And for your kind information, even September 2024 RTP is having a new model. Yes, if you did not observe, I guess supplementary is being given to you. Okay, they might arrange to give you. And September 2024 RTP model is also having different. And if I was not wrong, your attempt will be January 2025. So corresponding RTPs, please go ahead. If at all again there's a different model, just prepare it. So now I'm going to cover especially that model exhaustively because obviously that's the only difficult element. And of course, next typical aspect is all about some portion of foreign exchange is dealt as per accounting standard number 16. Anyway, shall I start, my dear children? And accounting standard number 16. What is accounting standard number 16, Nana? Borrowing costs. Remember, my dear children, A16 is applicable for borrowing cost, but it is not applicable to the owned cost. Owned cost might be either notional cost or it might be either actual cost. Actual cost is nothing but dividend, outflow of cash resources will be there. And notional or imputed or opportunity cost is nothing but interest on capital. Interest on capital, there is no outflow of resources at all. Respond everybody, clear. Sir, A16 is applicable only for dash cost, Nana? Borrowing cost. But remember, my dear children, as per accounting standard number 16, to capitalize the borrowing cost, when to capitalize the borrowing cost, which is nothing but commencement of capitalization. What is the concept, my dear children? As per accounting standard number 16, you have to start capitalizing the borrowing cost. When to start capitalizing the borrowing cost? As simple as such, there should be a loan and there should be a borrowing cost. I mean to tell, there should be a borrowing, there should be a borrowing cost, there should be a qualifying asset, and activities of qualifying asset must be work in progress. Activities of qualifying asset must be work in progress. These activities may not be physical activities all the time. Even administration activities can also be considered. Respond, is it clear? These activities may not be physical activities all the time. Even administration activities has to be considered. Respond, clear? Now, without telling the definition also, I told the commencement of capitalization. Reason being, yesterday in accounting standard number 29, you got something. For provision for decommissioning and restoration expense, we have done with the concept of unwinding of discount. Under unwinding of discount, you have actually got some borrowing cost. Now answer me. Does this borrowing cost A16 will be dealing or it will not deal? Respond, sir. For this borrowing cost, is A16 applicable or not applicable? No, it's not applicable because there is no loan there. For provision for decommissioning and restoration expense, there is no borrowing. Even though you are putting borrowing cost there. Since decommissioning and restoration expense was written at present value, you have to take that present value to future value. The difference between future value and present value is nothing but borrowing cost, and hence for that borrowing cost, AS16 is not applicable because it is the difference between present value and future value. It is not the borrowing cost computed on a loan. Logic clear? And hence for that borrowing cost AS16 is not applicable. Moreover, that borrowing cost is created as per AS29, which is the concept of unwinding of discount. So AS16 is applicable or not applicable? Cheppali, AS16 is applicable or not applicable? No, it will not be applicable. Respond, everybody, clear? Okay. Now let me start. What is included in the borrowing cost? Yeah, one more thing I have forgotten. Wait. Whether preference dividend, is it a borrowing cost or not? Listen, yes, there is a controversy for preference dividend actually. Sir, if at all preference share capital is treated as a liability, then preference dividend will become borrowing cost. If preference share capital by the business concern is treated as shareholders' funds, then preference dividend will not become borrowing cost. In this context, preference dividend will become owned cost. You might ask me why this controversy is there. If I was not wrong, framework. The definition of equity is given that equity is not a liability. Company is not having any present obligation to repay the equity shareholders. But coming to preference shareholders, company is having a present obligation to repay the preference shareholders even at a maximum period of 20 years. Hope you have remembered. Maximum redemption period of preference shares is nothing but 20 years. Even at least after 20 years, company is having present obligation to repay the preference shareholders. And technically speaking, preference share capital did not satisfy the definition of equity. Respond, everybody, clear? But as per schedule 3, preference share capital is kept under the head equity and liabilities, which is nothing but shareholders' funds. So this is the controversy. Now, conclusion. Listen very, very carefully. A company can treat preference share capital as a liability, or it can treat preference share capital as shareholders' funds. It is its own wish. If it is treating preference share capital as a part of share capital, then preference share capital will be continued to be shown under shareholders' funds. If at all business concern is treating preference share capital as a liability, then business concern can show the preference share capital under non-current liabilities, long-term borrowings. Sir, listen. There is nothing wrong even when preference share capital is kept under non-current liabilities, long-term borrowings. It implies that business concern is considering preference share capital as liability. Sir, adenti sir, if you are changing the head, schedule 3 is getting altered kada? Then is it okay? Yes, absolutely okay. Because schedule 3 general instruction, it was very clearly given that this is given for presentation purpose. If any things are to be altered in accordance to your business concern, you can alter the heads. Respond everybody clear, huh? And hence conclusion, when preference dividend will become a borrowing cost, Nana? If preference share capital is treated as a liability. Sir, A16 is applicable only for dash cost and borrowing cost. It is not applicable to dash cost, amma. Owned cost. Respond everybody clear. And moving on to the next thing. I mean to tell preference dividend. Is preference dividend a borrowing cost or not? It just depends on preference share capital treatment. If preference share capital is treated as liability, then preference dividend will be treated as borrowing cost. If preference share capital is treated as a shareholder fund, then preference dividend will become owned cost and accounting standard number 16 is not applicable. Respond everybody clear. Okay, now very important, listen carefully. Borrowing cost includes, number 1, it includes interest. Number 2, it includes commitment charges. Bankers will take commitment charges on unreleased portion of loan. Say for example, banker had given a guarantee that he will give you a loan of 10 lakhs. But it had given initially only 6 lakhs. 4 lakhs it did not release yet. How much is released? On 6 lakhs, banker will charge some portion which is called as interest. Even on this 4 lakhs also banker will charge some expense which is called as commitment charge. So, borrowing cost includes both interest, commitment charges. It also includes discount on issue of debentures, loss on issue of debentures, very important. Cost which are relating to acquisition of borrowings but not relating to settlement of borrowings. Cost relating to acquisition of borrowings but not relating to, say for example, loan amount credited in your bank account is 4,92,000. Another 8,000 is deducted toward insurance and commission. Is it clear? Loan amount credited is? Please respond. Loan amount credited is 4,92,000. Another 8,000 is deducted towards insurance and commission. Respond everybody clear. Straight question. How much you have to repay? You have to repay 5 lakhs. This total is called as borrowing. But did you receive this 8,000 or you did not receive? This Chapali. So listen very carefully. Cash or bank account debtor 4,92,000. But to loan account is 5 lakhs. Then what about remaining 8,000, sir? Insurance and commission which are relating to borrowings, relating to acquisition of borrowing, relating to settlement of borrowing. And hence, this 8,000 will be transferred to P&L account kadandi. Tell me the journal entry. P&L account debtor to insurance and commission to the extent of 8,000. Now the next question. Where do this 8,000 be presented? In P&L account, under which head this will be presented? No, borrowing cost. In this context, insurance and commission should not be kept under other expenses. It must be under borrowing cost. Why, sir? Because this is a cost relating to acquisition of borrowings. Respond everybody, logic understood. Now the next question. Prepayment penalty. Prepayment penalty. Is it a borrowing cost or not a borrowing cost? It's not a borrowing cost. Why it's not a borrowing cost? Because that is relating to settlement of borrowing. Borrowing cost includes only those costs which are relating to acquisition of borrowing but not relating to settlement of borrowing. Respond everybody understood. And the next two things, as per accounting standard number 19, if it is a finance lease, you are having something called principal plus interest. Did you remember? So in that interest portion is there kada. For that interest portion, accounting standard number 16 is applicable. And some portion of foreign exchange difference which is dealt as per accounting standard number 11 should also be dealt as per AS 16 but not as per AS 11. Some portion of foreign exchange difference which is arising as per AS 11 that has to be dealt as per AS 16. Respond, everybody understood? So tell me, borrowing cost includes interest, commitment charges, discount on issue of debentures, loss on issue of debentures, cost relating to acquisition of borrowings but not relating to settlement of borrowings. Prepayment penalty is not a borrowing cost because it is relating to settlement of borrowing. Respond, everybody, clear? And next one, qualifying asset. It's the biggest judgmental decision. Generally, qualifying asset is an asset which takes substantial period of time either for usage or for sale. Usage is applicable for fixed assets. Sale concept is applicable for inventory. Am I correct or wrong? You have started constructing an asset. Check out whether will it take substantial period of time. Yes, sir. Then it's a qualifying asset. If it's not taking a substantial period of time, it's not a qualifying asset. Say for example, you're manufacturing goods. Check out whether will it take substantial period of time. Yes, then it's a qualifying asset. Otherwise, it's not a qualifying asset. Respond, everybody. What's a qualifying asset, my dear children? An asset which takes a substantial period of time, either for usage or for sale. Either for usage or for sale. Clear, everybody? We'll call that asset as dash asset, Nana. Qualifying asset. We'll call that asset as qualifying asset. Respond, everybody, clear? Okay. Next, very important. Generally, substantial period of time is 12 months. Exception, it can be more than 12 months or less than 12 months. So decided by the management. And the factors are technological considerations, commercial considerations, and marketing considerations. Depending on the technology aspects, commercial aspects, marketing aspects, management can take the decision whether more or less than 12 months is a substantial period of time or not. Generally, more than 12 months, absolutely substantial period of time. Exactly equal to 12 months, substantial period of time. But the problem is all with less than 12 months only. How to crack it, I'll tell you while doing the problematics. Respond, everybody. Shall I proceed? Now, the next one. How to recognize the borrowing cost, sir? Very, very simple. Check out if the borrowing cost is used for qualifying asset other than qualifying asset. If it is used for other than qualifying asset, no doubt at all, it can be straight away charged to P&L account. If the borrowing cost is used for qualifying asset, then you have to follow the principles of accounting standard number 16. If the principles of accounting standard number 16 is satisfied, it has to be capitalized. Otherwise, it has to be charged. Okay, respond, clear? Check out borrowing cost. You have to check out whether is it used for qualifying asset or other than qualifying asset. If it is used for other than qualifying asset, straight away it has to be charged. But if it is used for qualifying asset, then follow the principles as per accounting standard number 16. If satisfied, then capitalize. If did not satisfy, then charge. Respond, everybody, clear? Respond. Now, the first part as simple as such, commencement. Already I told you. There should be a borrowing, there should be a borrowing cost, there should be a qualifying asset, and qualifying asset activities must be work in progress. Clear, everybody? That qualifying asset activities must be work in progress can be either physical activities or even administration and technical activities. It can be either. Please respond. It can be either physical activities or it can be either administration and technical activities. And last and final, one more condition, qualifying asset expenditure must be spent. Because, listen very carefully, sir, you have taken a borrowing. There is borrowing cost of rupees 10,000 interest. There is a qualifying asset. You have started planning how to construct the qualifying asset. And a qualifying asset activities are work in progress. Am I correct or wrong? Now answer me, does this to be capitalized or charged? Please respond, sir. Is it to be capitalized or charged? Obviously this has to be capitalized. But to what it has to be capitalized? This has to be capitalized. In the sense it has to be added to cost of asset. But till now you did not incur any cost on etc. Did you understand the logic? You're telling that it has to be added to the cost of asset. But what I am telling you is that still asset cost is not incurred. Then how can you add it up to the asset? Possible or not possible? And hence one more condition is there, that is qualifying asset expenditure must be spent. I mean to tell, initial expenditure on qualifying asset must be incurred. Say for example, qualifying asset cost incurred is 1 lakh. For that you can add borrowing cost 10,000. But I'm telling you, qualifying asset cost price is not incurred. Then how can you add interest to that qualifying asset, sir? Respond, is the logic understood? So commencement of capitalization. Tell me, the capitalization should commence only when there is a borrowing. Only when there is a borrowing cost. Only when there is a qualifying asset. Only when the activities of qualifying asset are in work in progress. It can be either physical activities or it can be either administration activities. And last but not least, qualifying asset expenditure must be incurred. Respond, everybody, clear? Only when all these conditions are satisfied, you have to capitalize. Otherwise, you have to charge to P&L account. Respond, everybody, clear? Now, the next one. Sir, qualifying asset construction is completed. Qualifying asset construction is completed. Now what to do? Borrowing cost has to be charged or capitalized? Charged. Sir, why, sir? Borrowing cost has to be capitalized only when the qualifying asset activities are work in progress. Now qualifying asset construction completed. If construction is completed, how can you capitalize? So since construction is completed, never the activities of qualifying asset will be work in progress, and hence borrowing cost on completed qualifying asset have to be charged to P&L account. Respond, everybody, clear? Which is called as cessation of capitalization. Cessation is nothing but suspension. Chichi, stoppage. I'm sorry. Cessation is nothing but stoppage. Shall I proceed further? Sir, if at all qualifying asset is completed in parts, and such completed part is ready to use, then proportionately to such completed portion of qualifying asset, you have to charge. And the remaining portion, which is still work in progress, has to be continue capitalization. Respond, everybody, clear? Say for example, 4 floors of the building, 1 floor is absolutely completed and it is ready to use. Clear? Now, what is the treatment of borrowing cost for these 4 floors? To the extent of 1/4, it has to be charged. For the extent of 3/4, it has to be capitalized. Respond, everybody, understood? Say for example, process A is completed. Process B and process C are still work in progress. You can start the entire operation only when all the processes are completed. Now answer me. Is the borrowing cost to be capitalized or charged? Capitalized or charged? Because the asset is not yet ready to use. Even though process A is ready to use, it is connected on process B and process C, which is called as commercial production is not yet started. What is not yet started? Commercial production is not yet started, and hence you are not supposed to charge. It has to be capitalized. Even though process A is completed, it's ready to use, it cannot be used independently. It has to be used only along with process B and process C. Respond, everybody understood? Okay, that's all about cessation of capitalization. Tell me, cessation is nothing but stoppage. You have to stop capitalization when qualifying asset is ready to use, not the actual usage. When the qualifying asset is ready to use. If the qualifying asset is completed in parts, then you have to check out whether the completed part is ready to use or not. If at all the completed part is ready to use, then to such proportion it has to be charged. Clear? For the proportion which is not ready to use, it has to continue for capitalization. Respond, everybody. Clear? That's all about cessation of capitalization. Shall I proceed further? And the next one is suspension. Suspension is nothing but temporary cessation. Listen very, very carefully. Sir, if at all qualifying asset activities are suspended, if at all qualifying asset activities are suspended, then it's very, very simple. For the suspended period, you have to stop capitalization. Clear, everybody? For the suspended period, stop capitalization, and in such period you can charge to P&L account. If the suspension is for an extended period, say for example, work is suspended for 1 day. Out of 365 days, work is suspended for 1 day. Is it needed to separate 364 days has to be capitalized, 1 day has to be charged? No, because 1 day out of 365 will become immaterial. A response, sir. And hence, if at all qualifying asset activities are suspended for an extended period, for such a suspended period, stop capitalizing and charge or transfer to P&L account. Respond, everybody. Clear? Very important. Exception. If that suspension of work is a part of process of production, or this suspension is very much important for further production process or further construction process, in such a case it has to be capitalized. Respond, everybody. Clear? You have to check out why are you suspending. Are you suspending the work as a part of process of production? Are you suspending the work since it is very much needed for further production and activities? Yes, sir. Yes. In such a case, it has to be capitalized. But if at all, the suspension is not at all relating to process of production, suspension is not at all needed for further production, then immediately it has to be charged. Respond, everybody. Clear? Best example, at the time of constructing the building, after slab, minimum 15 days work will be upheld. After constructing the slab, minimum 15 days work will be upheld. So answer, my dear children, for this 15 days, what to do? Capitalize the charge. Capitalize the charge. Absolutely, it has to be capitalized, because that 15 days stoppage of work is very much important for further construction, or it is a part of production process. Respond, everybody. Clear? Say for example, you have wine. Okay, wine. Even you have to store the wine. Am I correct or wrong? So that storage of wine is very important to get future economic benefit for that wine. And hence, even though no activities are under work in progress, that storage part is very much important for further manufacturing, production, etc. And hence, it has to be capitalized. Stored. Great. Listen carefully. One more thing. Say for example, you are doing scientific research in germination of hybrid seeds. In germination of hybrid seed, you have chosen the seed, you have created that environment, but for the process of germination, it might take 3 to 6 months. for which you can't do any work. It must be upheld. What to do now? Capitalize, because it will, your activities will be started only once the seed is germinated. Today, if you provide the environment and tomorrow germinate and it will not germinate. Respond everybody clear, huh? And hence this 3 to 6 months work stoppage is very much needed for further production or manufacturing process. Respond everybody clear. Say for example, COVID. Work is upheld during COVID-19. Answer. Charge, because during COVID-19 work has to be stopped. That is very much important for further construction process. Ni bomba. That is not at all important for further construction process. That is important for your life, but not for production. And hence you have stopped. In such a case, since it is not at all connected to asset, this has to be charged. Strike period. Charge. Clear everybody? You have started the construction process, but heavy cyclone is there. Respond everybody. Of course, charge. Clear everybody? Sir, respond, is the logic understood? But take care. In this case of heavy cyclone, it actually has to be capitalized. It's not to be charged. You might ask me, sir, during heavy cyclone, it is not at all related to asset kada. It is the life of the worker kada, and hence you are suspending. That has to be charged kada. You may ask me in that situation. But remember, during COVID-19, if you have actively participated in manufacturing work, there will be no problem to that asset. That asset will work for 100% sure, but worker will not work for 100%. Hey, is the logic understood? Even though during the period of COVID-19, if all the workers are coming actively and participating in the construction activity, there is nothing happen to the building. It will happily work. But who cannot happily work? Worker. But during cyclone, all the workers are coming and actively participating, and they are constructing the building during heavy cyclone. They have constructed. Tomorrow, there is no building. I hope you have got the clarity. So, please take more care. During heavy cyclone, if you did not stop the work, it will affect the asset. Clear? In the same way, something like in the way of construction of a bridge. Due to high water levels, work is upheld around for 3 months. In this case, it has to be capitalized. It is not only dangerous to the worker, it is also dangerous to the construction activity. And hence it is very much important to stop the work for further construction. Respond everybody clear? Strike. Absolutely no problem to the asset. Heavy cyclone, what is this called? High water levels, hill slides are falling down, construction of road on the hill. Due to heavy cyclone, hill slides are falling down. Automatically, whatever the road you have constructed will get damaged again. So, stoppage of work is very much important for further construction. I hope the concept is absolutely clear for you. You have to check out during that suspended activity, during that suspension period, can you construct the asset or not? If yes, but suspended, then that has to be charged. You can't construct and hence suspended. That has to be capitalized. During COVID-19, you can happily participate and hence it has to be charged. But you are not participating. Logic understood? During COVID-19, workers can actively participate in the construction activity. There will be no problem to the construction. But due to government orders, you have stopped the work. And hence there is nothing relating to the asset here, and hence this has to be charged. But due to heavy cyclone for 1 week, if you are indulging into construction activity, your construction activity might get damaged. And hence in this case you should not do the work. Stoppage of construction activity is very much important for further construction. And hence in this case it has to be capitalized. Respond everybody clear? So just you have to check out why the work is suspended. Is it suspended for further production, or is it a part of production? In this case, it has to be capitalized. If at all it is not at all related to the asset, not at all relating to the production process, then it has to be charged. Respond, everybody understood? Now, strike done by the labor for 1 day. What to do? You can capitalize. Because 1 day is highlighting here. Already I told you. And again you told you charge. So out of 365 days, if workers are not doing the work for 1 day, there is nothing major loss. Moreover, that 1 day's work can be covered by working 1 hour extra on every day. Hey, respond, is the logic understood? Since 1 day is not an extended period, no need to charge. It can be continued capitalization. Respond, everybody understood? That's all about commencement of capitalization, cessation of capitalization, suspension of capitalization. Now moving on to the next thing, how much borrowing cost has to be capitalized or how much borrowing cost has to be charged. First of all, you find the borrowing cost minus income generated from temporary investments. Say for example, you took a loan of 20 lakhs, but you are actually using 10 lakhs. How much is still idle? So you have invested this 10 lakh somewhere else and you got an interest of 10%, which is nothing but 1 lakh. So from the borrowing cost, you deduct this 1 lakh and you will be getting net borrowing cost. This net borrowing cost has to be added to the qualifying asset. Respond, everybody understood? Take care, my dear children. Qualifying asset has to be recorded at cost price. Add net borrowing cost. Net borrowing cost is nothing but total borrowing cost minus income from temporary investments. Add that portion so that you will be getting the total cost price. Respond, everybody understood? Now very, very important. Compare this total cost price with recoverable amount if my qualifying asset is fixed asset. If my qualifying asset is fixed asset, you have to compare the total cost price with recoverable amount. Clear, everybody? And check out if there is any impairment of loss, immediately transfer it to P&L account. If at all my qualifying asset is inventory, then this cost price has to be compared with NRV and you have to value it at cost or NRV, whichever is lower, and hence the difference will be transferred to P&L account. Respond, everybody clear? This is nothing but the quantum of borrowing cost. I mean to tell the total. Check out here. Actual borrowing cost minus incidental income, you will be getting the net borrowing cost. Capitalize if it is a qualifying asset. Charge if it is not a qualifying asset. Respond, everybody, done? Okay, next. Very important part, rates of borrowing cost. Likewise, you might have general borrowings, specific borrowings. Specific borrowings, very, very simple. He will be giving in the question. And you take the rate, whatever is there. Coming to general borrowings, general borrowing, you have to do weighted average rate of borrowings. Which borrowings you have to do, Nana? Weighted average rate of borrowings. And my dear children, weighted average rate of borrowings is nothing but total borrowing cost. My dear children, please be careful. It's not total interest. Total borrowing cost. Clear, everybody? Total borrowing cost divided by total borrowings multiplied by 100. Respond, everybody clear? Let me give you an example. Say for example, I have already given you one loan amount credited is equal to 4,92,000 amount deducted towards commission and insurance is equal to 8,000. Interest on such loan is equal to 10%. This is first one. And second one, 6 lakhs loan taken for working capital at the rate 12%. And last and final, 3 lakhs general loan. Sorry, bank overdraft. This is general loan. Now 3 lakhs bank overdraft at the rate 6%. Clear, everybody? Sir, is it understood? This is taken on 1/7/2013. As usual, your year ending is 31/3/2014. Find the weighted average rate of borrowings. Adenti, if you stare like that, you won't get it. Rate. 9.67. Okay. But all you people are getting ready for examination. What if these kind of questions were being in your examination? It's a compulsory question, but you will take choice. Great. Listen, sir, in situation number 1, loan amount credited is 4,92,000 and amount deducted towards commission and insurance is 8,000, which implies that your total loan amount is 5 lakhs. Already I told you that by writing the entry I showed you also. So what is the loan amount in this context, Nana? So 5 lakhs into 10% is not yet over, plus another 8,000 should be taken. What is the reason, sir? Sir, what is your loan amount? Please respond. What's your loan amount? On 5 lakhs, you have to pay 10% interest. Am I correct or wrong? So 5 lakhs into 10% is 50,000 is your borrowing cost. Along with that, this 8,000 is the additional expenses incurred at the time of acquisition of borrowings. And hence, even this 8,000 is also borrowing cost, which has to be added. Respond, is the logic clear? First out. Next, 6 lakhs at 12%. This is bacha. Plus 3 lakhs into 6% into 9/12. Respond, everybody, clear? Whole divided by, let me tell you the loans now. Originally it is 5 lakhs. Originally it is 6 lakhs plus 3 lakhs into 9/12. Because you have taken this loan only on 1/7. And the interest is also computed only for 9 months. Then how can you take entire 3 lakhs? That's wrong. It should be only 3 lakhs into 9/12. So respond, is it clear? And hence the numerator total comes to 500 whole divided by 13,25,000 multiplied by 100. 10.83%, which is a perfect answer. How many of you have got it? Okay. Done. Anyways, my dear children, take care. That is the total complication, sir. To the max extent, whatever the complications that are there in AS 16, especially for examination part, I have prepared to tell all such kind of things. And I have delivered the first part in that. So general borrowings. So this is how to compute weighted average rate of borrowings. Tell me how to compute weighted average rate of borrowings, my dear children. Total borrowing cost divided by total borrowings multiplied by 100. If you want me to tell more clearly, total borrowing cost divided by total average borrowings multiplied by 100. Average borrowings is nothing but 3 lakhs into 9/12. Respond, everybody, clear? This is weighted average rate of borrowings. For dash borrowings, Nana? General borrowings. Respond, shall I proceed further? And nothing great to speak about specific borrowings. That's it. And that is actually ending point for your accounting standard number 16. Such a smallest standard, but as I said you, institute is always picking the complicated questions, especially in the area of specific borrowings and general borrowings. And sir, if at all institute has decided to ask an easy question from accounting standard number 16, then this could be the model. He'll be giving you multiple assets. You have to categorize what is a qualifying asset and what is a not a qualifying asset. So tell me, my dear children, construction of sea link, which is nothing but bridge. Chappali. Work was upheld due to high water levels. Capitalize, because it is very much important to stop the work during that 1 month period. Purchase of equipment and machinery, not a qualifying asset. Working capital, not a qualifying asset. Purchase of vehicles, not a qualifying asset. Advance for tools and cranes, not a qualifying asset. Technical know-how, not a qualifying asset. But take care, in one of the questions given by institute material, advance for truck is taken as if it is a qualifying asset. Clear? So that is basing on your assumption. Generally, you can take all the advances as if it is not a qualifying asset, but basing on your assumption, you can modify, because one of the questions institute material had considered that advance given for truck or crane, it will be given and it will be treated as if it is a qualifying asset. Take care. Shall I proceed further? Now the total borrowing cost, interest charged by the bank is 80 lakhs for 32 crores. Before solving all these questions, first of all check out whether the total amount is 32 crores or not. Of course, here it is 32 crores only. No need to check now. Check for all such kind of questions in the examination, whether the total loan is matching with the application or not. If it is more than the total loan, no problem. But if it is less than the loan, then it is a problem. I mean to tell, your loan taken is 32 crores, but you have utilized this loan for all these assets and the total of these assets comes to 40 crores. Sir, is the logic understood? How much loan taken? Please respond. How much loan taken? 32 crores. But you have utilized for all the assets which are totaling to 40 crores. In such a case, it's a biggest question mark. Of course, how to do? I'll speak later. You'll have one of the questions. Yes, simple. It has to be proportionated in proportion to the expenses spent. Anyways, let's come back. First of all, check out the expenditure, whether it is matched or not. And total 80 lakhs has to be proportioned. Total 80 lakhs has to be proportioned in proportionate to the expenses spent. I mean to tell, 80 lakhs into 25 crores divided by 32 crores. 80 lakhs into 3 crores divided by 32 crores. 80 lakhs into 2 crores divided by 32 crores. Like that, in the ratio of 25 is to 3 is to 2 is to 0.5 is to 0.5 is to 1. Respond everybody, clear? So, such portion of ceiling has to be capitalized and all the remaining has to be charged. And you just need to work out the same in proportionate. 25 by 32, 3 by 32, 0.5, 0.5, 1 and 2 by 32. Respond everybody, understood? Okay, my dear children, let me move on to the next thing. Sir, these are the favorite problems of accounting standard number 16, which are actually typical. So it is supposed to recommend, it is recommended to listen carefully. And let me tell you a small shortcut for solving all these kind of problems. First of all, would like to clarify one thing. If it is specific borrowings, irrespective of usage, you have to pay the interest. Am I correct or wrong? Sir, respond, sir. Even if it is general borrowings also, irrespective of the usage, you have to pay the interest. But specific borrowing is used for a particular fixed asset. General borrowing is used for all the assets. It can be used for fixed asset, it can be used for qualifying asset, it can be used for some other assets also. Respond clear, and hence rule is that for specific borrowings, whatever the total interest, total borrowing cost for qualifying assets work in progress period has to be capitalized irrespective of time period. Is the logic clear? I'll tell you, wait. Say for example, you borrowed 10 lakhs on April 1st at the rate 10%. You have utilized 4 lakhs on May and you have utilized, I mean to tell 2 lakhs on June and you have utilized remaining 4 lakhs on December. Clear everybody? Now tell me, what is the interest portion that has to be capitalized? Answer, interest to be capitalized is equal to, straight away 10 lakhs into 10% is 1 lakh, irrespective of the utilizations. You just ignore the period of utilizations and just straight away in a simplest way check out the total qualifying asset period and capitalize the same. Respond everybody, clear? Say for example it was given like this, 10 lakhs borrowed at the rate 10% for construction of an asset. This asset construction lasted up to 11 months. This asset construction lasted up to 11 months. Utilizations are as follows. Utilizations, same 4 lakh in May, say 6 lakhs in December. Clear everybody? Now tell me how much is the interest that is to be capitalized. Interest that is to be capitalized. అదేంటి చెప్పండి. 21,000, 91,000. Okay, how did you get that? 10 lakhs into 10% into 11/12 should be considered, because you have to capitalize only for such period where the qualifying asset activities are work in progress. Respond everybody, clear? These are the 2 examples for dash borrowings, Nana. Cheppali for dash borrowings, specific borrowings. If at all, this is general borrowings. General borrowings. Sir, general borrowings is such a kind of nature, can be used for qualifying asset, cannot be used for qualifying asset. Here, how much general borrowings were picked? 4 lakhs on May, which implies that for April, this amount might be utilized for some other purpose. Logic understood? For April, this amount might be utilized for some other purpose. So for general borrowings, you have to take the proportionate part. So 4 lakhs into weighted average rate of borrowings multiplied by 11/12. Respond understood? Next 2 lakhs on June. So 2 lakhs into weighted average rate of borrowings multiplied by 10/12. 4 lakhs into weighted average rate of borrowings multiplied by 4/12. Respond everybody, clear? So for dash borrowings, you have to take proportionately. Please respond. For dash borrowings, you have to take proportionately. General borrowings. For dash borrowings, you should not take proportionately. Specific borrowings. Respond everybody, understood? So this is the first rule that you have to feed in your brain. My dear children, for dash borrowings, you have to take total interest. Specific. For dash borrowings, you should have to compute proportionately. General. Is the rule clear to each and everyone? So now check out the questions. Check out. There's a company which had started a construction on 1st April 2017. It obtained 2 lakhs especially for construction of the factory building at 8% per annum on 1st April 2017. Ante 2 lakhs at the rate 8%. What is this loan, Nana? Cheppali, is it specific or general? Specific. And further expenditure is given like this: 4 lakhs, 5 lakhs, 3 lakhs is the outstanding non-specific loans at 9%, 12%, 14%. So these 3 are dash loans, Nana. General borrowings. Respond clear? Okay, first of all, find the interest rates. What are the interest rates, Nana? Specific interest rate is equal to 8%. You have to find weighted average rate of borrowings. Weighted average rate of borrowings is equal to total borrowing cost divided by total borrowings, total average borrowings multiplied by 100. What is the total borrowings? Check out. 4 lakhs into 9% plus 5 lakhs into 12% plus 3 lakhs into 14% divided by 4 lakh plus 5 lakhs plus 3 lakhs. Entama? So weighted average rate is equal to 11.5%. Respond everybody clear. Now check out expenditure spent. Expenditure spent. Check out, I'm just taking it as it is. 1st April, May, August and December. 1st April, 31st May. Yes, 31st May, 1st August, 31st December. If nothing is mentioned, year ending will be 31/3. And if nothing is mentioned, construction lasted for whole of the year. Respond everybody clear. Check out the amount spent. What is the amount spent, Nana? 3 lakhs, 2.4 lakh, 4 lakhs, 3.6 lakh. Respond everybody clear. Now, the simplest thing is here. Please listen very, very carefully. Simply follow FIFO method. Which method? What is FIFO method? First in, first out. You use your high common sense and tell me specific loan is there, general loan is there. What will you use first? It's common sense. Everybody will be using specific borrowings only. Clear. How much is the specific borrowings given in the question? 2 lakhs. So I'm just making it into two parts. One is 2 lakhs specific and this 1 lakh is nothing but general. And of course all the remaining these three things will become general. So 2 lakhs into 8% into 12 by 12. I asked you to take total period. Why did you take total period? Since it is from April to March. No, because this is specific borrowings, irrespective of utilizations, you have to take for the total period. Respond clear. Now start. General borrowings, 1 lakh into, yes, 11.5% into 12 by 12, since from April to March. Next, 2,40,000 into 11.5% weighted average rate of borrowings into 31.5 to 31.3 Nana. 10 by 12. Next 4 lakhs into 11.5% into 1.8 to 31.3. 8 months. 8 by 12. Last and final 3,16,000 into 11.5% into 3 by 12. Is it clear? Tell me the total amounts, Nana. Total, 5. That's it. There ends the matter. Check out. Finally, it's 91,517. Respond everybody clear. And I hope this method is very easy for you. Instead of computing weighted average rate of borrowings, you also have to compute like this. You can compute like this. This is one of the methodology which is given in your suggested answers. In suggested answers, he had given in 2 ways. Version 1 is computing weighted average rate of borrowings. Version 2 is computing directly. I feel computing directly is absolutely easy, just with 2 rules. Rule number 1, specific borrowings, you have to take the total period irrespective of usage. For general borrowings, you have to take proportionately. Respond everybody clear. And that's it, my dear children. You will be getting the total amount which has to be capitalized. And find the total interest. The total interest minus capitalized portion is nothing but charge. Respond understood. Next. Let me proceed to the next question. Check out. This is a very different and important question. Again, sir, this question is there in your institute material. Only this question is there. At that time, this question was tested in the exam. In the immediate next attempt, this model is tested. Different model. What is that? Check out. A company took a loan for construction of building 25 lakhs. If you observe, building total cost is 70 lakhs. What is the building total cost? Of which 25 lakhs is specific. Balance how much is there? 45 lakhs. It is nothing but general. But take care what happened. General loans are here. 15 lakhs, 30 lakhs and 18 lakhs. So total comes to 63 lakhs. But how much general borrowings needed for you for building? 45 lakhs. And in the question, he did not give specific loans for all these three things, which implies that for all these three things, general borrowings are utilized. Check out the total. 22 plus 90 plus 43 plus 45. So, total general borrowings needed are 200 lakhs. But how much general borrowings given in the question? 63 lakhs. So, you are utilizing 63 lakhs for this 200 lakhs of assets. Now, what to do, sir? Very, very simple. Yes, this 63 lakhs has to be proportionately distributed for all these assets. In the sense, check out. Building. Specific how much, Nana? 25 lakhs. General how much needed, Amma? 45 lakhs. And the other assets are furniture, plant and machinery, factory, shed. Tell me, for all these things, dash borrowings are there. General is needed. How much, Nana? 22 lakhs, 19 lakhs, 90 lakhs, 43 lakhs. Respond everybody clear. So you actually need a total of 200 lakhs, but you are having only 63 lakhs, and hence this 63 lakhs has to be apportioned to building is to furniture is to plant and machinery is to factory shed in proportion to the general amounts. That is 45 lakhs is to 22 lakhs is to 90 lakhs is to 43 lakhs. Respond everybody clear. You will be getting something like 63 into 45 by 200 lakhs. Entamma? Let me take it as 14 lakhs now. For, just for the point of telling you. And next one, 63 lakhs into 22 by 200 lakhs. Say for example, it's 7 lakhs. Clear everybody? Like that you will be getting here also. Listen, on this 25 lakhs, there is a specific interest rate. That is 25 lakhs into 12%, which has to be capitalized to building. Next, 14 lakhs into, find the weighted average rate of borrowings. Find the weighted average rate of borrowings for these three loans. So, 14 lakhs into weighted average rate of borrowings has to be capitalized to building. 7 lakhs into weighted average rate of borrowings has to be capitalized to furniture. 63 lakhs into 90 divided by 200. 28 lakhs multiplied by weighted average rate of borrowings has to be capitalized to plant and machinery, and follow the same procedure for factory shed also. Respond everybody understood. So this is another model which is given directly in your examination. What is this model, Amma? Borrowings are sufficient or insufficient? Insufficient for the construction of total assets, and hence borrowings have to be proportioned in proportion to the amount spent. Respond everybody clear. Amount spent after deducting the specific portion. Respond everybody understood. So respond, is the concept understood? What is this model, Nana? Total borrowings are sufficient or insufficient? But you have to utilize the total borrowings for all the assets. And hence it has to be apportioned in proportion to the general amounts other than the specific portion. Respond everybody clear. Okay. And this is another question. Yeah. If you observe, there is a specific loan. 20 lakhs and the rate of interest is 10%, and non-specific loan 46 lakhs directly given 12%. Directly given, no need to compute. Weighted average rate of borrowings. What else is being given? Simply is asking how much amount to be capitalized. Simple. Shall we start now? My dear children, which method is used? FIFO method. My dear children, which method is used? Whenever there are specific borrowings, first of all you have to use specific borrowings. Tell me initially, what are your specific borrowings, Nana? 20 lakhs. Check out this 10 lakhs multiplied by Please respond, Amma. 10% into 12 by 12. Hey, is it clear? Very, very important. Out of 20 lakhs, you have utilized only 10 lakhs. Still balance, how much specific is there? So make this 24 lakhs into two parts. One is 10 lakhs and the other is 14 lakhs. For this 10 lakhs, dash borrowings are utilized and hence specific, and hence 10 lakhs into 10% into 1st August to 31st March. No, that's wrong, because this is specific borrowings you have to take for the entire period. Respond clear, whereas 14 lakhs into general 12% into 1st August to 31st March, 8 by 12. Is it understood? And finally 4 lakhs into 12% into 3 by 12. So how much is that, Nana? 3,24,000. Specific? No, that's wrong. Sir, whatever you have done is absolutely correct as per your institute material. Because I have gone through many problems yesterday just to teach you this model. So whatever you have done is absolutely correct. No doubt at all in that. If I was not wrong, this is one of the assignment problems. What is the source given there? How much answer you have got? 3,24,000, which is absolutely correct answer. Sir, please listen. There are two methodologies actually provided by your institute material. In one style they are doing in one way, in another style they are doing in one way, in one place they are doing in one style, and at another place they are doing in another style. But yesterday, I mean to tell, before telling these options, I have gone through many elements of these kind of problems, and I'm telling you the conclusion part. Whatever that I'm telling you now is absolutely correct. Just you follow this methodology, it will become very simple for you. Even I hope you have got this in a very simplest way. So the answer is 3,24,000. It's 2,84,000 as per the different style of computation, but 3,24,000 as per your institute material is absolutely correct. Respond, everybody, clear? Okay, now moving on to the next problem. Yes, I do understand. Go for break and come back. I'll be starting by 11:03 and still not yet over. For another 10 minutes, I have to deal with the old problems here. This is your recent examination problem. I'll deal with the recent examination problem and I will deal with September 24 RTP problem. And then finally AS 16 will get completed after telling the foreign exchange difference, which is to be dealt as per accounting standard number 16. Another problem. Again, this is given in the examination. So hope you're experiencing what kind of different problems are giving in the examination. Institute material is having one problem and different styles were being given. Frankly speaking, for all these things, no way connected to accounting standard number 16. It's all something like a mathematical approach, that's it. Anyways, on 1st April 2023, a company started construction of a building and the building is the qualifying asset. For the purpose of construction, company raised a specific loan 14 lakhs at an interest rate of 12% per annum. An interest income of 15,000 was earned on the loan while it is held in anticipation of payments. Already we have discussed what is the actual meaning for anticipation of payments. Anticipation of payments is nothing but whenever surplus amount of loan is available, we will invest and we will get that income. Anyways, so now 14 lakhs at the rate 12% per annum. Say initially you are using only, see here, if you observe, initially he is using only 4 lakhs. So out of 14 lakhs, since 4 lakhs is used, how much is still idle? 10 lakhs. And hence 10 lakhs is invested. And hence he had got an investment amount of 15,000 as interest. Okay, is it clear? This is nothing but the word called anticipation of payment. As and when needed, the amount of loan will be utilized for loan. for the period for which loan is not needed, I will invest and I will get some interest amount. Respond everybody clear. So specific loan is 14 lakhs at the rate 12% per annum, remember. Next, outstanding general loans are given 20 lakhs and 30 lakhs at the rate 15 and 8% respectively. So immediately find weighted average rate of borrowings, my dear children. 20 lakhs into 15% plus 30 lakhs into 8% is whole divided by 20 lakhs plus 30 lakhs. 10.8%. 10.8% is the average rate of borrowings. And the next one, construction started on 1st April 2023 and it was completed on 31st January 2024. My dear children, in all the previous problem, construction period is entire 12 months. But in this problem, the construction is only for 10 months but not the 12 months. Shall I continue? Again same, let me start. Sir, what is the initial amount you are having, Nana? 4 lakhs. First you have to use which loan, Nana? Specific loan. How much is the specific loan given? 14 lakhs. Am I correct or wrong? So out of which use this 4 lakhs into 12% multiplied by, yes, normally you have to do 12 by 12, but here the construction period is only up to 31st January. You are having only 10 months. So multiplied by 10 by 12. How much? Next, 10 lakhs. Even this 10 lakhs can also be funded from specific loan. Multiplied by 12% is multiplied by 10 by 12. My dear children, irrespective of the period, irrespective of the actual period, for the whole period for qualifying asset activities or work in progress, that total period has to be considered. Even though I was started this 10 lakhs on 1st August, this is a specific loan. So you have to consider right from the beginning of the qualifying asset date. What is the date of beginning of the qualifying asset date? 1st April. So you have to consider right from 1st April. Respond everybody clear. And hence into 10 by 12. 1 lakh. 40. So now, my dear children, this company had earned 15,000 interest kada. This 15,000 interest is held only from this 14 lakhs. So the total interest is 1,40,000 minus 15,000, which comes to, respond everybody clear. And next one, these two things are funded from general borrowings. My dear children, total general borrowings are 50 lakhs. What is the total general borrowings, Amma? 50 lakhs. And here the general borrowings utilized were only 30 lakhs. So absolutely no problem. So 25 lakhs multiplied by weighted average rate of borrowings, which are 10.8%, multiplied by 1st December to 31st January. 2 months divided by 12. So divided by 12 is because of this rate is taken for 12 months, Nana. Anyways, which comes to, that's it. And last 5 lakhs into 10.8% into 0 by 12, which is nothing but 0. And hence total comes to 45,000 plus 1,25,000. 1,70,000. Respond everybody clear. Even my dear children, while telling in the classroom, for the first batch, I have told it in a different style, for which you will be getting a different answer. Likewise, this is the similarity of the same. I mean, 3,24,000 we have got, right? This one, yes. This is another style. In this style, I have told you in your classroom notes, but ICAI is following only this FIFO approach and it is solving, and hence it is making the problems very easy. Respond everybody clear. I hope whatever the confusions that you are having with these kind of models were totally done away with. Hey, is it okay? Some people are having little confusions with these models, and I hope these were absolutely done away. Simply follow FIFO method. If it is like specific borrowing, take the total period. If it is general borrowing, take only the proportionate period. Sir, let me give you one last and final model of this and I will close this model. Listen, say for example, construction started on 1st April. You have utilized 4 lakhs. Next, 1,8. You have utilized 6 lakhs. Next, 111, okay, 9 lakhs, and finally 28 to say for example 10 lakhs utilized, and the construction, yes, that's it. Construction completed on 28 to specific borrowings is equal to rupees 9 lakhs borrowed on 1/8. Yes, specific borrowings 9 lakh borrowed on 1/8 at the rate 10%. General borrowings 50 lakhs available at the rate 12%. Clear, everybody? Tell me how much interest is to be capitalized in this situation. Construction is completed on 28/2. Take care. Hey, this is another different model. You might get any of these things in the examination if the question is tested from age 16. In the meanwhile, those students who are actually watching on YouTube, you can give your answer in the comment section and then cross check with the answer. My dear children, what is the answer? 1,38,000. Okay. 1,58,000. You people are getting ready for your exam, right? Okay. Next answer. Next answer. Fine, my dear children, check out. Okay. 1,45,000, 25, 125,500, 126,500. One 2,500. Sir, shall I start now? 135,500. 145,500. Whatever this 500 is common in every answer. Sir, listen. Sir, initially only general borrowings are there. There are no specific borrowings at all. So 4 lakhs multiplied by 12% has to be taken. Next on 1/8, my dear children, specific one more thing, multiplied by 11 by 12 because construction completed on 28/2. Some of you people might have missed that. Next, sir, on 1/8 you are having a specific borrowing. So how much is the amount available here? 6 lakhs. So 6 lakhs is funded only from specific borrowing. When specific is there, remember. My dear children, is it clear? So 6 lakhs multiplied by 10% is multiplied by, you have borrowed it on 1/8. Am I correct or wrong? So 1/8 to 28 to 7 months. So into 7 by 12. Next, make it into two parts. Yes, this 9 lakhs plus 6 lakhs is utilized. Balance is 3 lakhs into 10% is into 7 by 12. Because you have taken the loan on 1/8. And finally 6 lakhs into 12% average rate of general borrowings multiplied by 111 to 28 to 4 by 12. This is the perfect answer. Respond everybody. How many of you have got that? Okay. Whatever, sir. Take more care. Just cross check with that minute level of confusion also. And say for example, the same question is given, but you have borrowed the loan actually on 1/6. Yes. Now on 1/4 this loan is not there. So it will be same. On 1/8 special loan is there. So take special loan, but not into 7 by 12. Since you have taken on 1/6, count from 1/6 till 28/2. How many months, Nana? 9/12. This will become 9/12. Respond everybody clear. And anyways, my dear children, that is the end of not A16. This model is completed. But check out. Sir, this is September 2024 RTP. Again, a different model of problem is given similar to that one. Check out. This is actually October, November, December, January, February, March. Every month is given right from October till March. If you observe, plan is there, actual is there. Always remember, my dear children, whenever both plan and actual is there, trash with the plan. Because accounting will not be considered the plan. Accounting will be considering only what have actually done. So you need to consider only actual. And if you observe, the company is having a bank interest at the rate 15% per annum, which is debited on a monthly basis. Which is debited on a, in the sense, bank is debiting the interest on monthly basis. It is an indirect hint to you that you have to continue with compound interest, but not simple interest. Compounding monthly has to be considered. Compounding monthly. That's a very new point in this problem. Take care. Company pays at 15% per annum, which is debited on a monthly basis. Sir, you might ask me, sir, if company pays that. No, company is not paying. If company pays, then banker would have told that credited the loan part. But here debited. Interest expense will be debited. Respond everybody clear, huh? And hence it's all about debited on a monthly basis, which implies that compounding monthly. Sir, what is this indicating? Compounding monthly. This is part 1. During the half year, company is having 20 lakh overdraft up to 31st December. Ante up to 31st December, 20 lakhs overdraft at the rate 15% per annum is there. Next, surplus cash in January. In cash, surplus is there. In the sense, they are using their own funds. Surplus. Surplus ante there is no bank overdraft, there is no bank loan. So business concern is using their own fund in January. In January, how much is actually spent, Nana? 50,000. This 50,000 is spent from the surplus available, which implies that there is no loan. There is no borrowing. Next, again overdraft of 14 lakhs in February. Okay. And 30 lakhs overdraft in March. In March it's 30 lakhs and in February it's 14 lakhs. Respond everybody clear. Sir, understood? Now, the company is having a strike during the December. During December there is strike. So borrowing cost has to be charged. Suspension of capitalization. But wait. And hence could not continue the work. However, administrative related work was continued. And hence suspension needed. No suspension. Sepali. Because qualifying asset activities are work in progress. No need of having physical work in progress. Even administration is also considered as work in progress. Clear everybody? Next. On-site work was commenced on 1st January. Okay. Physical work was started then. And it was completed on 31st March. Assume that expenditure incurred on first day of each month. He is telling that all the expenditure were incurred at first day of each month and asking how much interest has to be capitalized. Is the question clear? So is the question clear? So this is actually the question. So remember something like 4 lakhs is the expense on October 1st. 7,95,000. 7,95,000 nil 50,000 2 lakhs and 12 lakhs. October, November, December, January, February, March. My dear children, take care. In January, they are having surplus. Remember. Shall I proceed further? Now, check out very, very carefully. Sir, initially on October, 4 lakhs multiplied by, what is the rate of interest, Nana? given here 15 percentage. 4 lakhs multiplied by 15 percentage. Wait, multiplied by number of months by 12. Dash by 12. 1 month by 12. I told you already. Compounding on a monthly basis. So where the interest comes to? Please respond. How much, Nana? 5,000. So in November, you have to compute interest on 4 lakh 5,000 plus new expenditure added 7 lakh 95,000. So respond, is the logic clear? Huh? In November, the interest has to be computed on 4 lakh 5,000 plus new expenditure 7 lakh 95,000 multiplied by 15% multiplied by 1 by 12. Tantarana? 15,000 is the second month interest. Shall I proceed further? Now December month interest. December. Take care. 4 lakh 5,000 plus 7 lakh 95,000. Entama? 12 lakhs plus again interest 15,000 is there. So on that interest also you have to compute interest. Multiplied by 15% multiplied by 1 by 12. 15,187. Let me show you. Check out here. Something the interest check out. 5,000, 15,000, 15,188. Something like since the total expenditure is greater than 14 lakhs. Since the total expenditure is greater than 14 lakhs, you have to compute only on 14 lakhs. See here, 14 lakhs into 15% into 1 by 12, which is 17,500. And the last and final, total outstanding amount. That is 12,30,000 plus surplus funds plus interest on the total amount he is computing for again 1 by 12, which is nothing but 33,721. Respond, everybody clear? Sir, of course, since it's a marathon class, I can't cover this problem very exhaustively, but I have provided an idea to you how to compute. Depending on this idea, you just compute the same. Respond, everybody done? But what are the new points in this problem, Nana? Number 1. So please respond. Number 1. Monthly basis means it is compounding monthly. Respond, everybody clear? What is point number 2? In January, there is a surplus. Clear, everybody? Which means that no interest is to be capitalized. Absolutely, that is not needed. Respond, everybody done? And moving on to the next thing. Again from February, the expenditure is greater than 14 lakhs, which is bank overdraft. And hence you have to compute interest only on bank overdraft 14 lakhs but not on the total expenditure. Respond, everybody clear? And my dear children, that is the end of RTP problem. Still there is a last and final model with respect to AS16, that is all about foreign exchange difference. Shall I start now? So listen, this concept is applicable only when there is a foreign exchange loss. First of all, what is the concept? There is some foreign exchange difference as computed as per accounting standard number 11. There is some foreign exchange difference as computed as per accounting standard number 11. Strictly speaking, the total foreign exchange difference has to be transferred to P&L account. But A16 is interfering and it is telling that some portion of foreign exchange difference which is computed as per accounting standard number 11 has to be dealt as per accounting standard number 16. Clear, everybody? So take care. What is that situation? Sir, observe and listen very carefully. You'll understand it very simply. First of all, you have to compute borrowing cost if you have borrowed from India. First of all, you have to compute the borrowing cost if you have borrowed from India. Likewise, say for example, you have borrowed $1 lakh. At the time of borrowing, exchange rate is rupees 50. So in India, if you are borrowing, you will be borrowing rupees 50 lakhs. So respond logic clear, huh? How many dollars borrowed? So please respond, how many dollars borrowed? 1 lakh at a price of rupees 50 at a price of rupees. So if at all you are borrowing in India, then it is implying that you have borrowed rupees 50 lakhs multiplied by some rate of interest. Say the rate of interest in India is 10% and hence multiplied by 10%, which comes to how much, Nana? 5 lakhs is the borrowing cost in India. Next one, borrowing cost actual, I mean to tell, from foreign currency. Since you have actually borrowed in foreign currency, find the actual borrowing cost from foreign currency borrowings, which is nothing but, say $1 lakh, say the rate of interest is only 4%, but the exchange rate is 52. My dear children, you have to pay interest at the starting of the year, ending of the year, mid of the year. Ending of the year, what is the rate that is there? 52, and hence $1 lakh into 4% multiplied by 52, which will become rupees 2,08,000. Shall I proceed further? Now, very important, step number 3. Check out foreign exchange loss, not gain. Check out only foreign exchange loss. How much is the foreign exchange loss? $1 lakh multiplied by 52 minus 50. How much is that, Nana? 2 lakhs. Am I correct or wrong? Check out very carefully. Sir, originally if you are borrowing in India, your interest comes to 5 lakhs. Since you are borrowing from the foreign country, your interest is only 2,08,000. Respond clear, huh? In the sense, how much is the difference between these two things? 2,92,000. If at all there is a foreign exchange loss up to 2,92,000, then don't treat it as per accounting standard number 11. This has to be treated only as per accounting standard number 16. Up to 2,92,000 loss, that must not be treated as per AS 11. It has to be treated only as per AS 16. Here, how much is your loss, Nana? So this total will be treated as per AS 16. The response is the logic clear. In the sense, point number 1. This concept is applicable only when foreign exchange loss is there. This concept is applicable only when borrowing currency in Indian, borrowing currency in India is greater than borrowing currency from foreign currency borrowings. Respond, everybody understood. So tell me, what is the concept? Some portion of foreign exchange loss which is computed as per AS 11 should be dealt as per AS 16. Some portion of foreign exchange difference computed as per AS 11 will be dealt as per AS 16. What are the two rules for that? Rule number 1. Please respond. Rule number 1. Foreign exchange loss should be there. What should be there, my dear children? Foreign exchange loss should be there. If foreign exchange gain is there, this concept is not applicable. This is applicable only when there is a foreign exchange loss. And next one, borrowing cost in India is greater than borrowing cost in foreign currency borrowings. Then this difference, whatever is there, shall be dealt as per accounting standard number 16 by considering the foreign exchange loss. I mean to tell, if foreign exchange loss is 3 lakhs, the difference between borrowing currency in India and borrowing currency in foreign currency borrowing is 4 lakhs. Is it clear? Sir, what is your foreign exchange loss? What is the difference between two borrowings? 4 lakhs. So how can you treat entire 4 lakhs as per AS 16 now? There is loss only up to 3 lakhs. So this loss must be limited only up to foreign exchange loss. I mean to tell, this difference should be limited only up to foreign exchange loss. Respond, everybody clear. Even though it's clumsy, let me go with a problem. It will be more clear for you. There's no problem here. Okay, wait. I guess you're having many problems, right? CRD number 7. Just check out the data. Just check out the data. Tell me the data, Amma. How much is the loan amount? Euros? US dollar 10 lakh. Fine. Dollar 10 lakhs. At the rate 4%. What is the exchange rate as on that date? 56 as on that date. Clear, everybody? Now, borrowing currency rate from India. 10.5%. My dear children, take care. In some situations, you will be given something like LIBOR plus 2% or MIBOR plus 2%. LIBOR is nothing but London International Rate. MIBOR is nothing but Mumbai International Rate. And also LIBOR will be given in the question. Say LIBOR plus 2% and LIBOR is given at 10%. So 10 plus 2%, 12% is the rate. Sir, understood? Say for example, borrowing currency rate from India is given like LIBOR plus 2%. What is LIBOR rate is given in the question. Say it's 10%. So now the total rate will become 10 plus 2%, 12%. Respond, is it clear? Okay. And what is the exchange rate at the end of the year, Nana? 62. Shall I start now? My dear children, step number 1, you have to find the borrowing cost from India. $10 lakhs. If you borrow, it is like 56 rupees. And 560 lakhs multiplied by 10.5% since it is in India. 58 lakhs, 80,000. Next, what is the borrowing cost from foreign currency borrowings? $10 lakhs multiplied by rate of interest is 4%. You have to pay the interest at the end of the year. So you have to pay each and every dollar at rupees 62, which comes to 24 lakhs 80,000. Shall I proceed further? This is step number 1. This is step number 2. Now step number 3. This concept is applicable only when foreign exchange loss is there. If there is foreign exchange gain, no need to solve at all. Clear? Now foreign exchange loss is equal to $10 lakhs multiplied by 62 minus 56, which comes to rupees 60 lakhs. Now my dear children, out of this 60 lakhs, listen very, very carefully. If you are borrowing in India, how much it would be? 58 lakh 80,000. But what is your difference now? I mean, what is your amount now? 24 lakhs 80,000. So entire foreign exchange loss has to be made into 2 parts. Part 1, step 1 minus step 2. I mean to tell all about 58 lakhs 80,000 minus 24 lakh 80,000. 34 lakhs. Balancing figure. 26 lakhs. This 34 lakhs has to be treated as per accounting standard number 16. This 26 lakhs has to be dealt as per AS 11, which is nothing but foreign exchange difference, which has to be transferred to P&L account. Respond clear. If at all the company had adopted paragraph number 46A and paragraph number 46A conditions are satisfied, then follow accordingly. Now coming to this part, total borrowing cost as per AS 16 is equal to actual borrowing cost plus notional borrowing cost. Actual borrowing cost is 24 lakhs 80,000. This one plus extra 34 lakhs should be taken from foreign exchange loss, and hence the total comes to 58 lakhs 80,000. Respond everybody, clear? Now the next question. Say for example, the foreign exchange difference is only 20 lakhs. Is it clear? Sir, you want a difference of how much amount, Nana? 34 lakhs. But the foreign exchange loss is only 20 lakhs. So now this 20 lakhs will be treated as per AS16. No amount is left out to be dealt as per AS11. Respond everybody clear. Say for example, this borrowing cost in foreign currency is 60 lakhs. Answer. This concept is not applicable because borrowing cost in India is not greater than borrowing cost in foreign currency borrowings. Respond everybody clear. And the final verdict and final conclusion is somewhere here. Point number 1. Some portion of foreign exchange difference has to be dealt as per accounting standard number 16. This concept is applicable only when foreign exchange loss is there, and this concept is applicable only when borrowing cost in India is greater than borrowing cost in foreign currency borrowings, provided it must be limited only to foreign exchange loss. Respond everybody clear. And my dear children, this is the final part of accounting standard number 16. The next topic, accounting for reconstruction of companies or internal reconstruction, which is also called as. Now, I'm not going to deal all the basics of this concept at all because it is very, very easy. Straight away, I'm going to deal with some sort of journal entries, that's it. And please listen carefully. First of all, there is a concept called consolidation of shares. Consolidation of shares is nothing but consolidating two or more shares into a single shares. For that thing, the journal entry will be equity share capital old account debtor to equity share capital new account. Say for example, there are 1 lakh equity shares of 10 rupees each, and if you have decided to consolidate 10 shares, then the face value will become 100 and the number of shares will become 10,000. This is what called as consolidation. And coming to the next concept, that's all about share split. Share split is nothing but equity share capital old account debtor to equity share capital new account. The same journal entry. Say for example, 1 lakh into 10 shares are there. If at all they have decided to split each and every share into 2 shares, then automatically each and every share will become 5 and totally you will be having 2 lakh shares. And again the total will become 1 and the same. And moving on to the next thing. What is it called? Cancellation of some portion of share capital. Listen very, very carefully. Cancellation of some portion of share capital. Equity share capital account debtor, old face value. Say for example, 1 lakh into 10 rupees. Now we have told to all the equity shareholders that the new shares will be only 1 rupee each. So 1 lakh into 1 rupee is the new value and the remaining 1 lakh into 9 rupees will be transferred to a special account called capital reduction or reconstruction account. Respond everybody clear. And this is all about your equity shares. And coming to preference shares also, the same kind of thing is there, but extra is all about preference share capital can be converted to equity share capital. In such a case, percentage preference share capital account debtor to equity share capital account. Respond everybody clear. And sometimes these shareholders might be paid in cash also. In such a case, equity share capital or preference share capital account debtor to cash or bank account. You have to read the reconstruction style properly. Say for example, equity share capital 1 lakh into 10 rupees is there. Company promised that it will be giving cash for each and every share 2 rupees and it had told that new equity share is 1 lakh into 1 rupee and remaining 1 lakh into 7 rupees in this context will be transferred to capital reduction account. I hope it is absolutely clear. And the next one, listen very, very carefully about equity dividend. About equity dividend, if at all any dividend is declared and not yet paid, any dividend, it might be either equity or preference dividend, it is declared but not yet paid. In such a situation, this will be appearing in balance sheet as if it is other current liability. Now check out what is your stand. If your stand is to pay the dividend, declare dividend account debtor to cash or bank account. If your stand is to cancel, then declare dividend account debtor to capital reduction or reconstruction account. Respond everybody, done. And now coming to the special situation, that is preference dividend in arrears. My dear children, arrears in preference dividend is a contingent liability. Arrears in preference dividend is a contingent liability, and hence, my dear children, very, very important, you, if at all given in the question that preference dividend is settled, you can't write something like preference dividend to cash or bank. That will become wrong. Since it is a contingent liability, it is nowhere appearing in balance sheet. So if you are settling any contingent liability, then it is a very, very simple journal entry. That's all about capital reduction or reconstruction account debtor to the way of settlement. If you are paying cash, cash or bank. If you are giving equity shares, equity share capital. If you are giving preference shares, preference share capital. Respond everybody clear. Very important thing, if arrears of preference dividend is cancelled, if arrears of preference dividend is cancelled, absolutely no entry. If arrears of preference dividend is cancelled, absolutely no entry. Reason being, arrears of preference dividend is a contingent liability and it is nowhere in the books of accounts, and hence if it is cancelled, absolutely no need to write any journal entry. Respond everybody clear. So that is all about preference dividend in arrears. Now let me come with the next thing, that is all about reserves and surplus. My dear children, remember the rule. Any kind of reserve can be utilized for the purpose of scheme. Any kind of reserve can be utilized for the purpose of scheme. And hence accordingly, securities premium can be utilized for the purpose of internal reconstruction scheme. Even capital reserve can also be utilized for the purpose of internal reconstruction scheme. Understood everybody? Check out the question carefully. If at all any securities premium and capital reserve are there in the question, and if given in the adjustments that securities premium is utilized for the scheme, then you can write an entry that securities premium account debtor to capital reduction or reconstruction account. Or if at all any capital reserve is utilized for the scheme, then capital reserve account debtor to capital reduction or reconstruction account. Respond everybody, done. This is all about reserves and surplus, and the main reason behind this internal reconstruction might be due to huge losses incurred. So you will be having P&L account representing a negative figure at the end of your internal reconstruction. If nothing is given in the question, then it is recommended to write off the total loss. If nothing is given in the question, it is recommended to write off the total loss that is existing in the P&L account. But say for example, with the scheme of reconstruction, company has decided to reconstruct only 70% of the existing loss. Then you are supposed to cancel only 70% and still 30% will be continued to be shown at loss itself. Respond everybody, understood? Okay, now moving on to the liability. Check out very, very carefully. If at all any liability is cancelled, liability account debtor to reconstruction or capital reduction account. If at all any liability is settled, liability account debtor to cash or bank. If you have given equity shares, 2 equity share capital, preference shares, 2 preference share capital, debentures, 2% debentures. If issued at securities premium, then 2 securities premium. Respond everybody, clear? Of course, this is internal reconstruction. Company's position itself is not good, and hence generally there will be no securities premium. Respond everybody, clear? And coming to the asset, if any asset is upward revalued, then asset account debtor to capital reduction or reconstruction account. Downward revalued, capital reduction or reconstruction account debtor to asset account. If any asset is sold, cash or bank account debtor to asset account. Very important, this time profit or loss should not be transferred to P&L account. You have to transfer it only through capital reduction or reconstruction account. Respond everybody, clear? And check out the question. If any fictitious assets are there or miscellaneous assets are there, like heavy advertisement expenditure, preliminary expenses, training expenses, startup expenses, all these things must be immediately written off to P&L account as per S26. But under the scheme of internal reconstruction, they must be immediately written off with capital reduction or reconstruction account. Respond everybody, done. And check out the question. There might be some worthless intangible asset. Even worthless intangible assets have to be written off with capital reduction or reconstruction account debtor to intangible assets account. Sometimes you might need to settle the contingent liability. Then reconstruction account debtor to cash or bank account. You might get some contingent asset, cash or bank account debtor to reconstruction account. If at all contingent liability is cancelled, no entry. You did not get contingent asset, no entry, because contingent liabilities and contingent assets are not having any place in the balance sheet or books of accounts. Clear, everybody? Now a special case, listen very carefully. Say for example, debenture holders or liabilities were given away with assets for their clearing the dues. Hope you have got my intention. Say for example, this is one of the questions that you are having. Say percentage debentures 1 lakh and outstanding interest on debentures 2,500. If given in the question that debenture holders are settled, check out very carefully. Debentures are settled is given, then only this one. Debenture holders are settled implies for total this amount. So be very careful whether given debentures are settled, debenture holders are settled. In this point, debenture holders are settled by giving some freehold property. Book value of the freehold property is equal to 10 lakhs. Given, very important, take care, given 60,000 freehold property for rupees 90,000. And remaining debenture holders are paid in cash after reconstructing 1,000 rupees. And remaining freehold property is revalued upward by 10%. Clear, everybody, with all the adjustment, my dear children? So this is not difficult, but this kind of things will be there. You have to be very careful. First of all, check out how much is the amount you have to pay to the debenture holders. 1,02,500. For this 1,02,500, you are giving freehold property. Some portion is reconstruction, some portion is paid. So now how much is given freehold property? 60,000 property is given for 90,000. Ante 90,000 is given. How much is reconstructed? 1,000. So balancing figure, how much is there? 11,500 is paid in cash. Respond, everybody, clear. This is with respect to debenture holders. Now let me speak about the freehold property. The total freehold property is 10 lakhs. Make this into two parts. That portion of book value which is given for debenture holders and balancing figure. 10 lakh minus 60,000, 9 lakh 40,000. This was revalued to 90,000. This is revalued upward by 10%, which comes to 94,000. And hence the total is 10 lakhs 34,000. Respond, everybody, understood. Shall I start telling the journal entries for this now? So first of all, I have to revalue the freehold property now. Freehold property originally revalued is 30,000 plus 94,000. 2, am I correct or wrong? Here it's 30, Nana. Here it's 94. To reconstruction account 1,24,000. Hey, respond, everybody, understood. Now freehold property had become 60,000 plus 30,000, 90,000. 9,40,000 plus 94,000, 10,34,000. Am I correct or wrong? This portion is straight away given to debenture holders. Wait. Now for debenture holders, percentage debentures 1 lakh, outstanding interest on debentures 2,500, to debenture holders 1,02,500. And finally, debenture holders 1,02,500 to freehold property 90,000 because already revalued here. To cash or bank 11,500. That portion of 1,000 is reconstructed, transfer to reconstruction account. Respond everybody, done. So this is another kind of adjustment. Now, in some questions, you will be having something like Mr. A is the holder for debentures, he is the holder for creditors, and also he is the holder for some loan. Strictly speaking, given like Mr. A is the holder for first debenture, so second debenture, so and also he is a creditor. Mr. B is the holder for second debenture, so creditor. In this case, you should not check out how the debenture holders are settled, how the creditors are settled, how the loan is settled. No, that's wrong. You have to check out how Mr. A is settled. So, you have to pass first entry that first debentures account debtor, second debentures account debtor, creditors account debtor to Mr. A account. Now check out how Mr. A is settled. Accordingly, pass the journal entries. Respond everybody, clear. Now, please don't forget the concept relating to shares surrendered and never leave that concept. Generally, students will be taking it as light here and they are leaving, but even at least one adjustment from share surrender is being tested. And the concept is very, very simple. Listen very, very carefully. If at all any shares are surrendered, you have to write an entry like equity share capital account debtor to shares surrendered account. Further, if any equity shares or preference shares, take care. Initially, the shares surrendered will be taken and kept in shares surrendered account. Further, if any new equity shares or new preference shares are issued to any parties, then you have to issue only from shares surrendered account. So the entry will become shares surrendered account debtor to equity share capital account or shares surrendered account debtor to preference share capital account. Don't be in a wrong notion that since the shares surrendered here or equity, you have to issue only equity share capital. Such concept is not there. Clear everybody? You can issue even preference share capital out of the shares surrendered. Respond everybody, pakka. Sir, respond, is a logic understood? Okay. And let me give you an example. Say a debenture holder is due from the company. I mean, the company has to pay to the debenture holder to the extent of rupees 1 lakh. We are settling 70% of debenture holder by issuing 50,000 rupees equity shares from shares surrendered. Is the logic clear? Sir, is the logic clear? If at all, normally, if you want me to write the entry, normally, then the entry will become debenture holders account debtor 1 lakh into 70%, 70,000 to equity share capital account 50,000 to capital reduction account 20,000. But under share surrendered model, it is not like that. Total settlement portion has to be transferred to shares surrendered. Total settlement portion. How much is the total settlement portion, Anna? So the entry will be debenture holders account debtor to reconstruction account 70,000 and then issue 50,000 equity shares from share surrendered. Share surrendered account debtor to equity share capital. If you are issuing, let it be preference share capital, which comes to 50,000. Respond everybody, clear? This is what the normal problem, this is what the share surrendered model of problem is all about. And last but not least, if at all any shares surrendered were remain unutilized, close and transfer this shares surrendered to capital reduction account and the entry will become shares surrendered account debtor to capital reduction or reconstruction account. Last and final. Your capital reduction or reconstruction account has to be used to close loss of your P&L account. Even after closing the loss, if you are left with any surplus, that surplus has to be transferred to capital reserve account, balancing figure. Respond everybody, understood? That's the end. But there is one problem where I have to show you, which is a very different one. This one. Sir, there is a company is giving you the following information from the viewpoint of creditor. This information itself is given from the viewpoint of creditor. How, sir? Hey, creditors, we are having property, plant and equipment. Cost 3,90,000, but if I sell, I'll get only 1,50,000. A creditor, cash is there to the extent of 2,70,000. So the total amount available for debenture holders is 4,20,000. Wait, there is uncalled capital, which is nothing but 1,80,000. Hey, respond, is it clear? So given that 4,20,000 plus uncalled capital, you can get 1,80,000 also. So 4,20,000 plus 1,80,000. Total 6 lakhs is available for debenture holders. Respond clear, and given something like deficiency 7,50,000 and shareholders 1,80,000 called up and paid up. 6,000 equity shares, first debentures 3 lakh, second debentures 6 lakhs, unsecured trade payables 4,50,000. This is the question given. Hey, what is this? Question from the viewpoint of creditors. So strictly to tell you, this is a creditor's statement. What is this statement, Nana? Creditor's statement. How much amount is available? Ante 6 lakhs is available. Am I correct or wrong? To creditors, how much you have to pay? 9 plus 4. 13 lakhs 50,000. To creditors, you have to pay 13 lakh 50,000. But available amount is only 6 lakhs. So how much is the deficit? 7 lakh 50,000. That is the deficiency given in the question. A logic understood? This is from the viewpoint of creditors. But for internal reconstruction, do you want creditor statement or balance sheet? So you have to draft original balance sheet. Like equity share capital 1,80,000. First debentures, second debentures, creditors. The total comes to 13,50,000. PPE has to be recorded original cost price, that is 3,90,000, and cash 2,70,000. Hey, respond everybody clear? This is how you have to draft the original balance sheet, and then automatically you will be having some balancing figure at asset side, which is this 8,70,000 is nothing but P&L loss. Respond everybody clear? So now you have to start your problem by drafting the original balance sheet. Given in the question is a creditor's statement, but you have to draft the original balance sheet. Respond everybody clear? And my dear children, that is the end of internal reconstruction. Since it is an easy topic, I did not cover all the basics, but I have covered all the peculiar things. All the peculiar and different aspects were covered. And get ready, we are going to start the next typical standard, that is accounting standard number 15. First of all, let me start with accounting standard number 15, which is employee benefit expenses. Sir, frankly to tell you, this standard is a difficult standard to everybody. But to tell you, there will be some rules and regulations. You just follow those simple rules and regulations. You will get the exhaustive revision of accounting standard number 15. Sir, whatever you are learning now with respect to AS 15, that is highly enough for your examination. Provided along with this concept, you have to learn all the CRD questions which were given. And I hope the CRD questions were not difficult, but the concept itself is difficult in AS 15. Anyways, let me start. Sir, what is accounting standard number 15, Nana? Employee benefit expenses. Whatever the benefits that you are paying to employees, we will call it as employee benefit expenses. Whatever the benefits that you are paying to your employees or the relatives, I mean to tell the family or beneficiaries of the employees, are also called as employee benefit expenses. And one more thing, for the purpose of this standard, even directors are also considered as employees. Now, this standard is applicable for all the employee benefits which can be either formal practices. Likewise, you will be entering into the agreement in order to get some salary, bonus, commissions, etc. and etc. And some informal practices. Informal practices, say for example, even though something is not mentioned in the agreement, employer had been very much pleased with your work and he is declaring some bonus to you even when it is not there in your agreement, which is called as informal practices. And one of such examples is nothing but sabbatical leave. Sabbatical leave is nothing but after doing a hard employment, I mean to tell something like an employee is working almost for 10 years in that company. So employer was very much pleased with that employee and employer sent the employee for leave for 1 month. Clear everybody? Of course, that sabbatical leave might be either with pay or without pay depending upon their understanding. So now employee benefits might be either formal or it might be either informal or it might be either legislative or statutory requirement. Say for example, EPF Act is there. How much PF is to be paid? Like that, ESI Act is there. How much employee state insurance has to be paid? Like that, Minimum Wages Act is there. In the same way, Payment of Wages Act is there. Payment of Bonus Act is there. Depending on all these things, statutory requirements, you have to pay some benefits to the employees. Even that also will be included in the employee benefits. My dear children, employee benefit includes 3 things. What are those? Formal practices, informal practices and legislative practices. Clear everybody? And very important, there is something called ESOPs, employee stock option plan, or which is also called as share based payments. For this share based payments, there is a separate guidance notes which is issued by ICAI, and also there is a separate guidance note which is issued by SEBI. So accounting standard number 15 is absolutely not applicable for ESOPs or share-based payment. There is a guidance note issued by ICAI and SEBI. The same guidance notes will be made applicable. Respond everybody, clear? Now very important, AS 15 is applicable only for employee benefits. AS 15 is applicable only for employee benefits. It is not applicable for accounting for employee benefit plans. If you have remembered, even though not exactly, but the words you might have been remembered. Defined benefit plan, defined contribution plan. What are the 2 things, my dear children? Defined benefit plan and defined contribution plan. These are the plans which will be maintained by the employer. These are the plans which will be maintained by the employer. My dear children, AS 15 is applicable only for employee benefits. But this standard is not applicable for the accounting of DBP and DCP. Accounting for employee benefits, this standard is applicable. But how to do the accounting for defined benefit plan? How to do the accounting for defined contribution plan? For this one, accounting standard number 15 is absolutely not applicable. Respond everybody, clear? AS 15 is applicable only for employee benefits but not for employee benefit plan. But as per AS 15, you might need to create defined benefit plan. Something like accounting standard number 10 is dealing with provision for decommissioning and restoration expense. But the accounting is dealt by AS 29. In the same way, as per accounting standard number 15, an employer might enter into either DBP or DCP. But the accounting part is not dealt by AS 15. Respond everybody, logic clear? My dear children, AS 15 is applicable only to employee benefits but not for accounting of employee benefit plans. Respond everybody, done. Now the employee benefit can be either recognized as an expense or it can be either recognized as a liability. Something like, tell me, what is a journal entry for salary paid, my dear children? Salary account debtor to cash or bank account. What is the entry for outstanding salary? Salary account debtor to outstanding. In this case, this salary is nothing but expense. In this case, this outstanding salary is nothing but liability. So employee benefit can be either recognized as an expense or it can also be recognized as a liability. Say for example, gratuity. If I was not wrong, even as per your Income Tax Act, 15 by 26 into last drawn salary multiplied by number of years served is nothing but the gratuity amount. Am I correct or wrong? 15 by 26 into last drawn salary into number of years served is nothing but gratuity amount as per your Income Tax Act. Even I am ready to pay that much amount of gratuity. Of course, more or less than that, it's secondary. But the biggest question is that how much is the last drawn salary? I have to pay the gratuity to the employee at the time of his retirement. At the time of his retirement, I have to pay the gratuity. But how much I have to pay? I have to estimate and I have to create a provision for gratuity, which is also a liability. Respond everybody clear. So conclusion, employee benefits can be either in the form of expense or it can be either in the form of liabilities. Respond everybody done. Sir, very important. The word employee is actually not defined. In accounting standard number 15, the word employee is not defined. But as per Indian generally accepted accounting principles, we will be considering employee includes full-time, part-time, permanent, temporary, casual employees, contract employees, etc. Take care. Contract employees will be applicable. Contractor employees is not applicable for employees. I mean to tell, AS 15 is not applicable for contractors employees. AS 15 is applicable only for contract employees. Say for example, you are providing employment. An employee had come to you. You have entered into an agreement that for 3 years he has to work with your organization. He is called as a contract employee. Say for example, you have entered into a contract with one contractor for construction of the building. Contractor is putting his employee at your site of construction. Is it clear everybody? Contractor is putting one employee at the site of your construction. Now for that particular person who is employed by the contractor, is AS 15 applicable or not applicable? Not applicable from your business end because he is not an employee of your business. He is employee of contractor. So for him, he is an employee as per the contractor's point of view, but not from your business point of view. Respond clear. Employee will not be included. Contractor's employee. He is an employee of the contractor. He is not the employee of your business concern. Respond clear. And as per generally accepted principles, employee also includes whole-time director, managing director, or any other managerial personnel. And already we have discussed yesterday in accounting standard number 19, contract of service and contract for service. I told you something like, if it is contract of service, then it is like an employment. The relationship is like employer and employee, and hence no need to deal in accounting standard number 19. So there is a high time to deal with the same in accounting standard number 15. If it is contract for service, check out contract for service, and if at all there is any right to use of asset is transferred and right to use of asset is not transferred. Contract for service, right to use is transferred, AS 19 is applicable. Contract for service, right to use is not transferred, AS 19 is not applicable. Now coming to AS 15, straight away we don't consider contract for service, we will consider only contract of service. Respond everybody clear. Because contract of service is employer-employee relationship, whereas contract for service is principal-agent relationship. Respond everybody clear. My dear children, what is AS 15, Nana? Employee benefit expenses. Those benefits can be either given to the employees directly, or to the family members, or to the dependents, or to the trust or fund. Let me tell you very carefully. Listen. Say for example, employer is telling, Babu employee, your salary is 1 lakh. Now I am giving an instruction to the employer. Mr. Employer, give me only 80,000. Remaining 20,000 directly transfer to one charitable trust. Clear everybody? Or directly transfer to the orphanage or directly transfer to some other trust. Even such portion is also to be included in employee benefit. Respond everybody, clear? So employee benefit includes the benefits which are directly given to employees or his family members or even to the trust or funds. Respond everybody, clear? So respond clear. Now very important types of employee benefits. Short-term employee benefits, post-employment benefits, long-term employee benefits, termination benefits. Now in that first one, short-term employee benefits. Short-term employee benefits are those benefits which are to be paid to the employee within 12 months from the end of reporting period, that is end of balance sheet, but not from the end of service rendered point. Something like to tell you, yesterday we have seen in investment accounts, long term or current investment, intention to hold has to be considered. Intention to hold within 12 months from the date of purchase, not from the date of balance sheet. Hold on. LTFCMI as per accounting standard number 11, it will become long term if at all the settlement is for more than or equal to 12 months from the date of transaction but not from the date of balance sheet. Now compare the same here. Short-term employee benefits or those employee benefits which are to be paid within 12 months from the date of balance sheet but not from the date of point of rendering the service. Say for example, on 1/1/2024 he had rendered the service. Now you are at the end of the year 31/3/2024. So you have to pay the salary of January. Till now you did not pay, but you are planning to pay by the end of next year. That is 31/3/2025. Say this is bonus. Clear everybody? Current year bonus will be paid at the end of the next year. That is our policy. What is our policy? Current year policy. Current year bonus will be paid at the end of the next year. This is our policy, and hence January bonus will be paid at the end of the next year, that is 31/3/2025. Now tell me whether is it long-term employee benefit or short-term employee benefit. This is short-term employee benefits because you should not see from the date when the service is rendered. You have to check out from the date of balance sheet. Respond everybody, clear? So that is very important. Benefits which are to be settled within 12 months from the end of reporting period, but not from the date of rendering the service. Shall I proceed further? And now coming to short-term benefits, regular and normal benefits like salaries, wages, bonus, allowances, perquisites, etc. and etc. Profit linked bonus plans, just nothing great to discuss with it. You just keep it aside. The next one is all about short-term compensated absences, which is nothing but a kind of leave salary. So check out very carefully everybody. So concentrate. So leaves. You have to check out the policy of the business concern, whether the leaves are accumulated leaves or non-accumulated leaves. If it is non-accumulated leaves, again you have to check out whether the payment is done in cash or whether they will get expired, lapse. And next, coming to accumulated, you have to check out whether vesting or non-vesting. Vesting is nothing but payment option is available in cash. Non-vesting in the sense payment option is not available in cash. It is compensated only through leave versus leave. What is every option? I'll tell you very clearly. Nothing great. It's very simple. Just concentrate. That's it. So tell me, leaves are divided into dash and dash. Participate leaves are divided into dash and dash. Accumulated and non-accumulated. Non-accumulated are again divided into cash or lapse. Say for example, current year you have provided 30 leaves. How many leaves provided, Nana? 30 leaves. But he had utilized only 20 leaves. How many leaves are excess unutilized? 10 leaves are unutilized. Now you are going to the business concern and you are asking, sir, I was left with 10 leaves which are unutilized. Can I carry forward it to the next year? Sorry, sir. Our policy is non-accumulating. In the sense, you are not having any option to carry forward. But whatever the leaves you are having, for that portion, you can take cash and you can quit. You can take cash and you can quit. Clear, everybody? This is our policy. Say for example, for 365 days, 3,65,000 is your salary. And your leaves are actually 30 days. Even though you are working only for 335 days, I have to pay you 3,65,000. Hey, logic clear, huh? Even though leaves are not worked. Because I am offering you a casual leaves of 30. So what are your original number of working days? 365 days, sir. Minus 30 days is the leave. Even though a person who is working 35 days, I have to pay 3,65,000, which implies that person working for 365 days, 3,65,000 salary paid. Person working for 335 days, 3,65,000 salary is paid. But now an employee is telling that, sir, I have utilized only 20 days leave. So I have worked for 345 days. You are paying me 3,65,000 rupees. My unutilized leaves are 10 days. For this 10 days, you told our policy is not having to carry forward. Then what is our policy? Take cash and quit. What is my per day salary? 365,000 divided by 365, which is nothing but 1,000. So, for this 10 leaves multiplied by 1,000, you will get 10,000 extra. Clear, everybody? In the sense, my P&L account for the worker who is working for 345 days will be booked with 3,65,000 plus 10,000. Respond, everybody understood? What is this concept? Non-accumulated settled in cash. Non-accumulated settled in cash. In the sense, the entry will be employee benefit expenses account debtor to cash or bank account 3,75,000. Any doubts to anyone? Sir, respond clear. Now another employee is there. Who has worked exactly only for 335 days. Then very simple, employee benefit expense account debtor to cash or bank account 3,65,000. Respond, done. Now if at all he is utilizing more than 30 days, then automatically salary cut will be there. Automatically what will be there? Salary cut. Say for example, an employee had worked only for 330 days. For 335 days working, I have to pay him 3,65,000. But 5 days extra leave utilized. Ante 5 leaves of 1,000 per day. 5,000 will be salary cut. And hence the employee benefit expense will stood at 3,60,000. Respond, everybody clear with all the alternatives? Working for 335 days, pay the total salary. Working for more than 335 days, pay the total salary plus extra amount. Working for less than 335 days, pay only after cutting the leave salary. Respond, everybody clear? Any doubts to anyone? Shall I proceed? Now the next part. Non-accumulated lapse. Trash hell with nonsense. Those employees who are working for 335 days or more than 335 days, you have to pay a salary of 3,65,000. Not even 1 rupee will be paid extra. Clear? Those employees who are working only for 330 days, originally you have to pay 3,65,000, but since 5 days extra leave utilized, per day salary is 1,000, so 5,000 will be deducted. The expense will be only 3,60,000. Respond clear, everybody? This is the concept for non-accumulated. Conclusion. Check out non-accumulated. Whether expired, settled in cash. If it is expired, even though he is working for 335 days or more than 335 days, debit the total employee benefit expense of 3,65,000. Less than 335 days, cut the leave salary and put the remaining as expense. Now, if at all it is non-accumulating, settled immediately, then those employees who are working for more than 335 days, total salary 365,000 plus extra. Working less than 335 days, cut the leave salary and put the remaining portion. Respond clear with non-vesting to each and everyone. Now moving on to the next part, that is vesting. My dear children, listen very, very carefully. Under vesting, what happens, sir? Something like, yes, check out. I'm sorry, accumulated, kada? Yes. The next part is all about accumulated. Under accumulated, again, two parts are there. Number one is vesting. Number two is non-vesting. Now listen very, very carefully. Accumulated vesting. Say, for example, current year, 30 leaves offered. But one of your employees is utilizing only 20 leaves. How many leaves are there, Nana? 10 leaves can be carried forward. Now, how the carrying forward option is there? Can it be carried forward to the indefinite period? If yes, it will become long-term employee benefit. If yes, it will become long-term employee benefit. No, sir, it cannot be carried forward up to X number of years. It can be carried forward only in the next year. So, in the next year, if you utilize, we'll pay you. Otherwise, we don't pay you. Respond, is it clear? In the next year, if you utilize, we'll pay you. Otherwise, we don't pay you. They'll get lapse in the next year. Whereas accumulating non-vesting. Accumulating non-vesting, I don't pay anything. It is always leave versus leave. I'll provide you extra leaves. If you take extra leaves, they will get utilized. If you are not utilizing the extra leaves, they'll get lapsed. Respond logic clear. Under vesting, carried forward these leaves up to indefinite period. Then it will become a long-term employee benefit. Now carried forward these 10 leaves only up to the next year. Check out whether utilized. Okay, I'll pay you full salary. If not utilized, I'll pay you extra salary. Clear? If utilized, I'll pay you full salary. If not utilized, I'll pay you extra salary. Respond everybody clear. Whereas coming to non-vesting, check out whether he is utilizing full leaves. If yes, I'll pay him the full salary. If not utilized, they will get lapsed. Respond, is it clear? Again, same, let me take an example. Check out carefully. Current year, 30 days is the leave option provided. But he had utilized only 20 days. So 10 days is still unutilized. Now, how much salary, how many days he had worked, Nana? 345 days. Because out of 365 days, 20 days is the leave opted and worked for 345 days. For this 345 days, I have to pay him 3,65,000. Respond clear, Now, very, very important, listen carefully. For this 10 days, carry it forward to the next year. If next year he can utilize the leave, in the next year he can utilize the leave, I will give him the full salary. If not utilized, I have to pay the cash. If utilized, full, sir, please respond. If utilized, full salary. If not utilized, extra cash. So for which I have to create a provision. Current year employee benefit expense is 3,65,000. Provision for leaves, which is like 10 days, kada? So 10 days multiplied by 1,000. I'll create a provision of 10,000. Shall I proceed further? Now go for the next year. Go for the next year. Listen very, very carefully. Next year, how many days working days available? 365 days. My dear children, normal offering is only 30 days. But he is very special person and hence offered another 10 days. Last year carry forward. So he can work up to 325 days. If he is working only up to 325 days, if he is working up to 325 days only, then provide him full salary. If he is working for more than 325 days, then you have to pay him some extra. Clear everybody? So check out what is the entry. Employee benefit expense 365 days to cash or bank account 365 days. Or if he is working up to 325 days, then only up to 325 days. I mean to tell total 3,60,000. Sorry, 3,65,000. Up to this clear? If at all your employee had worked for 335 days, again 10 days unutilized kada. Respond clear. You can create a provision and this 10 days can be carried forward. Respond. If at all you are paying the last year leaves in cash, say for example 365 days, your employee utilized only 5 days. Your employee utilized only 5 days. Worked for how many days? 360 days. But you have to pay a salary of 3,65,000. Up to this clear everybody? Now check out how my P&L account will be. Employee benefit expense for 360 days. I have to create 3,65,000 as expense. Current year, how many leaves are there, Nana? 40 days. Out of which 10 days are relating to previous year, 30 days are relating to current year. How many days leave he utilized, Nana? So, very, very important. First of all, you have to set off the current year leaves and then last year leaves will be set off. Here you have to follow dash method, LIFO method, not the FIFO, take care. Which method is followed, Nana? LIFO. How many leaves utilized, Nana? 5 days. So, how many balance leaves are there? 25 days. So, immediately create a provision for 25 days. And whatever the 10 days relating to the previous year is there, remained unutilized kada. Response, sir. This will be paid in cash. What is the entry for this? Sir, concept clear, huh? Not clear. Sir, is it clear? Out of 365 days, he utilized 5 days leave, Nana. 360 days worked. Pay him 3,65,000. You have to follow LIFO basis. Totally 30 days leave is there. 5 days utilized. Balance 25 days is there. This will be carried forward to the next year. This part is done. Now out of last year leaves, he did not utilize anything kada. And hence that has to be paid immediately. Respond clear. In such a case, what will happen? Provision for leaves. I mean, last year you have created some provision for leave. Am I correct or wrong? That provision for leave account debtor to cash or bank account, which comes to 10,000. Respond everybody clear. This is correct to those employees who are following LIFO basis. But to those employees who follow FIFO basis. To those employees who follow FIFO basis. Generally, think with common sense and tell me which basis is followed. Last year carried forward leaves are there. Current year leaves are there. First set off with the last year FIFO basis. Otherwise set off with the current year LIFO basis. Sir, respond logic understood. So now say for example, last year 10 days are there. So last year 5 days utilized. Balance how many days are there? So pay cash only for the 5 days. In this case, you have to create a provision for 30 days. Respond everybody clear. And my dear children, this is the end for accumulated vesting. Simple logic. Check out FIFO or LIFO. Check out the unutilized portion of the last year. Pay the same in cash. Check out the current year unutilized leave. Create the provision. Done everybody. And last and final. Accumulated non-vesting. Say for example, 365 days you have to work. So total option available you is 40 days. You are working only for 325 days. I'll pay you the salary of 365,000. But say for example, out of 365 days, you have utilized the current year leaves of 30 days and last year leaves of 2 days were utilized. In the sense, company is following dash method, FIFO method. I already told you, generally FIFO will be followed. So 365 days, sorry, LIFO. Yes, LIFO. First utilize current year leave totally and then you can take last year leaves. First utilize. How many current year leaves are there? 30 days. How many last year leaves are there now? 10 days there, but out of which how many days utilized? 2 days utilized. Respond clear, huh? So you are working for 33 days. Ante kada? But I'll pay you the salary of 3,65,000. Remaining 8 days of previous year which are unutilized will get lapsed. I don't pay you any extra. Even that will not be carried forward. Respond logic clear. That is the end, Amma. So problem is all there with only vesting portion. So you have to be careful in that context. Apart from that, everything is very, very simple. Now check out one last portion for non-accumulating. Current year. Say for example, 365 days. But you have utilized only 20 days and 345 days worked, and hence I'm paying 3,65,000. How many leaves are carried forward? 10 days. Hey, yes or no? Say for example, this is non-vesting portion. What is that portion? Ante compensation is given only for leave versus leave. So I have to create a provision. For how many days salary I have to create a provision? Question clear, huh? I don't create the provision for entire 10 days. I'll estimate how many days will the employee take leave of current year in the next year. Babu, next year 30 days is there. Last year days 10 days are there. Totally 40 days are there. Sir, if at all employee is putting a message something like, since leaves are there, I am utilizing. Will you give him the leave? Answer, no. Sir, even in government organizations also they don't give you like that. If leaves are there, since leaves are there, I am utilizing. Your higher manager will not approve it. If some problem is there, some accident has been met out, or some family issues are there, show the reason properly, and then you will be getting the leave with pay. Respond clear, huh? So I will be estimating how many days of current year will be utilized by the employee in the next year. I'm estimating only 5 days. So I have to create provision only for 5 days. Clear, huh? My dear children, if it is vesting, I have to create a provision for entire 10 days. Because if he did not utilize the leave, I will pay him in cash. Logic clear, huh? But if it is non-vesting, it is not like that. I will estimate for how many days my employee will be utilizing the leave in the next year, and then I am going to create the provision. Respond, everybody understood? My dear children, whether you believe or not, I have covered exhaustively in a short span of time. I did not tell very fast. I did not tell very slow. I have delivered in a perfect way by taking a simple example. More than this, conveying leave salary is absolutely impossible. So respond, everybody. Is the concept till now done to each and every one? Okay. Let me move on to the next thing. That's all about post-employment benefits. Coming to post-employment benefits, my dear children, there are two kinds of things which are very, very important. Defined benefit plan, defined contribution plan. What do you mean by defined benefit plan and defined contribution plan? So defined benefit plan is a plan which is maintained by the employer. Defined contribution plan is a plan which is maintained by the outsider. There are two kinds of risk. Number one, actuarial risk, and number two, investment risk. What do you mean by actuarial risk? Actuarial risk is nothing but not estimating the number of employees properly. Say for example, I told you 15 by 26 into last drawn salary into number of years worked. This is nothing but gratuity computation as per your income tax act. Am I correct or wrong? Say for example, the same process is adopted by my business concern also. Now I have to estimate the last drawn salary of the employee. So I'm estimating. So initially when the employee is employed, to him it is 50,000. I'm estimating that the employee will retire at the 10th year. I'm estimating that the salary of employee at the end of 10th year would be 1.8 lakh. And I am computing the gratuity on the basis of 1.8 lakh. But exactly after 10 years, he told that he is not going to retire. So then automatically this provision will not be sufficient. So I've estimated he will be retiring at the 15th year. And his last drawn salary at the end of 15th year is 2.8 lakh. So I have gone to employee had gone to the 15th year. He is ready to retire. But this time his salary is 3.2 lakh. Again, sufficient or insufficient? This difference of risk, difference of estimations is nothing but actuarial risk. What is this risk, comma? Actuarial risk. Respond everybody clear. For this purpose, I have to pay the gratuity to the employee in future. Am I correct or wrong? For this purpose, I am maintaining a fund. Who is maintaining? Employer is maintaining a fund. Employer is maintaining a fund, and hence it is called as defined benefit plan. What is that plan, Nana? Defined benefit plan. I thought of like at the end of 15th year, I have to pay a gratuity of 20 lakhs. And hence I have invested in accordance to that. But unfortunately, my investment fetched only 18 lakhs. I planned for 20 lakhs. Even I have to pay 20 lakhs. But unfortunately, my investment fetched only 18 lakhs. And this risk is nothing but investment risk. Respond everybody clear. Sir, please listen very, very carefully. At the time of estimating the number or estimating the amount, how much I have to pay? How much I have to pay is called as dash risk, Rana? Actuarial risk. If at all the risk is relating to the investments made by the employer, then it will be called as an investment risk. And my dear children, in defined contribution plan, the fund is maintained by employer or outsider. So employer work is very, very simple. Pay him, thereby the problem is solved. Pay to the outside fund, thereby the problem is solved. Respond everybody clear, huh? Something like if it is DCP, simply you have to pay to the outsider. Actuarial risk and investment risk, both risks will be generally borne by the outsiders. Both risk will be generally borne by the outsiders. Of course, I mean to tell, actuarial risk will be borne by the employer. Say for example, let me tell you, Provident Fund. Provident Fund. Who has to deposit PF? Employer has to deposit the PF. Who has to deposit the PF? Employer has to deposit the PF with PF authorities, which is maintained by Government of India. So who has to pay PF to the employee? Is it the employer or the PF authorities? PF authorities has to pay to the employee. For that purpose, this PF authorities has to plan the investment properly. If the investment is not proper, then that risk has to be borne by the PF authorities, and it must be borne by the outsider. But say for example, employer had done wrong estimations and hence he is depositing short amount to the PF fund. This risk is dash risk. Actuarial risk, because he is going with the wrong estimations, and this risk must be borne by the employer. Respond everybody clear. Sir, what do you mean by defined contribution plan, Nana? Point number 1, fund is maintained by the outsider. Employer work will be completed only when he had deposited the fund into the outsider's fund maintenance. Respond everybody clear. Employer work will be completed when he is depositing the amount into the outsider's fund. Employee benefit expense account or to cash or bank account. Respond everybody clear. In this case, the investment risk will be borne by the outsider. Actuarial risk will be borne by the employer. This is called as dash plan, Nana. DCP. And there is one more plan called DBP. DBP is nothing but defined benefit plan. What is that plan, Nana? This plan is absolutely maintained by the employer. So employer will be maintaining a fund and he is going to invest the same also. So actuarial risk will be borne by the employer. Investment risk is also borne by the employer. Check out very carefully. Let me draft a balance sheet. Ask the employer to estimate how much amount he has to pay. Ask the employer to estimate how much amount he has to pay at the end of some X number of year. Say at the end of 20th year. Employer is telling, I have to pay 20 lakhs at the end of 20th year. Okay, bring everything to the present value. Bring everything to the present value because you are investing it kada. Sir, you will invest the present value portion and you will make it to the future value portion. This is not called as unwinding of discount. Present value of decommissioning and restoration expense. In that context, you are not investing anything. But here you are actually investing. Respond everybody clear. At the end of 20th year, employer is telling that he has to pay 20 lakhs. And hence you are asking him to bring everything to the present value and he is asking you to create a liability. Present value of defined benefit obligations. So he is telling you have to create a liability to the extent of 10 lakhs. Present value. Respond clear. Now very important, you have to invest this. You have to invest this 10 lakhs which is called as plan assets. What is that called as, Nana? Plan assets. Respond everybody, done. So present value of defined benefit obligation is 10 lakhs. Now I'm asking you to invest this 10 lakhs kada. Invest this 10 lakhs in plan assets. So 10 lakhs is invested. Clear everybody? Very important. One more element is there which is called as past service cost. Say for example your plan is changed. Your plan is something like give gratuity to those employees who have been working up to 5 years. But immediately you changed the policy to give the gratuity to all those employees who are working for 3 years. And automatically will your past service cost increase or not? So now check out such portion of past service cost which is increased and check out whether is it transfer to P&L account or not. I mean to tell past service cost totally 1 lakh is increased. Respond clear. And you check out whether this past service cost is transferred to P&L account or not. Say for example, past service cost 1 lakh to cash or bank account 20,000 to outstanding past service cost 80,000. Something like salary account debtor to outstanding salary account. So automatically whatever the portion of 20,000 is there, it might be transferred to P&L account, or whatever the portion of 1 lakh is there, it might be transferred to P&L account. Respond clear. So what you have to observe, check out the past service cost. It will be of two types. That past service cost which is recognized to P&L account and such portion of past service cost which is not charged to P&L account. How? That's not needed for you at all. It is very advanced concept. You just think only one thing. There might be past service cost. Some portion is transferred to P&L account as a charge. Some portion is not transferred to P&L account. So the portion which is not transferred to P&L account will be appearing in balance sheet. Say for example, the entry will be past service cost account debtor to cash or bank account 1 lakh. But P&L account debtor to past service cost account only 20,000 is transferred. Hey, is it clear? Which is relating to current year and previous year. But such sort of past service cost relating to future years is 80,000 and hence this is not transferred to P&L account. It is still lying in the balance sheet at assets side. Is the logic clear? Simple Nana. 5 years policy is changed to 3 years kada? Respond. The total difference is nothing but past service cost. Relating to the previous years is to be charged to P&L account. Relating to the future has to be transferred to balance sheet. Respond, done. So now your balance sheet is ultimately like this. Present value of defined benefit obligations is at liability side and asset side you are having two things. Number 1, planned assets. Number 2, past service costs which is not yet transferred to P&L account. Respond everybody clear. Check out. This is the part. Now very important. You have to set off and you have to show. You have to set off and you have to show. In the sense, don't show separately here as liabilities and here as assets. Set off and show the net figures. How there? If at all the net figure is positive. I mean to tell present value of defined benefit obligation is 10 lakhs. Fair value of planned asset is 8 lakhs. Past service cost is 1 lakh. So automatically what is the figure you have got, Nana? 1 lakh. This is positive figure which will be continued to be shown at liability side. If at all plan assets are more than the present value of defined benefit obligation, ante your payment is only 10 lakhs but plan asset fair value is 11 lakhs. Clear? Extra 1 lakh is there. Am I correct or wrong? This is called as negative defined benefit plan. It has to be shown at asset side at amount so determined or present value of future economic benefit, whichever is lower. What is this nonsense again, sir? Say for example, you have to pay 10 lakhs, but your fair value of planned asset is 12 lakh. So you're very happy, I got an extra benefit of 2 lakhs. But remember, simply this is an asset, am I correct or wrong? Simply compare it with recoverable amount. Recoverable amount is nothing but present value of future economic benefit. Whatever the difference is there, you have to transfer it to P&L account. Respond everybody clear? So this is all about DBP. My dear children, conclusion. DCP, straight away, employee benefit expense account debtor to cash or bank account. Deposit with the respective authorities. Thereby the problem is solved. Actuarial risk has to be borne by the employer. Investment risk will be borne by the outsider. If it is DBP, defined benefit plan, both actuarial risk and investment risk has to be borne only by the employer. Now, coming to DBP, estimate how much amount you have to repay after 20th year and bring it to the present value, which is called as present value of defined benefit obligation. And invest this, which is called as plan assets. And also check out if any change in policies are there. If any change in policies are there, that difference amount will be called as past service cost. Past service cost relating to current year and previous year has to be transferred to P&L account. Such past service cost which is relating to future years will be appearing in balance sheet. So now don't show it at liability side separately. Don't show it as asset side separately. Set off these two things. After setting off, if present value of defined benefit obligation is more, continue to be shown at liability side. If at all plan assets and this part is more, then it will be shown at asset side. With how much figure, sir? Compare the book value of net figure with present value of future economic benefits. Simple logic. My plan assets are more, right? Response, sir. If my plan assets are more, then automatically my future contribution will decrease. Yes or no? I want 20 lakhs at the end of 20th year. But already at the end of 19th year, I got 20 lakhs. So is there any need to deposit some more amount? No, that entire amount is benefit to me, kada. So that is what I am telling. No need to deposit some amount to the plan assets since already I have got my enough amount. I want 20 lakhs. Already 20 lakhs is there. No need to deposit anything. So that whatever portion no need to deposit is there, it is a big saving to me. Bring that saving to the present value. I mean to tell, compare the book value of the net figure with present value of future economic benefit. Whichever is lower has to be recorded. The difference, if any, is there, it will be immediately transferred to P&L account. Respond everybody clear? Sir, I'm trying to tell it in an exhaustive way, but I'm not telling very faster. I'm telling it in simple words itself. And take care. This is not needed. Amount that is to be transferred to P&L account, it will be actually in 7 components, but that's not that much needed. And long-term employee benefits, you can just go with that. Long-term employee benefits are those employee benefits which are paid after 12 months from the reporting date. Within 12 months aithe short term. After 12 months aithe long term. As and when incurred, it must be charged to P&L account by creating some provision. I mean to tell, sir, say for example, we had a policy. Babu, employee will give you some bonus at the end of your retirement. Current year, your bonus is 10,000. I don't give you now. I'll give you this 10,000 at the end of retirement. And hence, I will create a provision and I'll leave it. What is my provision? P&L account debtor to provision for bonus account. This provision for bonus will be shown in employee benefit expenses, and also this will be shown correspondingly as a liability. Respond everybody clear? And coming to termination benefits, again this is purely similar to your defined benefit plans. Termination benefits are two types, Nana. Number one, retrenchment. Number two, VRS. Retrenchment ante employer is throwing the employee outside the organization. Voluntary in the sense employee himself is going slowly from the organization. Whereas accounting treatment is very simple. Whatever it can be recognized as an expense by creating a provision, and also it will be shown a corresponding liability. I have to estimate how many employees will retire or how many employees will be retrenched. I have to estimate that, and I have to create a provision. And it has to be created, very, very important, only when there is a detailed formal plan. If at all the termination falls less than or equal to 12 months, normally you have to create it with undiscounted value because this is short term. If at all the termination falls after 12 months, then you have to create a provision by bringing it to the discounted value. Again, it is similar to DBP. After next year, sir, this is 7th year. In the 8th year, 12 employees will retire. Immediately create a provision and close it. After 16th year, this many employees will retire. You have to estimate it to the present value, and again same process will continue. You have to invest that in plan assets, and you have to compare these two things. Respond everybody clear? And my dear children, that is the end of accounting standard number 15. So you have to be careful in two areas. Area number 1. Short-term compensated absences with respect to vesting accumulated. And next area where you have to be very, very careful is all about DBP. Please work out on these two things. For sure you will get, they are not that difficult at all. And the beauty of the standards of AS 15, AS 25, AS 28, AS 23 and AS 27. The beauty of these 5 standards is all about 99.99% you will get a question from institute material itself. Hardly number change will be there. Sometimes even number change will also be not there because they are newly introduced standards. So take more care, my dear children. Sir, I hope AS 15 concept is clear to each and everyone. Sir, again, this will be understood only to those people who are having little idea in the regular batches. Otherwise, this is very difficult to you to understand here. And in this session, which will be running around from 3 to 5, we are going to cover only one topic. That topic is all about amalgamation. Yeah, from now you will be very active because marathon is going to get completed, right? So automatically you will become very active. And also most activeness part is all about from the next 2 hours, no need to see my face, right? And hence you people are a bit more active actually. Anyways, it's okay on my face. Amalgamation, which is guided by accounting standard number 14. And normally we are having 3 terms. One is merger, and the other is absorption, and the other is external reconstruction. Take care, my dear children. Internal reconstruction will not come in this part. Only external reconstruction comes in the concepts of amalgamation. Now, first of all, what do you mean by merger? 2 old companies will be forming, 2 or more old companies will be forming as if it is a new company, which is nothing but called as merger. And coming to absorption, one company will be acquiring or purchasing the another company, which is called as absorption. And finally, external reconstruction, existing management of our company will be floating in new company, and the entire assets and liabilities of the existing company will be transferred to the new company. Best example for merger is all about VI. Vodafone India is a very popular merger in the recent times. and of course very well known to each and everybody. And moving on to the next one, absorption. My dear children, in the context of India, almost the absorption happens between holding and subsidiary companies. Majority of the subsidiary companies will be subsumed into the holding companies. One of such best example is all about the SBI absorptions. Almost, if I was not wrong, 26 subsidiary banks were subsumed into SBI, like SBT, SBH, Bhartiya Mahila Bank, State Bank of Allahabad, etc. and etc. Anyways, and even for your kind information, if I was not wrong, what is it called? Ranbaxy, Sun Pharmaceuticals. Sun Pharmaceutical is the holding company and Ranbaxy is actually the subsidiary company. Ranbaxy only used to be there, right? So this Ranbaxy is the company which is acquired by Sun Pharmaceutical. Even another pharmaceutical absorption is all about Pfizer and Hospira. There is used to be a company called Hospira, and Hospira is a subsidiary company, and most of the people might have learned about Pfizer. You know it, right? Pfizer. Sorry, now you have learnt it, right? Holding company, you have heard it, right? So Pfizer, which is nothing but holding company. Hospira is a subsidiary company acquired by Pfizer. Anyways, my dear children, this is all about absorption. My dear children, take care. Generally, the word acquisition is used in the context of holding and subsidiary companies. The context of, my dear children, last 2 hours, the concept of acquisition is actually used in the context of holding and subsidiary company for the purpose of consolidation. Check out all the consolidation problems you will be having. Holding company acquired 1600 shares of subsidiary company. Holding company acquired 3000 shares of subsidiary company. There generally you will not be having holding company absorbed. No. Holding company acquired some X number of shares of subsidiary company. It will be given only in that style. Hey, is it clear? Huh? Okay, now moving on to the next thing. Absorption is a term generally used in amalgamation. Of course, here or there, acquisition is also used. A limited acquired B limited. Doesn't mean that A limited is holding and B limited is subsidiary. Acquired here in the context of amalgamation is nothing but absorption. Respond clear, everybody. If I was not wrong, except in one problem of your institute material, almost in every problem he had used absorption only. Only in one problem he will be giving like A limited acquired B limited. Apart from that, in each and every problem he is using the term absorption. Generally, the word acquisition is used for holding subsidiary relationship. The word absorption is used for amalgamation. Respond, everybody, clear. And the next concept is all about external reconstruction. My dear children, even though under external reconstruction there are 2 companies, the inner logic is only one company, because the existing company management themselves will be floating a new company and all the assets existing and liabilities were transferred to the new company. Hey, is it clear? Which is called as dash reconstruction? External reconstruction. Let me tell you a best example. Likewise, LG. Originally, there is a company called Gold Star. So that Gold Star is actually changed. Its management, I mean not management, Gold Star company. Initially, it's used to be there, but later on, the management of Gold Star themselves had started a new company, and that new company is nothing but LG, and the entire business of Gold Star is transferred to LG. And one more company, one more set that I will be giving you the general example is all about Starchick. This is totally a different external reconstruction. You know, Starchick Limited is a company which is actually a poultry business, which is doing a poultry business. Later on, the management of Starchick Limited had floated a new company which is called as Narbada Jewels and Gems. Huh? Sorry, Narbada Gems and Jewels Company, which is all about doing the business in all the Rangurallu. I mean to tell is all about This is not only just the external reconstruction, also this is the best example for diversification. Because from poultry business, they have totally shifted to gems and jewels business, which is nothing but a kind of diversification. And also this is another example for external reconstruction. Respond everybody, clear? Now tell me, we have learned 3 modes of amalgamation. What are the 3 modes of amalgamation? Merger, absorption, external reconstruction. These are the 3 modes of absorption in general, not as per accounting standard number 14. These are the 3 modes of amalgamation in general, and as per accounting standard number 14, any of these 3 things must be divided into 2 types of amalgamation. Those are amalgamation in the nature of merger and amalgamation in the nature of purchase. What are those 2 things, my dear children? In the nature of merger and amalgamation in the nature of purchase. And let me purchase. Mortgage. Sorry. Yes. Okay. Let me proceed further. In every amalgamation, obviously there will be 2 minimum companies. Number 1 is transferor company and the other is transferee company. Clear everybody? And my dear children, who is transferring the business to whom, amma? Transferor company is transferring the business to transferee company. Obviously, transferee company has to pay purchase consideration to transferor company. Am I correct or wrong? And my dear children, there are 2 things that are to be considered here. Number 1, closing the books of accounts of transferor company. Number 2, opening the books of accounts of transferee company. And the common thing for these 2 companies is all about computation of PC, purchase consideration. And one more thing, my dear children, amalgamation is applicable only to transferee company but not to transferor company. And for your kind information, in transferor company, liquidation proceedings, IGAPs are applicable. What are applicable, my dear children? IGAPs. Under IGAPs, which concept is applicable, Nana? Liquidation proceedings. Since the company is closing, the company has to liquidated. Respond everybody, clear? My dear children, accounting standard number 14 is not dealing with transferor company. But the chapter you are learning is actually dealing with transferor company also. Respond everybody, understood? So, hey, shut up. What are the 3 things that you are going to learn here, my dear children? Closing the books of accounts of transferor company, opening the books of accounts of transferee company, and foremost important thing, computation of purchase consideration. Respond everybody, clear? AS14 is applicable only for dash company, transferee company. This is not applicable for transferor company. For transferor company, dash is applicable. IGAPs. Under IGAPs, that is applicable. Liquidation proceedings. Respond everybody, clear? And before learning the concepts of transferor and transferee company, let us start learning about computation of PC. I don't ask you, it's okay. And PC is nothing but purchase consideration. My dear children, who has to transfer PC to whom, amma? Transferee company has to transfer to transferor company. And there are some people who might have learnt like transferor company is selling company and transferee company is like purchasing company. And some other company, some other students might have learned something like this company is like an old company and this company is like a new company. Respond everybody. No, don't respond. Let me proceed further. And types of PC as per accounting standard number 14. What is the concept? Types of PC as per accounting standard number 14. My dear children, there are 4 types of PC. What are the 4 types of PC? Number 1, lump sum method. Intrinsic value method, net assets method, net payments method. And first thing is all about lump sum method. Sir, transferee company will not actually bargain exactly how much is the PC to be given to equity shareholders and how much is the PC to be given to preference shareholders. How much is the PC should be given to each and every shareholder. This sort of terms and conditions will not be written in the agreement of amalgamation between transferee company and transferor company. On a wholesome basis, transferee company will give some lump sum consideration to transferor company. How the PC is distributed is the hell of transferor company. The liquidator of transferor company will be taking care about the distribution of PC. Respond everybody clear. In all of our problem, we will be seeing something like transferor company, each and every equity shareholder is getting 2 equity shares. 1 equity share is given with 10 rupees cash and 3 equity shares. Such sort of disbursement will not be there under dash method, amma. Lump sum method. How much is to be given to each and every equity shareholder, how much is to be given to each and every preference shareholder will not be spelled out in lump sum method. On a wholesome basis, some amount shall be given by transferee company to the liquidator of transferor company. It is the hell of liquidator of transferor company how to distribute the PC to all the shareholders. Respond everybody clear. And hence in all our problems we generally don't follow lump sum method. Why we don't follow? Because it will not be asked in the question. I mean to tell, it's generally not possible. I mean, if, sir, one and only complication part of amalgamation is computation of PC. If at all PC is given in lump sum method, there is no challenge in the question at all. PC to the transferor company, 20 lakhs. That's nothing but lump sum. So now what is there to compute PC now? Absolutely nothing. They respond, everybody understood. Sir, practically, sir, you are creating some disturbance. Please take care. Sir, practically which method is more followed ante? Lump sum method itself. Practically which method is more followed? Lump sum. But in problematic, we generally don't follow lump sum method. Respond, everybody clear. Likewise, accounting standard number 7. Practically, survey method and physical proportion method are more followed. Cost to cost method is less followed. But in all our problems, we'll follow cost to cost method. Like that, even in amalgamation, practically lump sum method is followed. But coming to the problematics, we'll ignore lump sum method. Sir, under lump sum method, do we have a clear-cut PC differentiation to each and every shareholder? No. Transferee company will give some lump sum amount to the liquidator of transferor company and he is going to distribute the same to the shareholders of transferor company. Respond everybody. Now, very important thing, actually very important thing, PC. Whatever is paid to shareholders will be included in PC. Whatever paid to debenture holders or outsiders will not be included in PC. My dear children, who are the owners of the company? Shareholders, who might be either equity shareholders or who might be either preference shareholders. Who might be either equity shareholders or preference shareholders. And hence whatever is paid to shareholders, it will be considered as PC. Whatever is paid to outsiders or debenture holders is not PC. Accordingly, debentures issued to shareholders will be included in PC, but equity shares issued to debenture holders is not PC. Clear everybody? What are issued? Equity shares. To whom it is issued, Nana? Debenture holders. Whatever is given to outsiders or debenture holders will not be included in PC. Whatever the debentures, whatever you issue, it might be cash, it might be check, it might be equity share, it might be preference share, it might be debenture, it might be bond, it might be any other asset also. Anything which is given to shareholder will be included in PC. Even though you give shares to debenture holders, it will not be included in PC. Respond everybody clear. And thereby the lump sum method is done. and it's not at all required, so throw it aside. What are the other three important methods that are required, Nana? Intrinsic value method, net assets method, net payments method. My dear children, intrinsic value method is nothing but point number 1. Intrinsic values shall be given in the question. Under intrinsic value method, dash values shall be given in the question. Intrinsic values shall be given in the question. If intrinsic values are not given in the question, intrinsic value method is exactly equal to net assets method only. Hey, respond, is it clear? Simple. PC is exchanged by considering intrinsic value of the share. What is intrinsic value method, my dear children? PC is exchanged by considering intrinsic value of the share. What is intrinsic value? It will be given in the question. If intrinsic value is not given in the question, but he is telling that you have to exchange on the basis of intrinsic value, then intrinsic value is exactly equal to net assets method. Respond, is it clear? Sir, is it understood? Say for example, given like this. A limited, B limited. Number of equity shares. 1 lakh and 2 lakh. Intrinsic values are also given. Intrinsic values of A limited is 20 rupees. Intrinsic value of B limited is 25 rupees. Clear, everybody? Now listen very, very carefully. Say for example, A limited is acquired by B limited. Who is acquired? A limited is acquired by B limited. Who is transferor company? A limited. Who is transferee company? Now who has to give the PC? B limited has to give the PC to A limited on the basis of intrinsic value. On the basis of intrinsic value. Now very, very important. What is the intrinsic value of A limited? Check out. Intrinsic value of A limited is nothing but 1 lakh equity shares multiplied by rupees 20, which is nothing but 20 lakhs. This 20 lakhs is the intrinsic value taken by B limited. Now B limited will issue as per the intrinsic value of B limited. That is 20 lakhs divided by 25, which comes to 80,000, which implies that 80,000 equity shares are issued. Respond, everybody, clear? Sir, respond, understood? In a simple words, number of equity shares of transferor company multiplied by intrinsic value of transferor company divided by intrinsic value of transferee company. But don't by heart it, you understand the logic. Transferor company number of shares multiplied by transferor company intrinsic value. Total intrinsic value of transferor company is 20 lakhs. This company is taken by transferee company. So transferee company will be giving on the basis of transferee company's intrinsic value, which is 25, and hence totally 20 lakhs by 25, 80,000 equity shares are issued. Say if nothing is mentioned, given only this one, nothing is mentioned. So the next question, what is the price of this 80,000 equity shares? Is the question clear? 80,000 equity shares are issued at a price of rupees 10 face value and at a premium of rupees 15. Altogether 10 plus 15 is nothing but 25, which is nothing but intrinsic value of B limited. Respond, everybody. Done. How many shares are issued? 80,000 shares are issued at a price of rupees 10 face value at a premium of 15. So altogether 25, which is nothing but the intrinsic value of B limited. Respond, everybody, clear? But given in the question that computation or exchange must be made on the basis of intrinsic value, but shares are to be issued at par, then computation, you got how many shares, my dear children? 80,000 equity shares, which are to be issued at a price of rupees 10. That's it. Clear? Given in the question that shares must be exchanged on the basis of intrinsic value and the issue price is only rupees 15. In this case, 80,000 equity shares are issued at a price of rupees 10 at a premium of rupees 5. Respond everybody clear. And this is the end of dash method, my dear children. Intrinsic value method. Tell me what is the purchase consideration under intrinsic value method, amma? Number of equity shares of transferor company multiplied by intrinsic value of transferor company divided by intrinsic value of transferee company. After computing this one, you will get number of equity shares to be issued at what price. If nothing is given, it has to be exchanged at intrinsic value, out of which generally 10 rupees will become face value, the remaining will become securities premium. If any other price is given in the question, take that price instead of intrinsic value. Respond everybody clear. Now, in the question he is telling exchange must be based on intrinsic value. But unfortunately, he did not give what is the intrinsic value in the question. Given that exchange must happen on intrinsic value, but he did not give what is the intrinsic value. In this context, intrinsic value method is equal to net assets method. Don't forget. If at all in the question given that exchange must happen on intrinsic value. But what is the value? Not given. In this context, intrinsic value is absolutely equal to net assets method. Respond everybody understood. Okay, now moving on to the next thing, net assets method and net payments method. Hardly in our problem, in our institute material problems, only 1 or 2 are basing on intrinsic value and all the remaining are basing on net assets and net payments only. 1 minute. Completed. Listen. The next 2 methods are all about net assets method and net payments method. Sir, if at all total PC is exactly given in the question, then we will call it as net payments method. Total PC is given. What is to be given to equity shareholders? What is to be given to preference shareholders? Given each and everything very, very clearly. And we will call it as net payments method. If at all some portion of PC is missing, say for example, necessary cash is paid, balance is given in equity shares, necessary equity shares. What is the balance and what is the necessary? Clear? Huh? For that purpose, what is to be computed? Net assets is to be computed, and hence that is nothing but net assets method. Respond everybody clear? Huh? Simply, if at all PC, for the purpose of computing the PC, if you are using net assets, we will tell that is net assets method. For the purpose of PC, if net assets are not at all considered, we will call it as net payments method. My dear children, to the maximum extent, not the maximum, almost all every time, under net assets method, net assets is equal to PC. Under net assets method, net assets is equal to PC. Remember this one. Under net assets method, almost all every time net assets is equal to PC, except in one problem. I'll tell you what is that. Respond as of now clear to each and every one. Tell me what are the 4 methods we are having now. Lump sum method, intrinsic value method, net assets method, net payments method. Dash method is not at all considered. But practically dash method is more considered. And hence our books are no way related to the practical aspects. Anyways, let's continue with the next thing. Next method is all about intrinsic value method. What is PC under intrinsic value method, amma? Number of equity shares of transferor company multiplied by intrinsic value of transferor company divided by intrinsic value of transferee company. Clear everybody? Now, if at all intrinsic values are not given in the question, but in the question he is telling that exchange must happen on intrinsic value. In such a case, Intrinsic value method is equal to net assets method. And moving on to the next two methods, net payments and net assets method. If at all each and every PC part is clearly mentioned, then that we will call it as net payments method. If some portion of PC is missing in the form of necessary cash, balance equity shares, balance in preference shares, some part of missing figure is there, then we will call it as net assets method. Respond everybody clear. And my dear children, this is the end of PC. Amalgamation here. Duffer fellow. This is the end of PC. Respond everybody clear. And now moving on to the next thing, Amma. Sir, I told you in amalgamation you are supposed to learn three things. Number one, closing the books of accounts of transfer or company, opening the books of accounts of transferee company, and computation of PC. Till now what is completed ante computation of PC is done. My dear children, almost in every problem, the only typical, peculiar, difficult, nonsense element is all about computation of PC. If you have got how to compute PC, and the rest of amalgamation is very, very simple. Because for closing books of accounts of transfer or company, there are some rules and regulations. For opening the books of accounts of transferee company, there are some rules and regulations. But computation of PC, no rules and regulations. There will be only agreement. Sir, you might understood in one way. They might written it in one way. But what is correct ante, what is given by institute material, that is the correct thing. So take more care. So computation of PC is very, very important. Even in your examination, PC computations will be having greater attentions. And let me start with closing the books of accounts of transfer or company. My dear children, for closing the books of accounts of transfer or company, we have to follow the principles as laid down in accounting standard number. Is not applicable. What is applicable? ICAPs are applicable. For closing the books of accounts of transfer or company, listen very, very carefully. For closing the books of accounts of transfer or company. Sir, frankly speaking, closing the books of accounts means you have to close all the ledger accounts. But technically, it is not possible to close any of the ledger accounts. Because, sir, practically you have to close ledger accounts. But coming to problematics, you will not be provided with ledger accounts. You will be provided only with balance sheet. Because hardly what are the types of accounts you are having? Real account, nominal account, personal account. Already all the nominal accounts will be closed and transferred to P&L account. Now what are the leftover accounts that will be appearing in balance sheet? Real account and personal account. So technically speaking, closing the books of accounts implies if you close the balance sheet, automatically everything is closed. Reason being, already expenses and incomes were closed and transferred to P&L account. And hence, my dear children, you will be provided in the questions with respect to the balance sheet of transfer or company. You will be provided with the balance sheet of transfer or company. Shall I continue? Now, coming to the balance sheet of transfer or company, you just need to observe how the balance sheet of transfer or company is there. Likewise, you will be having all the fixed assets, current assets, and you will be having share capital, reserves and surplus, and you will be having outside liabilities. And sometimes you might have some miscellaneous assets like discount on issue of debentures, preliminary expenses, etc. Clear everybody? I don't know how you have learned the amalgamation, but for closing the books of accounts, I'll tell you a simple approach. Follow that simple approach. All the time you're going to get the answers. Follow this approach. Sir, take care. First of all, you have to study the balance sheet of transfer or company. And in that, identify what are the internal items and what are the external items. What is step number 1, my dear children? Identify the internal items and identify the external items. What do you mean by internal items? Those items which are exactly relating to the shareholders. External items are those items which are relating to the company. My dear children, take care. Shareholders is different, company is different. Internal items are those items which are exclusively relating to the shareholders. External items are those items which are exclusively related to the company. So just answer me. Share capital, is it an internal item or external item? Internal item. Reserves and surplus. Internal item, because reserves and surplus has to be given only to the shareholders. What about outside liabilities? External item, because it has to be cleared by the company but not by the shareholders. Fixed assets and current assets. External items, because assets will be sold by the company and company will make some money. It will not be sold by shareholders. Respond everybody, clear? And miscellaneous assets are nothing but these are some sort of items which must be written off with P&L account. Hey, correct or wrong? Preliminary expense, discount on issue of debentures, underwriting commission, etc. These must be written off with reserves and surplus. And hence even this is also internal items. Respond everybody, clear? Hardly what will be the internal items, sir? Equity share capital, reserves and surplus, miscellaneous assets and preference share capital will be the internal items. And coming to external items, fixed assets, current assets and outside liabilities are the external items. Now check out. In these internal items, these three items are belonging to equity shareholders. This item is belonging to preference shareholders. Those items which are belonging to equity shareholders must be transferred to equity shareholders account. Those items which are belonging to preference shareholders must be transferred to preference shareholders account. Clear? Now come with external items. Sir, frankly speaking, just answer me. Do the transferee company take the share capital of your company? It takes the net assets of your company. Please respond, sir. Net assets. Why will it take share capital of your company? Share capital of your company has to be settled by you. It will take the net assets. Respond everybody. Now net assets are nothing but fixed assets, current assets and outside liabilities. Check out those assets which are taken over by the transferee company and those items which are not taken over by the transferee company. Respond everybody, clear? Step number 1, you have to identify internal items and external items. Internal items, those relating to equity shareholders must be transferred to equity shareholders account. Those items which are relating to preference shareholders have to be transferred to preference shareholders account. And external items, check out those items which are taken over by the new company and those items which are not taken over by the transferee company. Those items which are taken over by the transferee company has to be transferred to realization account. Those items which are not taken over by transferee company open separate accounts. Say for example, debtor is not taken over by the transferee company. Now what happens to debtor? Listen, in the balance sheet there is debtor. Fixed assets, cash, all other inventory, everything is taken over by the transferee company. But it left debtors. What will you do now? You will ask the debtors to pay the money. Ante kada? Sir, if debtors is taken over by the new company, then debtors has to pay the new company. But now the debtors were not taken over and it left. And hence, you have to collect. Which company has to collect? Transferor company has to collect. So, those assets and liabilities which are not taken over by the transferee company, you have to do sale of assets and settlement of liabilities. What is that, Amma? Sale of assets and settlement of liabilities. Respond everybody, clear? Shall I start with the journal entries? Take care, my dear children. Step number 1. What is step number 1, Amma? You have to identify internal items and external items. Sir, for every amalgamation, for every part, whenever you are closing the books of accounts, this is the common procedure. Clear everybody? So now you have to study the balance sheet first. Study the balance sheet and mark what are the internal items and what are the external items. And check out what are the items taken over by the new company and what are the items that are not taken over by the new company. Study that first. After studying, immediately closing the books of accounts of transferor company. Draft three accounts. Number 1, realization account. Number 2, equity shareholders account. Number 3, preference shareholders account. Clear everybody? And you have to draft some more accounts. Those assets and liabilities which are not taken over by the transferee company. Clear everybody? For that thing you have to draft separate account. Say for example, debtor is not taken over. Say for example, cash is not taken over. Shall I continue? Now, identify all the internal items. What are the internal items, Amma? Equity, share, capital, reserves and surplus, miscellaneous assets. Quickly answer me, sir. It's very, very simple. All the assets will be closed to the debit side and all the liabilities will be closed to the credit side. All the assets will be closed to the debit side and all the liabilities will be closed to the credit side. Let me tell you in a very simple way. Equity share capital is having which balance? Credit balance. So to close it has to be debited and it has to be transferred to equity share holders account. So what is the journal entry? Equity share capital account debtor to equity share holders account. So in equity share holders you are having by equity share capital. Respond everybody, clear? Now frankly speaking, no need of journal entries because closing the books of accounts, ledger posting is important. Closing the books of accounts, what is more important? Ledger posting. So I'll concentrate on the same lines. Start. Internal items. Tell me each and every internal item. Number 1, equity share capital. It is relating to dash. Equity share holders. Asset or liability here. Since it's liability, it will be at credit side. Pakka. Next, reserves and surplus. It is relating to equity shareholders. Asset or liability? Liability. So by reserves and surplus. Next internal item. Miscellaneous asset. It is also belonging to equity shareholders. So it is also to be transferred to equity shareholders account. Asset or liability? Asset, and hence it will be at debit side. Miscellaneous or fictitious assets. Respond everybody, done. The next internal item, preference share capital. My dear children, preference share capital is relating to preference shareholders. Clear, huh? Now preference share capital is relating to preference shareholders. Asset or liability? Liability. So it will be at credit side by preference share capital. Respond everybody, clear? Now come to the external item. What are the external items? Fixed assets, current assets, outside liabilities. Check out those items which are taken over, not taken over. Taken over will be in dash account. Asset kada, so it will be a debit side. 2, fixed assets. 2, current assets. Items which are taken over. And liabilities by outside liabilities like debentures, loans, creditors, outstanding liabilities, etc. Respond everybody, clear? Items which are taken over. Now items which are not taken over. As per our example, what are the items that are not taken over, Nana? Debtor and cash. So brought down balance 1 lakh, brought down balance 50,000. Hey, respond everybody, understood? And moving on to the next thing, very, 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 very important. You should never confuse. You are closing the books of accounts. In the sense, you have to close each and every value that is available in books. And hence, till now, whatever you have recorded, it will be recorded at book values. What is the values, Nana? Respond everybody, clear? My dear children, you are doing closing the books of accounts of transferor company. You are doing closing the books of accounts of transferor company. Closing the books of accounts of transferor company is nothing but you have to close each and every element. Each and every element will be closed with the value that is available in that books, which is nothing but book value. Respond everybody, clear? Till now you did not touch any other value except book value. Shall I proceed further? So respond. Okay, so this is all about the initial part. Now the next one. Listen very, very carefully, everybody. Sir, I told you those assets which are not taken over must be sold and settled. Sale of assets and settlement of liabilities. Say debtors are 1 lakh. You are asking cash from them. They told we can give you a maximum of 80,000 only. So to debtors account 80,000. Respond clear, huh? How much is the profit or loss on debtor, Nana? Loss. How much is the loss, Nana? Straight away, you are having 2 options. Option number 1, you can transfer it to realization account. Option number 2, you can transfer it to equity shareholder account. Anything is absolutely correct. There's nothing wrong. What are the 2 options? You can transfer it to realization account or you can transfer it to equity shareholders account. But it is my policy that I will transfer only to equity shareholders, because I will transfer only those items which are taken over to realization account. Since this item is not taken over, I will transfer the profit or loss only to the equity shareholders. But this is up to you. If you want, you can also transfer it to realization account. Respond everybody, clear? And hence this 20,000 will also be recorded in equity shareholders account. Something like 2 debtors. 2 debtors. How much ever the amount, that much. Respond understood. Next, check out. Check out in the question if cash is taken over by the new company or not taken over by the new company. If at all cash is taken over by the transferee company, then total cash of 1,30,000 has to be transferred to realization account. If the cash is also not taken over, this has to be transferred to equity shareholders. A logic clear? Sir, respond, is the logic clear? Check out if the cash portion is taken or not taken. If it is taken over by the new company or transferee company, transfer it to realization account. If at all the cash is not taken over by the transferee company, it has to be transferred to equity shareholders account. Equity shareholders will enjoy that cash by distributing among themselves. Respond, logic clear? This is all the end of step number 1. So you should not write like consolidation, step 1, step 2, step 3 like that. You have to understand the steps procedure in your mind and you have to draft the accounts. Shall I proceed further? Now step number 2 is all about PC. What is step number 2? PC. Purchase consideration. Strictly speaking, purchase consideration due, purchase consideration receipt and purchase consideration disbursement. Due, receipt, disbursement, which is nothing but distribution. Shall I continue? So respond everybody, listen carefully. First one, purchase consideration due. Who has to give PC? Transferee company has to give, and hence transferee company account debtor 2, it has to give PC because it had taken some items. All the items which are taken over were kept in dash account, realization account, and hence transferee company account debtor to realization account. Respond, logic clear? Now the next one, receipt of PC. You are receiving the PC. It might be either in the form of cash or it might be in the form of check or it might be either equity shares in transferee company or preference shares in transferee company or debentures in transferee company or bonds in transferee company or any other asset in transferee company to transferee company account. I mean to tell in a single word, PC account debtor to transferee company account. Last and final, distribution of PC among the shareholders. So you have to give each and every PC to the shareholders. So equity shareholders or preference shareholders account debtor to PC. Respond everybody, clear? These are the journal entries. But I told you what is important here. Closing the books of accounts, ledger is important. So now check out the magic. Transferee company cancel. PC and PC is cancelled. Ultimately, only 2 things are remain. Number 1, realization account credit side, shareholders account debit side. What is remaining? Realization account credit side, Shareholders account, debit side. Shall I continue? So now PC will be ultimately posted in realization account, credit side by purchase consideration. It might be either cash or bank or equity shares or preference shares, whatever it is. Clear? And finally, this has to be distributed to the shareholders. So equity shareholders PC will be given to equity shareholders, and preference shareholders PC will be given to preference shareholders. That is how PC is closed. Respond everybody, clear? My dear children, PC will be posted in dash and dash account. Realization account, credit side. Shareholders account, debit side. Respond everybody, done. Okay, now moving on to the last and final step, that is all about step number 3. Closing procedure. You have to close everything now. My dear children, all the balance sheet accounts were closed already. Share capital closed, reserves and surplus closed, miscellaneous assets closed, fixed assets, current assets, everything closed. Now what are the leftover items? Realization account, equity shareholders account, preference shareholders account. So what is the best procedure to close? Always it is recommended to close preference shareholders first. Always it is recommended to close preference shareholders first. Find the profit or loss and let the preference shareholders profit or loss transfer to realization account. And second, close the profit or loss of equity shareholders and transfer it to realization. Automatically realization account will be closed. If it did not close, then you have done some mistake. Respond everybody, clear? So take care, my dear children. Listen very carefully. So now check out the preference shareholders. Sir, you have to pay 1 lakh to preference share capital, but the PC is paid only 80,000. Profit or loss? Think from the shareholders point of view. You have to pay 1 lakh but paid only 80,000. Profit or loss? Loss. How much is the loss, Nana? That will be transferred to realization account. Clear everybody? So in realization account, by preference shareholders or equity shareholders if it is loss. If it is profit, to preference shareholders or equity shareholders, profit will be there. Respond everybody, clear? So you have to close first which account, Nana? Preference shareholders, and close and transfer it to realization account. And then equity shareholders, close and transfer it to realization account. Respond everybody, clear? And hence ultimately dash account will get closed, Nana. Realization account. Respond, done. My dear children, sometimes in the examination, he will not ask you to draft all these accounts. He will ask only to draft realization account. In such a case, you are not drafting preference shareholders account, kada? Yes or no? Even in this case also, you are supposed to transfer the profits or losses to the realization account. How, sir? Very simple. Check out the preference share capital that is existing in the balance sheet. Say it is 1 lakh. And check out how much is the PC paid. 80,000. So automatically find profit or loss. Loss. How much is the loss? 20,000. My dear children, to find the loss that is to be attained to the preference shareholders, no need to draft preference shareholders account. You can also work out in a very common sense way. But for equity shareholders, you have to draft equity shareholders account. A respond logic clear? To find the profit or loss to preference shareholders, no need to draft account. Just check out what is preference share capital and what is PC paid. If excess is paid, we'll call it as profit to preference shareholders. If less amount is paid, we'll call it as loss to preference shareholders. And if it is loss, by preference shareholders. And now you'll get one balancing figure here. Hey, is it clear? After posting all the assets and all the liabilities and PC and loss or profit to preference shareholders, you will be getting one balancing figure. That balancing figure is nothing but profit or loss to equity shareholders. Respond everybody, understood? And my dear children, this is the end of closing the books of accounts of transfer or company, which will be in a 3-step approach. Step number 1, just work out with your common sense. Analyze the balance sheet given in the question. What are internal items? What are external items? Check out what is the question is he asking. If he's asking to draft all the accounts, then you have to open all the accounts. If he's not asking to open all the accounts, just check out the requirement and open accordingly. But what is more important is all about step number 2. PC will be posted only in realization account credit side, shareholders account debit side. And last and final, close profits or losses. First find the profit or loss to preference shareholder and let the same be transferred to realization account. And then close equity shareholders and let it be transferred to realization. Sometimes in examination, you will be doing a blunder. It's all about even when preference shareholders and equity shareholders are there, you will be opening realization account, and after posting PC, fixed assets, current assets and outside liabilities, you'll straight away work out the balancing figure and you'll get a single figure. You would like to transfer it to equity shareholders account. Did you get my point? What did you miss here? Profit or loss to preference shareholders. So be careful in that aspect. If at all in the question preference share capital are not there, then you can tell the total profit or loss is belonging to equity shareholders. But if preference share capital is there, you have to be very, very careful and check out carefully. Respond everybody, understood? And my dear children, that is all about closing. And the last and final part of closing is all about realization expenses. If it is reconstruction expenses in internal reconstruction, there is nothing great. Capital reduction or reconstruction expenses account debtor to cash or bank account. But here it is not like that. You are having different cases. Take care. Realization expenses. Case 1, if it is borne by transferor company and paid by transferor company, in the sense it is by that company only. What is the journal entry? Realization account debtor to cash or bank account. Second one, if it is borne by transferee company and if it is paid by, reverse. Ante, it is borne by transferee company, but it is initially paid by transferor company. Borne by transferee company. New company has to bear. But initially, who is paying it? Transferor company. So check out very carefully at the time of payment to cash or bank. But as per the agreement, it must be borne by transferee company. So initially at the time of payment, transferee company account debtor to cash or bank. In future, transferee company will reimburse the amount to you. In that situation, cash or bank account debtor to transferee company account. Respond clear everybody? Last and final, third case. It is borne by transferee company and paid by transferee company. In the sense, it is totally considered only by transferee company and you are actually a transferor company and hence no need to give any accounting treatment. Respond everybody, understood? And that's it, my dear children. This is the concept of closing the books of accounts of transferor company. Clear everybody? In every problem it will be easy, but in some of the problems he will tell to draft realization account, equity shareholders account, preference shareholders account. Whenever we are drafting all these accounts, there is no problem. But in question, he will ask you to draft only realization account. Of course, in that case also, you can draft equity shareholders and preference shareholders account. But time will be wasted. And hence, draft only realization account. And I told you how to find profit or loss. What is easy to find? Preference share capital. Work out in your mind. Work out in your calculator. And put the preference shareholders profit or loss first. And you have to find the balancing figure, which is nothing but profit or loss to equity shareholders. Respond everybody, clear? And another peculiar part of closing the books of accounts, in one of the problems he will be given that debtors were not transferred and creditors were not transferred. Debtors were collected by transferor company and liquidator is supposed to take some percentage of commission. Did you remember that? Let me show you. There is a different adjustment. Yeah, see here. Liquidator of Glory Limited is appointed for collection of trade debtors and payment to trade creditors. He retained the cash balance and collected 1,10,000 from debtors, where the book value of debtors is 1,18,000, and paid 1,80,000 to the creditors, where he is supposed to pay 1,83,000. And liquidator is entitled to receive 5% commission for collection and 2.5% for the payment. Last and final twist. The balance of cash will be taken over by the new company. Clear, everybody? So now listen, you have to open realization account, you have to open equity shareholders account, you have to open preference shareholders account, along with this debtors account, creditors account, cash or bank account. How much debtors is given, sir? 1,18,000. How much creditors is there, sir? 1,83,000. How much cash is there, sir? Say for example 10,000. Is it clear? Now how much debtors is collected, sir? 1,10,000 by cash or bank account. 1,10,000 to debtors account. 1,10,000. How much creditors is paid, sir? 1,80,000 to cash or bank account. In cash or bank, by cash or bank account, 1,80,000. Respond, everybody, clear? Say for example, let me take opening balance, 1 lakh is there. What is the opening balance? 1 lakh. Not yet over. Liquidator is supposed to take some commission. So by commission to the liquidator. Clear, everybody? Now listen very carefully. What is the entry for commission to the liquidator? Commission account debtor to cash or bank account. And finally commission has to be closed and transferred again to the realization account. So realization account debtor to commission account. And hence ultimately you can write a single journal entry, that is realization account debtor to cash or bank. Clear? And listen very carefully, and ultimately the journal entry. What is the journal entry, Amma? Realization account debtor to cash or bank account. Respond, everybody, clear? And what is the commission he told, Nana? 5% on collection and 2.5% on payment. So 5% on 1,10,000, 5,500 plus 2.5% on 1,80,000. Entamma? 4,500. On a whole, it comes to 10,000 is the commission paid. Finally, you will be having some balance of cash, kada. That balance of cash has to be transferred to realization account because it is taken over by the transferee company. Respond, everybody, clear? So take care. This is one of the different points that you are having. Shall I proceed further? And my dear children, anyways, that's the end of amalgamation kadu. Closing the books of accounts of Swarrar company. Just relax for 2 to 3 minutes and then I'm going to start opening the books of accounts of transferee company. Listen. Stay calm. Sir, listen, my dear children, opening the books of accounts of transferee company. Shall I continue? Sir, this is the part where accounting standard number 14 is coming into the picture. So take more care, my dear children. Understand carefully. Sir, I told you that there are two kinds of amalgamation. What are the two types of amalgamation, Nana? Amalgamation in the nature of merger and amalgamation in the nature of purchase. Coming to amalgamation in the nature of merger, there will be 5 conditions. If all the 5 conditions are satisfied, then we will tell that it is amalgamation in the nature of merger. If not, we will call that as amalgamation in the nature of purchase. What are all the 5 conditions? Condition number 1. all the assets and liabilities of transferor company should become assets and liabilities of transferee company. And such a transfer should be made at book values. Such transfer should not be made at fair values. Such a transfer should not be made at fair values. Such transfer should be made at book values. In this context, clarifying you one more thing, listen carefully. While closing the books of accounts and in posting realization accounts, equity shareholders account and preference shareholders accounts, you have to consider book value. But while computing PC, especially when you are going with net assets method, you have to consider fair value or market value or agreed values. So take more care. So tell me, my dear children, we are seeing the conditions which are relating to amalgamation in the nature of merger. All the assets and liabilities of transferor company should become assets and liabilities of transferee company. And such transfer should happen at dash values, book values. Next one, very, very important. Tell me what is the next one, Nana? Shareholding of transferor company should become a minimum of 90% should become the shareholding of transferee company. I mean to tell 90% of not shareholders, shareholding of transferor company should become the shareholding of transferee company. And the next one, such PC must be given only in equity shares to the equity shareholders. PC must be exchanged only in equity equity shares. And last and final thing, whatever the business of transferor company is there, it must be continued by transferee company. Of course, for each and every point there are exceptions. You can read the exceptions, you'll understand. Exceptions are not important, only the main course is important. What are the 5 conditions? Condition number 1, assets and liabilities of transferor company should become the assets and liabilities of transferee company. Such transfer should be made at book values. 90% of shareholding of transferor company should become the shareholding of transferee company. Such a transfer PC to equity shareholders must be given only in equity shares. Please take care, my dear children. We are concentrating the PC to equity shareholders only. So for preference shareholders, you can give in any way. PC to equity shareholders must be given only in equity shares. Last and final, the business of transferor company should be continued by transferee company. Respond, everybody understood? And all these are the 5 conditions. If all these 5 conditions are satisfied, we will consider it as merger. Any of the 5 conditions are not satisfied, we will consider it as purchase. And my dear children, if it is amalgamation in the nature of purchase, we will be using purchase method. If it is amalgamation in the nature of merger, we will be using pooling of interest method, where we will call it as genuine pooling. Reason is very, very simple. Sir, amalgamation in the nature of merger, is it appearing like a new company or the old company? Transferor company is acquired by transferee company and it is amalgamation in the nature of merger. Even though it is in the hands of transferee company, it appears as if it is transferor company only. Same assets, same liabilities, even the values are also same. Moreover, 90% of the shareholding is also the same. Every owner is also your owner again, because PC to equity shareholders must be given only in equity shares. Whatever the business of transferor company is there, the same business is being continued by transferee company. So where is the concept of new company? It is something like the old company with a new name. Am I correct or wrong? And hence we call it as genuine pooling. Nothing great to adjust anything. Simply assets of that company plus assets of this company. I mean to tell assets of transferor company plus assets of transferee company. liabilities of transferor company plus liabilities of transferee company, even reserves and surplus of transferor company plus reserves and surplus of transferee company, which is nothing but genuine pooling. What is it called as, Nana? Genuine pooling. And the method is nothing but pooling of interest method. Shall I continue? Anyways, first let me start with purchase method. Sir, take care. I can tell simultaneously purchase method and pooling of interest method also. First and foremost entry, PC due. First and foremost entry is all about PC due. Who is purchasing? Transferee company. So who has to pay the PC? Transferee company. To whom it has to pay? Transferor company. But transferor company is an artificial person and hence a liquidator will be appointed. So you have to give the PC to the liquidator of transferor company. So the journal entry is you have to give PC because you are purchasing the business. So what is the journal entry ultimately? Business purchase account debtor to liquidator of transferor company account. Respond everybody clear. And the next entry for business purchase. What is the next entry, Nana? For business purchase. My dear children, your purchasing business implies you are purchasing dash and dash. All the assets and all the liabilities. So what is a journal entry? Assets account debtor to liabilities account. Very, very important. This has to be recorded at fair values or market values or agreed values. Respond everybody clear. Or even revalues. It will be given in the question. Follow that value and record that. And finally, to business purchase. This must be credited with PC. Very, very important. Very, very important. Assets minus liabilities is nothing but net assets. This is nothing but PC. So now you have to compare net assets and PC. If net assets is equal to PC, absolutely no problem. Entry will get tallied and closed. If net assets is greater than PC, automatically you have paid less. Am I correct or wrong? I mean to tell PC is greater than net assets, Nana. Let me take this way. It might be more simple for you. PC is greater than net assets. And you are paying more. Why you are ready to pay more? Goodwill of that company, and hence automatically goodwill has to be debited as if it is a balancing figure. If at all PC is less than net assets, you are paying less, which is nothing but profit for you, and hence it has to be transferred to capital reserve, which is again a balancing figure. Respond everybody clear. So the second entry will be as simple as such. Assets account debtor to liabilities account, which has to be recorded at fair value or agreed value or market value or revalue. And 2, business purchase account, which has to be recorded with PC. This is nothing but net assets. This is nothing but PC. Compare net assets and PC. If PC is equal to net assets, no problem. If PC is greater than net assets, you are paying more, which is nothing but goodwill. If PC is less than net assets, you are paying less, which is nothing but capital reserve. This will become balancing figure. Respond everybody clear. And that is how the entry will get tallied. Respond everybody clear, huh? And the third entry, what is it called? Settlement of PC or payment of PC. To whom we have to settle now? Liquidator of transferor company to very, very important. This time, sir, actually at the time of receipt of PC, we have written equity shares in transferee company. At the time of receipt of PC, we have written something like equity shares in transferee company, preference shares in transferee company, percentage debentures or bonds in transferee company. Now, it has to be recorded like to we are issuing. Am I correct or wrong? So, to equity share capital or preference share capital or percentage debentures or cash or bank account. If you issue at premium to securities premium. If you issue at discount on issue of debentures. Respond everybody, understood? This is nothing but payment of PC. These are the three main journal entries in opening the books of accounts of new company or transferee company. Along with these three main entries, there are three sub-journal entries also. Number one, what is it called? Settlement to the debenture holders. Sir, creditors is not having any document. Creditors of old company had become creditors of new company. It's okay. There is no proof, no document, nothing is needed. Outstanding expense of old company had become outstanding expense of new company. No document, no proof, nothing is needed. But debenture holders not like that. They are having debenture certificate. So if at all debenture holders of transferor company had become debenture holders of transferee company, then you have to write a special journal entry, that is settlement to the debenture holders. Percentage debentures of transferor company to percentage debentures account. This is relating to the transferee company. If issued at premium, to securities premium. If issued at discount on issue of debentures. Respond everybody, understood? Hold on this thing. This is actually very, very important. Let us speak with it later with different cases. And let me move on to the next sub-journal entry. And the next sub-journal entry is all about elimination of mutual owings or ICTs. Intercompany transactions. As simple as such, liabilities account debtor to assets account. To one company it is creditor and the other company it is debtor. Whenever the two companies have merged, the same company is debtor to itself, the same company is creditor to itself, and hence these elements must be eliminated. And ultimately the journal entry is liabilities account debtor to asset account. Very important. If at all there is a stock reserve. If at all there is a stock reserve, then you have to eliminate. How to eliminate, sir? Sir, take care. You have to eliminate the stock reserve by debiting it to goodwill. Goodwill account debtor to stock account. Say for example, A Limited sold to B Limited. Cost price is equal to 1 lakh. Selling price is equal to 1,20,000. So B Limited is purchasing the asset, purchasing the stock at 1,20,000. B Limited not yet unsold. In the meanwhile, A and B gets amalgamated. Now stock is lying in which company? B Limited. At a price of rupees 1,20,000. But what is the original cost price now? 1 lakh. How much extra portion is there? 20,000. This is nothing but stock reserve. What is this, my dear children? Stock reserve. And ultimately the journal entry will be stock is 1,20,000. It must be reduced to 1 lakh. And hence to stock account 1 lakh. And the 20,000 is there, right? The 20,000 has to be debited to goodwill. Because it is loss kada. My dear children, if there is capital reserve, you can debit capital reserve instead of goodwill. You can debit capital reserve if at all there is a capital reserve. So capital reserve or goodwill account debtor to stock account. Respond everybody, clear? And the last and final sub journal entry is all about realization expenses. Borne by transferor company and paid by transferor company. We are which company? Transferee company. So absolutely not needed for us. Next, initially paid by transferee company, later on, initially paid by transferor company, later on it has to be reimbursed by transferee company. Then what could be the journal entry, sir? At the time of payment done by the transferor company, they are doing the payment. Stay clear, everybody. So initially I have to write the due entry. Initially I have to write the due entry. Sir, for my company, is it payable or receivable? Payable. Payable to that company kadandi. And hence to liquidator of transferor company. Sir, is it my expense? That company's expense. I mean to tell transferee company expense, transferor company expense. transfer or company expense is borne by transferee company. So technically speaking, it is lost to me, and hence it has to be debited to capital reserve or goodwill. And ultimately at the time of payment or reimbursing, liquidator of transfer or company account debtor to cash or bank account. Respond clear? And finally, case 3, my dear children, transfer or company's expense is paid by transferee company outrightly. I mean to tell, initially it is not paid by transfer or company and then not reimbursed by transferee company. Straight away, transferee company is paying directly. So, capital reserve or goodwill account debtor to cash or bank account. Respond everybody clear? And this is the end of amalgamation in the nature of purchase, with last and final special point, that is all about statutory reserves. My dear children, no reserves and surplus of transfer or company will be transferred to transferee company if it is amalgamation in the nature of purchase, except statutory reserves. So statutory reserves have to be transferred from transferor company to transferee company. What are the statutory reserves you are having? Investment allowance reserve, foreign project reserve, export profit reserve. Generally only these will be the statutory reserves that will be tested for you. What are the 3 reserves, my dear children? Investment allowance reserve, foreign project reserve, export profit reserve. Generally these will be the 3 reserves and surplus which will be tested. Shall I proceed further? So now ultimately what is the entry for transfer of statutory reserves? Sir, I have to take all the statutory reserves to statutory reserves account. Then debit what, sir? A special account called amalgamation adjustment reserve account. What is a special account, my dear children? Amalgamation adjustment reserve account debtor to statutory reserve account. And statutory reserves will be as usual shown in reserves and surplus note 2. Amalgamation adjustment reserve will be shown in note 2 as if it is a negative item by a separating. I mean to tell, take the general reserve of transferee company, take P&L account. Transferee company, take all other reserves and surplus. Transferee company, take statutory reserves. Transferee company plus transferor company. And now check out the total. From this total, deduct amalgamation adjustment reserve. And finally, you are going to get the total. This will be taken to balance sheet. Respond, everybody understood? That's the end of amalgamation in the nature of purchase. Now let me start with amalgamation in the nature of merger. All the remaining things are same. Except where goodwill or capital reserve is used, it is recommended to use P&L account. Except where goodwill or capital reserve is used, it is recommended to use P&L account. Listen very, very carefully. Entry number 1 is copy paste. Entry number 3 is also copy paste. I mean to tell, PC due. What is the entry? Business purchase account debtor to liquidator of transferor company. Copy paste. Entry number 3, disbursement of PC. Liquidator of transferor company account debtor to PC. These 2 things are copy paste. Very, 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 very important business purchase entry. Check out very carefully. Assets account debtor to liabilities account. At what value, sir? Book values. Why book values, my dear children? This is amalgamation in the nature of merger. This is amalgamation in the nature of merger, and hence it will be always recorded at dash values, book values. You are following dash method, my dear children, pooling of interest method, and hence along with all the assets and liabilities, also you have to get all the free reserves. Also you have to get all the specific reserves. Also you have to get all the statutory reserves. Respond, everybody clear? Now finally, to business purchase account. You have to compare. Sir, up to this clear, everybody? Assets must be recorded at dash value, book value. Liabilities must be recorded at book value. Also, along with all the assets and liabilities, get all the free reserves, specific reserves, statutory reserves. And now finally, business purchase. So now ultimately very simple. For your kind information, in amalgamation in the nature of purchase, this is the entry you have written. Am I correct or wrong? If you observe this one, assets minus liabilities is nothing but net assets. You are comparing net assets with dash. PC. Correct or wrong? So now here also you have to compare this total part with PC. Total part is nothing but net assets. You have to compare it with PC. But here net assets doesn't mean assets minus liabilities. Check out assets minus liabilities minus free reserves minus specific reserves minus statutory reserves. Nonsense. This is simply nothing but share capital. From assets, you are deducting all the liabilities and you are deducting all the reserves. The leftover part is nothing but share capital. So conclusion, you have to compare dash and dash. Share capital and PC. You have to compare share capital and PC. Listen my dear children, if at all PC is equal to share capital, no problem. If at all PC is greater than share capital, very very important, listen carefully. If at all PC is greater than share capital, is it profit or loss? Loss. This loss has to be adjusted in the following order. First, this has to be adjusted against the free reserves of transfer or company. I mean to tell, you have to adjust this column. If free reserves of transfer or company is totally exhausted and if at all this had become zero, then immediately you have to adjust against the free reserves of transferee company. The same will be debited in this journal entry, free reserves of transferee company account. And last and final, part 3. If free reserves of transferee company are also totally utilized, simply debit P&L account. Respond everybody clear? This is very important part. Please don't confuse at all. Even here also indirectly you are computing net assets and PC only. But here net assets is nothing but share capital. So compare PC versus share capital. If PC is equal to share capital, no problem. If PC is greater than share capital, it is loss. That loss has to be adjusted in the following order. Order number 1, free reserves of transfer or company. If it is totally exhausted, free reserves of transferee company. If even that is also totally completed, simply debit P&L account. Respond everybody clear? So, you have to debit free reserves of transferee company only when free reserves of transfer or company had become zero. Respond everybody understood? So, I mean to tell something like, say assets are 100, 2 liabilities are 20, 2 free reserves are 10, 2 specific reserves are 5, 2 statutory reserves are 5. So, 2 business purchase. How much? 60. So exactly share capital is equal to business purchase here. Hey, respond everybody clear? Say for example share capital is equal to 60. So now share capital 60 is exactly equal to business purchase 60. Not a very big deal. Throw it away. Next, say for example if your business purchase is 65. What is your share capital? 60. But what is your PC? 65. Profit or loss? How much is the loss? First, this has to be adjusted against the free reserves of transferor company. So, let it be 65. But this is not 10. After adjusting that excess PC, this will become 5. Hey, respond clear everybody. Say for example, this is 68. How much is excess PC? 8. So, in 10, you have to adjust 8 and balance will be 2. Say for example, business purchase this time is 73. Compare share capital and business purchase. How much is excess? This 13 is loss. How much is free reserves I am having? So 10 minus 10, 0. Still how much loss is there? that 3 rupees has to be debited with free reserves of transferee company. Say for example, transferee company free reserve is only 1. Then remaining 2 will be debited to P&L account. Respond everybody, done. That is the end of this concept. No need to record a separate entry for carrying forward of statutory reserves, because statutory reserves are carried forward under pooling of interest method. Respond, shall I proceed further? And moving on to the next thing, my dear children, sub entries. Number 1, entry to the debenture holders. Copy paste, no change, it is same. I mean to tell percentage debentures of transferor company to percentage debentures. If issued at premium, if issued at discount. And the next one, elimination of ICTs. Copy paste, no change. Liabilities account debtor to assets account. But take care with stock reserve. That has to be debited to P&L account. P&L account debtor to stock account. Clear everybody? And the last and final thing, realization expenses. Wherever you are using goodwill or capital reserve, there you are supposed to use P&L account. I mean to tell, you have written an entry, goodwill or capital reserve account debtor to cash or bank account. Instead of that, now the entry will become P&L account debtor to cash or bank account. I mean, transferor company expenses is paid by transferee company. So what is the entry in purchase? Goodwill or capital reserve to cash or bank. But in merger, it will become P&L account debtor to cash or bank. Respond everybody, clear? I wantedly miss one very important case. That's all about if PC is less than net assets. What is so special in that, sir? Yes, there is a special and also there is a controversy. Say for example, assets account debtor to liabilities account to free reserves account to statutory reserves account to specific reserves account to business purchase account. Now, if your PC is less than net assets, the balancing figure will be at credit side. Correct or wrong? Now, to which account it has to be transferred? Listen, as per accounting standard number 14, this has to be adjusted against P&L account. I told you that very, very clearly. As per the Expert Advisory Committee of ICAI, it is transferring it to capital reserve. This is the controversy. Now, in your study material, they have purely followed accounting standard number 14 and they have credited the difference to P&L account in one problem. But in the past old IPCC materials, 2012 syllabus, in that part, they have followed the Expert Advisory Committee of ICAI rules and the difference is adjusted to capital reserve. Now what to write in the exam? Both. Likewise, first write to P&L account and then put note. As per accounting standard number 14, as per institute material, if at all PC is less than share capital and if it is amalgamation in the nature of merger, the difference must be adjusted through P&L account. But as per Expert Advisory Committee of ICAI, the difference has to be transferred to capital reserve account. Respond everybody, understood? My dear children, this is the end of amalgamation in the nature of merger and amalgamation in the nature of purchase. And get ready, we are going to start and solve the different aspects of amalgamation. Sir, whatever points I am going to discuss now are very, very different. Almost all the different adjustments of institute materials are covered except one Akasha Ganga problem. In one of the RTPs of institute material, he had given a very, very different problem, and in that problem, there will be negative net assets. Net assets itself will be negative. So automatically, equity shareholders are not getting any single rupee. Hope you have got my point. There the PC is totally given to the preference shareholders. So that was a very different problem. If at all you have encountered with such kind of problems in the examination, immediately it's an alarming point to you to leave it as choice. Because it's an advanced concept. You can't solve it. It is highly impossible to solve within 30 minutes. Anyways, let's come back. Issue of such amount of fully paid 6% debentures in LK Limited as is sufficient to discharge 5% debentures in K Limited at a discount of 5% after takeover, and the book value is 2 lakhs. So this is actually very important. Listen very carefully. Book value of transferor company percentage debentures is equal to 2 lakhs. Now transferee company is taking these debentures, and these debentures were settled at 5% discount after takeover. So now you are supposed to tell me what is the book value and what is the settlement value in this case. Listen very carefully. And what is the agreed value? I mean to tell. Listen very carefully, everybody. Sir, what is the book value of transferor company? 2 lakhs. First of all, the entire 2 lakhs is taken over by transferee company. So agreed value is also 2 lakhs. And after that, transferee company is settling this 2 lakhs with 5% discount. Hey, it is not issuing the debentures at 5% discount. It is settling the total value at 5% discount. What is the meaning of this? First of all, it will take assets account debtor to liabilities kada. Hey, response sir. 2% debentures of transferor company. 2 lakhs is the agreed value. And then settlement to the debenture holders. Percentage debentures of transferor company 2 lakhs. 2% debentures. Clear everybody? This is relating to transferee company. 2 lakhs multiplied by 95%. 1,90,000 is only issued at par. So what about the remaining 10,000, sir? This 10,000 is nothing but settlement value discount. Ante for 2 lakhs, I'll pay you only 1,90,000. I don't pay you the 10,000. So it's profit to me, which will be transferred to capital reserve account because it is a capital profit. Respond everybody clear? In this context, what is the agreed value? My dear children, what is the agreed value? 2 lakhs. What is the settlement value? 1,90,000. Shall I proceed further? Say for example, the same point is given. This is not there. After takeover is not there. In this case, 2 lakhs is taken over by the transferee company at 5% discount. Straight away it will become 1,90,000. In this case, 2% debentures will become 1,90,000. Percentage debentures will become 1,90,000, and this concept is not there at all. Respond logic clear? After takeover, word is having more sense here. Take care. After takeover ante initially we are accepting the 2 lakhs and then 2 lakhs is settled at 1,90,000. If this after takeover is not there, we will take the 2 lakhs at a discount of 5% and straight away the agreed value will become 1,90,000. Respond everybody clear? And moving on to the next thing, very important, take care. If at all, given in the question that provision is created for inventory to the extent of 10%, it doesn't mean that provision for inventory is created. Value of inventory is reduced. Respond, is it clear? Say for example, very carefully, 1 lakh is the value of inventory. And he is telling that provision for inventory is created to the extent of 10%. Then inventory account debtor 1 lakh to provision for inventory account 10,000 is wrong. You have to take all the assets account debtor. Along with that, you have to take inventory at 1 lakh minus 10%, which comes to 90,000. Respond everybody clear? I'm telling you the agreed value, my dear children. And of course, remaining liabilities is quite common. And say for example, provision is created for debtors. Obviously, you have to take the gross figure for debtors and you have to create a provision for debtors separately. Respond everybody clear. Sir, understood? Provision for inventory is created. Doesn't mean you should not create a provision. It implies that decrease in value of inventory. Provision for debtors is created means you have to create a provision. Say for example, next concept. Reduction in value of inventory doesn't mean you should create a provision. It is something like decrease in value of inventory. Reduction in value of debtors implies provision is created. Respond clear? Sir, is it clear? Conclusion. If at all you are seeing that debtors value is reduced, it is always recommended to create a provision. If at all debtors value is reduced, it is always recommended to create a provision. Whether or not in the question he is asking you to create the provision. Reduce the value of debtors, create the provision. Create provision for debtors, create the provision. Reduce the value of inventory, don't create the provision, decrease the value of inventory. Create the provision for inventory, don't create provision, decrease the value of inventory. Respond everybody clear. Conclusion for debtor decrease, always it is recommended to create a provision. Respond understood? And this is goodwill. So that's very, very simple. You can just go through that point. Goodwill point in one of your problems. That's normal. While computing goodwill, you should not consider abnormal items. While computing, my dear children, while computing goodwill, you should not consider abnormal items. You have to consider only normal items. Remember. Now, very important, unrecorded current asset. My dear children, in transferor company, there is an unrecorded current asset. This is taken over by transferee company. Tell me how this will be adjusted in the books of transferor company. There is an unrecorded current asset in transferor company. How will you adjust it in realization account? It will be ignored. It will be ignored because while preparing the realization account, each and every element has to be recorded with book values. Unrecorded current asset implies that current asset is not there in the books of accounts, and hence you are not going to record anything and it will become absolutely zero. But whenever it is taken over by transferee company, it has to be recorded in the taken over journal entries. Assets account debtor to liabilities account. In that you also have to record unrecorded current asset. And my dear children, also the same has to be considered for computation of net assets. My dear children, hope you know what is net assets. Net assets is equal to dash minus dash. Assets minus outside liabilities computed by considering fair values or agreed values or market values or revalues. And then you will be getting one amount. I told you under net assets method, net assets is equal to PC. Net assets is equal to PC. Take care, my dear children. Whenever this net assets is equal to PC, then automatically there is no goodwill or there is no capital reserve. Respond clear? So take care. That's one more point. Statutory reserves already done. This question, net assets computation. Yeah, sir, the main problem of this question is all about balance sheets were given as at 31st March 2020. But the amalgamation is happened on 1st July 2020. So how many months gap is there? 3 months gap is there. During these 3 months, 2 transactions happened. Number 1, net profit earned. Number 2, depreciation provided. What are the 2 transactions happened? Net profit earned. Of course, many transactions happened. Conclusion or 2 things given in the question. During those 3 months, net profit earned and depreciation provided. Respond everybody clear? So now how to adjust these 2 things in the books of accounts is the toughest task here. So in this context, you have to remember that depreciation is a non-cash expense and this has to be added to the net profit in order to find cash flows. Did you remember? Sir, generally, if nothing is mentioned, total net profit is earned in cash. Hope you have got my point. If nothing is mentioned, total net profit is earned in cash. Total net profit is earned in cash. Remember, this is very, very important. But here telling that in this P&L account, there is a depreciation. So now net profit plus depreciation is equal to cash. Respond everybody clear? Huh? So your adjustments will be like this. For existing P&L account, you have to add 3 months profit. For fixed assets, you have to deduct 3 months depreciation. For existing cash balance, you have to add net profit plus depreciation, where net profit plus depreciation is equal to cash. They respond understood. Here 3 months profit doesn't mean, here 3 months profit means after deducting depreciation. Check out, your total balance sheet is getting tallied. Point number 1, plus 3 months net profit after depreciation. At cash you are getting plus 3 months net profit plus depreciation. And at fixed assets you are getting minus depreciation. This is fixed assets, this is cash, and this is net profit. Check out, your balance sheet is tallied. Net profit 3 months plus depreciation minus depreciation is nothing but 3 months net profit. And the same is 3 months net profit here. So respond, is it clear? I have given you the little idea about how to adjust the 3 months data. If you read the question, you will get it in a better way. Respond clear. And yeah, this is another question where the concept of internal reconstruction is given in amalgamation. I mean to tell, transferee company is there, transferor company is there. Transferee company is first internally reconstructing and then it is acquiring transferor company. Transferee company is first internally reconstructing and then it is acquiring transferor company. This is the different problem, take care. And this question, sir, I told you generally in almost every problem net assets is computed, then net assets is equal to PC. Am I correct or wrong? But in this problem, net assets is computed, PC is on the basis of net assets, but net assets is not equal to PC. This is a different problem where net assets is computed for computation of PC, but net assets is not equal to PC. Clear? And for what net asset is computed here ante, see here PC is given like this. 60,000 equity shares must be given to Sun Limited and Neptune Limited in proportion to the profitability. These are the profitabilities. Basing on these profitabilities, you are supposed to give the 60,000 equity shares to the two companies. And then very, very important, 15% debentures must be issued at par to the income equivalent to 8% return on business of capital employed. Which implies that, listen very carefully, first of all, you have to compute the net assets of Jupiter, Sun and Neptune. So you have to compute net assets of Sun Limited and you have to compute net assets of Neptune Limited. Where, my dear children, net assets is equal to capital employed. Net assets is equal to, so please respond, net assets is equal to capital employed. After computing capital employed or net assets, say for example, you got 10 lakhs. Now you have to issue, what is the question is he telling? 15% debentures so as to provide income equivalent to 8% on capital employed, that is 10 lakhs. He is telling that issue 15% debentures so as to provide equal income of 8% on capital employed. Capital employed is nothing but net assets, which is nothing but 10 lakhs. So this is the equation, which is nothing but debentures is equal to 8% of 10 lakhs divided by 15%. They respond everybody clear? Something like in some questions you will be given like 15% of debentures in the transferor company is 1 lakh. Issue such many number of debentures so as to maintain the same amount of interest at 8%. Did you remember this terminology? Something like 15% debentures, 1 lakh is there in the transferor company. Now there is a point that issue such many number of debentures so as to maintain the same amount of interest, but the rate of interest had become 8% now. It is as simple as such. 15% of old debentures should equal to 8% of new debentures. So 15% of old debentures is nothing but 1 lakh. So 15% of 1 lakh is equal to 8% of new debentures. Therefore, new debentures is equal to 15% of 1 lakh divided by 8%. Anta. Hey, is it clear? That is equal to something like rupees 1,87,500. Sir, now check out 1 lakh into 15% is equal to 8% into 1,87,500. No compromise in interest. Respond everybody clear? And there is one more point with respect to the debenture holders, something like, listen very, very carefully. The debentures, 15% debentures of transferor company are taken over at 5% discount by issuing 10% debentures at a premium of 10%. You'll be having these kind of points, take care. 15% debentures of transferor company are taken over at 5% discount by issuing 10% discount at a premium of 10%. My dear children, always remember by is the separating preposition. By is the separating preposition. Till by, that is belonging to the old company. After by, that is belonging to the new company. Remember this one. Check out the book value. 1 lakh, sir. 1 lakh multiplied by, 1 lakh or settled at 5% discount and minus 5%. Issued at a premium of 10% and a whole divided by, if nothing is mentioned, face value of debenture will become 100 plus 10%. Hey, respond, is the logic clear? I mean to tell simply, number of new debentures issued is equal to debentures book value plus premium or minus discount, which is nothing but settlement value of debentures divided by issue price. Issue price might be face value plus premium or minus discount. Respond everybody clear? So let me show you one more point here. Check out this one. Debentures of Glory Limited are to be discharged by issuing 8% at a premium of 10%. I told you like by is the separating preposition. So before by it is belonging to the old company. After by it is belonging to the new company. Given in the question very clearly that issue at premium. Clear everybody? Issue at premium. But what about the discharged portion? Nothing is given. So it must be considered the discharged at par. Discharged at par. So it is as simple as such. Given here that book value is equal to 3,30,000. So discharged at par whole divided by issued at premium of 10%. If discharged at discount is given, minus that percent. If discharged at premium is given, add that percent. They respond everybody clear? Check out by is the separating preposition. Before by it is belonging to the old company. After by it is belonging to the new company. Respond everybody clear? And I have covered this point. Yeah, check out this one also. Similar to that one. Book value is 3 lakhs. 12% debenture holders are to be paid at 8% premium by issuing 12% debentures at a discount of 10%. And 3 lakhs plus 8% divided by 100 minus 10%. Hey, I hope I have clarified you with all the debenture points actually. So by is the separating preposition. Just hold on that one. You'll get everything very, very easily. Shall I proceed further? And my dear children, let me tell you the last two adjustments of this amalgamation with which I can close, and you have to spare for 15 or 20 more minutes for telling you some other things. Okay. Listen very carefully. The two adjustments are actually very different. Sir, say for example, inventory of A Limited sold to B Limited. As I already told you, book value is equal to 1 lakh and selling price is equal to, I mean to tell not book value, let it be cost price. Cost price is equal to 1 lakh, selling price is 1,20,000. It is sold to B Limited, so cost price of inventory is 1,20,000. Now inventory is in the books of dash company. Inventory is in the books of dash company. B Limited is having an inventory of 1,20,000. Clear everybody? But the original cost price is 1 lakh. How much is excess, Nana? 20,000. Say for example, in the meanwhile, A Limited and B Limited gets amalgamated. So I told you there is a stock reserve of 20,000 which has to be eliminated. But there is a point here that A Limited and B Limited gets amalgamated and B Limited is taking over all the assets of A Limited. Sorry, I have told you it in reverse way. Listen carefully. This time B Limited is acquired by A Limited. Who is acquiring? Is acquired by A Limited. Who is acquiring? A Limited is acquiring. Dash company B Limited. One very important point is all about B Limited assets were acquired by A Limited at 10% discount. Clear everybody? Each and every asset of B Limited is acquired at 10% discount. Accordingly, inventory in B Limited is equal to 1,20,000. This was acquired by A Limited at a price of 1,20,000 minus 10%, which comes to 1,08,000. Clear everybody? Sir, originally what is the cost price, Nana? 1 lakh. So originally what is the cost price for B Limited, Nana? 1,20,000. Strictly speaking, how much should be the stock reserve, Nana? 20,000. But out of that 20,000, 12,000 is automatically eliminated at the time of taking over the assets of B Limited. How much stock reserve you have to eliminate? 20,000. Already how much is eliminated? So remaining how much is there? So now you have to eliminate only 8,000. Respond, is it clear? This is one of the different adjustments which is there in your material itself. In institute sources it was given. Respond, shall I proceed further? Strictly speaking, you have to eliminate 20,000. But since the company is acquired at less than 10% value, automatically 12,000 gets eliminated and hence remaining 8,000 elimination is enough. Respond, everybody clear? And last and final adjustment. If you are seeing the CRD problems and assignment problems, there will be a confusion with respect to provision for bad debts. Sometimes intercompany transactions will be deducted and he is computing the percentage. Sometimes he don't deduct intercompany transactions and he'll compute the percentage. Before that, remember, while going with realization account, never deduct intercompany transactions or mutual owings. You should never deduct. While computing purchase consideration also, never deduct intercompany transactions or mutual owings. Intercompany transactions or mutual owings shall be deducted only after acquiring the business. I mean to tell you will be writing the longest entry, right? Assets account, debtor, 2 liabilities account, 2 PC account, and you will be comparing. After writing that entry only, you have to eliminate intercompany transactions or mutual owings. Till that point, you should never eliminate. So logic clear. Mutual owings should not be eliminated while drafting realization account. Mutual owings should not be eliminated while computing PC. Up to this clear, everybody? So that must be eliminated only after acquisition. Now listen very, very, very carefully. A limited is there, B limited is there. A limited debtors and creditors. Say 1 lakh, 1,20,000, 80,000 and 92,000. A limited is due to B limited. Say for example, B limited is acquired by A limited. What is the context, Amma? Dash is acquiring by dash company. Please respond. Dash is acquiring by dash company. B limited is acquired by A limited. So B limited is transferor company. A limited is transferee company. Who is due to whom, Amma? A limited is due to B limited. And A limited is? Sir, who has to pay? Tell me. A has to pay. So for A limited, 10,000 is payable. B limited is there in creditors. A limited is due to B limited. To whom it is receivable? Cheppali. For B limited it is receivable. So ante for B limited, A limited is there in debtors. Respond up to this clear. How much is the amount that is due, Nana? Say for example 10,000. So this 10,000 has to be eliminated only after acquisition. Something like creditors account, debtor to debtors account, 10,000 it gets eliminated. But the problem is all about, if at all given in the question that all the assets of B limited were taken over, debtors are taken over at a provision of 10%. Shall I start now? Sir, everybody listen very, very carefully. Debtors of B limited are taken over. Debtors of B limited are taken over by A limited by creating a provision of 10%. Use your common sense, Nana. 80,000 debtors to B limited, out of which 10,000 has to be paid by A limited. Balance 70,000 has to be paid by outsiders. In the question, he is telling that create a provision of 10% on debtors. High common sense that out of the entire 80,000 debtors, 10,000 is the debtor. I am the debtor. A limited is the debtor. Hey, clear? How will I have doubt on myself? Provision ante doubt kada. So for B limited, A limited has to pay. I have to pay to B limited. How much? 10,000. As per the agreement, I am having doubt on your debtors that your debtors might not pay to the extent of 10%. I am one of the debtor. Why will I have doubt on myself? Is the logic clear? And hence in this context, provision will be created after deducting 10,000. Ante 80,000 minus 10,000 multiplied by 10%. Only 7,000 is created. Respond pakka. This will be there in assignment problems. Now, say for example, A limited is due to B limited. I have given kada. Say B limited is due to A limited. Reverse. Ante B limited has to pay to A limited. Shall I start now? Sir, B limited entire debtors 80,000 are outsiders. I'm having doubt on outsiders, and hence on 80,000 create 10% provision now. Respond everybody clear? So that is the conclusion. Ante if that company's debtors is including me, then I will not be having doubt on myself. No need to create provision on my amount. If that company debtors are totally outsiders, then you have to create the provision on the total amount. And my dear children, that is the end of amalgamation. My dear children, let me continue with the next standard, that is all about accounting standard number 2. And what is accounting standard number 2? Which is nothing but valuation of inventory. Generally, accounting standards deals with recognition, measurement, presentation and disclosure. But accounting standard number 2 is dealing with the concepts of measurement and disclosure. Of course, disclosure is common to each and every standard, but the high point that you need to remember coming to accounting standard number 2 is all about that accounting standard number 2 is not dealing with the concepts of recognition. It is dealing only with the concepts of measurement and disclosure. Now coming to the next one, very important, which is all about scope. So accounting standard number 2, scope, coming to the first part, that's all about non-applicability. Of course, in majority of the standards, as we have already discussed that we are going to see the concepts of non-applicability, and here also it's non-applicability. Work in progress arising from service provider, work in progress arising from construction contracts, investments in securities held as stock in trade. These three are quite common, but you need to extend your concentration to this one, which is very important. Renewable and non-renewable resources, and this is applicable only for producers inventory. And my dear children, remember one thing, whenever we are dealing with asset related standard, then obviously for that standard, for renewable and non-renewable resources, that respective standard is absolutely not applicable. Then which standard is applicable, sir? Of course, industrial norms are applicable. No specific accounting standard is applicable for renewable resources and non-renewable resources. This is point number 1 that you have to remember. And accordingly, accounting standard number 2 is also nothing but valuation of inventory, which is dealing with parts of assets. Even this standard is also not applicable for renewable resources and non-renewable resources. But take care, my dear children, there is a special point that you need to consider, that this standard is not applicable for renewable and non-renewable resources only with respect to producers inventory, but not with traders inventory, which implies that accounting standard number 2 is absolutely applicable for traders inventory, and this is not applicable for producers inventory. For producers inventory, as we have already discussed, that industrial norms are applicable but not accounting standard number 2. Now let me show you one special situation. Just check out very carefully. Check out this part. Strictly speaking, renewable and non-renewable resources with respect to the producer's inventory is applicable only with industrial norms but not with any other standard. Of course, in accounting standard number 9, he had given the clarification what industrial norms are telling. Take care. Generally, for producers inventory who are engaged in producing the renewable resources or non-renewable resources, no standard is applicable. Only industrial norms are applicable. But a clarification is given in accounting standard number 9, and that clarification is being discussed now. So listen carefully. Before telling this one, what will be included in renewable resources, what will be included in non-renewable resources? Non-renewable resources, generally you will be having extraction of mines, minerals, etc., oil, gas, petroleum. And coming to renewable resources, agricultural crops, agricultural products, forestry products, etc. Anyways, let me come back, my dear children. So here we are speaking about those renewable resources which was relating to harvesting of crops, and those non-renewable resources which are relating to extraction of mines and minerals. Generally, these will be valued at cost price. Take care, my dear children. Generally, these will be valued at cost price. When do the performance will be completed? Say for example, there is a crop. When do the performance will be completed? After harvesting. After harvesting, performance is completed. And after selling the crop, we tell that sale is completed. Coming to mines and minerals. Mines and minerals. Performance will be completed only after extraction. Only after selling the mines and minerals to outsiders, we tell that performance is completed. But remember, my dear children, in this context, performance is substantially completed or deemed to be completed when the crop is just harvested but not yet sold, when the mines are just extracted but not yet sold. In the sense, even before selling, we are considering that the performance is getting substantially completed. Even before selling, we are assuming that the performance is substantially completed just after harvesting and just after extraction. In the following 3 cases, when there is a government guarantee, Government had given you guarantee with the concepts of MSP, which is nothing but minimum selling price or minimum support price. And whenever there is a forward contract, and the last and final, there exists a market with negligible risk. In these three situations, absolutely stock will be valued at NRV. No need to value it at cost price. So this is all about the concept which is applicable for producers inventory who are engaged in producing the renewable resources and non-renewable resources. Take care, my dear children. That's all about the concept of renewable and non-renewable resources. Take care. Once again, I'm repeating and I'll close this discussion. Accounting standard number 2 or no other accounting standard is applicable for renewable resources and non-renewable resources. Then what are applicable, sir? Industrial norms are applicable with respect to producers inventory. Then what about traders inventory? For traders inventory, absolutely accounting standard number 2 is applicable. I mean to tell the general principle, something like cost or NRV, whichever is lower, that's absolutely applicable. But coming to here for producers inventory, accounting standard number 2 is not applicable and no other standard is applicable. Only industrial norms are applicable. As per industrial norms, these must be valued at cost price. Generally, renewable resources or those resources which are relating to harvesting the crops, and non-renewable resources or those resources which are generally relating to extraction of mines and minerals. There is a special clarification which is given in accounting standard number 9, that is revenue recognition, of course linked to accounting standard number 2, and take care, this is not being dealt by any other standard. The clarification with respect to industrial norms is given in accounting standard number 9. Because AS9 is like revenue recognition. Revenue will be recognized only when the goods are sold. But here performance is substantially completed. Even when the crop is not yet sold, just harvested. Even when the mines are not yet sold, just extracted. In these two contexts, we can tell that performance is substantially completed in the following three situations. Point number 1, when there's a government guarantee, and when there's a forward exchange contract, and when there exists a market with negligible risk. In these three situations, we can tell something that, what is it called? Performance is substantially completed even before sale. Fine, my dear children, let me continue with the generalized principles of accounting standard number 2. Those are all about. So, accounting standard number 2 is applicable for valuation of inventory. What to be included? What will be included in inventory? Inventory includes finished good. Inventory includes work in progress. Inventory includes stores and spares, and of course inventory includes raw material in general. Now, what are the valuation principles? As simple as such, fixed assets has to be valued at cost or NRV, whichever is lower. Work in progress has to be valued at cost or NRV, whichever is lower. But these two things have to be valued at cost price. Of course, there's an exception, my dear children. There's an exception. But what is that exception? Everything we shall learn later as and when we are discussing with the valuation of raw material. As usual, first let me start with valuation of finished good. Coming to valuation of finished good. Finished good must be valued at cost or NRV, whichever is lower. Now let me start with what is a cost price. But before deciding what is a cost price, you are supposed to decide what is the nature of business concern. Business concern might be either a manufacturing entity or a non-manufacturing entity. A manufacturing entity is an entity which will be purchasing the raw material. So cost of raw material consumed plus it will convert the raw material into finished good, and hence it includes conversion costs. Whereas coming to a non-manufacturing entity, it generally purchases the finished good and it will sell the finished good, which is simply nothing but cost of finished goods purchased. So take care. For manufacturing entity, the cost is nothing but cost of raw materials consumed. For non-manufacturing entity, the cost is nothing but cost of finished good purchased. This is the total cost for a non-manufacturing entity, whereas this is just an initial cost for a manufacturing entity. Along with this, since the raw material is converted into finished good, even conversion cost will be included in the cost price of manufacturing entity. Now let me start with the cost. What is the cost of raw material purchased, or what is the cost of finished goods purchased? As simple as such, cost of raw materials or finished good purchase will be including purchase price plus direct expenses. In a single word, cost price is nothing but purchase price plus direct expenses. Purchase price is the price which is stated in the invoice. Direct expenses are all those expenses which are directly relating to the acquisition of inventory. Direct expenses are those expenses which are directly related to the acquisition of inventory. Now, purchase price is the price which is stated in the invoice. What will be stated in the invoice? Generally, three elements will be there. Number one, quoted price. What is the quoted price will be stated in the inventory itself. And the next is all about taxes and duties. And the next is trade discount. Coming to quoted price, it is the price as quoted by the seller, and hence you have to consider that it is your initial price. And next, taxes and duties. Take care, my dear children. If it is non-refundable taxes and duties, these have to be added when they are not included. And refundable taxes and duties have to be deducted if it is included. Take care. Non-refundable taxes and duties. Non-refundable taxes and duties have to be added if it is not included. Refundable taxes and duties have to be deducted if it is included. This is all about taxes and duties. And the next concept is all about trade discount, which is nothing but allowed between the traders. Volume rebate or quantity discount. If you purchase more than the certain volume, you will be getting a discount, which is nothing but volume rebate or quantity discount. And these things must be deducted. And these will be automatically deducted in the invoice price, in the invoice itself. And hence you can consider the final invoice as your price. That's all about purchase price, which is nothing but price which is stated in the invoice, where in invoice you will be stated with quoted price, taxes and duties and trade discount. And now coming to the direct expenses, those expenses which are directly relating to the acquisition of inventory, like freight inward, carriage inward, all the inward expenses, all the loading and unloading charges, etc. and etc. So this is all about cost price of finished good or cost price of raw material. And since you have already known about cost price of finished good, absolutely cost price of non-manufacturing concern is done away with. But coming to manufacturing concern, it's all about cost of raw materials consumed plus conversion costs. Coming to cost of raw materials consumed, as we have already discussed, something like purchase price plus direct expenses. Plus, coming to conversion cost. Conversion cost generally includes two things, my dear children. That's all about labor and overheads. Coming to raw material cost, of course, it's always generally direct cost. Coming to labor, it is also generally direct. And coming to overheads, some portion will be total overheads are nothing but indirect. Take care. Take care, my dear children. Material cost, labor cost, overhead cost. These will be generally direct, and total overhead is nothing but indirect. And material is always variable cost. Labor is also always variable cost. But coming to overheads, some portion of overheads will be variable, some portion of overheads will be fixed. And whatever variable cost is there, that variable cost has to be apportioned on actual production. Whereas coming to fixed cost, take care, my dear children, it will be apportioned on actual or normal, whichever is higher. Actual or normal, whichever is higher. Then what will be generally, logic behind this one? Sir, point number one, if you have observed your costing, also in overheads chapters, to the most of the times you will be having only under absorbed overheads. You will not be having over absorbed overheads at all. To the most of times. Of course, in cost reconciliation statements, you will be getting those both things. And as I said, what is the logic behind it? To tell the logic, this is not the time at all, because this is just a marathon class. We can't continue with the logic, but I can tell you in a smallest way. Say for example, listen carefully. Your fixed overheads are 1 lakh rupees. And your actual production is equal to 90,000 units. And your normal production is equal to 1 lakh units. As I said, whichever is higher is the apportion point. So totally rupees 1 lakh fixed overheads divided by normal, that is nothing but 1 lakh units, where it will become rupees 1 per unit. And how many units were actually produced? 90,000 units, sir. So 90,000 units multiplied by rupees 1, which is nothing but rupees 90,000, which is called as absorbed overhead. How much production is not undertaken, sir? 10,000 units. So 10,000 unit multiplied by rupees 1, which is nothing but 10,000, which is nothing but under absorbed or unabsorbed overheads, which has to be transferred to costing P&L account as per your costing terminology, and as per your accounting terminology, this has to be simply transferred to P&L account. And this 90,000 has to be included in the cost of production. This is the topic. I mean to tell computations. 90 or 1 lakh, whichever is higher. Since only 90,000 units are produced, you have to apportion only on 90,000 units. Whereas the remaining 10,000 units, since no production was taken place at all, and hence you are going to consider it as unabsorbed or underabsorbed overhead, and it will be straight away transferred to P&L account. Whatever the absorbed portion of overhead is there, it has to be transferred to cost of production. This is all absolutely fine. Now, the very important thing is all about, why did not you choose 90,000? We told whichever is higher, right? Why did not you choose 90,000? If you have chosen 90,000 here, automatically the cost will increase. 1 lakh divided by 90,000 is nothing but 1 point something. So then automatically cost price is getting increased. If cost price is getting increased, my dear children, if at all cost price is getting increased, how will be the cost price be increased if the work is not done for the same cost? I mean to tell, 1 lakh is the cost. 1 lakh is the total cost. Work is done only for 90,000 units. And this 1 lakh is the cost which is incurred on the basis of normal production. That is like 1 lakh units. For the remaining 10,000 units, work was not done. If work was not done, how will the cost price for each and every unit increase? No, it's technically wrong. If the work is not done, automatically the cost should not increase. And hence the ultimate logic is all about, my dear children, since the work is not done for 10,000 units, for that 10,000 units, you should not apportion for cost of production. You have to straight away transfer it to P&L account. And if it is of a reverse case scenario, I mean to tell, actual is again 90,000 units. But say for example, this time normal is 80,000 units. And it's all about 1 lakh divided by 90,000 units, where you will get around 1.11, because whichever is higher, right? So 1 lakh divided by 90,000 units, which is nothing but 1.11111. Now, something like to tell you, since the work was done, or else let me tell you another example which will be more clear for you. This time again, say the normal production is equal to 1 lakh units. But let me tell you that the actual production is equal to 1,20,000 units. So you have to apportion on whichever is higher. Your fixed expenses are nothing but 1 lakh divided by your actual production comes to 1,20,000 units. And hence the apportionment is all about 1 lakh divided by 1,20,000 units, where it had become 0.8333. My dear children, take care. It's all about 0.8333. This is the apportionment per unit. You might ask me, sir, this time the work is increased. I mean to tell, the normal is 1 lakh, actual production is 1,20,000. The work is increased, and hence automatically should the cost price be increased? No, here the cost price will not increase because it has been done for the same price of rupees 1 lakh. For the same price of rupees 1 lakh, we have produced 1,20,000 units, and hence cost per unit will come down. So conclusion, for how many units you have done the work, only for those number of units you have to transfer it to cost of production, and the remaining, if any, under work was done, that has to be transferred to P&L account. And hence fixed overheads are to be apportioned on the basis of actual or normal, whichever is higher. This is very, very important. And let me move on to the next thing, my dear children. So this is all about cost price of a manufacturing entity. What is the cost price of a manufacturing entity? Simply cost of raw materials consumed plus conversion cost. Coming to conversion cost, it might include labor and it might include overheads, and this is direct, this is indirect, and this is always indirect, and this is always variable, this is always variable. Some portion of variable, overheads is like variable, some portion of overheads is like fixed, and these three variable portions will be generally, these three portions of variable will be generally apportioned on actual production, but fixed will be generally apportioned on actual or normal, whichever is higher. If the actual production is higher, then you have to apportion it on actual only. Since the work was done, cost per unit will decrease. And actual or normal, whichever is higher. If the normal is higher, then you have to apportion only on normal, and only some portion will be transferred to costing period. Sorry, only some portion will be transferred to cost of production. The unabsorbed portion will be transferred to costing P&L account or simply P&L account. And my dear children, if at all, listen very, very carefully, if at all the work was not done for the same cost, how do the cost price increases? And hence, generally, you should not do like that. Simply actual or normal, whichever is higher. If actual is higher, for the same price, since the work was done, the cost price is decreasing per unit. 1 lakh divided by 1,20,000 rupees. Sorry, 1,20,000 units. And something like, since the normal is higher, work was not done. Since the work was not done, the cost per unit should not increase. So take care, these two are very, very different and of course logically based. Simply to tell you, actual or normal, whichever is higher. If actual is higher, since for the same price of rupees 1 lakh, work is done extra 20,000 units, cost price per unit will decrease. And the next one, since the normal production is higher in this context, rupees 1 lakh divided by 1 lakh units, and totally it is rupees 1 only. In this context, you can't take rupees 1 lakh divided by 90,000 units. If you have taken like that, cost will be like 1.11. Since the work is not done at all, cost will not increase. For the portion of work which was not done, it has to be transferred to P&L account with the name of unabsorbed or underabsorbed. And my dear children, this is all about the cost prices. And now coming to the next part, that's all about NRV. Very, very important. Take care. NRV of a finished good is equal to estimated selling price minus estimated selling expenses. NRV of work in progress. Be careful in this context. Generally, what is your aim? Work in progress will be converted into finished good and then finished good is sold, sir. Is your aim to sell work in progress as it is? No, sir. Our aim is not to sell the work in progress as it is. It has to be converted into finished good and ultimately finished good will be sold. In the sense, it is something like this. Say for example, this is your cost of production line. And here raw material production starts. Somewhere here you are, which is called as work in progress. And here it is the finished good part. Now the concept, listen very, very carefully. Something like you are at this point. You would like to know what is the NRV of this point. Very simple. Cost price is very, very simple. Cost of raw material consumed plus conversion cost till completion. What is the cost of work in progress? Cost of raw materials consumed, this one, plus conversion cost till completion is nothing but cost price of work in progress. Now coming to NRV, work from backward. I mean to tell NRV of finished good minus estimated further cost of production which is not yet completed. I mean to tell finished good, something like estimated selling price minus estimated selling expenses minus further cost of production is nothing but NRV of work in progress. So ultimately NRV should also be valued at work in progress is also to be valued at cost or NRV, whichever is lower, where cost of work in progress is nothing but cost of raw material consumed plus cost of production till completion, and NRV is nothing but estimated selling price of finished good minus estimated selling expenses of finished good minus further processing cost. Now coming to the next item, that's all about raw material. Let me speak out with raw material, or also the same is applicable for stores and spares. Raw material has to be valued at cost price. Rule number 1. Raw material has to be valued at cost price. Rule number 1, remember. Only when cost price of finished good is recovered, which implies that if selling price of finished good is greater than the cost price of finished good, we can tell that cost price is totally recovered and hence raw material has to be valued at cost price. Whereas, my dear children, if at all cost price is not recovered, cost price is not recovered, then raw material has to be valued at cost price or replacement cost, whichever is lower. If replacement cost data is not available, you can use NRV of raw material, where NRV of raw material is nothing but estimated selling price of raw material minus estimated selling expenses of raw material. But this provision is applicable only when the cost price of finished good is not recovered, which is nothing but selling price of finished good is less than the cost price of finished good. So tell me in a single stretch, finished good has to be valued at cost or NRV, whichever is lower. Cost price for manufacturing entity is nothing but cost of raw materials consumed plus conversion cost. Coming to conversion cost, it includes both labor and overhead. Labor is always variable, direct material is always variable, and overhead. Some portion of overheads will be variable and some portion of overheads will be fixed. Variable has to be apportioned on the basis of actual cost of production, but normal has to be apportioned on actual or normal, fixed overheads have to be apportioned on actual or normal, whichever is higher. And moving on to the next thing, cost price of a non-manufacturing entity is equal to cost price of finished good purchased, which is nothing but purchase price plus direct expenses. Purchase price is the price which is stated in the invoice. Direct expenses are those expenses which are directly relating to the acquisition of acquisition of inventory. And moving on to the next thing, NRV, estimated selling price of finished good minus estimated selling expenses of finished good. Moving on to the next thing, work in progress. What is the valuation rule for work in progress? Which is nothing but cost or NRV, whichever is lower. Cost price is equal to cost of raw materials consumed plus conversion cost till completion. Now, what is NRV, sir? Our aim is not to sell work in progress as it is. Our aim is to convert work in progress into finished good. And hence, estimated selling price of finished good minus estimated selling expenses of finished good minus further processing costs is NRV of work in progress. But if you would like to sell work in progress as it is, then work in progress NRV will be estimated selling price of work in progress as it is minus estimated selling expenses of work in progress as it is. And moving on to the next one, raw material has to be generally valued at cost price only if the finished good of cost price is recovered, which implies that selling price of finished good is greater than the cost price of finished good. And if at all the cost price of finished good is not recovered, which implies that selling price of finished good is less than the cost price of finished good, then raw material has to be valued at cost price or replacement cost, whichever is lower. If replacement cost data is not available, you can go for NRV. In this context, NRV is nothing but estimated selling price of raw material minus estimated selling expenses of raw material. And if you would like to sell raw material as it is, then the valuation rule will be cost or NRV, whichever is lower, where NRV is nothing but estimated selling price of raw material minus estimated selling expenses of raw material. And my dear children, this is all about the valuation rules. Now, the special rules, just two special rules are there. Point number 1, joint product, and point number 2, byproduct. Joint product can also be called as main products. You take one raw material, you do the process of production up to a particular point, and that particular point is generally called as split off point. And here at split off point, some sort of products will separate. The raw material will be separated into various products, like petroleum will get separated at one point into petrol, diesel, kerosene, crude oil, etc. and etc. Now, the point here is all about, there is something called common cost of raw material. Now the next one, here you are having various products. If at all those products which are having substantial value, we will generally call it as joint product. For those products which are not having substantial value, we will be generally calling it as byproduct. Those products which are having substantial value, we will call it as joint product. Those products which are not having substantial value, we will generally call it as byproduct. This is very, very, very important. Now, what is the cost price of byproduct? My dear children, our aim is not to produce byproduct at all. Our aim is to produce joint product or main product, and hence cost of byproduct is absolutely zero. Now, what is the price of, cost price of joint product or main product, sir? As simple as such, sir. Here there is some joint cost which is commonly incurred, which has to be allocated. So allocated joint cost, I mean to tell this cost has to be allocated, plus if at all after split off point one product is produced, something like petrol is produced, and after that petrol can be further processed into power petrol. Petrol can be further processed into power petrol, and hence my dear children, allocated joint cost, where the joint cost will get allocated, and further processing cost if any, or the cost price of joint product or main product. Allocated joint cost plus further processing cost if any. I mean to tell, after getting a product at split off point, it can also be further processed. Minus very important, minus allocated realizable value of byproduct. Because my dear children, your aim is not to produce byproduct, and hence cost of byproduct is absolutely zero. But byproduct will be sold in the market and you will get some realizable value. With that realizable value, the cost will have to be deducted from the cost of joint product. And what is the realizable value of byproduct, sir? As simple as such. Estimated selling price of byproduct minus estimated selling expenses of byproduct minus further processing cost if any. Even you can get a byproduct, even byproduct can also be further processed, and after further processing the byproduct, you will be selling it. I might be after incurring some selling expenses, and hence my dear children, estimated selling price of byproduct minus estimated selling expense of byproduct minus further processing cost if any. In a single word, what is the cost of byproduct? Zero, sir. Will we have any realizable value? Yes, you will be having realizable value, which has to be decreased from the cost of the main product or cost of the joint product. Then what is the cost of joint product, sir? Cost of joint product is nothing but allocated joint cost plus further processing cost if any minus allocated realizable value of byproduct. This is all about the special items. Now moving on to the next thing, cost formula. Sir, which method can I use? My dear children, remember accounting standard number 2. Accounting standard number 2 is permitting to use any method. It is permitting you to use any method which is, take care my dear children, any method which is representing the fairest approximation cost. Which method you can use? Any method, that's your wish. But remember, it should represent the fairest approximation cost. Sir, what is the meaning of fairest approximation cost? Cost which is approximating the true value. True value is nothing but past value, na? Current value. Na? Of course, true value is nothing but current value. It's not the past value. My dear children, just comment how many of you people know about this provision in the comment section. Because over across India, there will be very less number of people who will be knowing this provision. Generally, what students will be learning is all about cost formula. Let us follow FIFO method and weighted average method. LIFO is not permitted as per accounting standard number 2, but they don't know the logic here. Anyways, my dear children, which method of cost formula you can use as per accounting standard number 2? Any method which is representing the fairest approximation cost. Fairest approximation cost is nothing but cost which is approximating the fair value. Fair value is nothing but true value. True value is nothing but current value. Now check out FIFO method. What is the meaning of FIFO method? First in, first out. So closing stock is representing the latest good. Latest goods will be at latest prices. Latest prices is nothing but current value approximations, and hence FIFO method is permitted. Latest price is nothing but recent prices, current value. It may not be exactly equal to current value, approximating the current value. And moving on to the next thing, LIFO. LIFO is not permitted, my dear children. Why LIFO is not permitted? Because last in, first out. So closing stock is representing the older good at older prices. Older prices is not similar to current prices or the latest prices, and hence LIFO is not permitted. And coming to simple average method, my dear children, simple average method itself is a failure method. Failure method. Sir, why simple average method is a failure method? Because it is not generally considering the units. Say for example, if there are 1000 units purchased at rupees 10 and 10,000 units purchased at the rate rupees 2. So now, simple average method is considering 10 plus 2 by 2, which is nothing but 12 by 2 bunches, 2 times you have purchased the good. So 12 divided by 2, prices divided by how many times you have purchased the good, which is nothing but 6 rupees per unit. This itself is a failure method. Then what is the best method, sir? Weighted average method is the best method again. Why, sir? Point number 1, it is considering the units. So 1000 into 10, which is nothing but 10,000, plus 2 into 10,000, which is nothing but 20,000, whole divided by 11,000 units. So 30 divided by 11,000 units, which is nothing but 2.7272. 7272 per unit is nothing but what is it called, cost price per unit. Now, is weighted average method permitted, sir? Yes, it's not a failure method since it is considering the units. Then why it is permitted? How is it representing the fairest approximation cost? My dear children, weighted average cost is always representing the latest prices, and hence also representing the older prices. I mean to tell, average cost is representing both the new prices and older prices. Absolutely nothing great, and hence it is absolutely representing the fairest approximation cost. So that is all about weighted average method. And now whatever the 4 methods that I told you, like FIFO, LIFO, simple average and weighted average, these is applicable, or these methods are applicable only to those inventories which are not specifically identifiable. What do you mean by this one again, sir? Say for example, you just go to a shop and ask him to purchase, ask him to purchase a perk. So shopkeeper is giving you a perk, and unfortunately the perk was again dripped into the same box. So now can you pick the perk which you have already picked? Perk chocolate. You picked one perk chocolate from the perk box, and unfortunately it fell down into that perk box again. I mixed everything. Can you pick whatever the perk chocolate that you have already picked? That's nearly impossible. We don't know that, which is nothing but not specifically identifiable. We don't know which inventory we have taken. Moreover, you can't argue with the shopkeeper something like, no, I want only that perk which you have given previously. That's all nonsense, and hence not specifically identifiable. So these methods are applicable only to those inventories which are not specifically identifiable, which are called as historical cost methods. And of course, there are another set of methods which are called as non-historical cost methods. These methods will not consider the historical cost price, whereas FIFO, LIFO, simple average, weighted average will be considering the cost price at what you have purchased. Whereas non-historical cost methods are those methods which do not consider the cost price at the time of your purchase. And there are 3 methods for these things, and non-historical cost methods can be used only when the historical cost methods are not compatibly available. Only when the historical cost methods are not reliably available, you can use non-historical cost method, where it generally includes 3 things: latest purchase price, standard cost method, and adjusted selling price method, out of which this is very important. Adjusted selling price method is nothing but closing stock for a retailer. It is very simple to be available at selling price rather than the cost price, because retailers will be generally purchasing at different prices. Even though they are purchasing one lace packet at 3.8, 4.2, 4.1, 4.5, they are going to sell each and every lace packet only at 5 rupees. So for a retailer, finding closing stock at selling price is very easy, and hence closing stock at cost price is equal to closing stock at selling price minus profit percentage is nothing but closing stock at cost price. And this method is nothing but adjusted selling price, because closing stock at selling price is adjusted with the profit margin in order to arrive closing stock at cost price. Now, this method is variedly used by retailers, and hence, my dear children, this is also called as retail inventory method. This method is also called as retail inventory method, since it is abundantly used by retailers. Now, As I already said you, all these methods, whatever I taught till now, something like FIFO, LIFO, weighted average, simple average, of which LIFO is not applicable because it is not satisfying the condition of fairest approximation cost, and simple average method is not applicable because simple average method is itself, it is a failure method. And as I have already shown you, something like non-historical cost method, which will be generally picked only when the price is not reliably computed under historical cost method, and non-historical cost method generally includes latest purchase price, standard cost method, and adjusted selling price, which is also called as retail inventory method. All these methods are applicable only when the inventory is not specifically identifiable. But if it is a gold shop, like specifically identifiable, my dear children, each and every good is specifically identifiable. Under gold shop, under jewelry shop, each and every good is specifically identifiable, and each and every good will be valued separately. Whereas under inventories which are not specifically identifiable, no need to value each and every perk separately. Value at a bunch itself. Whereas coming to specifically identifiable method, or for those inventories which are specifically identifiable, then my dear children, you are supposed to value each and every inventory separately. So that is all about methods of inventory, or something like cost formula. And my dear children, that's the end of accounting standard number 2. Let's check out with some problematic parts. Check out. If you observe problem number 1, which is a very different problem but very simple problem, I'll just tell you the overlook, you just concentrate it later. There's a company which is producing fancy terry towels. And this company is also having a forward exchange contract. So what this company is telling that, since we are having a forward exchange contract, listen very carefully. Since we are having a forward exchange contract with respect to fancy terry towels, performance is substantially completed. Performance is substantially completed even before selling. Once if the production is done, performance is substantially completed, and hence we would like to recognize the inventory of fancy terry towels at NRV. This is the question. Take care, my dear children. Take care. A company is there which is telling that it is producing fancy terry towels. They are having a forward exchange contract, and hence they are telling that performance is substantially completed once if the goods are produced. No need to sell it, since we are having forward exchange contracts, and hence we have decided to value the inventory of fancy terry towels at NRV. How far it's correct? Yes, it's absolutely wrong, because this concept is applicable only for producer and also only for renewable resources or non-renewable resources. Say for farmer, this concept is applicable, provided if he is engaged in renewable resources, provided if he is having any of the three things, like when government guarantee is there, when there is a forward exchange contract, or when there exists a market with negligible risk. But here, point number 1, a private limited is a producer, but is not a producer of renewable resources or non-renewable resources. I mean to tell, fancy terry towels is like a general product. It will not come under renewable resource, and also it will not come under non-renewable resource, and hence conclusion, my dear children, this application for a private limited is absolutely wrong. It has to value normally something like cost or NRV, whichever is lower. And coming to this one, see, I'll just tell you a simplified version of solving all these kind of problems. If you observe, 16,000 kgs are purchased at 160 per unit, and this 160 is including rupees 10, where full input tax credit is available. In the sense, it's a kind of refundable taxes and duties. So take units at the left side, take amount at the right side. How many units we are having, sir? 16,000 units at the rate 160 minus 10 rupees, because this 10 is refundable taxes and duties. So 16,000 units at the rate 150, where it is something like 16,000 into 150, 24 lakhs. And then what happened, sir? Freight invert is 140, 160. Yes, it has to be included. Freight invert, which is nothing but direct expenses, 140, 160, where it comes to 25, 40, 160 for 16,000 units. I mean to tell like 24 lakhs plus 140, 160, 25, 40, 160. Now the biggest point, if you observe the question, normal loss is 2%. My dear children, remember normal loss is something called unavoidable, and hence cost will not be found separately. So minus normal loss at the rate 2%. So 16,000 into 2% into 2%, which is nothing but 320 units. As I already said, cost of normal loss is absolutely zero since it is unavoidable. And ultimately 16,000 minus 320, where 15,680 units are costing 25, 40, 160. From here you can solve it. Check out how many number of goods sold, units sold. If you find this is called as cost of goods sold. Check out how many number of units are left, and if you find proportionately, you're going to get what is a closing stock. To tell you, 13,600 is consumed and 15,500 is received. So strictly speaking, 15,680 is there at 25, 40, 160. But we have received only 15,500. So remaining 680 minus 500, 180 units is called as abnormal loss. My dear children, abnormal loss can be avoidable, and hence you can't take it directly to cost of production. You find it separately and you have to transfer it to P&L account. That's very, very important. And of course, as given in the question, that 13,500 units are consumed. So after finding this one, just take proportionately again. 13,500 units are consumed, find it proportionately. This is called as cost of goods sold. And from 15,500 minus 13,500, you are having 2,000 units left out. Again, find it proportionately, which is nothing but closing stock. And my dear children, this is what the problem is all about. Simply, if you take units on one end and rupees on one end, you're going to get very, very easily. And let me show you one different part in problem number 3. Generally, I told you like cost price is equal to purchase price plus direct expenses. And you people know that unloading charges is a direct expense and freight inward is a direct expense. But if you observe carefully, 380, and I mean to tell generally, since these two things are direct expense, since I told you cost price is equal to purchase price plus direct expense, logically speaking, this 20 and 40 should be included in this 380. This is correct for provision basis, but my dear children, while solving the problematic basis, whatever the cost price given here, assume it is just a purchase price and direct expenses are not included. And hence your total price will become 380 plus 20 plus 40. It is 60, 60 plus 380, 440, and check out material consumed price is given at 440. So what is the conclusion? Cost price is equal to purchase price plus direct expenses when you are learning the provisions. But coming to the problematics, cost price is just purchase price. So that's all about another different point in this problem. And to show you another different point in the next problem, check out point number C. Cost is 50,000 and NRV is 55,000, where commission is 10% on the sales which is payable to the agents. And we already learnt that NRV is equal to selling price minus selling expenses, where the selling price is 55,000 minus selling expenses is 10%, where it comes to 49,500. So cost price is 50,000, NRV is 49,500, whichever is lower, 50,000, and hence stock will be valued at 50,000. If you have done like this, it's absolutely wrong. Reason being, cost is 50,000, NRV is 49,500. You have to value it at whichever is lower, and hence you have to consider it at 49,500 but not at 50,000. If you have done like this, it's absolutely wrong again. Why, sir? Reason is very simple. Check out the question very, very, very carefully. That NRV is 55,000, which implies that already commission is deducted. He had deducted the commission and he had given you the final figure, and hence cost price is equal to 50,000, NRV is equal to 55,000, whichever is lower is nothing but 50,000, and hence you have to value the same at 50,000. And my dear children, that's the end of accounting standard number 2. My dear children, let me continue with the next standard, that is all about accounting standard number 7. What is accounting standard number 7? Construction contracts. As you all people know that for a particular contract, there are two parties. Number 1 is contractor and number 2 is contractee. And accounting standard number 7 is applicable only for contractor but not for contractee at any cost. This is one first and foremost thing that you need to understand. And for contractee, respective accounting standard is applicable. Say for example, if the construction is building, then for contractor A7 will be applicable, and for contractee respective standard, like since it is building, accounting standard number 10 is applicable for contractee since it is PPE to the contractee. And if at all inventory is being given under a particular contract, then for contractor A7 is applicable, for contractee accounting standard number 2 is applicable. Simply to tell you, respective standard is applicable for contractee and accounting standard number 7 is applicable for contractor. This is first part. And say for example, there is something called, yes, one special situation. If contractor is doing the business and constructions in his own name, and after the completion, contractor is selling the same to the outsiders. In this case, accounting standard number 2 is applicable but not accounting standard number 7. Because contractor is constructing in his own name and he is selling. So this is like doing a business. This is not like a construction contract. So this is first another thing which could be understood with respect to the scope. So coming to the point, my dear children, this is applicable only to the contractor, not applicable to contractee. Contractors who are doing the business in their own account or own name, which is nothing but real estate, and hence accounting standard number 2 is applicable. Now, what is the most important thing in this standard, sir? Sir, coming to this part, the very important thing is all about learning contract revenue, contract cost, contract profit or loss. There itself, this standard is absolutely done away with. So you are supposed to know what is a contract revenue, what is contract cost, and what is contract profit or loss. But before knowing this one, you are supposed to know what are the types of the contract. And my dear children, actually there are two types of the contracts. Number 1, fixed price contract. Number 2, cost plus contract. Cost plus contract is nothing but how much ever cost that the contractor incurred, along with the cost, some profit will be reimbursed. This profit can be either in relative terms or this profit can be either in absolute terms. Now, coming to fixed price contract. Fixed price contract is a contract where the contract revenue is fixed. Irrespective of cost incurred, here you will be getting your revenue, which is called as fixed price contract. Now, moving on to the next thing. How do the contract account appears? If it is fixed price contract, listen very carefully. If it is fixed price contract by contract revenue, but the part is that total contract revenue multiplied by percentage of completion, and 2, contract cost incurred, and finally 2, contract profit or by contract loss. This is the account that you have to prepare for fixed price contract. If it is cost plus contract, then contract revenue is equal to contract cost incurred plus some profit. The same profit will be booked here, and if it is loss, it shall be booked at the credit side. So this is all about cost plus contract. So for cost plus contract, finding revenue is very, very simple. Cost incurred plus profit is nothing but finding revenue. But for fixed price contract, it's not like that. For fixed price contract, you have to find the contract revenue something like total contract revenue multiplied by percentage of completion. Now you are supposed to know what is the percentage of completion. My dear children, percentage of completion can be computed under 3 methods as per accounting standard number 7. But before that, listen very, very carefully. What are the types of accounting you are having? There are 2 types of accounting, Amma. Number 1, completed contract method. Number 2, proportionate completion method. For your kind information, completed contract method is not permitted by accounting standard number 7. only proportionate completion method is permitted. There's an exception. Completed contract method can be permitted if the entire contract is completed within the same accounting period, not within 12 months. Completed contract period will get completed if everything is completed within the same accounting period. Remember that one. And coming to proportionate completion method, as I have already told you, percentage of completion. There are three methods for percentage of completion, of which the first one is all about cost to cost method, or on the basis of proportion of cost incurred, survey method, and physical proportion method. My dear children, practically these two methods are followed, but coming to the problematics, we will be following this method. Survey method is nothing but one outsider will attend the construction, he will check each and everything, and he will tell what is the percentage of completion. Coming to physical proportion method, how much proportion is completed, that will be assessed by the contractor himself, and he will be telling the same to the contractee. And cost to cost method is nothing but cost incurred till date divided by total estimated cost multiplied by 100. This is nothing but contract completion under cost to cost method. Cost incurred till date divided by total estimation cost multiplied by 100. So take this is an initial note which is very, very important. So let me tell you, there are two types of contracts, my dear children. Number one is fixed price contract and the other is cost plus contract. This is reimbursed in nature. This is obviously fixed. For cost plus contract, contract account is very, very simple. By contract revenue to contract cost, cost incurred plus profit is nothing but contract revenue, and finally you will be getting either profit or loss. And coming to fixed price contract, the contract account by contract revenue to contract cost, this is cost incurred, this is total contract revenue multiplied by percentage of completion, finally you will be having profit or loss. Now, when do you need to prepare these accounts? There are two methods of accounting for this. Number one, completed contract method, and the other is proportionate completion method. Completed contract method is not permitted, only proportionate completion method is permitted. Under proportionate completion method, you are supposed to know what is the percentage of completion. For knowing percentage of completion, you are having three methods. One is cost to cost method, and the other is the survey method, and the other is physical proportion method. Cost to cost method is nothing but what is the cost incurred divided by total estimated cost multiplied by 100. Survey method is nothing but one outsider will be attended and he will be telling how much percentage is completed with respect to the construction. Physical proportion method shall be asserted directly by the contractor himself. He will be physically surveying the same, and contractor himself will be telling, which is called as physical proportion method. Now, moving on to the next thing, you are supposed to know the first and foremost thing, what is contract revenue. My dear children, contract revenue is nothing but revenue which is receivable on a particular contract is nothing but contract revenue. Now, the next one, how to recognize the contract revenue. In order to recognize the contract revenue, first of all, you have to check whether the outcome of the contract is reliably measured or not. What do you mean by outcome of the contract? Meaning, sir, as per accounting standard number 7, outcome of a fixed price contract can be reliably measured if contract revenue can be measured properly, contract cost can be measured properly, percentage of completion can be measured properly, if future economic benefits will be generated. Whereas coming to cost plus contract, the outcome of the cost plus contract can be reliably measured as per accounting standard number 7 if at all contract cost is reliably measured and future economic benefits are reliably measured. Because there is nothing to do with contract revenue here. If cost is reliably measured, you will automatically get what is the contract revenue. And percentage of completion is absolutely not needed under cost plus method. So, as per A7, if these two conditions are satisfied, we tell that outcome of cost plus contract can be reliably measured. If these four conditions are satisfied, we tell that outcome of the fixed price contract will be reliably measured. But what is the general meaning of outcome of the contract can be reliably measured? Simple. Whether will you complete the contract or not? Whether will you able to complete the contract or not? Whether contractee will be giving you the contract revenue properly on time or not. These two things. Outcome is nothing but whether you will be able to complete the contract or not. Whether contractee will be giving you the amount on time or not. General meaning. But only when these two conditions are satisfied, we tell that outcome is reliably measured as per cost plus, and for fixed price, 4 conditions are there. Now, let me move on further. The first part, that's all about contract revenue. Now, contract revenue has to be recognized basing on the percentage of completion, provided if outcome of the contract is reliably measured. If outcome of the contract is not reliably measured, then recognize only to that extent for which you are having certainty. That's it. Contract revenue has to be recognized based on percentage of completion, that is on the basis of accrual if outcome is reliably measured. If outcome is not reliably measured, initially don't recognize, but exception, you can recognize to the extent for which you are having certainty. Generally, contractor will be expecting at least contract cost has to be reimbursed. So to that extent, you can recognize it as contract revenue provided you are having certainty of receipt of the same. Otherwise, don't recognize. If outcome is not certainly measured, better not to recognize anything at all. Exception, you can recognize if there is certainty. Generally, to what extent contractor wants certainty? He wants certainty at least up to cost incurred. So this is all about the recognition of contract revenue. But the next and important thing is all about elements of contract revenue. Contract revenue includes initially agreed amount. Contract revenue also includes escalation clause. Also, it includes de-escalation clause. Also, contract revenue includes variations. Also, it includes claims. And finally, penalties. All these things will be included. What do you mean by initial? One more thing is there. Yes, I'm sorry, incentive. Another thing is nothing but incentive. Now, the first one, initially agreed amount. Whatever is clearly specified in the agreement that our contract value is 50 lakhs, 60 lakhs, 70 lakhs, 80 lakhs, that we will call it as initially agreed amount. And moving on to the next thing, escalation clauses. My dear children, under cost plus contract, we will be taking care about the cost incurred. Whereas under fixed price contract, we seriously don't bother about the cost incurred at all. In fixing the contract revenue, it is fixed in absolute terms. That's it, like 50 lakhs, 60 lakhs, 70 lakhs, like that. But sometimes prices might rise, inflation might occur. In that case, who are under cost plus contract, absolutely no loss. Because if the cost is increasing, you incur the cost first and reimburse. Whereas under fixed price, it's not like that. Irrespective of cost incurred, you are supposed to get only the fixed amount. And hence, to be on a safer side, there is one more clause which is called as escalation clause, which will be clearly stated in the agreement. In the agreement, it will be clear it will be very clearly written something like in excess of 5% of raise in prices, 10% contract revenue should increase. In excess of 10% raise in prices, 12% revenue should increase. If 5% raise in prices is there, 5% revenue should increase. Like that, they will be writing some clauses. Actually, simply, if raise in prices, raise in contract value, which is nothing but escalation clause. And coming to de-escalation clause, generally nobody will be entering this into the contract, but it is just something like a theoretical notion. If the cost price decreases, then automatically contract revenue should also decrease, which is nothing but de-escalation clause. But generally, this will not happen practically. Now, coming to variation. Variation is a change. That change can either be proposed by the contractor or it can either proposed by the contractee and the other party had to admit for it. If at all the change is proposed by the contractor, contractee needs to accept. If at all the change is proposed by the contractee, then contractor need to accept. And the change might cause increase in revenue or it can also either decrease in revenue. And the next one, claim. Claim is nothing but asking, demanding. So claim is always done by the contractor and it must be accepted by the contractee. Due to the faulty decisions taken by the contractee, contractor will be incurring some extra cost. Please take care, please take care. Due to the faulty decisions taken by the contractee, contractor is incurring some extra cost. Those costs will have to be reimbursed by the contractee and we will generally call it as a claim. So claim will be always done by the contractor and it has to be admitted by the contractee. So claims must be recognized only when the negotiations reach the conclusion stage. Only when the negotiations reach the conclusion stage. Only then we will be recognizing it as a contract revenue. Otherwise, we don't recognize it as contract revenue. And next one is incentives. Incentive is something like, oh yeah, claim is also like increase only. Incentive is also like increase itself. What is it called? If at all you have met the standard performances or exceeded the standard performances, contractee will be giving you some extra benefit, which is nothing but incentive. Say for example, contractee is very much satisfied with the quality of the work done, and hence for that quality, contractee is giving some extra amount, which is nothing but incentive. Or contractor has to complete the contract within 3 years, but fortunately contractor had completed the contract within 2 years 6 months itself, and hence contractee is very much satisfied and giving some extra amount, which is nothing but incentive. So incentive is a benefit to the contractor for meeting the standard performances or exceeding the standard performances. And moving on to the next one, that's all about the last and final one, which is nothing but penalty. So due to the faulty decisions taken by the contractee, contractor might incur some additional amount, which is nothing but claim. Due to the faulty decisions taken by the contractor, due to the gross negligence of the contractor, he had done some mistakes, and hence contractee will be deducting some contract revenue, which is nothing but penalty, and hence automatically the contract revenue comes decrease. So conclusion, my dear children, you are supposed to recognize all these elements of contract revenue only when the outcome of the contract is reliably measured. Otherwise, you are not supposed to record or recognize any of these items. And my dear children, that's all about contract revenue. And now, let me go for contract cost. Coming to contract cost, my dear children, contract cost is if you observe, is again of 3 types. One is like directly attributable cost, allocable cost, and specifically chargeable cost. Directly attributable cost are those costs which are exclusively for a particular contract. Allocable costs are nothing but costs which are incurred for more than one contract, and hence the contract cost has to be allocated for all the contracts, where we will call it as allocable cost. And specifically chargeable cost will be charged as contract cost only when there is agreement. Otherwise, it will have to be charged to P&L account, remember. So, some of the examples of directly attributable cost like material, labor, overhead, depreciation, hire charges, etc. and etc. There is one special item in that, which is nothing but estimation of rectification for guarantee or warranty works. I mean to tell, say for example, contractor had constructed a building for the contractee. There is an agreement between contractor and contractee that for the next 2 years, if at all any repairs were being occurred to the building, then contractor needs to provide the same at free of cost, which is nothing but contractor is giving some sort of warranty or guarantee here. In such context, contractor need to estimate how much expense he has to incur because of this warranty or guarantee, and he need to create a provision, and the same also has to be treated as contract costs. So that's one of the special items of directly attributable cost. And coming to the next one, allocable cost. Say for example, if a particular asset is used for 2 contracts, then automatically the depreciation on these assets have to be apportioned to the 2 contracts. And specifically chargeable cost will be only as per the agreement. Generally, specifically chargeable cost includes what is it called? Only 2 things like research and development cost and administration cost. Research and development cost. Say for example, because of this contract is accepted, contractor has to do more research. And hence they have clearly mentioned in the agreement that let the contractor undertake with the research, but the research cost will be reimbursed by the contractee, which is called a specifically chargeable cost. In the same way, general administration cost, say for example, contractor will be generally opening his office only for 2 hours a day, and remaining he will be spending at the sites, contract sites. But since this contract is accepted, contractor needs to open his office for 8 hours a day. In the sense, almost 6 hours increase. The contractee is telling, you just go and work, whatever the additional cost incurred, I'm here to reimburse. So those are like specifically chargeable costs, will be booked as a contract cost only when there is agreement, otherwise it will not be spent at all. Anyways, that's all about specifically chargeable cost. Now one more very important thing, all these three costs will be charged to the contract account. There is another cost which is called as unallocable cost. Unallocable costs are those costs which are not at all relating to the contract. Say for example, depreciation on idle plant and machinery. You are having plant and machinery which is not used for any of the contracts. In such a case, that depreciation on idle plant and machinery has to be charged to P&L account. It should not be charged to contract account. And also administration cost and research and development cost, if there is no specific agreement, even they will become unallocable cost and they have to charge it to the contract account. One very important thing, say for example, if there is incidental income which is absolutely relating to the construction, then that incidental income has to be reduced from the respective cost. You should not treat it as contract revenue, remember. I mean to tell, say for example, there is scrap of material. You have sold the scrap of material and automatically some sort of amount is realized to you. And whatever the realizable value is there, that has to be deducted from the cost of production, or simply to tell you, contract cost. It should not be treated as contract revenue. That's one more thing that could be appreciated. And let me move on further. Listen very carefully, everybody. Say for example, this is the contract site. Here construction of building is going on. This place is vacant actually, and hence the party had decided to level the land and to give it for car parking. Party had decided to level the land and let him give the same for car parking. So automatically the party had got some revenue from this car parking. This car parking revenue should not be deducted from the construction cost at all, because this is not at all directly relating to its construction of building. This amount, whatever they have received, has to be transferred to statement of P&L account as if they have to consider it as other income. It should not be deducted from the contract cost. But if it is scrap material or scrap of material, since that is directly relating to the construction contract, you can just sell the scrap, you will get some realizable value that has to be deducted from the contract cost which is incurred. And my dear children, that is all about scrapping of material or unallocable cost. Now moving on to the next thing, this is important again, cost incurred for securing a contract. Say for example, sometimes you might need to bid or you might need to participate in tenders. At the time of participating in bids or tenders, you might need to incur some extra cost. Say for example, to a specified employee who had who had involved in preparing the tender, to that person we are promised that we are supposed to pay 1 lakh to him. Now 1 lakh paid to this employee is something like cost incurred for securing a contract. Now how this 1 lakh has to be treated? Remember and listen very carefully. What is your certainty? Will you secure the contract? If there are more chances for securing the contract, then this cost has to be postponed and it has to be treated as if it is a contract cost. If you are having not certainty that you will secure the contract, then immediately charge it to P&L account. Check out, my dear children. If at all securing the contract certainty is there, then such costs have to be postponed and must be recognized as a contract cost. If you are not having certainty to secure the contract, then immediately it has to be charged to P&L account. Sir, initially we thought we are having certainty and postponed, but subsequently certainty lost. Immediately charge it to P&L account. Sir, initially no certainty and hence charge it to P&L account. But further we got certainty. What to do? Remember, my dear children, once charged can never be capitalized. Since you have already charged it, let it go off. That's it. You can't revert it back again. That is all about contract cost. Now, moving on to the next thing, uncertainty in contract revenue. If you are having uncertainty in contract revenue, as we have already discussed, recognize or don't recognize or don't recognize. You have to recognize the contract revenue on cash basis, or you have to recognize only when the certainty is established. Till there is uncertainty, better not to recognize any contract revenue. But if at all you would like to recognize, then you have to recognize only till the certainty is established. I mean to tell, you have to recognize only after the certainty is established. In the sense, it should be on cash basis. It should be on cash basis. This is what something called uncertainty in contract revenue. So, if at all initially uncertain, then this is the point. If at all subsequently uncertain, initially it's certain and hence recognized, but subsequently it had become uncertain, then remember, my dear children, don't reverse. You have to create a provision. Take care. My dear children, take care. If at all there is certainty in receipt of contract revenue, then recognize. If initially it is uncertain, then don't recognize contract revenue. You have to recognize the same on the basis of, cash, or you have to recognize contract revenue only when certainty is established. Otherwise, you should not recognize. Now moving on to the next thing, my dear children. If at all initially it is certain and hence recorded, but subsequently it is uncertain. Now what to do? Don't reverse, my dear children. You have to create a provision. Now moving on to the last and final, contract profit or loss. What do you mean by contract profit or loss? Contract revenue minus contract cost is nothing but contract profit or contract loss. If it is contract profit, absolutely no problem. You can just work out normally. And if at all it is a contract loss, then you have to recognize the total loss. Remember very, very carefully. You're not supposed to recognize 1 year loss. You're supposed to recognize the total loss, irrespective of commencement of the contract, percentage of completion, and profits from the other contracts if separable. Say for example, you have accepted the contract, but later on you worked out. You have got to know that you are going to incur the loss. You have to recognize the loss immediately, irrespective of commencement of the contract. Contractor can't tell, sir, the contract is not yet started and hence I don't recognize the loss. I'll recognize the loss as and when I've started the contract. No, Babu. Case 7 did not permit you like that. You have to recognize the contract loss irrespective of commencement of the contract, percentage of completion. Sir, my total loss is 10 lakh. Since only 60% of the work is done, 60% of 10 lakh, I'll recognize only 6 lakhs. No, irrespective of completion, you have to recognize the total loss. And sir, from this contract, I'm having a loss of 10 lakhs, sir. But from another contract, I'm having a profit of 20 lakhs, sir. So if I set off overall, it's profit only, sir. And hence I don't recognize loss, sir. No, such kind of things are not permitted. Irrespective of profits from the other contracts if separable, you are supposed to recognize it as contract loss only. That's very, very important. Now, so as we've already discussed that this is contract account, which is similar to P&L account of a particular contract. Finally, contract profit or contract loss, whatever you get, that has to be transferred to P&L account. Remember this one. Now moving on to the next concept, that's all about combining and segmenting. Generally, what students will be thinking, if not combine, you have to segment. If not segment, you have to combine. No, that concept is wrong. I mean to tell, what students will be thinking, if at all combining conditions are satisfied, you have to combine. If segmenting conditions are satisfied, you have to segment. Or they will be thinking, if combining conditions are not satisfied, you have to check for segmenting conditions. If segmenting conditions are not satisfied, you have to check for combining conditions. No, this attitude or this concept itself is wrong. What students will be thinking, if combining conditions are satisfied, let it combine. If combining are not satisfied, let me go for segmenting conditions. If segmenting conditions are satisfied, okay. If segmenting conditions are not satisfied, then check out for combining conditions. Amma, this concept itself is wrong. Then what is correct and what to do, sir? Listen very, very carefully, everybody. If at all there is a single contract entered for construction of 3 assets. Now you have to check out the conditions only relating to segmenting. Something like Whether separate proposals are there, separate negotiations are there, contract revenue and contract cost are identified for all the construction of 3 assets separately, and can you accept part of the assets and can you reject part of the assets? If all these conditions are satisfied, you have to segment. Otherwise, directly combine. No need to check for combining conditions once again because it is already combined in a single agreement. Please take, my dear children, don't be in a wrong notion that if combining conditions are not satisfied, I have to check for segmenting conditions. If segmenting conditions are not satisfied, I have to check for combining conditions. That's not the concept at all. Check out the agreement, how the agreement is. Sir, agreement is having construction of 3 assets, sir. Okay, now you check out whether segmenting conditions are satisfied or not. If segmenting conditions are satisfied, then you can segment contract asset account number 1, contract asset account number 2, contract asset account number 3. So if segmenting conditions are not satisfied, no need to check for combining conditions, straight away combine. Now moving on to the next thing, if at all 3 separate contracts were entered for 3 separate assets. Now you have to check out the conditions relating to combining only. What are the conditions relating to combining? It should be a single package, negotiated with an overall profit margin. Work should be performed either one after one or everything simultaneously, sequentially or simultaneously. If these conditions are satisfied, you combine. If not, no need to check for segmenting conditions. Since already each and every contract is separate, just prepare 3 contract accounts. This is the concept of combining and segmenting, but many people will be presuming it in a wrong way. If combining conditions are not satisfying, let me continue with segmenting conditions. No, there's nothing like that at all. Anyways, my dear children, let me go for the last and final part of this standard, which is very, very important. That is all about disclosures. Generally, disclosures are important only for disclosure related standards, but even in AS7, disclosures are important. For completed contract, disclosures are not important. For contracts which are work in progress, disclosures are important. Check out contract revenue, contract cost, percentage of completion, contract profit or contract loss, very important, advance or retention, progress billings, amounts due to or due from customers. Now, say for example, if there is a particular contract which is under work in progress, you are supposed to tell what is the contract revenue recognized. You are supposed to tell what is the contract cost. But in some questions, contract cost will not be directly given. Contract cost will be given like work certified and work uncertified. I mean to tell, say for example, contract T had completed a work relating to rupees 10 lakhs. But due to survey method, work is certified only to the extent of 6 lakhs and remaining 4 lakhs, it was not yet certified. Work completed is to the extent of 10 lakhs. But certified is only 6 lakhs. Uncertified is 4 lakh. Since the certified portion is 6 lakh, contractee needs to release 6 lakh amount. But if at all contractee is not releasing the entire 6 lakh amount, he is releasing only the part of that amount, then we will call it as retention. He is retaining some amount. If at all contractor is releasing more than 6 lakhs, more than the work certified, then we will call it as advance. Take care. What is the total contract revenue and what is the contract revenue recognized till now? And what is the contract cost? In some questions, contract cost will not be directly given. You have to check out what is the work certified and what is the work uncertified, and you have to recognize accordingly. And moving on to the next thing. Sometimes a contractee will be releasing the total work certified portion, then no problem. But sometimes what happens, contractee will be returning some portion, only some portion will be released, which is called as retention. Sometimes contractee will be releasing more than the work certified, which is called as advance. Now, progress billings. Say for example, contractee is releasing 5 lakh amount and another 50,000 is billed but not yet received. So, progress billings includes amount which is already received and also amount which is still in pipeline. Pipeline is nothing but work in progress. Take care, my dear children. Progress billings include 2 things. Progress billings include 2 things. Number 1, sir, listen very, very carefully. Progress billings include 2 things. Number 1, billings already completed and received. Number 2, billings already completed but not yet received. Receipt in pipeline. In all these 2 contexts, we can tell that progress billings is completed. And my dear children, last and final, amount due to or due from customers. Generally, how much amount I have to receive from the customer? I have to receive contract revenue. What is contract revenue? Either contract cost plus profit or contract cost minus loss. Please take care. It is something like this. How much amount you have to receive from the contractee? Contract revenue, sir. What is contract revenue? Contract cost plus profits recognized or contract cost minus losses recognized. This much I have to receive. Now, how much is received? Minus progress billings. Progress billings include two things. Number one, billings which were already done and received, billings which were already done but payment in pipeline. So this much I have to receive, this much I have received. So balance, if it is positive, due from contractee. If it is negative, due to contractee. And my dear children, that is the end of accounting standard number 7. And now if you observe problem number 1, in this problem number 1, he is asking you to prepare P&L account. But P&L account doesn't mean that it is general P&L account. P&L account in relation to a particular contract means contract account only. Take care. Now customer account. He is also asking you to prepare customer account. Let me tell you the entry so that it will become very easy for you. So my dear children, you have to receive the amount from the contractee. So contractee account debtor to contract revenue account. And contract revenue has to be closed and transferred to contract account. Contractee account debtor to contract revenue to contract. Simply like debtor account debtor to sales account debtor to trading P&L account. And hence your contractee or customer account will be like this. To contract revenue, how much you have received by cash or bank. Balance if any shall be carried down and for the next year it is brought down. And further contract revenue shall be added by cash or bank, and hence it will continue like this. And now coming to contract account, already we have discussed two contract cost incurred by contract revenue, which might be either fixed price or cost plus, and in that if it is cost plus profit. If it is fixed price, simply like total contract revenue into percentage of completion. And finally you will be having either profit or loss. This is nothing but contract account. My dear children, take care. After completion of contract account, if you find any loss, how to solve? Let me tell you. First, generally compute percentage of completion. Sir, in almost except in one problem, every problem is relating to fixed price contract only, and hence you have to compute percentage of completion. Percentage of completion is equal to on the basis of cost incurred, cost till date divided by total estimated cost multiplied by 100. This is very, very important. After which, draft the contract account. If there is profit, you can close the problem. But if there is loss, then immediately you have to find total estimated loss. You have to find total estimated loss, and you have to recognize the total estimated loss in the contract account. Not only the current year loss, the total loss has to be recorded, and the balancing figure you have to create a provision. Let me show an example. With that you will be getting better clarity. No, these are actually lengthy examples. Let me choose a small example for you. Okay, let me choose a small example. Something like, say for example, contract cost incurred to contract cost is 64,99,000. Sorry, I asked you to find first percentage of completion, right? Percentage of completion is equal to cost till date divided by total estimated cost multiplied by 100. Say 64,99,000 is the cost incurred till now. 64,99,000 plus 32.01 lakh is further estimated cost. Now what is the percentage of completion? 64, 99,000 plus 32,01,000, total 97 lakhs. Okay, so 64,99,000 divided by 94 lakhs. Sorry, 97. The total exactly comes to 67%. Okay. Say for example, now let me draft the contract account. Contract account to contract cost incurred, which is nothing but 64,99,000 by contract revenue. Say the total contract revenue comes to 90 lakhs. Say 67% is completed. So 90 lakhs multiplied by 67%, which comes to 60 lakh 30,000. So in this context, obviously there is some contract loss. 64 lakh 99,000 and the loss comes to 4 lakh 69,000. If it is like this, don't close your problem. Immediately do one more step, which is nothing but total estimated loss. Total estimated contract loss is equal to total estimated contract revenue minus total estimated contract loss. Sorry, contract cost, which is nothing but 90 lakhs minus total estimated cost is nothing but 97 lakhs. And hence total loss comes to 7 lakhs. So take care, my dear children. Here it should not be 4,69,000. It should be 7 lakhs because you have to recognize the total contract loss irrespective of percentage of completion. If you are recognizing only 4,69,000, then out of the total loss, you are recognizing only 67%. But that's wrong. Sir, then if you observe contract account, it's not getting tallied. And hence you will be having a balancing figure at debit side, which is 4,69,000 minus 7 lakhs, 2,31,000. This 2,31,000 is nothing but provision for loss. So that's the end of contract account, my dear children. Be very, very, very careful. And moving on to the next thing, if contract account is having loss, then immediately you have to find the total loss and you have to put the same amount. Take care. And coming to this problem, that's easy. Yeah, check out this one. So this is a problem relating on contract revenue with escalation clause. Only on contract revenue with escalation clause. If you observe material escalation to the extent of 20% increase in the material cost. Given in the question somewhere here that material, one second. Material costs have increased by 40% due to short supply. Total increase due to 40% escalation is 80 lakhs. In the sense, for 40% he had given it is 80 lakhs. So for 100% how much it will be? Something like 80 lakhs divided by 40%. 80 divided by 40%, where you are going to get 200 lakhs is the total contract revenue. So now for 200 lakhs plus 20% should be the contract revenue. And in the same way, labor cost up to 30% increase in the minimum wages. If you observe, the original increase is 25%. So up to 30% they told they are going to reimburse. And hence 1,20,000 multiplied by 25%. Take care, labor cost escalation they will provide up to 30%. Material cost will be provided up to the extent of 20% of the increase in the material cost. So to the extent increase in the material cost, 40% is like 80 lakhs. So 20% comes to obviously 40 lakhs. 200 into 20% is nothing but 40 lakhs. Or in another word, 40% increase, it is 80 lakhs. So 20% increase, it comes to exactly half. That comes to 40 lakhs. This is with respect to material. Coming to labor, they told 30% increase up to they will provide. But here the increase is only up to 25%. So they have to provide the total amount. So 120 lakhs multiplied by 25% will be the increase in the contract revenue. So anyways, this is a different problem which is just concentrating on the contract revenue. So be careful. Now coming to the next problem. Yeah, if you observe here, labor charges paid are 36 lakhs, but outstanding is also there. In order to find the total cost, you also have to add this labor charges outstanding. And materials issued are 75 lakhs. Issued are 75 lakhs. It is, if you observe, out of the materials issued, unused at the end of the period is 4 lakhs, which is nothing but closing stock. Issued 75, closing material is nothing but 4 lakhs. So 75 minus 4. You have to take 71 lakhs as material issued. And say for example, if at all there is any scrap of material sold, then 75 lakhs minus 4 lakhs minus scrap value of material sold is also to be considered. And coming to the next problem, this is a peculiar problem wherein if you observe point number 1, contract cost is 6168 and that 6168 is including 100 lakhs which is stored at the site and it will be used in year 3. 6168 is including 100 lakhs which is not used in year 2. It will be used in year 3, which implies that this 100 lakhs is not the cost of year 2 and hence 6168 minus 100 which comes to 6068. Whereas year 3 8100 is excluding 100 lakhs which is brought forward from year 2 and hence 8100 plus brought forward from year 2 is 100 and hence the total is 8200. This is point number 1. And point number 2, generally you always want to find percentage of completion contract cost till date divided by total estimated contract cost multiplied by 100. But if you observe, here you are having initially agreed revenue, variation in revenue plus, because variation can be either plus or minus, and these two things are relating to contract revenue. And this is contract cost incurred up to reporting date until till date, numerator. But denominator is not there. Total estimated cost is not there. But my dear children, estimated total profit is given. So you have to find the total estimated cost. How, sir? Generally, contract profit is equal to contract revenue minus contract cost. Now, estimated contract profit is equal to estimated contract revenue minus estimated contract cost. You are supposed to find this thing. This is given, this is also given, estimated whole profit is given and hence estimated contract cost is equal to estimated contract revenue minus estimated contract profit. From this you are going to get total estimated cost with which you can solve the problem again. Now moving on to the next one, my dear children, that's all about the last and final problem which is relating to disclosure. If you observe, total contract price is given. And if you observe, work certified and work uncertified is given, which is nothing but cost incurred till date 605 and estimated further cost is 495. So 605 plus 495 which is nothing but 6 plus 5 1100 is the total estimated contract cost. You have to find the percentage of completion, something like 605 divided by 1100 multiplied by 100 which is nothing but 55% is exactly completed. So now if you observe, first of all, what is the total amount of foreseeable loss? 1100 minus 1000 which is nothing but 100. And work certified is 500, uncertified is 105, total cost is nothing but 605 and hence 55% is the completion. So 1000 is the contract revenue multiplied by 55% is nothing but 550 is the contract revenue which is recognized. Now see here 550. Now is it amount due to customers or due from customers? Contract cost plus profit minus loss. Here cost is 605, profit is 0 and loss. You have to recognize the total loss, that is 100. So 605 minus 100 minus already received is 400 and to be received but billing is completed. Pipeline is 140. So total is nothing but 540 and hence 605 minus 100 minus 540. So where it is negative 35 lakhs and hence due to customers, it's not due from customers. And my dear children, that is the end of accounting standard number 7. And relax for 2 to 3 minutes. We are going to start accounting standard number 9. And fine, my dear children, let me start with the next standard, that is all about accounting standard number 9. And what is accounting standard number 9? Revenue recognition. And please be very, very careful, my dear children. This is the standard which is dealing only with the concepts of recognition, but this is not about dealing with the calculations, measurements, etc. and etc. This is just dealing with recognition, like when to recognize. This is the biggest part for accounting standard number 9. And it will be dealing with that revenue which is absolutely relating to the due course of business. Something like revenue which is relating to the due course of business. Okay, so what do you mean by revenue? Point number 1, revenue includes gross inflow but not net inflow. Be very, very careful with this context. What do you mean by net inflow? Maybe after deducting sales returns or after deducting some amount, we'll call it as net inflow. But remember, always revenue includes only gross inflow, which is arising in the due course of business. That revenue might be received either in cash, cash equivalents, or it might be debtor, or it might be even other consideration. And how can you recognize the revenue? How can you get the revenue? You can get the revenue either from sale of goods, rendering of service, or use of enterprise resources by others yielding interest, dividend, and royalty. Very important, revenue is generally gross inflow, but for agent it is net inflow. Revenue is equal to net inflow in an agency relationship, because in an agency relationship, best example is like consignee. Say for example, consignee sold goods for 1 lakh, but how much amount he has received? The total 1 lakh. But you can't tell something like 1 lakh is the total revenue of the consignee. Consignee's revenue is only to the extent of his commission. Say for example, his commission comes to 10%. So 1 lakh multiplied by 10%, which is nothing but 10,000. So after receiving 1 lakh into his hand, he will be putting only 10,000 and remaining 90,000 will be sent back to consignor. And here per consignor it is gross inflow, that's like 1 lakh. But for consignee it's only net inflow, that's like only 10,000. That's very, very important. And now this is a standard which is dealing with all the three things like applicability, non-applicability, and also even with what is it called, exclusion. Now coming to applicability, sale of goods, rendering of services, use of enterprise resources by others yielding interest, dividend, and royalty. Coming to non-applicability, revenue from construction contracts, revenue from government grants, revenue from leases, and revenue arising to insurance companies with the help of policies, insurance policies, which is dealt by IRDA. Simply to tell you, 7 plus 12 is equal to 19 and IRDA. I mean to tell, construction contracts, government grants, leases, insurance contracts. For all these things, AS9 is not applicable. Now moving on to the next thing, exclusion. Very, very simple. Both realized and unrealized gains from renewable and non-renewable resources. I already told you, whenever we are speaking about a revenue asset related standard, then that standard is silent for renewable and non-renewable. And here, even though this is not totally asset related standard, this is like revenue recognition. When will you recognize the revenue? Only after selling the good. Good is nothing but asset. And hence, my dear children, for renewable and non-renewable resources, both realized and unrealized gain, AS9 is not going to deal with it. Even AS2 is not going to deal with it. Only industrial norms are going to deal with it. What are industrial norms? Already we have discussed in AS2. Something like generally this will be recorded at cost price, but exception, performance is substantially completed even before selling, just after harvesting, even before selling the mines, just after extraction. In such a case, straight away we can recognize it as it at NRV, provided if any of the following three conditions are satisfied. Something like what is it called? When government gives guarantee, when there is a forward exchange contract, and when there exists a market with negligible risk. Already we have discussed about each and everything. So please take care and follow it. If needed, you pause, go back, revise accounting standard number 2 and come back here. And let me proceed further. Both realized and unrealized gains with respect to foreign currency transactions and foreign currency operations, accounting standard number 11 is taking care. Of course, we will be dealing in the further sessions of marathon. And also, very important, both realized and unrealized gain with respect to PPE, accounting standard number 10 is being dealt with. As I said, in the further sessions of marathon, you will be learning. This is very, very important. Both realized and unrealized gain on an obligation. Sir, always remember, for liability, there is no specific standard except accounting standard number 29. That is also dealing only with provisions and contingent liabilities. But for all the remaining liabilities, there is no specific standard at all, and IGAPs are taking care. Of course, to some extent, employee related provisions, AS15 is taking care. To some extent of employee related provisions is 15 is taking care, and for other provisions and contingent liabilities 29 is taking care. But for all the general liabilities there is no specific standard. General IGAP, Indian generally accepted accounting principles are followed. One more important thing, if you observe till now, both realized and unrealized, realized and unrealized, realized and unrealized. But if you observe, only unrealized gain on current assets AS2 is applicable. Unrealized gain on current asset. Current asset is nothing but stock. If you sell the stock, then AS9 is applicable. Because selling the stock is nothing but you will be getting the revenue. How will you recognize the revenue? AS9 is speaking. But unrealized gain on stock, accounting standard number 2 is applicable. Of course, 2 is dealing only with the concepts of measurement but not with the concepts of recognition. Now let me move on to the next thing. Sale of goods. Sir, you are supposed to recognize only when the ownership is transferred. What do you mean by transfer of ownership, sir? It might be either significant and related risk and rewards are transferred, and there's no uncertainty in collection, and there should be ultimate collection. I'm sorry, not might be either. All the three conditions should satisfy. Ownership is transferred only when significant and related risk and rewards were transferred. Only when there is no uncertainty in collection, and only when there is ultimate collection. Okay, sir. What if there is initial uncertainty? Just wait. Okay. If there is initially uncertain, then don't recognize. You have to recognize only when certainty is established or simply on cash basis. Till that point, you are not supposed to recognize. So initially it is certain and hence recognized, but subsequently it is uncertain. Now what to do? Initial certainty recognized, and subsequently if it is uncertain, remember, don't reverse. You have to create a provision. This provision is purely similar to accounting standard number 7, recognition of contract revenue. Contract revenue, if needed, you can go back, you can revise that, and you can come forward again. Anyways, so let me move on. When do the ownership transfers, and we told something like significant and related risk and rewards are transferred, there's no uncertainty in collection, and there is ultimate collection. But there are some special cases here. In these special cases, you are going to learn when do the ownership will be transferred. Otherwise, when will you recognize the revenue? Only when the ownership is transferred. So you are going to learn under each and every special case when do the ownership is transferred. Sir, this first one is very important. And my dear children, I am not going to cover each and everything here. I am going to cover only which are different and important. Different, important. Easy, I am leaving. Anyway, we'll try to cover to the max extent everything. Otherwise, as I said, only important aspects and different aspects shall be covered. Delivery is delayed at buyer's request, and buyer accepted the billing and title is transferred. Buyer accepted the billing, invoice is published, ownership is transferred, but the delivery is not yet done. It's delayed. It's still in the seller's godown only. Now, sir, since already ownership is transferred to buyer, do the seller needs to recognize the revenue? Or since it is there still in the godown of the seller, does he need to wait till the point of delivery when we need to recognize the revenue? Very simple. You have to recognize the revenue only when the 4 conditions are satisfied. When the stock is in hand, identified, packed, ready for delivery. Stock is in hand, identified, packed, ready for delivery. If all these works are done, you can recognize. Otherwise, you are not supposed to recognize. Goods supposed to installation. Very simple. Goods must be installed and inspected. Goods must be installed and inspected. Only then you are supposed to recognize the revenue. Otherwise, you are not supposed to recognize the revenue. Of course, be in line with that. There's a controversy with the institute solution for this one. I'll discuss it with later. But remember, goods are subjected to installation. First of all, goods must be installed and it must be inspected by the customer. Only then, if he is satisfied, if there is no flaw, then he can recognize the revenue. Otherwise, no revenue will be recognized. Now, sale on approval or return basis. Sale on approval or return basis. Listen very carefully. This is very simple. You people know it. Sale on approval or return basis will be recognized only when the sale is approved. That approval might be either express or implied. Next one, guarantee or warranty sales. recognize the sale immediately plus corresponding provision. You're not supposed to wait till the guarantee or warranty period is over. Say for example, Fast Track had sold a watch to us and it had given 2 years warranty. And do the Fast Track company recognize the revenue after 2 years? Absolutely no. It will recognize in the first year itself with corresponding provision, to create a corresponding provision for the same. And moving on to the next one, consignment sales. As we have already discussed, for consignor it is gross amount. For consignee, since he is an agent, it is net amount. But the both parties are supposed to recognize the revenue only when the consignee sold to the third party. Only when the consignee sold to the third party. Cash on delivery sales is simple. Only when the goods are delivered and only when the cash is received either by the principal or by the agent. Next, installment sales. This is important. Listen. Sir, what is the main difference between hire purchase and installment sale? My dear children, installment sales and hire purchase are similar. The only difference is that passage of ownership. Delivery of goods will be done at immediately. Immediate possession is transferred immediate. But ownership under hire purchase is transferred at the last payment of installment. But ownership under installment sale is transferred at the first installment itself. Ownership under installment sale is transferred after payment of first installment itself. Whereas ownership under hire purchase will be transferred only after clearing the last installment. Now, hire purchase is available generally to the customers. Installment sale is not generally available to the customers. It is available to the traders because trader has to do the business. Without transferring the ownership, he can't sell it to the outsiders. Kada. Let me give you an example. Say for example, there is a car dealer. He would like to purchase the car and he would like to sell the cars. This is his business. Each car is valuing rupees 10 lakhs. He had gone to the manufacturer and he is asking, sir, I will take 10 cars on installment basis. Okay, manufacturer is telling 10 cars into 10 lakhs, sir. Totally it comes to 100 lakhs, sir. Pay us immediately and take the delivery of 10 cars. Then car dealer told, sorry, sir, I'll pay it on installment basis. Okay, sir, absolutely no problem. You take all the 10 cars, you pay on installment basis. How much will be the down payment you will pay? I'll pay 10 lakhs, sir. Okay. Remaining 90 lakhs, you have to pay it on installment basis. But remember, sir, we will transfer the ownership only after the last installment is paid. But if it is of such a case, how do the car dealer will sell the goods without transferring the ownership to him? And hence car dealer is requesting the manufacturer, no, sir, it was not like that. I would like to pay you on installment after selling the cars only. Okay. So there is a new system emerged here, which is nothing but installment sales. Under installment sales, ownership will be transferred immediately just after paying the down payment, and the remaining amount will be paid in installments. But ownership is transferred immediate because only then a car dealer is supposed to sell that and he can be able to repay. So this is all about installment sales. And hence under installment sales, they are supposed to recognize the revenue immediately by the moment when the goods are sold. And there's one more thing which is very different. Payment is an installment and goods will be delivered at the last installment is paid. What is the meaning of this one, sir? Best example is like all the gold schemes, Kajana, GRT jewelries, gold schemes. Initially, you have to pay some amount. Initially, you have to pay some amount. Okay. After the payment of that some amount, like monthly, installment wise, you have to pay. After the completion of 12 months or after the completion of 11 months, after the completion of the said period, then the good will be sold to you and then good will be delivered. So now when do the seller has to recognize the revenue? Only when all the installments is paid, only when the good is sold, only when the good is delivered. Exception. Say for example, buyer is paying rupees 1 lakh per month. Totally 12 installments he has to pay. After the completion, it will pool to 12 lakhs and only after that seller will be selling the good. Only when the good is delivered, seller is going to recognize it as revenue. But in the meanwhile, buyer had requested the seller, sir, I want the good immediately. So seller, since seller knows that sale is consummate, mandatory, absolute, for sure it will happen. Moreover, buyer is requesting the same after 10 months itself. He may request or he may not request. Okay. So seller is telling to the buyer something like, sir, let the good be delivered. You take the delivery and you just do your business. It's okay for us. Now, after 10 months, since the buyer is requested or since the seller had accepted for the delivery, he sold the goods. After the substantial deposit is made. So, after the substantial deposit is made, that is 10 months, which is like 10 lakhs, I am selling to him to the extent of rupees 12 lakh good, for which my sale will be 12 lakhs, already received is 10 lakh, and newly debtor 2 lakhs will be erased. So generally sale has to be done only after the completion of all the installments. But due to the understanding between buyer and seller, if the sale is consummate, in the sense sale is absolute, then after significant deposit is received, seller can sell the good to buyer. In such a case, till that amount portion is received and it will be converted into sale, and whatever the extra portion is not yet received, he will be treated as debtor. Let me tell you an entry. Say for example, you have received cash from Mr. A, who is a debtor. Advance from Mr. A, debtor advance, say 10 lakhs. Now listen very carefully. Mr. A, that is like advance 10 lakhs, sorry 12 lakhs to sale 12 lakhs. Out of 12 lakhs, since already received 10 lakhs, so balance 2 lakh has to be paid, where he will be converted to debtor. Till that point he is like a creditor. Debtor advance, since he is treated as a creditor, and from the next point he will be treated like as if it is an advance debtor. I hope the concept is clear for you. So up to 10 lakhs he will be treated as a creditor, advance received from debtor, who will be treated as a creditor, and after the sale is done, for the remaining unpaid portion he will be converted to debtor again. And this is simple. If you read, you will understand. Special order, if you book the order, only then we will manufacture, identify, packed and ready for delivery. Seller has to recognize, otherwise he should not. Sale to intermediary parties, very simple. You check out, say for example, wholesaler is selling to retailer, retailer is selling to what is it called, customer. Or say for example, let me take a big channel of distribution, manufacturer to wholesaler, to dealer, to agent, to retailer and to customer. In this case, whether this agent needs to recognize the total revenue or not, it just depends on how the sale is happened between the dealer and the agent, or the wholesaler and the agent. Say for example, my dear children, goods are sold subjected to return of unsold stock. Then automatically he has to recognize only when the goods are sold to the third party. If the ownership is immediately transferred, he can recognize immediately. Say for example, A is sold to B and 1 lakh units. B is able to sell only 80,000 units. Still 20,000 units are pending. This loss has to be borne only by B, since the ownership is transferred immediately. In this context, A need to recognize the revenue immediately when the ownership is transferred. But this is a special case, something like, listen very, very carefully, everybody. Say for example, Mr. A sold to B, but this sale is subjected to return of unsold stock. Return of unsold stock. So B had taken initially 1 lakh units and sold 80,000 units, and still 20,000 units are pending, and hence these were given back to Mr. A. So now here A or B has to recognize the revenue only when Mr. B is selling the goods to the outsiders. Otherwise, two parties are not supposed to recognize the revenue. That's one more special point. Subscriptions for publications, you know this one. If the delivery is constant SLM basis, otherwise depending upon the number of copies sold. And the next one, trade discount and volume rebate. My dear children, trade discount and volume rebate is not at all a revenue. It is a deduction from the cost price. And cash discount, it is not at all a revenue. Discount allowed is an expense. Discount received will be treated as if it is other income. And sale or repurchase agreement is also not dealt as per accounting standard number 9. As we have already discussed in AS1, A sold the goods to B, B sold the same goods to A at a later price at a later date. So that's like repurchase agreement, which is similar to way of financing. It's not at all a revenue. And special case with respect to renewable and non-renewable resources, that's agricultural crops and mineral ores, already we have done in accounting standard number 2, and even in AS9 starting also I told you. Now coming to the rendering of services, you're supposed to recognize the revenue only when the service is rendered, only when there's no uncertainty in collection, only when there is uncertainty in collection. If uncertainty exists, follow the same principles what you have followed for sale of goods and also the same principles what you have done for accounting standard number 7. If there is initial uncertainty, you are not supposed to recognize the revenue. Recognize the revenue only when the certainty is established better on cash basis. If at all initially it is certain and subsequently it is uncertain, then you are supposed not to cancel and you are supposed to create a provision. And there are two types of revenue recognition for rendering of services. Number 1, completed service contract method. Number 2, proportionate completion method. So you are supposed to adopt completed service contract method if at all there is only one act in performing the contract or service. Follow proportionate completion method if there are more than one acts in performing the service. Say for example, there is only one act, manufacturing of one bench. Then simple, proportionate completion method is wrong here. Since it's only one bench, you're supposed to recognize the revenue only when the bench is totally manufactured. So you're supposed to follow completed service contract method. If it is two benches, by the end of the year, one bench is completed. So you can follow proportionate completion method and 50% revenue can be recognized. If it is only one bench, say for example, at the end of the year, only 50% of the bench is completed, you're not supposed to recognize 50% of the bench. Because in the case of services where only one act is there, you're supposed to follow completed service contract method. If at all the services are more than one, then you are supposed to follow proportionate completion method. And let me move on to the next thing. Again, same special situations or special cases. Number 1 is installation fees. You might get a doubt like, when do the installation fees will become sale of good and when do it will become rendering of service? It is as simple as such. It will become sale of good when the installation is provided as if it is a package of sale of good. When installation is exclusively and separately provided, then we will call it as rendering of service. Take care. If installation is separately provided, then it's rendering of service. If installation is provided along with a package of sale of good, then we will call it as sale of good. So if you have gone to for a shop to purchase an AC, along with AC, he will also provide installation service. In this case, installation is called a sale of good. If at all Mr. Shopkeeper is only selling ACs and you have to arrange installations, in this case, installation will be rendering of service. And the next one is all about advertisement. Coming to advertisement, you're supposed to recognize the revenue only when the advertisement appears before the public. Otherwise, you're not supposed to recognize. And the next one is all about financial service commission. Financial service commission, listen very, very carefully. What is the kind of service that is provided? If the service is provided once for all basis, then you're supposed to follow completed service contract method. If at all you're supposed to follow, or if at all it's a continuous service, then you're supposed to recognize only on proportionate completion basis. If it is continuous service. And insurance agent commission, if it is a new policy, only when the policy is approved. If it is a renewal policy, when the renewal is done. Admission fees only when the event takes place. Tuition fees basing on the period of instructions. Entrance fees, sir, accounting standard number 9 is not dealing with it. Generally, entrance fees has to be capitalized. Of course, as per the policies that were being adopted by the non-profit organizations, even entrance fees, some portion can also be shown in income and expenditure account. And membership fees or subscription only when the membership is provided. So all very, very simple. So now you have to check out whether only one service is provided or more than one service is provided. If only one service is provided, better to follow completed service contract method. If more than one services are provided, then you have to follow proportionate completion method. And my dear children, let me proceed to the next thing, that is third part of the standard, use of enterprise resources by others yielding interest, dividend and royalty. Take care, interest is to be provided on the outstanding balance at a specified rate of interest proportionately, like number of months by 12. And coming to the second part, that's all about dividend. Remember, my dear children, dividend is not supposed to be recognized on accrual basis. Say for example, this is the current financial year 13-14. This is year ending date, and say this is the date of approval of the financial statements. You have invested in K Limited. K Limited declared the dividend after the completion of your year ending, and you have something here, declaration of dividend. Fortunately, you did not close your books of accounts because this is the date of approval. In between the balance sheet date and date of approval, K Limited had declared the dividend. Now, company is pleading that since this dividend is relating to 13-14, since my 13-14 financial year books of accounts were not yet approved and closed, let me adjust this dividend in the financial year 13-14. No. Accounting standard number 9 had clearly told that it should not be on accrual basis. It should be recognized only when right to receive is established. Right to receive is established in the financial year 14-15, and hence you are supposed to recognize only in the financial year 14-15 but not in the financial year 13-14. Moreover, right to receive is established only when the dividend is declared. So the date of declaration is nothing but right to receive. And coming to the royalty, it must be on accrual basis as per the agreement, remember. Now, very, very important. Sir, when we are supposed to recognize these revenues? Very simple. Interest must be recognized on proportionate basis, royalty on accrual basis, dividend on right to receipt basis. But you have to recognize these things only when there is no uncertainty in collection and only when there is ultimate collection. So these two conditions are common for each and every kind of revenue. Otherwise, the different sale of goods, significant and related risk and rewards are transferred, rendering of services for when the services are rendered. So these are the different things, and these two things are common. Now, very important, if there is initial uncertainty, then don't recognize. You are supposed to recognize only when the certainty is established. Better to follow cash basis. Now, the important thing is all about subsequent uncertainty. My dear children, generally under sale of goods and rendering of services and subsequent uncertainty, you should not reverse, you have to create a provision. But here, you should reverse, you should not create a provision. Because did you ever see something called provision for interest, provision for royalty and provision for dividend? Nonsense. And anyways, my dear children, you're not supposed to create a provision in this context. You have to reverse. Remember this. This one is very important. And now let me go with some special cases of accounting standard number 9. See, this is the first problem which is very common and frequently tested, which is relating to sale of goods. Different situations. See here, on the buyer's request, delivery was done on 10th April. But on 31st March itself, goods were sold. So this is relating to buyer, title is passed, buyer had accepted the title, billing is done, but delivery is delayed due to buyer's request. Since nothing is mentioned, it's a deemed assumption that the goods are identified, packed, ready for delivery, and hence you can immediately recognize the revenue. And this is relating to consignment basis. This is relating to sale on approval or return basis, and this is relating to trade discount. Take care, my dear children, trade discount is not a revenue. It is decreasing the cost price, or it will also decrease the selling price. So that is this question. And coming to this one, it is a very different problem. Just check out. Machine 1 and machine 2 are there. Machine was installed by their employees itself. Machine 2 is very specialized in nature, and installation is more complicated. Installation is more complicated. So to tell you in a simplest way, machine 1 installation is simple. Machine 2 installation is complicated. Something like best example, TV and AC. Now when we are supposed to recognize the revenue, very simple. You are supposed to recognize the revenue for machine 1 immediately when the good is delivered. Since for machine 2, the installation process is more complicated, you are supposed to recognize the revenue only when the installation is done. Here given that installation was done, machine 2 installed between 2nd and 5th of the April. 2nd and 5th of the April, and installation fees is also 10,000. Whereas coming to machine 1, it was installed by the ST employees, their employees itself, that's on 2nd April itself, and no installation fees also. So logically speaking, machine 1 has to be recognized in the financial year 10-11, and machine 2 has to be recognized in the financial year 11-12, right? But if you observe the solution, machine 1 has to be recognized in the financial year 10-11 itself. Coming to machine 2, it's very different. Check out. Since machine is already accepted by the company, to the extent of sale of machine, that is 3 lakh selling price and cost of production 1,50,000, 1.5 lakh profit and sale of 3 lakh can be recognized in 10-11, and installation fees of 10,000 will have to be recognized in 11-12. So even like this, is it possible? Yes, it might be possible in this situation, because if you observe, machine is already accepted by ST and delivery is installation is absolute by the company, and it will be doing the installation in the next period. And hence here it is actually a separate part. So now check out very carefully, my dear children. Just wait. Installation. If installation is provided as a package of sale of good, then it will be treated as sale of good, and it has to be recognized only when the installation is completed. If installation is exclusively provided, then it will be treated as rendering of service, and it has to be recognized only when the installation is completed. And installation is provided as a part of sale of good, but sale of good and installation can be separated. In the sense, if at all there is any defect in the good, then you're not supposed to accept the delivery. But since you have accepted the delivery, there is no defect in the good. If there is no defect in the good, installation is absolute. And hence this is separate, this is separate. This will be treated as sale of good, this will be treated as rendering of service. So you have to check out in a simplest words whether the installation is separable or inseparable. First of all, you have to check out whether installation is sale of good or rendering of service. If exclusive installation is provided, it is rendering of service. If at all installation is provided as a package of sale of good, then it is called a sale of good. Now we have to check out whether it is separable or inseparable. If at all it is inseparable, then you have to treat entire thing as sale of good. If it is separated, sale of good will have to be treated as sale of good. Installation has to be treated as if it is rendering of service. So coming to this answer, he had given it very clearly that here this is a separable part. And he is taking an assumption that machine is already accepted by ST Limited, and hence they can recognize a part of sale, whereas installation should not be recognized. It needs to be recognized only once the installation process gets completed. And my dear children, that is the end of accounting standard number 9. And that's the end of the main marathon classes and sessions of your advanced accounting.